Hello, hi guys. This is CA Balakrishna. How are you? Hope you people are doing well. Even I am fantastic. Welcome to the second part of CA Final Audit Marathon for Jan 2026 attempt. So I hope you have gone through the first part of Audit Marathon, and as I have already told you in the first part, there will be all the standards that will be covered except SRE and SAE, and in the second part you will find remaining all other chapters. And in this second part, all the chapters are included except internal audit and investigation. Except these two chapters, all other chapters I have covered in the second part of the marathon, because as I already told you, there is a time restriction of 12 hours for each video. So those two chapters I will upload them separately. Got it? So as I have already told you in the first part, I will be giving the timestamps. So if you wanted to revise any particular chapter, you can directly jump away to that particular timestamp and start the revision. Understanding? So yes, this is a brief intro that I wanted to give you. Now you can start watching the second session or second part of audit marathon. All the best. In the today's class, we'll be revising SRE 2400, that is standard on review engagements. Basically, here in this review engagement series, we'll be having two standards. One is SRE 2400 and SRE 2410. I'll be explaining you what is the difference between SRE 2400 and 410, when you should apply 400, that is SRE 2400, and when you should apply SRE 2410. First of all, we'll understand what is meant by a review, what is difference between audit and a review, and who will conduct audit, who will conduct review. See, in case of audit, you will provide reasonable assurance, right? Whereas in case of review, you will provide only limited assurance. Now the question that arises is, what is the difference between reasonable assurance and limited assurance? Basically, in case of reasonable assurance, the type of opinion that you give, it will be positively worded. Whereas in case of limited assurance, the type of conclusion that you give, it will be negatively worded. How? See, in case of audit, audit of financial statements, what will be the wording of your opinion? It will be financial statements as a whole or free from material misstatements, whether due to fraud or error. Like this you will write in your opinion. Okay, in your opinion, financial statements are free from material misstatements. Like this you will write, which is positive. Okay, you are confirming that financial statements are free from material misstatement. In case of limited assurance, that is in case of review, the type of wording will be based on our procedures. We have not come across any areas which makes us to believe that financial statements are which makes us believe that there are material misstatements in the financial statements. That means here in case of review, you are saying that based on our procedures, we have not come across any misstatements, but there can be misstatements in the financial statements. See, in case of assurance, that is reasonable assurance, you are confirming that financial statements are free from material misstatement. But in case of review, you are saying that you have not come across any material misstatements during your audit or review procedures, but there can be misstatements in the financial statements. That is, here in case of review, the conclusion is negatively worded. That is the difference between reasonable assurance and limited assurance. Okay, so I have given what is difference between audit and a review. Now in order to deal with this review, first of all, audit has to be mandatorily conducted by chartered accountant only, right? Now whether review should also be conducted mandatorily by a chartered accountant? Yes, only a chartered accountant can conduct review of financial statements. Other than a chartered accountant, no other person can conduct review of financial statements. Hope that is clear. Now, in order to provide certain guidance, certain procedures with respect to the review that will be conducted by a chartered accountant, the institute, it has issued standards on review engagement, basically 2400 and 2410. So SRE 2400, SRE 2410. What will be dealt by SRE 2400? If you see the name of the standard SRE 2400, engagement to review historical financial statements. Okay, review of historical financial statements. Just a second. Okay, I guess this pen, okay, it's working. So if you see SRE 2400, it deals with engagement to review historical financial statements. If you see SRE 2410, the name is review of interim financial statements performed by independent auditor of the entity. So the main difference between SRE 2400 and SRE 2410 is, if review is conducted by a chartered accountant other than auditor of entity, in that case you need to apply SRE 2400. In the same way, if review is conducted by a chartered accountant who is also auditor of the entity, in that case you need to apply SRE 2410. This is the main difference between 2400 and 2410. Now, what are the examples of situations where SRE 2400 will be applicable? Let's say there is a company. That company, it wanted to take a loan from a bank. Now, as per the loan agreement of the bank, in order to get the loan, the financial statements of the entity has to be reviewed by a chartered accountant other than auditor of the company. Okay, the bank wanted the financials of the company to be reviewed, not audited, by a chartered accountant who is not auditor of the company. Auditor of the company, he will however conduct audit of financial statements, but we will not completely believe on auditor. Either we will appoint another chartered accountant, or you yourself appoint another chartered accountant and conduct a review of the financial statements. Another time again audit is not necessary, you just conduct a review of your financial statements and submit that review report. Okay, this is one of the scenario where review of the financial statements may be conducted. Another scenario, let's say there is a partnership firm, and for this partnership firm, however, audit as per Companies Act, it will not be applicable for partnership firm. Tax audit can be applicable, but for this partnership firm, tax audit is also not applicable. Its turnover is within the limits. Now, even though tax audit is not applicable to the partnership firm, the partners of the firm, they voluntarily wanted to conduct a review of financials of the firm by a chartered accountant. Okay, in this type of engagement also, the chartered accountant who is accepting that engagement must comply with SRE 2400. Hope that is clear. Now, coming to the examples of where SRE 2410 will be applicable. However, we will be discussing that while discussing that SRE 2014, but I'll just give one example of where that 2014 will be applicable. In case of listed companies, they need to conduct limited review and they need to submit that limited review report to stock exchanges as per LODR regulations. Now, that limited review, it will be conducted by statutory auditor of the company himself. So here, since the statutory auditor himself is conducting the review of quarterly financial statements, for that type of engagement, SRE 2004-10 will be applicable. Hope that is clear. So these are the situations where you will be applying 2400 and 2410. Here are also the examples that I have given. Now, while conducting this review engagement, practitioner, basically in case of audit we will be calling him as auditor, right? But in case of review we will be calling him as practitioner. Now the practitioner, while conducting the review, he must comply with all the relevant ethical requirements like integrity, objectivity, confidentiality, all that ethical requirements he need to comply, including independence. Hope that is clear. And practitioner himself is responsible for ensuring appointment of quality reviewer for that particular review engagement. Hope that is clear. Now, in order to accept the review engagement, there are certain preconditions. These are normal, general. Okay, the general preconditions that we have been discussing from almost in all the standards. Okay, in standards on auditing we have discussed this. In also in 3400 series there also we have, not 3400, 800 series there also we have discussed these preconditions for accepting the engagement. Now, in order to accept the engagement, first of all, the applicable financial reporting framework that is being used for preparation of the financial statements, that must be acceptable. Yes. And also the management should agree for its responsibilities of preparation of financial statements as per applicable financial reporting framework, and also to establish internal controls in the organization. Management, they should agree that this is their responsibility. Only then the practitioner, he will accept the engagement. And also management should agree that they will provide the practitioner with all the information that is relevant in the context of preparation of financial statements. And also the management will provide the additional information that has been asked by the practitioner, and management will give unlimited access to all the persons within the entity for the purpose of practitioner to conduct inquiries. Okay, all this must be, access to all this must be provided to the practitioner by the management. Okay, all information that management is aware of, and additional information required by the practitioner, and also unrestricted access to the persons within the organization, all that information must be given access to the auditor. Next, if the practitioner is not satisfied with any of the above, okay, if the management is not providing any of the above information, or practitioner is not satisfied with the applicable financial reporting framework, then what the practitioner should do? See, if the practitioner is not satisfied with above before accepting the engagement, then in that case you discuss with the management, you discuss with those charged with governance, and ask them whether they will change it. If they don't alter, then you should not accept the engagement. Hope that is clear. In case after accepting the engagement, the practitioner became aware that he is not satisfied with the preconditions, okay, the preconditions for accepting the engagement are not present, in that case what he should do? Here also he should discuss the matters with the management and check whether those matters they can be resolved, and what will be the appropriate action that he can take. Okay, whether he can continue the engagement or he has to withdraw from the engagement. If he cannot withdraw from the engagement, how he has to report this matter in his report, in his review report, that he needs to consider. If after accepting the engagement he comes to know that preconditions are not present. Hope that is clear. Next, overview of performing review engagement as per SRE 2400. There are certain steps for conducting the review engagement. First of all, just in case of auditor, if you have been appointed as an auditor, what you will do first? You will understand the entity and its environment in order to identify the risks, right? Here also in case of review, you will first of all understand the entity, and you will also determine the materiality in the second step. By this first step of understanding the entity, you will come to know about the risks that are present in the entity, and in the second step you will determine materiality. Now for this materiality, the professional judgment of the auditor, professional judgment of the practitioner is required. In case of audit also you will determine materiality. So the professional judgment that is required for determining materiality as per audit and materiality as per review, both is same. Okay, the materiality will be same whether it is audit or it is review. Hope that is clear. After that, you will design and perform the procedures, review procedures. Now basically 99% of the procedures that the practitioner performs in case of review is inquiry and analytical procedures. Okay, these two are the major procedures that the practitioner will perform in case of review. However, in certain necessary cases he will also perform certain other procedures, but not to the extent that he performs in case of audit. Since in case of audit he needs to give reasonable assurance, he will extensively perform all the procedures, but here in case of review he will give only limited assurance. So the procedures, the review procedures that he performs will also be mostly limited to this inquiry and analytical procedures. Next, the practitioner, he will also perform certain additional procedures in case of certain specific circumstances. Now in the standard there are certain 4 specific circumstances that have been described. Of those, the first circumstance is related parties. With respect to related parties, during the entire review the practitioner has to be alert to find any conditions that will inform the auditor about existence of any related party relationships or related party transactions that were not earlier communicated to the practitioner. Okay, that procedure he need to apply in case of related parties. And with respect to non-compliance with laws or regulation, if the practitioner comes across non-compliance with laws or regulation during his review, he has to first of all communicate it with management or those charged with governance, and also he should determine whether there is any responsibility on him to communicate this matter to any third party outside the entity. Generally in case of audit, as per Companies Act, if there is this non-compliance, sorry, as per SA 250, if there is non-compliance of law or regulation, you will be reporting it in the audit report, right? In the same way here also you need to determine whether there is any requirement to communicate this non-compliance with any third party. Hope that is clear. And next, going concern. If there are any events or conditions that may cast significant doubt on entity's ability to continue as a going concern, then the practitioner, he has to determine what are the future actions of the management in order to mitigate these conditions, and what is the feasibility of those future actions, whether those future actions will mitigate the conditions or not. This must be determined by the practitioner with respect to going concern assumption, if there are any events or conditions that will cast significant doubt on entity's ability to continue as a going concern. Next, whenever a practitioner, if he wanted to use the work that is performed by other person, whether he might be expert or other practitioner or other auditor, then he needs to determine whether the work that has been performed by such other person is adequate for the purposes of the practitioner. Based on that, he needs to determine whether he can use his work or not. These are certain procedures that you need to perform in case of those specific circumstances. Next, whenever necessary, apart from that inquiry and analytical procedures, you can also perform other audit procedures if necessary. Hope that is clear. Next, written representations. The practitioner, he should also obtain written representation from the management. Basically, these are the normal written representations. Firstly, with respect to the responsibility of the management regarding preparation of the financial statements as per applicable financial reporting framework, whether management has fulfilled its responsibility or not. This representation you need to ask from the management. And also whether all the transactions that have taken place have been properly recorded and reflected in the financials. Even this representation you need to ask from the management. And also you should ask from the management whether management has disclosed to the practitioner all the related party transactions and all the related party relationships that are known to the management. With respect to related parties, this representation the practitioner should get from the management. And also whether management has disclosed all the known non-compliances with the laws and regulations. Even this written representation the management should give to the practitioner. And also the information related to the frauds that has taken place during the year, even that you need to give And with respect to the going concern assumption, how the management has assessed its ability to continue as a going concern. Okay, even this representation the management has to give to the practitioner, and management whether it has properly adjusted all the adjusting subsequent events as per the relevant standard or not. Okay, even with respect to this the management has to give written representation to the practitioner. Now what if those written representations which the practitioner has requested are not given by the management, then in that case discuss with the management or those charged with governance why you are hesitating to give these written representations to me. Okay, and you consider the reasons that are given by the management or those charged with governance, and determine whether there is any impact on the integrity of the management. Because of that, whether he can rely on the written representations that are previously provided by the same management. Okay, if management is lacking integrity, then there might be chance that the previous written representations that have been given by the management, even they might not be reliable. So now whether I can rely on those written representations or not, even this you need to, even from this angle you need to think. And in case management you feel that there is a sufficient evidence in order to doubt about the integrity of the management, and because of that the written representations that are provided by the management are not reliable. Okay, if you have sufficient evidence to believe this, then you can either disclaim your opinion or disclaim your conclusion in the review report, or you can withdraw from the agreement from the engagement if possible. And also if management is refusing to give basic minimum written representations with respect to its responsibility for the financial statements, in that case also you can determine whether to give disclaimer of opinion or to withdraw from the engagement. Now coming to the type of conclusions, basically the type of conclusions, it is similar to that of type of opinions. Okay, unmodified conclusion. In case of modified conclusion, there will be qualified conclusion, adverse conclusion, and disclaimer of conclusion. Now what would be the wording of each type of conclusion, that we'll see. First of all, in case of unmodified conclusion, if you are following fair presentation financial reporting framework, then the wording of the conclusion paragraph will be like, nothing has come to our attention that causes us to believe that financial statements do not give true and fair view. Okay, that is negatively worded. During our procedures, nothing has come to our attention which causes us to believe that financial statements are not showing true and fair view. That means financial statements are showing true and fair view. Okay, based on that is, you are just saying that we haven't found any misstatements, but there might be misstatements. Hope you are able to understand. Next, compliance financial reporting framework. Here also, based on our review procedures, nothing has come to our attention which causes us to believe that the financial statements have not been prepared as per the financial reporting framework. The only difference is, in case of fair presentation framework, you will use the terminology true and fair view, whereas in case of compliance framework, you will not use that true and fair view, but instead you will say that the financial statements are either prepared or not prepared as per the applicable financial reporting framework. Next, in case of qualified conclusion, and you are using fair presentation framework, in that case, except for the matters that are described in basis for qualified conclusion paragraph, nothing has come to our attention that causes us to believe that financial statements have not been prepared as per the financial statements are not showing true and fair view. Okay, nothing has come to our attention which causes us to believe that financial statements are not showing true and fair view. If in case the compliance framework is used, except for the matters that are described in basis for qualified conclusion paragraph, nothing has come to our attention which causes us to believe that financial statements have not been prepared as per the financial reporting framework, the applicable financial reporting framework. Next, adverse conclusion. In that case, you will say that due to significance of matter, that is that is specified or described in basis for adverse conclusion paragraph, financial statements are not showing true and fair view. Here you have concluded, you are straight away saying that financial statements are not showing true and fair view because it is adverse conclusion. Okay, how you will determine these types of conclusions? Again, same rules that we have discussed in SS 700 705, the same rules you will apply based on materiality, pervasiveness, and the audit evidence. Based on that rules only you will determine whether to give unmodified or qualified, adverse, or a disclaimer of conclusion. And if you are giving disclaimer of conclusion, then due to significance of matter that is described in the disclaimer for a conclusion, basis for disclaimer of conclusion paragraph, practitioner is unable to obtain sufficient appropriate audit evidence from the review procedures that he has performed. This will be the terminology that he will be using. And coming to the practitioner's report, even this is also general format. First of all, you will be having title and addressee, then there will be an introductory paragraph. In this introductory paragraph, you need to identify the financial statements that you have reviewed, and you should also identify the title of each of the financial statements, and you should make a reference to the summary of significant accounting policies that have been used for preparation of these financial statements. And also you need to state that financial statements have been reviewed. Okay, you need to state the fact that you have reviewed the financial statements. Next, there will be management responsibilities. What are the responsibility of management that you will specify in that paragraph, and you will also specify the responsibilities of the practitioner. And if the financial statements are prepared as per special purpose financial reporting framework, then in that paragraph you need to specify what is the purpose of these financial statements and who will be the intended users of these financial statements. And if management is having a choice for selection of the applicable financial reporting framework, then you need to specify that it is the responsibility of the management for selection of those applicable financial reporting framework. And you should also give description of review of financial statements and its limitations. And finally, there will be a conclusion paragraph, basis for conclusion paragraph, and date, signature, and place of the signature. And again, the requirements with respect to emphasis of matter paragraph, other matter paragraph, and other regulatory requirements, all that will be as it is applicable as in case of audit. Okay, emphasis of matter paragraph you will give when the auditor wanted to emphasize a particular item that is present in the financial statements, if it is very much important for the users understanding of the financial statements. And other matter paragraph, auditor, he will provide those matters which he thinks are necessary for the users to understand about the audit in case of audit. Here about review and other reporting responsibilities. Finally, you should also maintain documentation with respect to this review engagement that you have conducted. Okay, this is a brief revision of SRE 2400. This chart you can get it from the link that I will be giving you in the description. Okay, and if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. Hope that is clear. Now I will be winding up this class as of now. We will be meeting in the next class with SRE 2004-10. Okay, take care. Bye bye. See you. In the today's class, we will be quickly revising SRE 2004-10. This SRE 2004-10, it will be similar to that of SRE 2400. Okay, the concepts of difference between audit and review, what is difference between reasonable assurance and limited assurance, those concepts I have already explained them in the video related to SRE 2400. Okay, for those concepts you please refer SRE 2400 revision video. That link I will be giving it here in the I button. Okay, now in the today's class we will be revising SRE 2004-10, which deals with review of interim financial information which is performed by statutory auditor of the entity. In the previous revision video itself, I have told you that in case the chartered accountant who is not statutory auditor of the company if he performs a review of historical financial statements of an entity, then SRE 2400 will be applicable. If statutory auditor of the company, he himself performs a review of this interim financial statements, then SRE 2410 will be applicable. The only difference between 2400 and 2410 is 2400 will be applicable when the chartered accountant other than statutory auditor of the company performs a review. 2410, if chartered accountant who is statutory auditor of the company, he himself performs a review, then 2410 will be applicable. Hope that is clear. Now, what is interim financial information? Generally, financial statements, they will be prepared by a company for the entire financial year. Instead of preparing it for entire financial year, some companies, okay, listed companies, there is a mandatory requirement for listed companies, along with preparation of that annual financial statements, they need to prepare quarterly financial statements also, and they need to submit those quarterly financial statements to stock exchanges. Now, annual financial statements, they will however conduct auditor, he will conduct the audit of annual financial statements. But for interim financial statements, audit is not required. Instead of audit, review has to be conducted. The same statutory auditor of the company, he must conduct a review. Now, in review, as I have discussed in SRE 2400, the type of assurance that the auditor provides in case of review is limited assurance. He will not give reasonable assurance, because the procedures that the auditor or practitioner performs in case of review, they are limited procedures. Okay, he will mainly perform inquiry and analytical procedures. Now, just like normal engagement, even for the review engagement also, auditor, he needs to enter into a agreement with the client. That is, engagement letter is required even for this review engagement also. And for this review engagement also, auditor, he needs to obtain understanding of the entity and its environment. However, since he is the auditor of annual financial statements of the entity, he will be having understanding of the entity. He just needs to update that understanding that he is already having for this 3 months period, for this quarter. Okay, since the auditor, he would have already conducted audit of previous year's financial statements, he would have obtained understanding of the entity. Now he is conducting quarterly review. Now for this quarterly review, he should update his understanding of the entity that he is already having. Okay, for this 3 months, if at all any new occurrence have happened in the entity, those updates he need to take in these review. Okay, for the purpose of review. See, understanding entity and its environment, it is necessary for the auditor to identify potential misstatements that may occur in the interim financial statements, and to select the review procedures that the auditor has to perform based on that risk of potential misstatements. Okay, risk of material misstatements, auditor, he will determine the audit procedures he needs to perform. Generally, in case of review, he will perform mostly inquiry and analytical procedure. Now, what procedures auditor will perform in order to update his understanding of the entity? First of all, since he has already performed audit for the previous year, he will verify, or he will go through the records, audit documentation that he has maintained in the previous year. See, reading preceding year audit documentation and recent annual and interim financial information. By reading this, he will update his knowledge about the entity, and he will identify if at all there are any inherent risk in the entity. Why auditor, he is understanding the entity in order to identify inherent risks, he is understanding the entity. In the same way, he will also consider whether there are any significant risks in the organization. Significant risk we have discussed. Okay, risk of fraud is a significant risk with respect to transactions involving related parties is also a significant risk. Okay, risk with respect to complex transaction is also a significant risk. Whether there are any such significant risks in the organization, that auditor will consider, and consider nature of uncorrected or corrected misstatements of the previous year financial statements. Now, in the previous year, auditor, he will determine whether there are any misstatements that have been corrected, that have not been corrected, and what is the impact of that corrected or uncorrected misstatements of the previous year. Okay, what impact they will have in the current periods financial statements or interim financial information, and consider results of internal audit. Generally internal audit, it will be conducted on a quarterly basis. So if the internal audit has been conducted, just a second, what happened to this? If the internal audit has been conducted, excuse me, sorry, if the internal audit has been conducted, auditor, he should also consider whether any recommendations or any findings have been made in the internal audit report by the internal auditor. This will also help the auditor to update his understanding with respect to the risks in the organization or the entity, and inquire about results of management risk assessment of interim financial statements. Now interim financial statements, they will be prepared by the management. While preparing the interim financial statements, management will also perform risk of material misstatements in the interim financial statements. They will also perform risk assessment. So what is the results of that risk assessment that have been performed by the management? First of all, whether they have performed risk assessment or not. If they have performed risk assessment, what is the results of that risk assessment that the auditor needs to inquire. Next, inquiring management about effects of changes in the entity's business activity. I guess this pen, it is not working properly. Inquire management about effect of changes in an entity's business activity, changes in internal control on preparation of interim financial information. Now, when compared to previous year, whether any change in the business activity has taken place in these 3 months, in this quarter, if any change in the business activity has taken place, what impact that will be having on the preparation of this interim financial information, and also whether any internal controls have been changed for this quarter. If yes, then what impact that change will be having on the preparation of this interim financial information. Okay, by performing all this, auditor, he will update his understanding of the entity. Okay, next, coming to the procedures that the auditor will perform. As I have already told you, auditor, he will perform inquiry and analytical procedures. Here, firstly, reading the minutes. Okay, by reading the minutes, he will be able to obtain more information with respect to the entity. This is also one type of audit procedure, you can say, wherein auditor, he will obtain the information with respect to the various activities that has taken place in the entity during that period of 3 months or during that quarter, and consider effect of matters giving rise to risk to modification in the previous audits or reviews. Okay, if the previous year's audit report or the previous interim period review report has been modified, then because of which matters there is a modification that has been given in that previous report, and what impact it will be having on the current review. Communicating with auditors of significant components of the entity. Now, if the entity is having any subsidiaries or any significant branches, and if the audit of those subsidiaries is being done by some other auditor, you should also communicate with those other auditors. And this final part, that is inquiry, the management, this is the actual inquiry procedure auditor will perform. Now, regarding which aspects auditor can inquire with the management, auditor, he can inquire with the management relating to various aspects. Some of the examples include whether interim financial information is prepared as per the applicable financial reporting framework. You can inquire this with the management, and whether there is any change in the accounting policies that the management is following from the previous year. Okay, when compared to the previous year, whether there is any change in the accounting policy, this you can inquire with the management. And also whether there are any new transactions that have occurred in the current year for which a different accounting policy has been adopted by the entity. You can inquire whether there are any such new transaction taken place in the entity. With the management, you can inquire this. And also whether this interim financial information contains any known uncorrected misstatements. Okay, you can directly ask the management, see management, we have prepared this interim financial state information na, whether there is any uncorrected misstatement in these interim financial statements. If yes, whether that uncorrected misstatement is material or not, auditor he needs to determine, and whether there are unusual or complex situation that will affect the interim financial information. This you can inquire with the management. Okay, whether there are any new transactions for which different accounting policy has been adopted, or whether there are any uncorrected misstatements in the interim financial statements, and whether there are any unusual or complex situation that is that has arisen during the year, during the period, which will impact the interim financial information. All this you can ask with the management, and you can also inquire with the management with respect to the significant assumptions that they have made with respect to fair value measurement. Okay, certain investments they have to be measured on a fair value basis. For determining fair value management, they will take certain assumptions. So you can inquire whether these assumptions are reasonable or not, and whether all the related party transactions are appropriately accounted and properly disclosed in the interim financial information or not. You can directly inquire this with the management, and whether significant changes in commitments and contractual obligations has taken place during the year, and whether there is any significant change in the contingent liabilities. Okay, so these are the various aspects with which regarding which you can inquire with the management. And you should also take, see, all the points that we are discussing in this standard, they are not new points. Okay, these points, they are all already repeated points of the previous standards. Here you will not find any new standard. Okay, almost all the points, they will be repeated from 2400 standard. Okay, now management representation, you should ask a written representation from the management with respect to whether management has prepared the interim financial information as per the applicable financial reporting framework or not. Okay, management, they have to acknowledge that they have prepared interim financial information as per the applicable financial reporting framework. And management, they should also provide acknowledgement with respect to implementation of internal controls in the organization. Okay, this written representation management, they will provide even for the entire financial year audit also. So the same written representation, it should be given with respect to this interim period also. Hope that is clear. And whether management believes that effect of uncorrected misstatements that are aggregated by the auditor during the review are immaterial. Now the auditor, during the review, he would have found out certain uncorrected misstatements. Whether management believes that these uncorrected misstatements, they are not material, they are immaterial only, with respect to this, management, they have to give a written representation. And management has disclosed all significant facts relating to the frauds that have occurred. Okay, management, they should give a written representation to the auditor that they have disclosed all the information with respect to all the frauds to the auditor, and management have also disclosed all the information with respect to non-compliance with laws and regulation to the auditor. Next, management, they have also disclosed all the information to the auditor with respect to related party transactions. Okay, with respect to all these items, management, they should give written representation. See, non-compliance with laws or regulation, disclosure to the auditor with respect to results of management's assessment of risk of material misstatement, and disclosure with respect to significant subsequent events. All these disclosures, management, they need to provide. Next, auditor's responsibility for accompanying information. Now, management, whenever they furnish this interim financial information to the stock exchange, apart from the interim financial information, there will also be certain additional information that will be there in that submission or in that report. Now, the information apart from that interim financial information is known as accompanying information. Now this accompanying information, they should be in accordance with the interim financial information. If auditor, after reading, he finds that this accompanying information is inconsistent with the interim financial information. In that case, auditor he needs to ask the management to make the respective amendments in the accompanying information in order to make this accompanying information consistent with the interim financial information. If management refuses to make such amendment, then auditor he should consider including additional paragraph describing material inconsistency in his review report. Okay, he has asked the management there is a inconsistency between this accompanying information and interim financial information, so you please make the amendment to the accompanying information. Management they have refused to amend the accompanying information. In that case, auditor in his review report he should include a paragraph describing that there is a inconsistency between accompanying information and interim financial information, and he should also consider withholding issue of the report. Okay, he should also determine whether it is permissible to issue the report or he should withhold the report or he should withdraw from the engagement itself. He needs to determine this based on the circumstances of the situation. Next, written review report. The format of the review report, it is normal general format, title and addressee, identification of the interim financial information that has been reviewed. Okay, IFI means interim financial information. You need to identify the interim financial information that you have reviewed, and you should also identify the name of each statement that is included in interim financial information, and also you should identify the period for which this interim financial information belongs to. Next, you need to include management responsibility for preparation of this interim financial information as per applicable financial reporting framework, and also you need to include auditor's responsibility to express conclusion on the interim financial information. That is auditor's responsibility paragraph. Next, statement that scope of review is less than the audit. Okay, you need to specifically include in your review report that the type of assurance that you provide in case of this review is lesser when compared to the audit opinion, and you need to give your conclusion, date, signature and place. This is the simple format of the review report which we have discussed in SRE 2400 also. Next, departure from the applicable financial reporting framework. If auditor finds that this departure from applicable financial reporting framework materially affects the interim financial information, then auditor he needs to modify the review report describing nature of departure. That means if the interim financial information they have not been prepared as per the applicable financial reporting framework, then auditor he needs to modify his opinion. If the departure from the applicable financial reporting framework is very material and pervasive, okay, it is so material and pervasive that giving qualified opinion is not sufficient, then auditor needs to give adverse opinion. Hope that is clear. Next, limitation on scope imposed by the management. Now, if management has imposed limitation on the scope of the auditor before accepting the audit, then auditor he should not accept the audit if he feels that even though he accepts the audit, he accepts the audit with this limitation, he has to give disclaimer of opinion only. In that case, he should not accept the audit in the first instance itself. Okay, instead of accepting the audit and then giving disclaimer of opinion, why to accept the audit first of all? So you should not accept the audit if there is any limitation that has been imposed by the management. If this limitation has been imposed by the management after accepting the engagement, then you should request the management for removal of the limitation. If management refuses for removal of the limitation, then if auditor is unable to complete the review and express a conclusion, okay, if management they refuse to remove the limitation, then you should try to obtain evidence by performing other alternate procedures. By performing other alternate procedures also you are not able to complete the review and you are not able to come to a conclusion. In that case, determine whether there is legal or regulatory requirement to issue a report. Okay, you should determine whether there is any legal or regulatory requirement in this scenario to issue a report. Okay, whether I can avoid issuing a report since there is a limitation on the scope of on my scope that has been imposed by the management. Okay, whether I can avoid issuing the report, you have to see this. And if yes, disclaim the conclusion in the report. Okay, if as per law or regulation you have to mandatorily give the report even though there is a limitation on the scope, in that case there is no option, you have to give the report by disclaiming the conclusion. Okay, since law or regulation is asking you to give the report even though there is a limitation on your scope, so you should give the report, but in the report you have to disclaim your conclusion. Hope that is clear. Next, with respect to going concern, just like management, they will make going concern assessment for entire financial year. Okay, while preparing financial statements for the entire financial year, they will make going concern assessment, right? In the same manner, while preparing this interim financial information also, management, they will make going concern assessment whether entity will be able to continue as going concern or not. Now if auditor finds that there is a material uncertainty with respect to this going concern, and the interim financial information they adequately disclose with respect to this material uncertainty, then in that case auditor in his review report he should include a emphasis of matter paragraph. If there is no such adequate disclosure is made in the interim financial information, okay, there is a material uncertainty with respect to going concern assumption, but such disclosure is not made in the interim financial information, in that case auditor he needs to give either qualified or adverse conclusion. Next, if in the prior audit or review report auditor may have included emphasis of matter paragraph emphasizing material uncertainty which still exists and adequate disclosures are made. Now in the previous year audit or in the review of previous interim financial information, auditor he has included this emphasis of matter paragraph because there was uncertainty with respect to going concern assumption, and that disclosure was properly made in the previous year's financial statement or previous uh, previous interim financial information. So since the disclosure was properly made, auditor he has given emphasis of matter paragraph. Now for the current interim financial information also there is a uncertainty. Okay, that uncertainty is continuing for current interim financial information also. In that case auditor he needs to include a paragraph. See, auditor in the current review report include a paragraph highlighting the material uncertainty. Okay, he should indicate that in the previous interim report I have included an emphasis of matter paragraph stating that there is a material uncertainty with respect to going concern assumption. That material uncertainty is continuing for current interim period also. Okay, by communicating this he needs to include a paragraph in his review report. Hope that is clear. So this is with respect to SRE 2014. Most of the concept of SRE 2014 it is similar to that of SRE 2400. So I would recommend you to first of all listen to SRE 2400, then come to SRE 2014. Hope that is clear. And if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. I'll be winding up this class as of now. Take care. Bye bye. See you. In the today's class, we will be revising SAE 3400 series standards. In this series, we are having three standards: 3400, 3402, and 3420. Now, first of all, what is this SAE series is all about? It is about assurance engagements. Now, you might get a doubt, sir. Even on the historical financial statements, also auditor will provide assurance only. Can't we call those engagements as assurance? The answer is no. If auditor provides assurance on historical financial statements, then they will be known as audit engagement. Next, if auditor provides assurance on other than historical financial statements, then you will call that particular engagement as assurance engagement. Examples of items other than historical financial statements: prospective financial statement, or providing assurance on controls, Okay, these type of engagements will be covered under SAE 300 SAE series. Now, for audit of historical financial statements, all the standards from SA 200 to SA 720 will be applicable, whereas for assurance engagement, SA 200 to SA 720 they will be applicable. Along with them, SAE 3400 series will also be applicable. Okay, now as I have already told you, there are three standards under this series. The first standard, that is SAE 3400, deals with assurance on prospective financial information. Now, what is this prospective financial information? Historical financial statements means after the transaction has taken place, you will prepare financial statements at the end of the year, whereas prospective financial statements relate to future transactions. Okay, and these prospective financial statements, they are of two types. One is forecast and another one is projection. What is the difference between forecast and projection? Generally, prospective financial information, they will be prepared based on assumptions, right? Now, what type of assumption you are taking is the difference between forecast and projection. Now, if assumptions that you are taking are based on past data, based on past history, past trend, then that particular that particular prospective financial information will be known as forecast. Okay, the assumptions that you use in the forecast will be based on past data. Okay, you can call them as best estimate assumptions, whereas if you use hypothetical assumptions, then that particular prospective financial information will be known as projection. Example, let's say for example, in the past 5 years sale has increased at rate of 5%. Now, based on the past trend, you are forecasting that in next 5 years also sale will increase at 5%. So here that assumption is based on past data, so this prospective financial information will be known as forecast. Now, coming to projection. Now, let's say you wanted to project how the sales will be if a new competitor comes into the market. Okay, this is a hypothetical assumption, a new competitor coming into the market, or if there is a recession in the market, then how the sales will be. So this type of hypothetical assumptions will be taken in case of projection. That is the difference between forecast and projection. Hope you got it. So if you see, there are three standards under this series. First standard deals with the prospective financial information, assurance, providing assurance on prospective financial information. Next standard deals with providing assurance on controls at service organization. If you see, we have discussed SA 402, which deals with the controls at service organization. Both SA 402 and SAE 3402 are linked. We will see what is how these standards are connected. Next, SAE 3420, which deals with providing assurance on compilation of pro forma financial information that will be included in prospectus. Okay, now first of all, start with revision of SAE 3400, which deals with prospective financial information. I have already told you, prospective financial information or the financial information relating to future, and these prospective financial information can be either a forecast or a projection or a combination of both. Now, in a forecast, the assumptions that you use will be best estimate assumptions, whereas in case of a projection, the assumptions that you use will be hypothetical assumption. Hope that is clear. Now, scope of SAE 3400. What is the scope of SAE 3400? It provides guidance to the chartered accountant on how to give assurance on assumptions. If you see, chartered accountant, he will not give assurance on the prospective financial information. No, he will give assurance on the assumptions used for prospective financial information, because prospective financial information or financial information related to future. So the chartered accountant also doesn't know whether the same figures will actually arrive even in future also. You cannot correctly predict. Okay, so you will not provide any opinion on those figures. Instead, you will provide assurance on the assumptions that have been used for preparing those prospective financial statements. Hope that is clear. See, this standard provide guidance to engagement to examine report on prospective financial information, including examination procedure for best estimate and hypothetical assumptions. And this essay does not apply to descriptive, or this essay does not apply to general or narrative terms. If you see in the annual report, management, it will speak about its future business in normal, general, descriptive terms, like in the next 5 years our sales will grow this much because of this reason, and because of that the profit will have this much impact. Like this, about future, management will make certain narrative descriptions. For such narrative descriptions, this standard is not applicable. Only for the quantitative terms, only if you have quantified, then the standard SAE 3400 will be applicable. Okay, next, acceptance of the engagement. At the time of acceptance of the engagement, auditor has to discuss, the chartered accountant has to discuss certain points with the management. We call them as terms of engagement. What will be included in the terms of engagement? First is intended use of the information. Okay, for which purpose you will use these prospective financial information? There will be various purposes. Let's say if you wanted to raise certain capital from investors, then investors can ask you to show the picture of business in the next 5 years. Or if you wanted to take a loan from the bank, then bank might also ask you to show the picture of the company in the next 5 years or 10 years. So what is the intended purpose of these prospective information, and to whom these prospective information will be distributed, whether it is distributed to all the users or only to the limited users. Next, what are the nature of assumptions that you are using for this prospective information, whether they are best estimate assumptions or they are hypothetical assumptions. You have to discuss this with the management. Next, what are the elements to be included in the financial in this information, and what is the period covered by this prospective financial information, whether it is for next 5 years, whether it is for next 10 years, or what is the period that has been covered. Okay, and if auditor feels that, the chartered accountant feels that the assumptions that the management has taken are unreasonable, then the chartered accountant, he will not accept the engagement. Next, nature of assurance. Here if you see, the chartered accountant, he will provide assurance on the assumptions but not on the prospective financial statements. He will also provide assurance on whether the prospective financial information has been prepared as per the assumptions or not. Okay, two assurances he will provide. First one, whether the assumptions are reasonable or not. Next, whether the prospective financial information has been prepared as per the assumptions or not. These two assurances he will provide. Next, responsibility for preparation and presentation of this prospective financial information. Obviously, management will be having responsibility for preparation and presentation of this prospective financial information, including making of the assumptions and explaining the basis for the forecast. Next, can professional accountant be associated with prospective financial information? If you see, as per clause 3 part 1 of second schedule to the Chartered Accountants Act, a chartered accountant in practice will be deemed to be guilty of professional misconduct if he allows his name or the name of the firm to be used in respect of a prospective financial information, which gives a belief to the users that the chartered accountant has watched for the accuracy of the prospective financial information. But if chartered accountant doesn't watch for the accuracy of the financial information that is present in the prospective financial information, then chartered accountant can sign that prospective financial information. Okay, in the note he should provide that, he should say that he is not watching for the accuracy, and he should also clearly indicate all the assumptions that have been used for preparing this prospective financial information. Then he can use his name with the prospective financial information. Using name with respect to prospective financial information means you can sign the prospective financial information. So chartered accountant can associate with prospective financial information provided he doesn't give a belief to the users that he is watching for accuracy of the figures. Next, duties of member who is examining prospective financial information. Okay, if you are examining the prospective financial information, what are your duties? First of all, you have to verify whether prospective financial statements has been prepared on the basis of assumptions or not. Next, you should also see whether the best estimate assumptions that have been made by the management are unreasonable or not. Okay, they should be reasonable. Next, all material assumptions should be adequately disclosed in the prospective financial information, and prospective financial information should be prepared in a consistent basis from the historical financial statements. That means whatever the accounting policies that you have followed for preparation of historical financial statements, the same accounting policies you should follow even for the preparation of prospective financial information. Hope that is clear. Next, examining procedures. See, while examining these prospective financial information, first of all, auditor will see whether he is having knowledge to examine the prospective financial information based on his past experience. Then he will also see whether management is competent enough to prepare the prospective financial information. What is the experience of management in preparing prospective information? Next, he will also see whether the people in the engagement team are having experience to prepare the prospective financial to verify the prospective financial information. Next, he will also calculate risk of material misstatement, that is likelihood of material misstatement. Next, he will see how to what extent these prospective financial information are affected by management's judgment. Next, what is the source of information for preparation of these prospective financial information, and whether the business of the company will be stable or unstable. Okay, all these will be considered by the auditor or the chartered accountant. Next, presentation and disclosure. First of all, the prospective financial information should be presented in a very informative manner. It should not be misleading. That is the first point. Next, you should also disclose all the accounting policies that has been used for preparation of these prospective financial information. Next, assumptions should also be clearly disclosed along with information whether such assumption is a best estimate assumption or a hypothetical assumption. Next, the date as on which these prospective financial statements have been prepared, and whether the assumptions that have been taken by the management are relevant as on the date of preparation of prospective financial statements or not. Even that has to be disclosed in the prospective financial statements or financial information. And if there is any change in the accounting policy, the management has to disclose that particular change in the prospective financial information. Next, report on the examination of prospective financial information. What will be the report? First of all, there will be title, there will be address. Next, you need to identify that these prospective financial information has been verified. Next, you should also refer to the standards on auditing that are applicable for conducting these assurance engagement. Next, you have to specifically identify responsibility of the management with respect to preparation of these prospective financial information. Next, you should also state in your report what is the purpose of these prospective financial information and to whom this prospective financial information will be circulated. And you should also state the examination procedures that you have followed for examining these prospective financial information. Next, you should also state whether the assumptions that have been taken by the management are reasonable or not, and you should also give your opinion on whether the prospective financial information has been prepared as per the assumptions or not. Next, appropriate caveats. Caveat means conditions. See, for some of the assumptions that the management has taken, there may be some conditions, like in the past 5 years sales have grown at 5%, but in the next 5 years sales will grow at a rate of 10%, subject to the condition that the research that we are conducting with respect to a particular product becomes successful and we successfully launches that product in the market. Okay, so this is the condition. This condition is known as caveat. Okay, subject to this condition our sales rate growth will be 10%. That is known as caveat. If at all there are any caveats, you need to properly report them in the report that you give. Next, date of report, place of signature and the signature. Okay, next, you should also specify in your report that actual results are likely to be different from the prospective financial information since anticipated events frequently do not occur. Okay, you have to specify that the actual results that might occur in the future, they might be different from the prospective financial information, from the information that is shown in the prospective financial information, because the future is uncertain. We cannot exactly predict the future. Because of this reason, the actual figures might vary. Okay, this information has to be given for both projections as well as for forecast. Next, in case of projection, you have to say that, see, in case of projection, prospective financial information has been prepared for particular intended use using set of assumptions that include hypothetical assumptions about future events and management action that are not necessarily expected to occur. Okay, we have taken certain hypothetical assumptions. These hypothetical assumptions are not likely to occur. Okay, that information should also be given in the report. Okay, this point should also be mentioned in the report if the prospective financial information is a projection. Next, documentation. What documentation you have to maintain? See, matters which are important in providing evidence to support report on examination of prospective financial information and evidence that such examination was carried out in accordance with this standard, that is SAE 3400. Okay, so this has to be documented. Yes, now we'll move to SAE 3402, which deals with assurance on controls at service organization. Now, if you remember, we have discussed SA 402. There is a link between SA 402 and SAE 3402. Before starting this standard, first of all, let me explain you context of this SAE 3402. Let's say, for example, yeah, here if you see, there is a company A Limited. Let me use ink. Yeah, there is a company A Limited. Now this A Limited has outsourced payroll activities to B Limited. We call A Limited as user entity, B Limited as service organization. Now A Limited will be audited by a particular auditor. We will call him as a user auditor. Now auditor, while conducting audit, he will first of all verify the controls. Now the payroll expenses like PF, ESI, salaries, all those will also be included in the financial statements of A Limited. So while auditing them, the user auditor has to verify the controls around that expenses or controls around processing of this payroll activities. But this processing of payroll is done by B Limited. So the auditor, the user entity auditor, has to go to B Limited, that is service organization, for verification of controls. Okay, if only user auditor, only one auditor goes to B Limited, that is a service organization might facilitate him to verify the controls, but service organization will not be providing the services only for A Limited. Just like A Limited, there will be various other clients that service organization will be having, like C Limited, E Limited. Okay, for all of those clients, service organization will be providing the same service. Now the auditors of those user entities will also come to B Limited asking to verify controls. Now if B Limited keeps on facilitating all these auditors to verify the controls, B Limited cannot do its business. So what B Limited will do is, it will appoint an auditor and we will call him as service auditor. What this service auditor will do is, he will audit the controls at service organization and he will give the report on controls at service organization. Now this report which the service auditor has given will be given to the user entity auditor. Okay, now SA 402 we have discussed. SA 402 deals with responsibilities of user auditor when user entity uses service organization. So SA 402 was in the context of user auditor. Now SAE 3402 describes about how service auditor will conduct audit of, or how service auditor will provide assurance on controls at service organization. This is the context of SAE 3402. Hope that is clear. Now I hope you are clear with these terms. Now moving into the standard SAE 4302. What is the scope of SAE 3402? See, SAE 3402 is applicable only for those engagements in which service auditor provides assurance on controls at service organization with respect to services that are being given to user entity. Okay, only in this context SAE 3402 is applicable. If let's say, for example, a particular auditor is appointed to provide assurance on controls on the entity, but this engagement is not in the context of services provided to user entity. Then for such engagement, for such standalone engagement to just to verify the controls at the entity, for such engagement SAE 3402 is not applicable. Okay. Next, objectives of service auditor. What are the objectives of service auditor? Now if you see, there are 4 points that you need to remember. First point is description of system. Now service organization is there, it would have implemented the internal control system. Now how it has implemented internal control system, what is its structure, how it is working. Okay, with respect to all these, service organization will prepare a document. That document will be known as description of its system. Okay, now service auditor is there, he has to verify whether this description of system is properly or fairly representing the actual system. That is the first objective of service auditor. Next, in this description of system, control objectives will be there. Now controls has to be designed so as to achieve those control objectives. Now the second objective of service auditor is to check whether controls have been properly designed or not. Okay. Next, third objective will be, in case if the service auditor is giving type to report, then his objective would be to verify whether controls are operating effectively or not. These are the objectives of service auditor. And service auditor will also see what criteria has been used for establishing this system of internal control. There will be criteria like COBIT, COSO. These are the frameworks. Just like for preparation of financial statements, we are having applicable financial reporting framework. Even for preparation of this description of system and implementation of the internal control system, there will be frameworks like COSO, COBIT, ISO. Okay, all that we have discussed in chapter number 4. So what criteria has been used? So these are the objectives of service auditor. Okay, hope you are clear with this. Next, coming to how the engagement is proceeded with. First of all, in this engagement, to provide assurance on service organization's control, the service auditor has to comply with all the ethical requirements and also independence, because here he is providing assurance. Next, the service auditor, he has to determine who is management, who is those charged with governance in the organization, for the purpose of inquiring them and for the purpose of communicating with them. Next, service auditor, before accepting this engagement to provide assurance on the controls at service organization, what the service auditor has to do is, he has to first of all check whether he is competent enough to perform this engagement, whether his team is having proper experience and expertise to perform that engagement. Next, he should also check what criteria is being used for implementing the controls at the service organization, whether that criteria is acceptable or not. Just like while accepting audit engagement, you will check whether the applicable financial reporting framework is acceptable or not. Just like that, while accepting this assurance engagement also, auditor has to check whether criteria is acceptable or not. Okay. Next, assessing suitability of criteria, whether that criteria is suitable for the purpose or not. Basically, for example, let's say, in order to implement internal controls with respect to information technology, you will be using criteria COBIT, whereas there is also COSO framework, which is a comprehensive framework. So based on your requirement, you should use a framework. So whether that criteria is suitable for your purpose or not. Next, you have to obtain understanding of the service organization's structure and service and controls implemented at the service organization. Next, you should also determine materiality. Here materiality means acceptable rate of deviation. Just like in the financial statements, you determine materiality, here in case of controls, you have to determine acceptable rate of deviation. Next, you need to obtain audit evidence. I have told you, you will verify 3 aspects, whether description of system present fairly or not. So with respect to description of system, you have to obtain audit evidence. Next, you will see whether controls have been properly designed or not. With respect to this aspect also, you have to obtain audit evidence. Next, you will see whether controls are operating effectively or not. For this aspect also, you need to obtain audit evidence. Okay, 3 audit with respect to these 3 areas, you need to obtain audit evidence. Next, you have to understand if the organization is having any internal audit function, whether service organization is having any internal audit function, because if internal audit function is there, the service auditor will determine whether any of the work that has been performed by the internal auditor can be used by him. Next, you should also determine subsequent events. What is meant by subsequent event in this scenario? Let's say, for example, the management has prepared description of its service on 1st April 2025. Now, the auditor is giving his assurance or giving opinion on this description on 30 September 2025. Now, the events that have occurred between these period will be known as subsequent events. The auditor has to check whether these events are having any effect on his report and whether these events are having any effect on the description of system. Okay. Next, written representation. The service auditor should also obtain written representation stating that in this this written representation has to be obtained by the service auditor from the management. What should be there in this written representation? Management has to reaffirm, that is reconfirm the assertions that it has made through description of system. Next, management should also provide in this written representation that it has given the auditor all the relevant information that is necessary. Next, management should also state that if at all there is any non-compliance with law or regulation that has been identified in the organization and management is having knowledge about that, management has communicated the same to the auditor. Next, if at all there is any deficiencies in the design of internal control, the same has been communicated to the service auditor. Next, if at all there are any instances of deviations in the control, even those instances communicated to the service auditor. Next, if at all there are any subsequent events that are having impact or that will affect the service or auditor's report, even those subsequent events are also communicated to service auditor. Okay, like this, a written representation has to be obtained from the management. Next, reporting. In the reporting, first of all, there will be title. Next, there will be addressee. Next, in the report, the service auditor has to identify description of the system. Next, those part of service organization description on which service auditor is not providing any opinion. Okay, there will be, if let's say for example, on any part of description of system, service auditor is not giving any opinion, then the service auditor has to mention that these items, on these items I am not giving any opinion. Next, if the description refers to need for complementary user entity controls, the service auditor has to mention that service auditor has not audited the complementary user entity controls. I guess you already know what are complementary user entity controls. See, let me tell you. Those controls that are operated at user entity are known as complementary user entity controls. Why these are necessary? Let's say for example, one of the control objective is data privacy. Now, in order to achieve data privacy at the service organization, there are controls. Now, the data that is processed by service organization will be shared with user entity also. Now, there is a possibility that at the user entity, this data might lose its privacy. So, in order to maintain the data's privacy, there should be complementary user entity controls even at the user organization also. Okay, so those are known as complementary user entity controls. If at all any such complementary user entity controls have been required in the description of system, then service auditor has to mention that I have audited only the controls at service organization and I have not verified the controls, I have not verified the complementary user entity controls. And proper working of complementary user entity controls is very much necessary in order to effectively or for effective working of the controls at service organization. Okay, this point you need to mention in your report. Next, if services are performed by sub-service organization, the nature of activities performed by such sub-service organization should also be mentioned in the assurance report. Sub-service organization means the user entity has outsourced its services to service organization. Now, let's say service organization is not having knowledge in that area or service organization has more work. In that situation, service organization will again outsource that work to sub-service organization. If at all any such work has been outsourced to sub-service organization, you need to mention the nature of work that has been outsourced to sub-service organization in the report. You need to identify. Next, Identification of criteria. Criteria means framework like COBIT, COSO, ISO. Okay, all these frameworks. Next, statement that report, and in case of type 2 report, description of test of controls are intended only for user entities. Okay, whatever the tests of control that I have performed, they are relevant only for user entities, not for any other person. That is in fact restriction of the report. Okay, next, statement that service organization is responsible for preparing its description of system, for providing the services, for stating that control objectives and designing and implementation. Okay, all these are the responsibilities of service organization. Okay, service auditor doesn't have responsibility for this. In a way, this is a management responsibility paragraph. Next comes auditor's responsibility paragraph. What is auditor's responsibility? Service auditor's responsibility is to express opinion. Okay, next, you have to give a statement that this engagement was performed in accordance with SAE 3402, and you should also give summary of procedures that you have performed. Okay, all the list of audit procedures that you have performed on the controls. Next, if the controls are having any limitations, you should also state limitations of controls. And in case you are giving a type 2 report, you have to give your opinion on the following: whether description fairly presents for specified period or not. If you see, there are two types of reports that the service auditor can give. One is type 1 report, another one is type 2 report. Now, type 1 report will be as on a particular date, whereas the type 2 report will be for a specified period. Okay, for a specific period. Now, in type 1 report, auditor will give opinion only on description of system and design of internal controls. Whereas in type 2 report, auditor will give opinion on description of system, design of controls, and also operating effectiveness of controls. Okay, the same will be there here also. Okay, type 2 report what will be given, type 1 report what will be given. Next, date of service auditor's assurance report. Okay, on which date you are giving signature, place of signature. Okay, this is what will be reported in the assurance report on controls at service organization. Next, additional matters requiring reporting in type 2 report. See, if at all the service auditor is giving type 2 report, then in type 2 report you will give opinion on operating effectiveness of the controls. Now, in order to check operating effectiveness of the controls, you have to perform test of controls. So, if you have performed such test of controls, you have to describe all the test of controls that you have performed. Okay, this description can be given either as an attachment to the audit report or in the main audit report itself. Next, you will modify your report in the following situation. What are the situations in which you will modify your report? First of all, first situation, if description of the system is not presented fairly. Okay, if the description of the system is not as per the actual system that has been implemented, in that situation you will modify your opinion. Next, if the controls are not properly designed to achieve its objective, then also you will modify. Next, if controls are not operating effectively, then also you will modify. Next, if auditor is not able to obtain sufficient appropriate audit evidence to verify the controls, then also you will modify. Okay, these are the situations in which you will modify your opinion on controls at service organization. Hope that is clear. So by this we have completed revision of SAE 3402. Now moving to the next standard, which is SAE 3420. Now this standard deals with auditor or the practitioner providing assurance on pro forma financial information that will be presented in prospectus. Now the question that might arise is, what is meant by pro forma financial information? Example, let's say a company wanted to raise 20 crores through IPO or FPO. Now this 20 crores, out of this 20 crores, company will use 10 crore for factory construction and remaining 10 crore as working capital. Now let's say company is making this public issue in the year 25-26. Now in the prospectus it has to present pro forma financial information. That means if after raising this amount and deploying this amount for the respective purposes, how the financial position and how the financial performance of the company will look like. Okay, that has to be presented in the prospectus. So for this, what you will do, you will take the unadjusted financial information. For this purpose, the unadjusted financial information would be audited financial statements for the year 2025. Now you have taken unadjusted financial information, which is the financial information for March 2025. For this, you will make adjustments. These adjustments, you have raised 20 crore, so capital will increase, bank balance will increase, and let's say you have deployed this out of this 20 crore for construction of factory, so asset will increase. Next, working capital will increase. Once factory has increased, once factory has come, the consumption of raw material will increase. Based on that, output will also increase, sales will increase. So because of this, what impact or how the financial statements or financial position of the company will look like, this is preparation of pro forma financial information. This is known as pro forma financial information. Okay, not only just for financial statements, even for a particular item, okay, for a particular financial item, you can prepare pro forma financial information. Okay, pro forma financial information means taking unadjusted financial information and making the adjustments to it is known as pro forma financial information. Now, if the practitioner has been appointed to provide opinion or to express assurance on this pro forma financial information, he needs to comply with SAE 3420. Okay, what is pro forma financial information? I have already explained you. Now, objectives with respect to SAE 3420. See, the objective of SAE 3420 is to enable the practitioner to obtain reasonable assurance about whether pro forma financial information has been prepared as per applicable criteria or not. Here also there will be applicable criteria. Applicable criteria is nothing but applicable financial reporting framework, and to report in accordance with practitioner's finding. Now, compilation of pro forma financial information. How will you compile pro forma financial information? The two steps. First of all, you will take unadjusted financial information. For that, you will make adjustments and you will present pro forma financial information. Okay, identify source of unadjusted financial information, making pro forma adjustments, and presenting the resultant pro forma financial information. Now, nature of practitioner's responsibility. Now, if you see here, practitioner is not responsible for preparation of pro forma financial statements. Management is responsible for preparing pro forma financial information. Practitioner is responsible only for providing opinion or assurance on whether pro forma financial statements is prepared as per applicable criteria or not. Next, steps involved in such engagement. Firstly, engagement acceptance. Just like any other engagement, while accepting engagement to perform or to provide assurance on pro forma financial information, the chartered accountant has to see whether he is capable, whether he is competent enough to perform this engagement or not. Next, he will see whether the applicable criteria is suitable and acceptable or not. Next, he will also check what should be the wording of the opinion that has to be given, and in order to give that particular wording in the opinion, what procedures he has to perform. Okay, to achieve that type of wordings, what procedures he has to perform on pro forma financial information. Next, he needs to obtain sufficient understanding of the entity, and if the event or transaction includes acquisition of a acquiree, then the chartered accountant has to see whether he can obtain sufficient appropriate information from the acquiree. Let's say, for example, A Limited is acquiring B Limited. Now, A Limited is preparing a pro forma financial information wherein it is presenting the position after acquisition of B Limited. Okay, after acquiring B Limited, what will be the financial position, or what will be the, how will the financial statements will look like these adjustments A Limited is making. Now in this situation, the auditor, the chartered accountant of A Limited would not have conducted audit of B Limited. So here in this situation, the chartered accountant, he has to check whether he will get sufficient appropriate evidences from the B Limited with respect to its financials. That is a query. Next, planning and performing the engagement. Now, while planning and performing the engagement to provide assurance on pro forma financial information, first of all, you have to calculate materiality, and you should understand how responsible party has compiled pro forma financial information. That means management. How management has prepared pro forma financial information. Next, practitioner shall obtain evidence about the appropriateness of source from which unadjusted financial information has been extracted. Okay, the practitioner, he should obtain evidence about the source from which unadjusted financial information has been obtained. Next, if there is no audit or review report on the source from which unadjusted financial information has been extracted, then practitioner shall perform procedures to be satisfied that source is appropriate. Okay, if at all the unadjusted financial information is unaudited or no report is available, then practitioner has to perform procedures to ensure that the source from which the unadjusted financial information has been taken is appropriate. Next, he should also obtain evidences with respect to the adjustments that you make. Okay, first one, the adjustments that are related to events or transactions that have that is pro forma adjustments, which is adjustments to unadjusted financial information that illustrate impact of significant event or transaction as if event has occurred. Okay, pro forma adjustment means that only event has not yet occurred, but if the event has occurred, how will it will impact the financial statement? That is pro forma adjustment. So you have to obtain evidence with respect to such adjustment, and you should also obtain evidence with respect to the adjustments that have been made in order to bring pro forma financial information in compliance with applicable financial reporting framework. Okay. Next, practitioner shall also read other information included in the prospectus. Now in the prospectus, apart from pro forma financial information, various other information will also be included. So the practitioner has to check that the other information is consistent with the pro forma financial information. Okay. Next, opinion. Unmodified opinion. If a practitioner feels that the pro forma financial information has not been prepared as per the applicable criteria, then he will give unmodified opinion. Next, modified opinion. Sorry. If a practitioner feels that the pro forma financial information has been prepared as per applicable applicable criteria, then he will give unmodified opinion. If they are not prepared as per applicable criteria, then he will give modified opinion. Now, if any law or regulation precludes, that means prevents from publishing prospectus in which there is pro forma financial information on which modified opinion has been given. Okay, see, pro forma financial information will be included in a prospectus. Together with the prospectus, the pro forma financial information will be published to the users. Now, if law or regulation precludes, that means prohibits from publishing this prospectus which contains pro forma financial information on which modified opinion is given, then the chartered accountant, he has to withdraw from the engagement, because if he is giving modified opinion, law is not allowing to publish them along with the prospectus. So in such a situation, why to accept the engagement and to give modified opinion? It is better to withdraw from the engagement, right? So he has to withdraw from the engagement. If law or regulation permits giving such type of opinion, then you can continue the engagement and you can give that opinion as per the respective framework. Next, emphasis of matter paragraph. If the practitioner wants to emphasize any disclosure that has been already made in the prospective financial information, then he can emphasize that in his assurance report under emphasis of matter paragraph. Next, assurance report. what will be the format of assurance report? As usual, first of all, there will be title, then there will be addressee. Then in the introductory paragraph, you need to identify the pro forma financial information and the source from which unadjusted financial information has been obtained, and the period that is covered by this pro forma financial information, and reference to the applicable criteria as per which this pro forma financial information has been prepared. Next, you should also include a statement that responsible party is responsible for compiling the financial information, and practitioner is responsible solely for expressing opinion on this pro forma financial information about whether pro forma financial information has been prepared as per applicable criteria or not. Okay, next, a statement should also be included that stating that the pro forma financial information and this engagement has been performed as per SAE 3420, and you have to use any of the following paragraphs for the purpose of providing opinion. They are: pro forma financial information has been compiled in all material respects on basis of applicable criteria, or pro forma financial information has been properly compiled on the basis stated. Okay, your opinion paragraph has to include any of these two below points. Next, signature and date and place of signature. So this is revision of SAE 3420. By this we have completed revision of all the three standards under SAE series. Okay, and before winding up this class, a small information: we have recently launched a Lecturepedia app. On this app, you can practice MCQs of all the subjects of CA Final, CA Inter, and CA Foundation. Along with this, you can also purchase classes of various topmost faculties on Lecturepedia app. You can download this Lecturepedia app from Play Store. Okay, I'll be winding up this video as of now. We'll meet in the next video. Until then, take care. Bye bye. See you. So in the today's class, we will be revising our next chapter, which is CARO 2020. See, this discussion of CARO 2020, which we are going to make, it is applicable both for CA Inter students as well as for CA final level students. CARO won't change whether CA Inter or CA final. Okay. So, as you already know, there are 21 clauses in CARO, right? So, first of all, CARO is a additional reporting responsibility which you will give as annexure to the audit report, right? Now, this CARO, it is not applicable to all the companies. There are certain exceptions from applicability of CARO. First of all, we will see what is the applicability of CARO. So, if you see, CARO, it is applicable for every company, including a foreign company. Foreign company is a company which is incorporated outside India but having a place of in India. That means even for a foreign company also, this CARO is applicable, except following. That means for the following companies, the CARO is not applicable. What are they? Firstly, for the banking company, insurance company, section 8 company, 1% company. So in case of banking company, insurance company, the regulatory requirements are even more stricter. So the reporting requirements that are there in CARO, they are already there for banking and insurance company as per their own respective laws. So for these two, CARO is exempted. And section 8 company, 1% company, these are some small companies, right? Section 8 company, it is incorporated for charitable purposes. So to encourage them, government has reduced the reporting burden on them. So for section 8 company, CARO is not applicable. Even the 1% company, 1% company is also only one director will be there. To reduce the reporting burden, the CARO is not applicable. Next, small company, even for small company, CARO is not applicable. Now, what is meant by small company? Small company is a private company whose paid up share capital is less than 4 crore and turnover is less than 40 crore. If these two conditions are satisfied, you will call it as a small company, and for small company, CARO is not applicable. Next, coming to private companies. For private companies, CARO is applicable, but however, if the private company is falling in this threshold, then private company can claim exemption from applicability of CARO. So what is this? What is this exemption for private limited company? First of all, private limited company, in order to claim the exemption, it should not be holding company or subsidiary company of another public company. Got it? See, private limited company not being subsidiary holding company of a public company. If private limited company is holding or subsidiary of a public company, then for the private limited company, CARO will be applicable even if it satisfies these criteria. Now, what are the criteria? So, for private limited company, in order to claim exemption, following criteria should be satisfied. First of all, paid up share capital and reserves and surplus should be less than or equal to 1 crore rupees. And you should observe here it is and borrowings is less than or equal to 1 crore rupees. Turnover is also less than or equal to 10 crore rupees. If all these conditions together are satisfied, then private limited can claim exemption from applicability of CARO. Got it? Next, this paid up share capital and reserves and surplus, this you need to see as at the end of the current financial year for which you are checking the applicability of CARO. And borrowings is there, na? This borrowings you need to see at any point of time, not as at the balance sheet date. So during the year, at any point of time, if borrowing crosses 1 crore, then CARO gets applicable. And turnover is less than or equal to 10 crore rupees. If all these three conditions are satisfied, you can claim exemption from CARO. Got it? Next, this CARO, it is applicable to standalone financial statements. In case of consolidated financial statements, even for consolidated financial statements also, auditor needs to give audit report, right? So in case of audit of consolidated financial statements, CARO is not applicable except clause 1. See here, you can see that note, CARO 2020 is not applicable to consolidated financial statements except clause 21. Got it? This is with respect to applicability of CARO. Now we'll go through all the clauses of CARO one by one. So first clause, it is related to PP, property, plant and equipment. There are basically 5 sub clauses in this first clause. Let us see what are they one by one. First of all, auditor needs to see whether company has maintained proper records of PPE, including both tangible as well as intangible. So whether proper records are made or not, that will be reported by the auditor. Next, whether this PPE has been physically verified by the management at proper intervals or not. So that auditor will report. If management is not physically verifying PPE at periodic intervals, then auditor will report it here. Next, coming to immovable property, the title deeds of immovable property should be in the name of the company, because if immovable property is shown in the balance sheet, in the books of accounts, the title, in the title deed, the company should be owner. Correct or not? So that is the third thing that the auditor will see with respect to PPE, clause 1. If at all the title deeds are not in the name of company with respect to immovable property like land or building, then auditor will report it here. Next, whether company has revalued its assets. Now company, it can revalue its assets, right? So if at all it has revalued its assets, then the revaluation should be based on a certificate of valuation given by registered valuer, that auditor needs to see. And if in case because of revaluation, change in the value is more than 10% each class wise, okay, class of asset means like plant and machinery is one class, land and building is one class, like this there will be different classes of assets. So because of revaluation, if increase in the value of asset is more than 10%, you should see this not individual asset wise but class wise, because in each class there could be various assets. Got it? Now if total class taken together the change is 10% or more, then auditor will report. Okay, see, specify the amount if change is 10% or more, each class of PPE wise you need to see. Got it? Not the fixed asset wise but the class wise you need to see. Next, the auditor will report whether there are any proceedings that are initiated or pending against the company as per prohibition of Binomy Property Transaction Act. If there are no proceedings against the company, then auditor will say that no, there are no proceedings against the company as per prohibition of Binomy Property Transaction Act. Got it? These are the 5 points that the auditor will report as per clause 1 of CARO 2020. Next, moving to clause 2, which is inventory Now here with respect to inventory also, auditor will see whether physical verification of inventory has been done by the management at reasonable intervals, and during such a physical verification, if any discrepancy of 10% or more in aggregate for each class of inventory were noticed, then also auditor will see whether they have been properly dealt in the books of accounts or not. Now here also, if you see, they are saying class of inventory wise. Now for the inventory class means, see, for fixed assets, class of assets will be like uh, plant and machinery, land and building, furniture and fixtures. These will be class of fixed assets. Similarly for inventory, class of inventory will be raw material, work in progress, finished goods, right? Like this, if there is any discrepancy between book value and physical value, okay, book value, physical value, if difference between book value and physical value is more than 10%, that too class wise, not total inventory, you need to see, okay, you should not see the total inventory difference, no, class wise difference you need to see. So if class wise difference is more than 10%, auditor should ask the management to properly account it in the books of accounts. Got it? If it is not properly accounted, of course auditor will report it here. Got it? Yes. Next, so that is the first point under clause 2. Now coming to the second point, auditor needs to see whether during the year company has been granted a working capital limit of 5 crores or more based on security of its current assets. If at all working capital of more than 5 crores has been sanctioned to the company during the year, auditor needs to see for working capital, the company will give stock statement, debtor statement on a quarterly basis to the bank. So whether the amount of stock, amount of debtors shown in this stock statement and debtor statement that the company gives to the bank, is it matching with the books of accounts or not, that auditor needs to report as per the second subclause of clause 2 with respect to inventory. Understood? Got it? Yes. Next, coming to clause 3. Now this clause 3 deals with investments, loans, guarantees, securities. See, investments made by the company, loans given by the company, not taken by the company, guarantees and securities also given by the company. So with respect to loans, guarantees, investments made or given by the company, clause 3 reporting will deal with. Got it? Now let's see what the auditor needs to report. So whether, what happened, yeah, whether during the year company has provided any loans, guarantees or securities to any other entity. In such a situation, auditor needs to report in clause 3 of CARO aggregate amount that has been given during the year. Okay, during the year, how much of aggregate amount you have given and what is the outstanding balance as at the balance sheet date. Because in the previous years also you might have given loan, all that accumulated after reducing the repayments, what is the outstanding balance as on balance sheet date, that you need to report. And also what is the fresh amount of loan or investment that you have made during the year, that also you need to report. See, aggregate amount during the year and balance outstanding as at the balance sheet date with respect to such loans and advances, guarantees or securities given to subsidiaries, associates and joint ventures. So you need to separately show how much loan or advance you given to subsidiary, how much loan advance given to associate, how much loan advance given to joint venture, and how much is given to others. Okay, this way you need to report, and also how much is given in current year and how much is the outstanding balance. So in this manner you need to present, you need to report in this clause 3 first subclause. Next, second point that the auditor needs to report is whether investment made by guarantees, whether investments made, guarantees provided, securities given are not prejudicial to the interest of the entity. See, the terms and conditions of loans that the company gives, it should not create loss to the entity. Let's say, for example, in the industry, in the market, the general rate of interest is 12% for any loan, but company has given loan to one of its subsidiary at just 3% rate of interest. Is this prejudicial to the interest of the company or not? Yes. So auditor needs to report any loans, advances, investments made where the terms and conditions are prejudicial to the interest of the company. Got it? Next one, in respect of loans and advances, whether schedule of repayment of principal and payment of interest has been stipulated, and whether the repayments are regular. See, if you take any loan from the bank, generally there will be schedule of repayment, correct or not? In the same way, for the loans that the company has given, whether there is a schedule of repayment, like on which date the EMI amount will be received by the company, like this schedule of repayment should be there, and also there should be a proper realization of amount on a regular basis. These two things auditor needs to report. If at all the amount is not received on a regular basis, then auditor will report it. Next, state total amount overdue for more than 90 days, and whether reasonable steps have been taken by the company to recover that amount. See, the company has given some loan to some person, and if that person has not repaid the EMI or installment amount for a period of more than 90 months, that needs to be specifically reported by auditor in this clause. And auditor should also report whether company is taking proper steps to recover that amount. Got it? Yes. Next, auditor should also report whether any loan or advance which has fallen due during the year has been renewed or extended. See, during the year, the borrower has to repay the amount to the company. So due date is falling during this year. But what company has done is, let's say 2 crore amount has to be repaid by the borrower to the company. But company, in order to repay this loan by the borrower, it has issued fresh 2 crore loan to the borrower, or it has renewed the existing loan. So due date is today, na, you don't repay it today, you take some more 2 years, like this you have renewed the existing loan or given fresh loan to repay the existing loan. In such a situation, we will call this as evergreening of loans. So if at all any evergreening of loans happens, auditor needs to report it. So in this evergreening, auditor needs to report aggregate amount of such dues renewed or extended or settled by fresh loan. So how much amount of loan is evergreened, that is fresh loan granted to repay it, or its due date extended, and percentage of aggregate to the total loans or advances granted during the year. Now during the year, let's say company has granted total loans of some 15 crores. Of these 15 crores, some 3 crore loan belongs to evergreening. That means some 3 crore loan has to be repaid by the borrower in the current year, but the company has issued fresh loan to repay that existing loan. So such type of loans that the company has given is 3 crore out of the total 15 crore. Now how much percentage it comes? So 3 by 15 into 100. So how much percentage is the evergreen loans? That also you need to report. Understood? Yes. Next, whether company has granted any loans or advances repayable on demand. Repayable on demand means whenever the company asks, that borrower has to repay. There is no fixed tenure for repayment of loan. Such loans are known as demand loans, or any loans where there are no terms and conditions with respect to repayment. So if the company has given any such demand loans or any loans for which there is no stipulated terms and conditions, the auditor needs to specify aggregate amount of such loans without terms and conditions, or aggregate amount of such demand loans, and percentage thereof to the total loans granted. So of the total loans that the company has granted, how much is that demand loan, how much is that loan which is without proper terms and conditions. Got it? So these are the points that you will report as per clause 3. Yes. Next, moving to clause number 4, right? So clause 4 deals with section 185 and 186. See, as per section 185 and 186 of Companies Act, whenever company wants to give any loan to its directors, or whenever company wants to make any investment, then it needs to follow certain conditions, like some special resolution is required, and there can be maximum cap of the amount that you can give as a loan to directors. So that is specified in section 185 and 186. So as per clause 4, auditor needs to report in respect of loans, investments, guarantees and securities, whether the provisions of section 185 and 186 have been complied or not. Understood? Yes. Next, clause 5, with respect to deposits. Now, with respect to deposits that the company accepts, now deposit, it is a type of borrowing for the company. See, whenever company wants to raise funds, it can raise funds either in the form of equity share. By giving equity share, it can take money from the public, or by borrowing from the bank, that is another source, or by issuing debentures to the public. Another source is deposits. So the company can accept deposits from the public. This is also one of the source for the company. Now deposits become liability for the company. Now with respect to the deposits, the company needs to comply with three things. First one, RBI will issue various directives with respect to the deposits that the company accepts. So the company should comply with all the directives issued by RBI. Next, with respect to deposits, in Companies Act, there is a section number 73 to 76. So all those sections that are dealing with the deposits should be complied by the company. Next, if any order is passed by Company Law Board, National Company Law Tribunal, or any court, that order should also be complied by the company with respect to deposits. Got it? Understood? Yes. So that was clause number 5. Now moving to clause number 6. So clause 6, cost records. Whether maintenance of cost records has been specified by central government. Generally, central government, it will ask some companies to maintain cost records. Certain regulated sectors like telecom industry, electricity generating companies, or sugar manufacturing companies. So some companies, they need to be mandatorily maintain cost records as per section 148 subsection 1. So auditor, he will report whether cost records have been maintained or not. See, this is not speaking about cost audit. In CARO, you will never report about cost audit. You will just report whether cost records are required, if required, whether cost records have been maintained by that company or not. This is the only thing that you will report. Got it? Yes. Next, moving to clause number 7, which is statutory dues. Some of the examples for statutory dues: ESI, PF, income tax, GST, TDS. All these are some of the examples for statutory dues. Now, statutory dues, you can bifurcate it into two: undisputed statutory dues, disputed statutory dues. Undisputed statutory dues means there is no dispute with respect to such a statutory due between the government and the company. That is known as undisputed statutory due, which will be dealt by clause 7 subclause A. Now, if at all there is any undisputed statutory due which the company has not paid for a period of more than 6 months as on the balance sheet date, that should be reported by the auditor under subclause A. So this is a 31st March balance sheet date. So as on balance sheet date, there is some outstanding 2 crore of income tax or any other statutory due like GST or ESI, PF, any some amount of statutory due, 2 crore is there. Now the due date of this 2 crore is falling before 31st before 30 September. So the due date of this 2 crore is before 30 September. So if the due date is before 30 September means as on the balance sheet date, it is being outstanding for more than 6 months. Correct or not? So such a type of statutory dues which are outstanding as on balance sheet date for a period more than 6 months should be reported by the auditor under subclause A, clause 7. Got it? Now let's say for example this 2 crore this 2 crore statutory due. Let's say for example the auditor is giving his audit report for this financial year on some 10th of June 20 okay, irrelevant of the year. On 10th of June he is giving his audit report. Now if let's say for example this 2 crore which is outstanding as on balance sheet date for a more than 6 months is paid by the company on 4th April, that is before the audit date report, it has paid off. In this situation also, even if a company has paid that due after 31st March, you need to report because it is outstanding as on 31st March. Got it? Yes. Next, with respect to disputed statutory due, that means government is saying that you have to pay 10 lakh rupees, but the company is saying that no, my liability is only 5 lakh rupees. Like this, there is a dispute going on between company and the government, that becomes a disputed statutory due. So in case of disputed statutory due, auditor needs to report with which authority that dispute is pending, that is with which forum that dispute is pending, and what is the amount involved in such a dispute. Got it? That has to be reported. Next, clause number 8, which is undisclosed. Just a second. Yes, clause number 8, which is undisclosed income. Now what is this undisclosed income? Generally income tax department will come up with some scheme every once in 3 years or 4 years, it will come up with a scheme known as disclosure of undisclosed income. That means in the past, if the assessee has not disclosed his income in the income tax return, now the income tax department is giving a chance to the assessee to disclose his undisclosed income under this disclosure of undisclosed income scheme. Okay, fine. Now the company has disclosed the income that is not disclosed earlier in this scheme. So let's say for example income related to 2020 to 2021, this financial year is disclosed in the financial year 2024 2025. So this income is disclosed in this year. In such a situation, okay, you have disclosed to the income tax department and you have paid off the income tax. But what about books of accounts? Auditor has to check whether that income that is disclosed in the current year is properly accounted for in the books of accounts or not. Got it? Yes. Next, clause number 9, which deals with loans and advances taken by the company. See, clause 3 deals with loans to advances given by the company. Clause 9 deals with loans to advances taken by the company. Understood? See, so now the first subclause with respect to clause number 9, whether company has defaulted in repayment of loans or borrowings or interest thereon to any lender. So the loan that the company has taken, whether it has defaulted in repayment of either principal or interest. If there is a default, you will the auditor will report under this CARO. Got it? Next, whether company is declared as a willful defaulter like Vijay Mallya, Nirav Modi, right? So like this, whether the company is declared by the bank or financial institution as a willful defaulter. In such a situation, auditor will say in this clause that this company is a willful defaulter. Next, whether term loans were applied for the purpose for which loans were taken. See, when you are taking the term loan, you will take the term loan by specifying the reason that I will use this term loan for so and so purpose. If you don't use that term loan for that purpose, auditor will report here. Next, whether the funds raised on short term basis or used for long term basis. See, if you have taken working capital loan is a short term loan. You should use it only for the short term purposes, but not for the long term purposes. If in case you use short term loans for long term purposes, auditor will report here in this clause. Got it? Yes. Next, whether company has taken any funds from any entity or person to meet the obligation of its subsidiary, associate or joint venture. So if the company has taken any loan and it is meeting the requirements of his subsidiary, joint venture or associate with that loan, then auditor will report it here. Next, whether company has raised loans during the year by pledging the shares of its subsidiary or joint venture, that also auditor will report in clause number 9. Yes. Next, clause number 10. So clause number 10 deals with whether the amount raised through IPO and FPO it is utilized for the purpose for which it was raised, that is end use of funds. Similarly, whether amount raised through private placement, preferential placement, whether that amount also is used for the purpose for which it is raised or not. And with respect to private placement and preferential allotment, there is section 42 and section 62 of Companies Act that needs to be complied. So you will also report whether that is complied or not. Next, moving to clause number 11, which deals with fraud. Basically, the reporting with respect to fraud is there in clause 11 of CARO 2020, and also section 143 subsection 12 of Companies Act. So as per clause 11, auditor reports any fraud that is conducted by the company or any fraud that is happened on the company. Both things will be reported by auditor here in section 140, here in clause number 11. But in section 143 subsection 11, only frauds on the company by employees or officers will be reported. Understood? Yes. And in case of that section 143 subsection 12, reporting will be made to audit committee or board of directors if amount involved in fraud is less than 1 crore rupees. If amount involved in fraud is more than 1 crore rupees, reporting will be made to central government in the form ADT4 in that section 143 subsection 12. Now, if in case any report is given to central government in ADT4 because the fraud is more than 1 crore rupees, auditor should say that here also in second subclause of clause 11 that during the year I have given form ADT4 to central government because a fraud has occurred on the company exceeding value 1 crore rupees. Understood? Next, auditor should also report whether he has considered whistleblower complaint. See, whistleblower is basically a mechanism that will be there in the company to handle the complaints that comes from the employees. Understood? Yes. Next, clause number 12. So this clause 12, it is related to Nidhi companies. Here you will see three things: whether Nidhi company is maintaining net own fund to deposit ratio of 1:20. That is the first thing you will see. Next thing you will see is whether Nidhi company is maintaining 10% unencumbered term deposits or not. Yes, unencumbered term deposits 10% should be maintained. Next, whether there has been any default in payment of deposits that the Nidhi company has accepted. These 3 points you will report in clause 12. Next, clause 13 with respect to related parties, the auditor will report whether section 177 and 188 with respect to related party has been complied or not. Next section, clause number 14, which deals with internal audit. See, here auditor will report whether the internal audit in the company is incommensurate with the size of the company. Taking into consideration size of the company, is the internal audit is sufficient for the company. That is the first point you will see. The auditor will report. Next, auditor will also report whether he has considered the internal audit reports that the internal auditor has given. See, during the year, internal auditor will give 4 internal audit reports, one for every quarter. So those internal auditors reports should be considered by statutory auditor during his final audit. Understood? That is clause 14. Next, clause 15 with respect to non-cash transactions. Non-cash transaction is nothing but a barter. So if any non-cash transaction takes place with company and director, then requirement of section 192 has to be complied. Whether the requirement of section 192 is complied or not, auditor will report it here. Next, clause 16 with respect to NBFC. Now, with respect to NBFC, in order to start a business of NBFC, you need to obtain certificate of registration from RBI. So auditor will report whether this NBFC has obtained certificate of registration from RBI or not. Next, that is the first point. Second point, the auditor will report whether this company is doing business of NBFC or business of housing finance without obtaining certificate of registration from RBI. That is the second point that will be reported. Next, whether if in case the company is a core investment company, then in case of a core investment company, to treat it as core investment company, it needs to satisfy certain criteria given by RBI. Whether such criteria is being satisfied by this company or not, you will see if at all it is a core investment company. And in case the group of companies is having more than one core investment company, you will state the fact that this group is having more than one core investment company. How many core investment company are there, you will specify. Understood? That is clause 16. Next, clause 17. So if the company had made any cash losses during the current year or during the preceding financial year, you will mention. Cash losses means you will take profit or loss that is generated as per profit and loss statement, and you will reduce and add back all the non-cash items. Okay, so you will get a cash loss. Understood? So if there is any cash loss, net cash loss during the current year or during the preceding financial year, you have to report it. Next, clause 18, resignation of auditor. In case the auditor has resigned and a new auditor is appointed, then incoming auditor has to communicate with the resignation auditor about why he is being resigned. Understood? That is the clause 18. Auditor will report whether he has communicated with the resigning auditor and he has considered the reasons and objections raised by resigning auditor or not. Next, clause number 19, which related to going concern. Simple. So based on all the information that I have obtained and based on my audit, whether I feel that this company is going concern or not, auditor will report in clause number 19. Understood? Yes. Next, clause number 20, which is about unspent CSRs, that is corporate social responsibility. So certain companies, they are having a mandatory requirement to spend 2% of their profit for the purpose of for the benefit of society. Now this amount is there that has to be generally spent within 6 months from the end of the financial year. If at all you fail to spend that amount within 6 months from the end of financial year, you have to deposit this amount in investor education and protection fund. So that amount has to be deposited within 6 months from the end of the financial year. So whether the unspent CSR is deposited within 6 months from the end of financial year in that investor education and protection fund or not, auditor will report in this first subclause. Next subclause, if there is any ongoing project, like the company is, let's say, constructing a school building, it is spending CSR amount for the purpose of free education, so it is constructing a school building. Now for constructing school building, it is taking, let's say, 2 years. So you cannot complete school building within 6 months from the end of financial year. So in such a situation, if you are spending the amount on any ongoing project, in such a situation you have to keep that amount in a separate bank account. So auditor will see whether funds utilized for, that are being utilized for separate project or being kept in a separate bank account and utilized from that bank account or not. That you will report with respect to CSR, corporate social responsibility. Next, clause number 21, it is applicable only for the consolidated financial statements. See, in case of audit report of consolidated financial statements, you will give CARO. In that CARO that you give on consolidated financial statements, all the first 20 clauses will not be there. Only clause number 21 will be there. And in this clause number 21, what you will report is, let's say for example, A Limited. A Limited is having some subsidiaries, subsidiary 1, subsidiary 2. Now, for this subsidiary, CARO report would have been prepared. For this subsidiary also, CARO report would have been prepared. And A Limited now preparing CFS. In this CFS, clause 21 will be given. So, in this clause 21, let's say, in the subsidiaries CARO, any clause has been negatively reported, negative remark is there, you will give only that negative remark clause in this clause 21 that you will give in the consolidated financial statements. Understanding? So let's say for example in subsidiary 1, CARO, clause 5 and clause 10 have been negatively reported. So here auditor of consolidated financial statements, in CARO of consolidated financial statements under clause 21, he will say subsidiary 1, clause 5 so and so negatively reported, clause 10 so and so negatively reported. Next, in subsidiary 2, clause 3 negatively reported and clause 7 negatively reported. You will say subsidiary 2, clause 3 negatively reported, clause 7 negatively reported. That clause you will copy and paste here in the consolidated financial statement, clause 21. That is the reason why clause 21 is applicable only for the report CARO report of CFS, but not CARO report of standalone financial statements. Understood? So this is the entire discussion of CARO 2020. So that's it for today. I'll be winding up this session. We'll meet in the next class with a revision of a new chapter. Until then, take care. Bye bye. See you. In the today's class, we'll revise group audits. Group audits is nothing but audit of consolidated financial statements. Along with this chapter, we will also discuss SA 600 in this lecture itself. Okay, so starting with the chapter group audits. What are the topics that are covered in this chapter? Firstly, we will cover audit of financial statements. After that, we will cover SA 600, which is use of other auditors' work. Next, types of financial statements. You already know that there will be two types of financial statements. One is standalone financial statements. Okay, standalone financial statements will consist of financial statements of only one company. Okay, either the holding company or the subsidiary company or the associate company. The financials of only one company will known as a standalone financial statements. Next, we will be having consolidated financial statements. Now, if a company is having subsidiaries, joint ventures and associates, then it has to prepare consolidated financial statements, consolidating the financial statements of the holding company, subsidiary, associate and joint ventures. Those financial statements will be known as consolidated financial statements. Now, just like standalone financial statements are audited by an auditor, even consolidated financial statements will also be audited by auditor. Now, the entity can appoint same auditor for both standalone financial and consolidated financial statements, or if the entity wants, it can appoint a different auditor for consolidated financial statements. Hope that is clear. Now, understanding the terms that we will be using in this chapter, if you see, we will be using certain terms like parent entity, parent auditor or principal auditor, and component auditor. So let us understand these terms. First of all, there is a company A Limited. This company is parent company because it is having certain subsidiaries and associates. Now, this parent company is having subsidiaries. This parent company is also having associate. See, subsidiary means if you hold more than 51% of shareholding, that becomes your subsidiary. If you hold more than 20% of shareholding, then it becomes associate. And joint venture. This A Limited is also having certain joint ventures with some other company. Now, all these three types of entities will be known as components. Okay, together you can call them as component. Okay, this subsidiary will be component of parent entity, associate will be component of parent entity. Okay, the common term that you can use for all these entities is components. Now, the parent entity will have an auditor. He will be known as parent auditor or principal auditor if he also audits consolidated financial statements. Okay, you will call the auditor of parent entity as parent auditor, and if the same auditor is appointed for auditing consolidated financial statements also, you will call that auditor as principal auditor. Okay, now the components will also be having a auditor, right? This auditor is known as components auditor. Next, what will be included in these consolidated financial statements? Just like the standalone financial statements, even consolidated financial statements also include consolidated balance sheet, consolidated profit and loss statement, consolidated cash flow, consolidated statement of changes in equity, and explanatory notes. Now, Schedule 3 of Companies Act format for preparation of financial statements. The same format you need to follow even for preparing consolidated financial statements also. And with respect to consolidation, AS 21 and Ind AS 110 deals with this consolidation. And the statutory auditor of consolidated financial statements can be parent's auditor or some other auditor. This point I have already explained to you, right? Next, is it mandatory to prepare consolidated financial statements? If you see, as per Companies Act 2013, if the company is having subsidiaries, it is mandatory for that company to prepare consolidated financial statements. However, there are certain exceptions. What are those exceptions? We will see. There are three types of exceptions. As per Companies Act, there are exceptions. As per Ind AS, there are exceptions. And as per accounting standards, there are exclusions. Okay, as per accounting standard, there is no exemption, but there is a exclusion. We will see what are the exceptions and exclusions available for preparation of consolidated financial statements. But generally speaking, if the company is having subsidiaries, it is mandatory to prepare consolidated financial statements as per Companies Act 2013, and as per Ind AS, as per accounting standard 21. Okay, as per these three laws, or as per these three rules, it is mandatory to prepare consolidated financial statements, but there are certain exemptions and exceptions available. See, as per Companies Act, there are exemptions from preparations of consolidated financial statements. We will see that. And as per Ind AS also, there are exemptions, and as per accounting standard, there are only exclusions. Okay, let us see all of them. First of all, requirement as per Companies Act 2013. Now, what Companies Act 2013 says, as per section number 129 subsection 3, where a company has one or more subsidiaries including associate and joint venture, then it shall, in addition to its own financial statements, prepare a consolidated financial statements. Now it became clear. Companies Act itself makes it mandatory to prepare consolidated financial statements if the company is having subsidiary, and these consolidated financial statements shall also be approved by board of directors and shall be placed in the annual general meeting. Just like standalone financial statements will be approved by board of directors, even the CFS should also be approved by board of directors. Next, a separate statement containing salient features of financial statements of its subsidiary in form AOC1 shall be attached along with these financial statements. See, along with these consolidated financial statements, you will attach a form known as AOC1. What will be there in this AOC1? This AOC1 will contain salient features of the subsidiaries. Okay. Now coming to the exemptions from preparation of consolidated financial statements as per Companies Act 2013. General rule is you have to prepare consolidated financial statements, but if you satisfy the three conditions, okay, if you satisfy all these three conditions together, then you need not prepare consolidated financial statements. What are these three conditions? Let us see. First of all, the company, if it should be either wholly owned subsidiary or partially owned subsidiary of another company, and you should obtain approval from all the shareholders that they do not have any objection for company not preparing consolidated financial statements. Okay, let's say B Limited. B Limited wants to take exemption from preparation of consolidated financial statements. Okay, B Limited is having some subsidiaries and B Limited wanted to take exemption from preparation of consolidated financial statements. Now, what conditions should be satisfied by B Limited? B Limited should be either wholly owned subsidiary or partially owned subsidiary of another company. Let's say B Limited is subsidiary of A Limited. Just a second. So, this is the first condition that has to be satisfied in order to claim exemption. Okay, next, along with this, you should not be either listed entity or not in the process of listing, whether in India or outside India. Okay, this B Limited, it should not be listed entity or it should not have listed or it is not in the process of listing either in India or outside India. This is the second condition that needs to be satisfied. And third condition, it's ultimate holding company, that is A Limited, which is ultimate holding company of B Limited, should file consolidated financial statements with registrar. Okay, if all these three conditions are satisfied together, then you can claim exemption from preparation of consolidated financial statements. Okay, let's quickly once again go through these conditions. First of all, the company should be either wholly owned subsidiary or partially owned subsidiary of another company, and it should have obtained permission from all its shareholders that they are not having any objection if the company doesn't prepare consolidated financial statements. Next condition, the company is not a listed entity or not in the process of listing whether in India or outside India. Next condition, the company's ultimate holding company should file consolidated financial statements with registrar. If all these three conditions are satisfied together, then you can claim exemption from preparation of consolidated financial statements as per Companies Act. Okay, there are also exemptions and exclusions as per Ind AS and accounting standards. We will see that now. Next, exemption from preparation of consolidated financial statements as per Indian Accounting Standard 110. Now, if you are an investment company, then you need not prepare consolidated financial statements provided you value your subsidiaries at fair value through profit and loss. Okay, if you are an investment company means your business itself is to purchase and sell various companies. Okay, so since your business itself is to purchase and sell various other companies, in that process you might acquire more than 51% of shareholding of some other company. Even though you have acquired more than 51%, you are an investment company, your intention is to sell them within a period of time. Okay, you just wanted to make a profit by purchasing and selling the shares of that company. You are no way concerned with business of that company, so you need not prepare the consolidated financial statements. Okay, so as per this, exemption is as per Ind AS 110. Okay, so if you are an investment entity, you need not prepare consolidated financial statements if you measure all subsidiaries at fair value through profit and loss. Now you can get it out. What is meant by an investment company? There is a definition for that. In order to call an entity as an investment entity, it should satisfy three conditions. What are they? It should obtain funds from one or more investors and provide them investment management services. Okay, investment entity should obtain funds from various investors with an intention to provide investment management services to those investors. Next, with those money, the intention of the investment company is to earn profits either in the form of capital appreciation or in the form of investment income. Investment income means interest and dividend will be known as investment income. So your intention is to earn money through capital appreciation or investment income. See, commits to investors that its business purpose is to invest funds solely for returns from capital appreciation or investment income or both, and it will measure substantially all of its investments on fair value basis. If all these three conditions are satisfied, then you are an investment entity, and if you are an investment entity, you need not prepare consolidated financial statements as per SA, as per Ind AS 110, right? Next, now exclusion as per Accounting Standard 21. See, Accounting Standard 21 doesn't give permanent exemption to any company from preparation of consolidated financial statements. Okay, if you are having a subsidiary, then you have to prepare consolidated financial statements as per Accounting Standard 21, but certain types of subsidiaries can be excluded from your consolidated financial statements. So what are the subsidiaries that can be excluded from consolidated financial statements? See, there could be two reasons for exclusion. First one, relationship of the parent with the subsidiary, associate or jointly controlled entity is intended to be temporary. Okay, if intention of the parent entity is to sell off the subsidiary, joint venture or the associate within a short period of time, okay, that is the period of holding will be very less. Okay, so if the intention of the entity is to sell off the subsidiary within a short period of time, then you need not include that subsidiary in your consolidated financial statements. Now the question arises, what would be known as a temporary period? If the period is less than 12 months, you can call it as a temporary period. Okay, so if you are having any subsidiary, joint venture or associate where your intention is to sell off these components within a short period of time, then you need not include them into your consolidated financial statements. Next, another reason, subsidiary, associate or joint venture operates under severe long term fund transfer restriction. That means, example, there is a foreign company which is incorporated in USA. Now that foreign company is also having a subsidiary in India. Okay, now as per the rules and regulations in India, the foreign company, it cannot take profits from the Indian subsidiary to out of India. So here this subsidiary, it is operating under severe long term fund transfer restriction. So you cannot include this subsidiary into consolidated financial statements. Okay, if you are having any subsidiary where that subsidiary is operating under a severe long term fund transfer restriction, then you cannot include that subsidiary into your consolidated financial statements. So these two types of subsidiaries can be excluded from your consolidated financial statements. So now if you see, accounting standard 21 has not given any exemption from preparation of consolidated financial statements. You have to prepare CFS, but while preparing CFS, you can exclude these two type of subsidiaries or components, you can say. Okay. Next, information used in preparation of consolidated financial statements. Which information you will use for preparing the consolidated financial statements? First of all, the separate financial statements of a parent entity and separate financial statements of components you will use for preparation of consolidated financial statements. That is okay. Apart from that, you will also use other financial information not covered by separate financial statements. What will be that? First one is consolidation adjustments. That is, you will be having permanent consolidation adjustment and temporary consolidation adjustments. These two will be other information. We will discuss what are these two in the coming slides, and you will also make some disclosures that are to be made in the consolidated financial statements. These disclosures, they will not be there in the standalone financial statements. So this disclosure will become other financial information. Okay. So this is the information that you will use for preparation of consolidated financial statements. Next, responsibility of parent entity with respect to consolidated financial statements. So for preparing consolidated financial statements, what is the responsibility of parent entity? Now, parent entity should identify the components. Okay, it should list down what are all the components that it is having, what subsidiaries it has, what associate it has, what joint ventures it has. It needs to identify all of them. After identifying the components, you need to obtain accurate and complete financial information from these components. Okay, you have to gather accurate information. Next, you should identify reportable segments for the purpose of segment reporting. Then you should also identify related parties and related party transactions for the purpose of disclosure in the consolidated financial statements. Next, you have to make appropriate consolidation adjustments. That is, current period consolidation adjustments, permanent consolidation adjustments. Next, you have to harmonize accounting policies and accounting framework. See, if financial statements are prepared as per different accounting policies, then for preparing consolidated financial statements, let's say a component has prepared its financial statements as per a different accounting framework, and the component, let's say for example, this is accounting policy. Now component has valued its inventory at a cost or NRV, whichever is lower, but parent has valued its inventory at a cost. So different accounting policy followed. Now for preparing consolidated financial statements, you need to harmonize all these accounting policies. Same accounting policy has to be followed. Okay, only one accounting policy has to be followed. So that harmonization of accounting policies and accounting framework will also be the responsibility of management. And gap conversion where applicable. Gap conversion means generally accepted accounting principles. Let's say the company is having a foreign subsidiary. Now foreign subsidiary, it will prepare its financial statements as per foreign gap, right, foreign standards. Now for the purpose of consolidation, you have to convert the foreign subsidiaries financial statements into generally accepted accounting principles that is acceptable in India, right? So that gap conversion is also responsibility of management. Auditor will not do this gap conversion. Okay, so all these are the responsibilities of management with respect to consolidated financial statements. Next, responsibilities of auditor with respect to consolidated financial statements. Now auditor, he needs to satisfy himself that the consolidated financial statements have been prepared as per applicable financial reporting framework. Okay, applicable financial reporting framework means either Ind AS or accounting standards. Okay, the requirements of that applicable financial reporting framework are followed for preparation of CFS. Okay, that needs to be checked by the auditor. Next, express opinion on the true and fair view of these CFS, whether the CFS are showing true and fair view or not. Next, auditor should also report on matters that are present in section 143 subsection 3, just like he reports in case of a standalone financial statements under section 143 subsection 3 of Companies Act. Same reporting. Next, he should also report under section 143 subsection 1. Next, he should verify whether there is the requirement for preparation of consolidated financial statements or not. Okay, only if the company is required to prepare consolidated financial statements, it has to prepare. So whether company is required to prepare or not, you need to see that. Okay, those are the responsibilities of auditor. Next, planning audit of consolidation. Now how you will plan the audit of consolidation? Let us see. You will first of all understand group structure and group wide controls. Group structure means there will be parent entity. Under parent entity there will be subsidiary. For subsidiaries there will be again subsidiary associate, and for parent entity there will be associate, and for some associates there will be subsidiaries. So you need to check the group structure. Okay, this is known as a group structure. You need to understand this group structure and also group wide controls. Next, understanding of accounting policies of parent and its components. Now what accounting policies the parent is following and what accounting policies the components are following, you need to understand these accounting policies. Next, determining the extent of use of other auditors work. Other auditor means for auditor of the auditor of consolidated financial statements will be known as principal auditor, right? And the auditor of components will be known as other auditor. So you need to determine how much work of other auditor has to be utilized. Next, determining the nature, timing and extent of audit procedures to be performed, that is NTE of audit procedures has to be determined. Next, coordinating the work to be performed. You should coordinate with other auditors with respect to the work that has to be performed. So this is how you will plan audit of consolidation. Next, materiality with respect to consolidated financial statements. Now for preparing standalone financial statements with respect to audit of standalone financial statements, you will determine a materiality, right? Whether the same materiality can be used even for audit of consolidated financial statements also, or auditor will determine the materiality for consolidated financial statements separately. The answer is he will determine separate materiality for audit of CFS. See, materiality for standalone financial statements will be done component wise. However, in determination of materiality for CFS, auditor should compute the materiality for the group as a whole. Okay, for the entire group he needs to determine the materiality. Next, materiality at group level can be used to determine whether the components financial statements are material to the group or not. Now for the entire group means what will be included in the group? Parent, its subsidiaries of subsidiaries, associates, joint ventures, all these together will be known as group. Now at the entire group level you will calculate the materiality. Once you have calculated materiality at the entire group level, based on this materiality you will determine whether the financial statements of component are material to the group or not. Okay. Next, materiality would be considered while considering the observation of the component auditor. Okay, you'll also consider materiality while considering observations that have been made by the component auditor. Now, component auditor might have found that there is a misstatement of worth 1 lakh rupees in the financial statements of one of the component. But if you see the entire turnover of the group, it is 100 crores or 1000 crores. Now in that 1000 crores, that 1 lakh misstatement is immaterial. So you will consider the materiality at the group level to determine, or while considering the conclusions, or while considering the observations of component auditor. Next, principal auditor can also compute materiality for each component and communicate to the component auditor. See, if the principal auditor wants, principal auditor means the auditor of CFS, he can calculate materiality for each component and he can communicate this materiality to each component if he wants. Okay, this is materiality with respect to consolidated financial statements. Next, completeness of information. Now auditor, he should verify whether complete information has been included in the consolidated financial statements or not. For this purpose, see, auditor shall verify that all components have been included in the consolidated financial statements. In this respect, auditor shall review working papers for the previous years. Okay, the auditor of CFS, he will see working papers of previous year audit to see whether any subsidiaries or any components have been missed in the current year. Next, parent's procedure for identification of various components. Okay, what procedures the parent organization or parents management is following for identification of components. You'll see that investment of parent as well as its component. Okay, you will also once go through the investments made by the parent and investments made by the component. See, investment means if a company is investing in other company, there is a chance that that other company might become subsidiary or associate if the investment value exceeds 20% of other company or 51% of shares of other company. So you will go through investment account of parent as well as the investment account of component, right? Next, joint ventures and joint arrangements. You will also verify whether there are any joint ventures and joint arrangements. Statutory records maintained by the parent, make inquiries of management to identify any new components. Okay, you'll also make inquiry with the management whether any new component can be identified. Okay, any new subsidiary has been acquired during the year. Okay, next, identify the changes in shareholding. Okay, that means in the previous year a particular subsidiary might be there. Okay, subsidiary means, let's say for example in the previous year the shareholding might be 60%, so it became a subsidiary, but in the current year the shareholding reduced to 40% only, so that will not become a subsidiary. So you need to identify changes that has taken place in the shareholding. Okay, next, consolidation adjustments. Now if you see with respect to these consolidation, there are two types of adjustments. One is permanent consolidation adjustments and another one is current period consolidation adjustments. These permanent consolidation adjustments, they will be made only at once. Okay, at the time of acquisition of a subsidiary you will make these permanent consolidations adjustments, and whenever there is a change in say shareholding in the subsidiary, then also you will make these permanent consolidation adjustments. Whereas temporary current period consolidation adjustments you will make in each and every year in which you are preparing consolidated financial statements. So this is the difference between permanent consolidation adjustments and current period consolidation adjustments. See, Permanent consolidation adjustments made only on first occasion or subsequent occasion in which there is a change in shareholding, whereas current period consolidation adjustments made in accounting period for which the consolidation of the financial statements is done. Okay, for each and every accounting period for which CFS is prepared, you will make current period consolidation adjustments. There is a list of 10 current period consolidation adjustments, and there are 2 permanent consolidation adjustments that you will make. Let us discuss these consolidation adjustments one by one. Starting with permanent consolidation adjustments, I have told you there are 2 permanent consolidation adjustments, right? What are they? First one is determination of goodwill or capital reserve. What is goodwill? Let's say you have purchased subsidiary at a price more than its value of assets or more than its book value, then goodwill will be created. Let's say you have purchased subsidiary at a lesser price, then capital reserve will be created. So this goodwill or capital reserve, it will be calculated only at the time of acquisition, so it is called as permanent consolidation adjustment. Next, the second permanent consolidation adjustment is a calculation of minority interest or non-controlling interest. Minority interest means both are same. Minority interest, you will call it as per AS 21, it is known as minority interest. As per Ind AS 110, it is called as non-controlling interest, NCI. Now, what is this non-controlling interest or minority? Now, subsidiary means, let's say A Limited is holding 60% of B Limited. Now, remaining 40% is held by some other shareholders. So those shareholders who are holding remaining portion of shares are known as minority interest or non-controlling interest. Now, while making these permanent consolidation adjustments, auditor has to give particular attention to pre-acquisition reserves, because these pre-acquisition reserves play a very important role in determination of goodwill. Okay, pre-acquisition reserves and also date of acquisition, these two play a crucial role in calculation of goodwill. You would have observed this in your financial reporting while discussing Ind AS 110 consolidated financial statements. There will be lot of sums in that chapter, right? And you should also examine whether pre-acquisition reserves has been properly allocated between the parent entity and the minority interest. This pre-acquisition reserves, they will be bifurcated between parent entity and minority interest as per their sharing ratio, right? So that bifurcation has to be done properly. Next, verify the subsequent changes in these permanent consolidation adjustments on account of subsequent acquisition or disposal of shares. Okay, in future, if the additional shares have been acquired or if the existing shares have been disposed by the parent entity, then the consolidation adjustments, they have to be done again properly. Okay, so these are the 2 permanent consolidation adjustments. Next, going to current period consolidation adjustments. Before discussing that, there is one point with respect to setting of goodwill with capital reserve. Now, sometimes what happen is, parent entity, it can acquire as many subsidiaries as it want. Now, while acquiring subsidiary 1, goodwill has arisen, and while acquiring subsidiary 2, capital reserve has arisen. Whether these 2 can be set off, goodwill is debit balance, capital reserve is credit balance, whether you can set off these 2 and a net figure can be shown in the financial statements, in the consolidated financial statements, answer is yes, you can set off goodwill with capital reserve. But however, if you have set it off, in the notes you should show gross figure of goodwill and gross figure of capital reserve. Okay, that is the requirement with respect to netting of goodwill and capital reserve. Next, current period consolidation adjustments. I have told you now there are 10 current period consolidation adjustments. What are they? Let us discuss. First one, intra-group interest paid and received or management fee, etc. Let's say A Limited is parent entity, B Limited is subsidiary. A Limited has given loan to B Limited. Now, B Limited will pay interest on that loan to A Limited. Now, this interest will be expenditure in B Limited, income in A Limited. Now, that is okay for standalone financials. But while you are preparing consolidated financial statements, both the financials of A Limited, B Limited will be combined. Now, when you have combined, it is not required to separately show interest expenditure, interest income. You can just strike them off. That is the adjustment with respect to intra-group interest paid, received, or management fee, etc. Next, unrealized intra-group profits on assets acquired or transferred from to other subsidiaries. Same. Now, A Limited has sold an asset to B Limited, which is a subsidiary, at profit. Now, in the A Limited's book, that profit will be shown. While you are combining both these financial statements, that profit need not be shown. You can just set off the profits on acquisition or selling of assets to components. Next, intra-group indebtedness, same. If A Limited has given loan to B Limited, in B Limited it will be shown liability, in A Limited it will be shown as asset. You can just net off them. Next, adjustment related to harmonization of different accounting policies being followed by the parent and its component. I have told you, inventory valuation, parent is making as a cost or inventory, whichever is lower, component is calculating at a cost. So while in consolidated financial statements, you should harmonize them. Okay, you should follow any one type of accounting policy only. Next, that is also current period consolidation adjustment. Now, a question: who will make these current period consolidation adjustments? Management will make. Okay, auditor will not make these current period consolidation adjustments or the permanent consolidation adjustments. Next, in case of foreign component, adjustments to convert foreign GAAP to GAAP under which CFS are prepared. This point we have already discussed in responsibilities of management. Okay, it is a responsibility of management to convert foreign GAAP to Indian GAAP. Next, determination of movement in equity attributable to minorities. Okay, record deferred tax assets, adjustments of deferred tax assets. Okay, adjustments with respect to deferred tax and recording of deferred tax has to be done by management, and it falls under current period consolidation adjustments. So here we have done with 8 consolidation adjustments. Still there are 2 consolidation adjustments. Let us see. Current period consolidation adjustments with respect to subsequent events. Now, what is this? Adjustments to the financial statements of a parent and the components being consolidated for recognized subsequent events or transactions that occur between the balance sheet date and the date of auditor's report on the consolidated financial statements of the group. Now, the balance sheet date, the balance sheet or the financials of component and the parent will be prepared as on 31st March 2024. That will be the balance sheet date of both CFS and standalone financial statements. They will be prepared as on that date. Now, let's say on standalone financial statements, audit report has been given on 30 May 2024. On consolidated financial statements, audit report is being given on 30 June 2024. Now, all the subsequent events that occur between 31st March 2024 and 30 June 2024 has to be adjusted in the consolidated financial statements. Okay, whereas in the standalone financial statements, only those subsequent events that occur between 31st March 2024 and 31st May 2024 will be included, right? So this is a adjustment with respect to subsequent events. There is another adjustment with respect to subsequent events. Adjustment for the effect of transactions or other events that occur between the date of components and the balance sheet and not already recognized in the financial statements and the date of the auditor's report on the group's consolidated financial statements. Then the financial statements of the component are not drawn up to the same balance sheet date as of the parent. What is this? Now, sometimes what will happen is the financial statements of components, it will be prepared as on 31st December. Generally, the financial statement should be prepared as on 31st March, but in some countries, the companies, they will prepare the accounting period for them will be 1st January to 31st December. So the Indian company, it is having a foreign subsidiary which has prepared its financial statements as on 31st December, but consolidated financial will be financial statements has to be prepared as on 31st March. Now, in the consolidated financial statements, all the events that occurred between 31st December and 31st March with respect to that subsidiary should be included. Okay, even they will be considered as subsequent events. So this adjustment is also current period consolidation adjustment. Hope you understood. Again, I'll explain with the help of a timeline. See, the balance sheet of component has been prepared as on 31st December 2023. Okay. And consolidated financial statements and also the parent entities financial statements, they will be prepared as on 31st March 2024. Now you need to consolidate this financial statement and this financial statement, right? Parent entity financial statement and component financial statements, and prepare consolidated financial statements as on 31st March 2024. But balance the financials of component are available only till 31st December 2023. Now all the transactions of component that occurred between this period should be adjusted in the consolidated financial statements. Okay, this you need to adjust, and this however you will adjust. Okay, audit report on consolidated financial statements is being given on 30 June 2024. So the events that occur between the date of balance sheet and the date of audit report, they will be subsequent events. Okay, these events you will however adjust, but along with them, with respect to component, even this event should also be adjusted. Okay, this is a adjustment with respect to subsequent events. Next, impairment loss with respect to goodwill. Now with respect to goodwill, for each and every year you need to verify whether there is a impairment loss. Okay, goodwill is to be tested for impairment loss at every balance sheet date. You should also test whether impairment in the goodwill has occurred because of intra-group losses. Okay, because of loss in the subsidiary, whether the goodwill will get impaired, you need to test that. Next, examine whether any impairment loss has been determined by the parent. If yes, examine the procedure followed. Okay, if the parent has already determined the impairment loss, you need to see the procedure that has been followed by the parent. Next, in case the impairment loss has been determined in foreign currency. Okay, let's say impairment loss has occurred with respect to foreign subsidiary, then you will calculate the impairment loss in foreign currency only. Now while preparing CFS, that impairment loss has to be converted into Indian currency. Now while converting that foreign currency into Indian currency, there will be certain loss that might occur, which you will call as currency translation loss. Okay, at the time of recognizing, the value of INR to dollar will be different with when compared to the value of INR to dollar at the time of preparing financial statements. So while you convert the foreign currency, while you convert the impairment loss that has been recognized in foreign currency into Indian currency, certain currency translation loss can occur, right? So that needs to be transferred or adjusted from currency translation reserve. Okay, next we have another topic with respect to consolidated financial statements, which is reporting. Okay, that aspect we will see from book. Let me open the book. Now regarding reporting, basically if you see here, there are 5 scenarios. So in each of these scenarios, how should the auditor will report, what considerations has to be taken into account by the auditor. Let us discuss each scenario wise. When the parent's auditor is also auditor of all its components. See, when the auditor who is auditing the financial statements of parent is also the auditor of all the uh, components financial statements. So in such a situation, how will the principal auditor reports, what considerations he needs to take into account? See, first of all, whether principles and procedures for preparation of CFS laid down in the accounting standards have been followed or not. You need to verify whether the CFS have been prepared as per applicable financial reporting framework or not, and you should see the requirement as per SA 705. If at all there is any deviation between CFS and the applicable financial reporting framework, and you should also examine whether these CFS are showing true and fair view or not. Okay, this is with respect to the reporting aspect when the parent auditor is also auditor of all its components. Okay, he needs to see whether financial statements CFS are showing true and fair view or not, whether CFS prepared as per applicable financial reporting framework or not. If applicable financial reporting framework is not followed, then you need to check the requirements of SA 705, that is modification of opinion. Next, when parent's auditor is not the auditor of all its components, okay, the consolidated financial statements are being prepared by or being audited by one auditor and the components are audited by some other auditor. In this situation, what should be the reporting consideration of the parent auditor or the principal auditor? Now, the auditor of CFS should consider requirement of SA 600, that is using the work of other auditor. Since the auditor of components is different, the principal auditor is using the work of those component auditors, you need to consider the requirement of SA 600. Next, as per SA 706, if the auditor considers it necessary to make reference to the audit of other auditors, he can make such reference in other matter paragraph, and also you will have to refer the magnitude of a portion of financial statements audited by other auditor. See, the component financial statements are audited by other auditor. Now that work is being used by principal auditor. Now in the principal auditor, in his report, he can mention that this much amount of financial statements are audited by some other auditor. Okay, you can represent this in the form of assets or in the form of liabilities. You can represent like of total assets, 40% of assets audited by some other auditor. Like this, you can quantify the amount of financial statements audited by some other auditor. See, this may be done by stating aggregate rupee amounts or percentage of total assets, revenues, cash flows of components included in the CFS not audited by parents auditor. Okay, you will include the financial statements of component in the consolidated financial statements. So how much percentage of those total assets or total revenue or total liabilities audited by some other auditor, you can mention it in the audit report under other matter paragraph. And such a reference shall not be construed as a qualification. Okay, just because of the fact that you are referring to the work done by other auditor in the audit report under other matter paragraph, it doesn't mean that you are qualifying your opinion. Okay, next, when components auditor reports on financial statements under accounting framework different than that of parent. Now the components have prepared their financial statements as per a different accounting framework, whereas parents financial statements are prepared in a different accounting framework. Now in this situation, you have to, the management of the parent entity has to convert, gap conversion I have told you na. So have to convert the financial statements of a component into the accounting framework that is being followed by the parent entity, and those conversion adjustments will be audited by the principal auditor. See, financial statements are prepared under a accounting framework that is different than that of framework used by the parent. Then parents management shall perform a conversion of audited financial statements from framework used by component to the framework under the consolidated financial statements. Now these conversion adjustments are audited by the auditor. This is one option. Another option is the component itself can prepare its financial statements as per the accounting framework that is followed by the parent entity, and those financial statements will be audited by the principal auditor. See, alternatively, on the basis of prepare, the component will prepare financial statements on the basis of parents accounting policies as outlined in the group accounting manual. Now the local component auditor can then audit and issue audit report on components financial statements prepared in accordance with group accounting policies. Okay, so any of these two alternatives will be used if the component has prepared its financial statements as per a different accounting framework. Next scenario, when component auditors report under auditing framework different than that of parent. See, in the previous scenario, the components have prepared financial statements under different accounting framework. Now in this scenario, auditor, the component auditor is auditing the components financial statements under different auditing standards. Now, the financial statements should be strictly audited only as per the Indian auditing standards for the purpose of consolidating them into the consolidated financial statements. Now here the principal auditor, he needs to ask the management to get those components financial statements audited as per Indian auditing standards, and only then the audit report that the component auditor has given will be used by the principal auditor. Okay, you can find it here. Okay, they should also be audited under framework that corresponds to Indian gas means generally accepted auditing standards. Next, components are not audited. See, if components of financial statements are not audited, then the principal auditor, he cannot obtain audit evidence with respect to component financial statements. Okay, why he needs to obtain audit evidence with respect to component financial statements? Because they are included into CFS while preparing CFS. So if the components are not audited, the auditor of CFS cannot obtain sufficient appropriate audit evidence. So he needs to consider the opinion that he has to give on CFS. Okay, he needs to give modified opinion because he is not able to obtain sufficient appropriate audit evidence. Next, essay 600, using the work of another auditor. Now you already know these definitions: principal auditor, other auditor, component. These definitions you already know. Purpose of essay 600. See, the essay 600's purpose is to establish standards when principal auditor uses to decide the other auditor's work. Okay, how there should be coordination between principal auditor and other auditor, and what communications has to be there between principal auditor and other auditor, and what should be considered by principal auditor when he decides to use the work of other auditor. All these aspects, with respect to all these aspects, essay 600 will establish standards. Now, what matter should be considered by principal auditor while he accepts the audit of consolidated financial statements? Let us see. Materiality of a portion of financial information which the principal auditor audits. Now, in the consolidated financial statements, components financial statements will also be included, which will be audited by component auditor. Now, apart from that component financial statements, how much of the CFS should be audited by the principal auditor? So that materiality needs to be considered. Next, principal auditor's degree of knowledge regarding business of components should also be considered. Next, risk of material misstatement in the financial information of the components audited by other auditor. Okay, what is the risk of material misstatement in the financial statements that are audited by component auditor? Next, the performance of additional procedures as set out in this essay should also be considered by the principal auditor before he accepts the work. Next, principal auditor's procedures. What procedures principal auditor will perform? He will visit component and he will examine books of accounts of the component. He will consider professional competence of other auditor. Now, other auditor has audited the component financial statements. Whether the other auditor is capable and what knowledge the other auditor is having, the competency of the other auditor will be considered by the principal auditor. He will perform procedures to obtain sufficient appropriate audit evidence that work of other auditor is adequate for principal auditor purposes. The other auditor, he has audited the components, but whether that work which other auditor has performed is useful for the purposes of the principal auditor or not, this also will be checked. Next, the principal auditor, he will discuss with the other auditor with respect to what procedures other auditor has performed in the audit of component financial statements. Next, principal auditor should consider significant findings of other auditor. Next, communication by principal auditor with other auditor. See, there should be proper liaison between principal auditor and other auditor. Liaison means proper coordination. Now, principal auditor may find it necessary to issue written communication to the other auditor. Okay, principal auditor can communicate with other auditor through written communication. Principal auditor should advise other auditor of matters that may come to his attention that he thinks are necessary for the purpose of audit of other auditor. Okay, now principal auditor, while conducting his audit of CFS, if he finds any matter and if he feels that this matter is necessary for the purpose of audit of component auditor, then principal auditor has to communicate this matter to the other auditor. Next, the principal auditor may require the other auditor to answer a detailed questionnaire regarding matters on which principal auditor requires information. Okay, if in case the principal auditor prepares any questionnaire, then the other auditor has to answer those questionnaire. Next, coordination of work of other auditor and the principal auditor. Now, the other auditor, if at all he finds any significant findings, he needs to communicate them to the principal auditor. Okay, communicate the significant findings. Next, other auditor should follow the timetable, that is within the given time limit he should complete the audit of component. Next, ensure compliance with relevant statutory requirements. Okay, other auditor should comply with all the statutory requirements, and if in case the principal auditor has sent any questionnaire, the other auditor should answer that questionnaire. Okay. Next, division of responsibility. Now, principal auditor would not be responsible in respect of work entrusted to the other auditor. Okay, the other auditor is responsible for the audit of component. So, with respect to audit of component, principal auditor will not have any responsibility. Now, except in circumstance which should have aroused suspicion about the reliability of work performed by the other auditors. However, if principal auditor gets any suspicion with respect to the work that is done by the other auditor, then with respect to that work where there is a chance of occurrence of suspicion, okay, with respect to that work, the principal auditor will also be responsible. Okay, just by seeing itself you can find out that there is misstatement in the components financial statements, but principal auditor has kept silent because the components financial statements responsibility is not the responsibility of principal auditor. This should not be done. Okay, if there is a chance of arouse of suspicion and even then you kept silent, then the principal auditor will also be responsible with respect to that work, even though that work has been allocated to other auditor. Okay. Next, when principal auditor has to base his opinion on the financial information on the entity as a whole, he can make a reference to the point that there is a division of work that has been done, wherein in the consolidated financial statements, components financial statements have also been included, and the responsibility to audit component financial statements lies with other auditor. Like this, he can mention the division of responsibility for the financial information of the entity by indicating extent to which financial information of component audited by other auditor. Okay, how you will quantify percentage of asset, percentage of liability. Okay, this much percentage of total assets have been audited by component auditor, this much percentage of total revenue is audited by component auditor. Like this, you have to quantify and you can refer to the fact that there is a division of responsibility. Next, reporting considerations. When principal auditor concludes that work of other auditor cannot be used and unable to perform additional procedures regarding financial information of the component audited by other auditor, then the principal auditor should express qualified opinion or disclaimer of opinion. See, the principal auditor, he is not able to use the work of other auditor, and also he is not able to obtain audit evidence with respect to the component by performing alternate procedures. In this situation, he is not having audit evidence, and if the misstatement is material, he will give qualified. If at all there are any misstatements and those misstatements will be material as well as pervasive, he will give disclaimer of opinion. Okay, now in all circumstances, if other auditor issues or intends to issue modified audit report, the principal auditor should consider whether subject of modification is of such nature and significance that it requires modification in principal auditor reports also. Now, if component auditor in his audit report on component has given modified opinion, then principal auditor should consider whether modification given by the component auditor is of such a significance and is of such an importance that the principal auditor should also modify his opinion on the CFS. He needs to consider it before giving opinion on the consolidated financial statements. Okay. So by this we have completed revision of SA 600 also. Okay, we have completed revision of group audit and SA 600. Before winding up the class, there is a small announcement. We have launched Lecturepedia app. On this app, you can solve MCQs of all the subjects of CA Final, CA Inter and CA Foundation. And on this app, you can also purchase classes of various faculties. Okay, you can download this Lecturepedia app from Play Store. And we'll meet in the next revision class. Until then, take care. Bye bye. See you. We'll be revising audit of PSUs in the today's video. We have already discussed all the standards and we have also discussed digital audit and assurance in the previous videos. You can find those revision classes in the playlist. Now we'll start with audit of PSU. PSU means those organizations in which the interest of government is present. They will be known as PSUs, public sector undertakings. Now there are three categories of public sector undertakings. What are those categories of public sector undertakings? Let us see. The first category is those undertakings which are managed by government departments, like railways. Railways is managed by railway department, and postal. The postal is managed by postal department. So these are undertakings, government undertakings for which there is a separate government department, right? That is one category of public sector undertaking. See, departmentally managed undertakings. Next, corporations which are set up under separate act. The government, it has set up certain corporations under a particular act. Examples, LIC, Life Insurance Corporation, it is set up under LIC Act. And UTI, Unit Trust of India, it is also government organization set up under a separate act. Next, National Payment Corporation of India, NPCI, which oversees the aspects related to UPI. It is also a corporation which is set up by government under a separate act. So they are corporations under specific acts. This is second category of public sector undertakings. And third category are government companies. Okay, the companies which are incorporated as per Companies Act and in which government has invested. They are government companies, which is third category. Examples, Coal India, NMDC, National Mineral Development Corporation, BHEL, etc. These are government companies. So these are the three categories of PSUs. Okay. What are the three categories? Firstly, departmentally managed undertakings. Next, corporations set up under separate act, and government companies. Now, what is meant by a government company? See, any company in which either central government or state government or both central government and state government together holds not less than 51% of share capital, then that particular company will be known as government company. Because government is holding higher share in that company, you will call that particular company as a government company. You can find the definition here. Okay, either central government or state government or both central and state government together holds not less than 51% shareholding in any company, then such company will be known as government company. Now, all these three categories of PSUs will be requiring audit, right? Just like any company, any private company requires audit of its financial statements, the financials of these PSUs, the public sector undertakings which we have discussed, either they might be departmentally managed undertakings or they might be corporations or they might be government companies, even their financial statements needs to be audited. right? Now the auditor for these PSUs will be appointed by C&AG. Okay, C&AG means Comptroller and Auditor General of India. C&AG is a separate authority which will oversee the audit in the with respect to these public sector undertakings. So first of all, let us discuss about this C&AG, Comptroller and Auditor General of India. Now if you see, the name of this authority is C&AG, and the position, or you can call the person who is appointed as chairman of this C&AG will also be known as C&AG. Okay, here the name given to the authority and person who is head of this authority, both will be known as C&AG only. Okay, see, if you see, presently in India, the C&AG is Mr. K. Sanjay Murthy. Okay, he is recently in November 2024, he has been appointed as C&AG of India. Okay, he is present C&AG. Hope you understood this concept of C&AG. Okay, Comptroller and Auditor General of India is a separate authority which will deal with the audits of all the PSUs, and the person who is holding or the head of this C&AG will also be known as C&AG. Hope that is clear. See, I have given the note. C&AG is the body, and position of person who is head of this body is also known as C&AG. Now if you see, with respect to this C&AG, there are certain provisions in Constitution of India. There are 5 articles in the Constitution which deals with C&AG. Firstly, article number 148 of Constitution of India. As per this article, C&AG will be appointed by President of India. Okay, in the previous slide we have seen the present C&AG, Mr. Murthy. He will be appointed by whom? The President of India. Next, removal of C&AG can be done only on ground of proven misbehavior. Okay, if there are proofs that the C&AG has misbehaved, C&AG has committed frauds, okay, only if the conviction has been proved, only then you can remove C&AG. Other than that, you cannot remove C&AG. Okay, next, salary and other conditions will be determined by the Parliament. Okay, how much salary has to be paid to the C&AG and other duties will be determined by Parliament. That is article number 148. Next, article number 149. As per article number 149, it will contain the duties and powers of C&AG. Okay, what duties C&AG has to discharge, and in order to discharge those duties, what powers has been given to C&AG. And C&AG's duties, powers and conditions of Service Act 1971 also defines these functions and powers in detail. Okay, there is a separate act by name C&AG Duties, Powers and Conditions of Services Act 1971, which will listed on all the duties and services and powers of this C&AG. Okay, this is article number 149. Next, article number 150 of Constitution. Now, as per article number 150, C&AG will advise the President with respect to how the accounts of all the public sector undertakings, all the government departments has to be maintained. Okay, based on that advice, President will prescribe the same to all the government authorities and public sector undertakings. Okay, see, on the advice of C&AG, President will prescribe form in which accounts of union and states shall be kept. Okay, whether it might be central government or state government. Okay, how their accounts has to be maintained, that will be prescribed by President based on the advice given by C&AG. That is article number 150. Next, article number 151. As per article number 151, audit reports of C&AG should be submitted to President. Okay, audit reports with respect to central government will be submitted to the President by C&AG, whereas audit reports with respect to state government will be submitted to Governor of the respective states, which further shall be laid before either parliament in case of central government and state legislative assemblies in case of state government. Okay. So as per article number 151, the audit reports of C&AG will be submitted to president or governor and they will be laid in parliament or state legislative assembly. Okay. Next, tenure of C&AG. Okay. Now Mr. Murthy is the present C&AG. So what will be his tenure? His tenure will be either for a term of 6 years from the date of his appointment or up to he attains the age of 65 years, whichever is earlier. Okay. Now a person whose age is above 65 years, he cannot be appointed as C&AG. Okay. In order to act as C&AG, his age should be 65 years. So the tenure of the person who is appointed as C&AG is either completion of 6 years from the date of appointment or the time he reaches 65 years of age, whichever is earlier. That is tenure of C&AG. Next, organizations subjected to audit by C&AG. Obviously, all the public sector units are subjected to audit by C&AG. Along with those public sector units, we have discussed in the categories of PSU. The first category is those undertakings which are managed by departments, right? Those departments will also be audited by C&AG. Okay. See, organizations that are subject to audit by C&AG. First of all, union and state government departments. Okay, all the departments of union government, that means central government and state government, will be audited by C&AG. Next, all public commercial enterprises controlled by union and state government. Commercial enterprises means those enterprises which are working on profit basis. Okay, for profit basis. All these enterprises, railways, postal department, LIC, okay, all these are commercial enterprises. Okay, even though they are government organization, their motive is to make money, their motive is to make profits, right? So all these public commercial enterprises will be audited by C&AG. Next, non-commercial enterprises, non-commercial autonomous bodies. Now if you see, the government will also frame certain non-commercial bodies, that means not for profit bodies. Example, National Payment Corporation of India, NPCI. It is non-commercial organization, okay, which has been set up for developing payment methods in India. So one such initiative that has been brought by National Payment Corporation is UPI. It has also brought various other initiatives. And if you see, even our ICAI, Institute of Chartered Accountants of India, is also a non-commercial autonomous body. Its purpose is not to earn profits. Instead, its purpose is to promote education related to accountancy in India. Right. So these non-commercial autonomous bodies will also be audited by C&AG. Next, authorities and bodies substantially financed by central government or state government. Okay, all other organizations in which the state government or central government has invested substantially, even those organizations will also be audited by C&AG. Okay, substantially means more than 51% shareholding, you can say. So all these organizations will be subjected to audit by C&AG. Hope that is clear. Now, generally in case of private limited companies, auditor will be a chartered accountant, right? Now, in case of this government departments, in case of this public sector undertakings also, auditor will be chartered accountant only. Okay, but chartered accountant will be appointed to these organizations by C&AG. Okay, here the term that C&AG will audit the accounts of these organizations doesn't mean that C&AG itself will audit. No, C&AG will appoint auditors. Basically, C&AG will have an empanelment. Okay, all the chartered accountants, they will empanel with C&AG. Okay, you can search in the Google C&AG empanelment. Okay, there you can empanel. Okay, you can list your name with C&AG, and if you are eligible for any audits on a yearly basis, C&AG will allot audits to you. Okay, so for government departments, for PSUs also, audit will be done by chartered accountant only, but C&AG will appoint those chartered accountants. Hope that is clear. Next, committees. Now, to deal with these audit and accounts of public sector undertakings, 3 committees have been established by C&AG, because C&AG itself cannot handle the entire work burden, right? So in order to distribute the work burden, certain committees have been established. What are they? Those committees: firstly, public accounts committee, estimates committee, and committee on public sector undertakings, or you can call it as COPU, right? So these are the 3 committees which we will be discussing now. Now, if you see, the audit reports of C&AG and annual accounts of all the PSUs will be forwarded to these committees, and these committees will analyze those reports and it will forward that analysis to Parliament. Okay, see, audit reports and annual accounts are automatically referred to these committees for scrutiny. Okay, now we will see the duties or functions of each of these committees, starting with public accounts committee. Now, what are the duties of this public accounts committee? Now, this public accounts committee, once it receives the audit reports and the financials of public sector undertakings, it will check whether expenditure that has been incurred was authorized or not. Okay, whatever the expenditure that the public sector undertakings incur, that expenditure should have been authorized by proper officer. Okay, so whether such authorization has been there or not, that will be checked by this public accounts committee. That is the first function. Next, it will also see whether monies were disbursed legally on the purpose to which they were applied. Let's say, for example, government has allotted certain 1000 crore rupees for construction of a particular dam. Now, that 1000 crore rupees has to be utilized only for construction of dam. You should not divert the money. So whether the monies have been properly utilized for the purpose for which they have been allotted or not, this aspect will also be checked by public accounts committee. Next, reappropriation has been made as per the provisions made. Reappropriation means allocation of money. Let's say for construction of dam, the budget was 1000 crores, right? So public accounts committee will see whether the allocation, that means only this 1000 crores has been used, or any extra amount has also been used for that purpose. Okay, even this aspect will be verified, whether reappropriation has been made as per the provision or not, or the allocation has exceeded the provision. Okay, so these are the 3 aspects that will be verified by public accounts committee. Okay, and this public accounts committee will verify this with respect to public sector undertakings. Okay, now all these 3 duties which public accounts committee will perform with respect to public sector undertakings, the public accounts committee will perform these duties with respect to government departments, not public sector undertakings, with respect to government departments. Okay, now all these 3 duties which public accounts committee will perform with respect to government departments, these same duties will be performed by committee on public undertakings for public sector undertakings. Okay, these duties with respect to government departments will be done by public accounts committee, and the same duties with respect to accounts of public sector undertakings, that is the commercial enterprises, government companies. Okay, with respect to those enterprises, the verification of whether expenditure has been properly authorized or not, and whether monies that has been disbursed were properly applied for that purpose or not. Okay, they will be checked with respect to public sector undertakings by Committee on Public Undertakings, scope, the third committee. Okay, we will be discussing that in the third slide. Okay, next committee is estimates committee. Now estimates committee will verify the estimations, the budgets that have been prepared. See, the committee examines the estimates with a view to report what economies or improvements in organization consistent with the policy underlying the estimates may be affected. Okay, economies means by spending 1,000 crore rupees, the government trying to impact lives of some 10 crore people. Now, whether in this program more economies can be gained, like instead of impacting 10 crore people, whether this can be, whether in the same budget can you impact the lives of more people, that is 15 crore people, that is economies. Okay, doing the utilizing the same amount for achieving more scale is known as economies of scale. Okay, so whether that can be achieved with the same budgeted amount will be verified by estimates committee. Next, suggest alternative policies. Okay, instead of implementing this policy which the government is thinking to implement, instead of that policy, if you slightly alter that policy or if you implement some other policy, whether you can get more benefit. Okay, the estimates committee will analyze this and will suggest alternative policies to the government. Next, examine whether the money is well laid out within the limit, the same thing. Okay, whether the money has been expended within the budget or not, that will be verified by estimates committee. Next, the final committee, committee on another one, suggests the form in which the estimates shall be presented to the parliament. Okay, in which format the budgets has to be presented in the parliament, even that format will be suggested by estimates committee. Next committee, committee on public undertakings. I have told you now the duties that PAC, public accounts committee, will perform with respect to government departments. The same duties will be performed by COPU, committee on public undertakings, with respect to public sector undertakings. Okay, apart from that, see, exercises the same financial control on PSU as the PAC exercises over functioning of government departments. Okay, apart from those functions, COPI will also examine reports and accounts of PSUs. Okay, all the reports and accounts of public sector undertakings will be examined by committee on public sector undertakings, and it will also examine reports of C&AG on PSU. Okay, C&AG will submit audit reports on these public sector undertakings, right? Those reports will also be examined by COPU. Next, examine the autonomy and efficiency of PSU. Autonomy means independence. Okay, whether this PSU is working independently or it is showing biasedness towards any party. Okay, the autonomy of PSU and efficiency with which it is working, even this aspect will be verified by COPU. And finally, such other functions vested in PAC and the estimates committee as may be allotted by speaker. Okay, COPU will also exercise those functions which speaker of parliament will allot to the COPU. Okay, so these are the functions of COPU. Next, role of C&AG. What is the role of Comptroller and Auditor General of India? If you see these three committees which we have discussed, these three committees will work on the reports that have been given by C&AG, right? If reports of C&AG itself are not there, there will be no work for these committees. So his reports form the basis for committees working, right? Next, C&AG will also scrutinize the notes which the ministries of government will send to these committees. Okay, now the ministries of committees, they will send notes to the committees, these committees, with respect to the expenditures, with respect to the policies that they are taking up. So those notes will be analyzed and scrutinized by C&AG. Okay, C&AG will help the committees to scrutinize those notes. Next, C&AG will also help committees to prepare reports to be presented to Parliament or state legislature. Now, these committees, they will prepare the reports that has to be placed in the Parliament, because in the Parliament much time will not be available to go through all the reports of all the public sector undertakings. So all the reports will be summarized and a single report will be prepared. So in preparation of that summarized report that has to be presented in the Parliament, the C&AG will help these committees for preparing such report. Not only such report, any other report that has to be presented in the Parliament, in preparation of such reports, C&AG will help these committees. Next, elements of public sector undertaking audits. There are three elements of PSU audits. The first element is people involved. If you see, three people are involved in this public sector undertaking audit. First of all is auditor, and the second person who is involved is responsible party. Responsible party means auditee. Okay, the entity which is subjected to audit is known as responsible party. And the third party who is involved in this PSU audit is users. Who will be the intended users? The public, the government, right? These are the users of the audit reports of C&AG. So the first element of PSU audit is people involved. Who are the people involved? Auditor, auditee, and intended users. Next, second element is subject matter criteria and subject matter information. What is this subject matter criteria and subject matter information? Let me explain this with an example. Now, financial statements. The management, they will prepare financial statements. These financial statements are known as subject matter. Okay, and these financial statements will be prepared as per applicable financial reporting framework, that is accounting standards or Indian accounting standards. That accounting standards or Indian accounting standards are known as criteria. Okay, criteria means benchmark as per which you have to prepare. Okay, financial statements are subject matter, criteria is the accounting standards or Indian accounting standards. Now, if these financial statements are compared with the criteria and it is proved that these financial statements are prepared as per accounting standards, they are in compliance with the accounting framework, then you will call it as subject matter information. Okay, if subject matter is in compliance with criteria, then you call it as subject matter information. Hope that is clear. That is the second element. Third element, types of engagements. Now, there are two types of engagements. First one is attestation engagement. Second one is direct reporting engagement. Now, what is the difference between attestation engagement and direct reporting engagement? In case of attestation engagement, the responsible party will compare subject matter with criteria and he will present subject matter information to the auditor, and the auditor has to verify the subject matter information. Whereas that is attestation engagement. Whereas in case of direct reporting engagement, auditor he himself has to compare subject matter with criteria, and he himself has to create subject matter information. Hope that is clear. So the difference between attestation engagement and direct reporting engagement is that in attestation engagement, the responsible party will compare subject matter with criteria, whereas in direct reporting, auditor himself has to compare subject matter with criteria. Generally, the financial statements audit is a attestation engagement, whereas performance audit, compliance audit, these are direct reporting engagement. Okay, what is this compliance audit, what is this performance audit, we will be discussing. The financial statement audit you already know, right? Note, financial audits are always attestation engagements, just now I told you, as they are based on financial information presented by responsible party, whereas performance audit, compliance audits are generally direct reporting engagements. We will discuss these audits. Next, appointment of auditors. How the appointment of auditors in case of public sector undertakings will be done. See, the statutory auditors of government companies will be appointed by C&AG, and C&AG will also direct the auditor on how the accounts of government company has to be audited. Okay, and report includes the directions, if any, issued by C&AG, the action taken thereon, and its impact on the accounts and financial statements. The auditor of PSUs will be appointed by C&AG. While appointing, C&AG will also direct the auditor on how to audit the financials of the government undertakings, and the audit report that will be issued will also contain directions issued by C&AG and the impact of those directions on the financial statements. Okay, this is with respect to appointment of auditors. Now, if you see in the Companies Act section number 139, which deals with appointment of auditor, there we have discussed appointment of auditor in case of other than government companies will be done by shareholders of the company, whereas in case of government companies, appointment of auditors will be done by C&AG. We have discussed this point, right? The first appointment, it will be made by C&AG within 30 days, and subsequent appointment, it will be made within 180 days from the end of the financial year, right? This provision we have in Companies Act 2013 section number 139, right? Next, supplementary audit under section 143 subsection 6. What is this supplementary audit? Now, C&AG, it has appointed the auditor, and the auditor has conducted the audit, and he has given audit report to C&AG. Now, C&AG, after seeing the audit report, it felt that the auditor has not done the audit properly. There are still some areas that has to be audited. Okay, if C&AG feels so, then it can order for supplementary audit within 60 days. Okay, supplementary audit means order to conduct the audit of that organization again, because the first time the auditor has not done the audit properly. Okay, so such power is available with C&AG as per section 143 subsection 6 of Companies Act. See, C&AG shall within 60 days, the time limit is within 60 days from the date of receipt of audit report, have right to conduct a supplementary audit. And in this supplementary audit, the information that is required for conducting this supplementary audit will be given by such person who has been ordered by C&AG. Okay, C&AG will order particular person of the organization to submit whatever information is required for conducting the supplementary audit. So such a person will submit the required information. Next, on this supplementary audit report, if C&AG makes any comments, those comments should be circulated to all the people to whom the financial statements, the audited financial statements of the organization have been sent as per section number 136 subsection 1 of the Companies Act. See, any comments given by C&AG upon or in supplement to the audit report shall be sent by the company to every person who is entitled to copies of audited financial statements under section 136 subsection 1. Generally, all the shareholders will be entitled to receive audited financial statements. So to all those people, along with the audited financial statements, you should also send the comments that have been made by the C&AG on the supplementary audit report. Okay. Next, test audit. What is this test audit? You need to understand difference between a supplementary audit and test audit. See, supplementary audit is ordered when C&AG feels that the audit was not done properly, whereas test audit will be done to check whether audit has been done properly. Okay, in case of test audit, C&AG doesn't feel that audit has not been done properly. In order to just cross verify whether all the audit has been done properly or not, it will order for a test audit. Okay, in case of supplementary audit, C&AG found out that audit is not done properly, whereas in case of test audit, C&AG doesn't know that audit is not done properly, everything is fine, but in order to just check once, C&AG will order test audit. Okay, it will randomly select some organizations and it will order for test audit of those organizations. See, without prejudice to provisions relating to audit and auditor, the C&AG may, in case of any company covered under section 139 subsection 5 or subsection 7, that means government company, if he considered necessary by an order, could test audit those organization. And for this, the test audit, section number 19A of C&AG Duties, Powers and Conditions of Services Act 1971 shall apply to the report of such test audit. Okay. And types of PSU audits. Basically, there are 5 types of PSU audits. What are those 5 types of PSU audits? First one is financial audit. This financial audit you already know. Audit of historical financial statements is financial audit. Next, compliance audit. We will discuss all these audits one by one. Okay, compliance audit, I will just briefly explain you. In case of compliance audit, the auditor will check whether the entity has complied with law or regulation, whether the entity has complied with certain policy and regulation or not. Okay, so compliance audit will be done to check the compliance with respect to particular aspect. Okay, next, performance audit. See, the performance audit will be done to check the performance of the organization. Performance will be measured in 3 E's. What are those 3 E's? Economy, efficiency, effectiveness. Okay, in case of performance audit, these 3 E's will be measured. Next, comprehensive audit. Comprehensive audit is a combination of compliance audit and performance audit. Okay, you can also call this comprehensive audit as 360-degree audit. And finally, propriety audit. Okay, in case of propriety audit, the auditor will verify the propriety element. Propriety means ownership element, because in case of government, what will happen is the money that is available with the government belongs to general public, right? And that money will be spent by government officers on various issues or on various programs that are beneficial to the public. Now here, in case of these government expenditure, it becomes very much essential to verify whether those government authorities are utilizing that money with propriety element or not. That means, if I am having 100 rupees and that 100 rupees belongs to me, I will spend that 100 rupees wisely. I will not waste that 100 rupees. Whereas, if that 100 rupees is given to me by someone and it doesn't belong to me, then I will utilize it on wasteful expenditure because that amount doesn't belong to me. I will not take ownership. So, in case of government, the government authorities should spend the amount as if that amount belongs to them. That is known as ownership aspect. They have to take the ownership. Okay, that is that will be checked in case of a propriety audit. We'll discuss that in the coming slides. Basically, we'll discuss these remaining 4 types of audit through our book. Let me open the book. Yes. Now let us discuss these types of PSU audits. Firstly, financial audit. This is nothing new which you already know. In case of financial audit, auditor will express audit opinion on financial statements, right? This will enhance the degree of confidence of the users on the financial statements. This is a financial audit. Next, compliance audit. Now in this compliance audit, the main purpose of the auditor will be to verify whether subject matter is in compliance with applicable criteria or not. What will be the applicable criteria? Regularity, that means particular law or regulation. Let's say for example, in our general terms, you are appointed to verify whether income tax act has been properly followed or not. This can be a compliance audit, right? Because you are being appointed to verify compliance with particular law. Okay, this is known as a compliance audit. In the same way, in case of government department also, let's say for example, for particular program or for a particular public policy, there are certain rules and regulations as per which that policy has to be implemented, right? Now the auditor will be appointed to check whether the implementation of this public policy has been done as per that rules and regulations or not. This is known as compliance audit. Okay, here you are verifying whether subject matter is in compliance with the criteria or not. Okay, now this compliance audit, it can be done individually or it can be done along with the audit of financial statements. That means along with the financial audit, you can also do compliance audit, and you can also do this compliance audit in combination with performance audit. Okay, performance audit we'll discuss. Now what will be the compliance audit process? General process. Okay, first of all, general principles and annual compliance audit plan. You will prepare the plan. Next, planning compliance audits, performing audit and gathering evidences, evaluating those evidences, and based on that evaluation you will report, right? This is compliance audit. Next, moving to performance audit. Now, as I have already told you, in this performance audit, you will evaluate the performance of particular organization or performance of particular program. Now, in evaluating the performance, you will verify three aspects. You will measure performance in three terms. What are those three terms? Firstly, economy, efficiency, effectiveness. What is meant by economy? Economy means doing particular activity in as much as lesser cost as possible. Okay, you have to spend lesser amount for doing particular activity, then it is known as doing the activity in a economical way. Okay, this is the first way in which you will measure the performance. See, issues addressed in performance audit or economy: minimizing the cost of resources for particular activity. Okay, in economy you will speak in money terms, and some of the examples, some of the example questions or some of the example areas that you will verify with respect to this economy, or have the best practice prices been obtained for consultancy services. Okay, the government should obtain consultancy services from the people who are offering at lowest price, and that means that it doesn't mean that you should compromise on the quality. Okay, it should also be qualitative and the price should be also lower. Next, is there potential for reducing the cost? Is there any potential or possibility for reducing the cost of sickness absences? Are there procedure in place to ensure that transport cost of food aid are lowest available? Okay, see, these are examples of ways in which you can verify whether lowest cost can be possible in this. Has there been waste of resources in achieving output? Okay, these are some of the ways or some of the areas you will audit in with respect to economy. Next, going to efficiency. What is known as efficiency? Now, in efficiency, it is in terms of input output ratio. Okay, it can be two ways. You have to utilize lesser resources for achieving a given amount of output. Okay, you want to achieve some 100 kg of output, just an example. Now for achieving that 100 kg of output, you are using as much as lower resources as possible. You have to use as much as lower resources as possible. Then it will be said that you have worked efficiently. Okay, resources can be anything, not only in terms of money, in terms of human resources, or in terms of raw materials, whatever it can be. Okay, in terms of time also, right? So economy speaks completely with respect to monetary terms, whereas efficiency speaks with respect to resources. Okay, so that is one way. Another way is, by utilizing the given resources, you have to achieve as much as output as possible. Okay, so there are two ways. It is a input output ratio. Efficiency is achieved when output is maximized at minimum inputs. Okay, for given minimum inputs, you have to maximize the output, or input is minimized for achieving any given quantity of output. Now some of the areas or aspects that you will verify with respect to efficiency are whether there are sound procurement policies followed. Procurement policies means purchase of materials is known as procurement. Okay, sound policies, that means efficient policies should be there for procuring the materials. Next, resources are properly protected. Okay, after you have purchased the resources, they have to be protected properly. Next, human, financial and other resources are used efficiently. Optimum amount of resources are used in producing or delivering the appropriate quantity and quality of output. Efficient operating procedures should be there, and the objective of public sector program are met cost effectively. That is efficiency. These are some of the areas that you will verify with respect to efficiency. Next, effectiveness. What is meant by effectiveness? Now effectiveness doesn't deal with the resources or the cost involved. Effectiveness will just measure how much of the objective has been met, whether you have achieved your goal or not. Let's say you wanted to clear both the groups of CA final. This is your goal, this is your target. You wrote the exams, but you are able to clear only group 1. Now here you are only 50% effective, because you achieved only 50% of the target. Okay, if you cleared both the groups, then you are 100% effective. So how much of the target you have achieved is known as effectiveness. In the same way, in the government programs also, let's say one of the government program is to eradicate poverty. Now how much of the objective has been achieved, that is measuring the effectiveness of the program of the government. Now in this effectiveness, some of the areas are assess whether objectives of and the means provided for public sector program are proper, consistent, suitable or relevant to the policy. See, objectives and means should match. Means means the resources to achieve that objective, that is known as means to achieve the objective. Okay, so your resources should match the objective. Auditor needs to see this. Only if you are having proper resources, you will be able to achieve your target. If you don't have proper resources, you cannot achieve the target. So auditor will see whether objective and means are consistent and suitable or not. Next, determine the extent to which program achieves desired level of results, that is targets. Next, establish with evidence whether observed social economic impacts of policy are due to implementation of policy or due to some other causes. Now the objective is to eradicate poverty. This program will run for 5 years. Now the 5 years has completed. The result is that complete poverty has been eradicated. Now auditor has to check whether the achievement of the objective, that is eradication, actual eradication of poverty, whether that is actual result of the program, or are there any other reasons because of which poverty has been eradicated. Okay, whether some private organizations have helped, okay, because of which poverty has been eradicated. You should see that whether the results achieved are completely due to the program, or other factors are also involved in achieving that result. Okay, in this area also you have to see, in this direction also you have to verify. Okay, if the result is not completely due to the program, then you cannot tell that the program has worked effectively. Even though the result is achieved, that result is not because, that result is entirely not because of the program. So this program is not that much effective. Okay, next, assess whether program completeness duplicates, sorry, whether program complement, duplicates, overlaps other program. Now government has brought a policy or a program to eradicate poverty. Now the steps that the government taking in this program are similar to the steps that the government is taking in some other two other programs. Now this new program will overlap the steps that the government is already taking in other programs, so there should not be duplication. Okay, instead of duplicating, you can just introduce this money in that previous program itself. Why to again create a new program and spend money here, right? So there should not be any duplication. Determine whether management has considered alternatives for carrying out the program that might yield desired results. Okay, whether management has considered other alternatives for implementing this program, and whether management has chosen the best alternative or not. Assess compliance with laws and regulation. Identify ways of making program more effective. Okay, so this is performance audit. In performance audit, you will measure in these three terms: efficiency, effectiveness, and economy. Objective of performance audit. See, the objective of performance audit is to evaluate economy, efficiency, and effectiveness, and also to promote accountability, to promote transparency, and it provides constructive incentives for responsible parties in making appropriate decisions. Next, planning of performance audit. How you will plan for performance audit? Before conducting performance audit, let's say you are conducting performance audit of a government policy to eradicate poverty. Now before doing performance audit, first of all you have to understand that policy. Okay, understanding the entity or the program or the policy. Next, define the objectives and scope of the audit. Okay, what is the objective of this performance audit and which areas you have to verify? That is scope. You have to determine the scope and objective. Then determine audit criteria. Criteria means benchmark. Now for implementing this policy, there will be certain rules and regulations, right? As per that rules and regulations, you have to implement this policy. So auditor has to determine those criteria. Auditor has to understand those policies and procedure. So this can be understood from procedure manuals that are available, policies, standards, directives, and guidelines, criteria used, expert opinion if required, scientific knowledge, and subject matter literature. Okay, from all these sources, auditor needs to gather the criteria. Then deciding the audit approach. So how you will audit? See, you cannot audit all the programs in a same way, in a similar way. Okay, you have to determine your own approach. So some of the approaches are analysis of procedure. You will analyze the procedures or policies that has been implemented, or you can prepare a case study of entire program and you can conduct the audit, or use of existing data, or you can conduct surveys. Okay, you can conduct surveys of public to determine how much this program has helped them, or analysis of results, quantitative analysis, okay, or combination of any of these you have to perform. Okay, you have to select your audit approach. Then developing audit questions. The audit team is required to prepare a list of questions to which they would seek answers. The questions should be framed in comprehensive manner involving detailed hierarchy of questions. Next, assessing audit team skills and whether outside expertise is required. Now, auditor, before doing the performance audit, he has to once verify whether all the people involved in his team is having proper proper capacity and capability to discharge this audit, whether they are competent enough. Okay, you need to once analyze this. If they are not competent enough, you have to replace your audit team with people who are more competent to perform or to discharge the work. Next, prepare audit design matrix. Okay, here I have given the specimen copy of design matrix. Next, establish timetable and resources. Okay, by what time you have to complete the audit, and when should you do each work. The timetable has to be established, and intimation of audit program to audit entities. Here a practical example of performance audit has been given with respect to how you will conduct performance audit of enforcement mechanisms for administering the provision of Minimum Wages Act. Now, there is a particular act known as Minimum Wages Act, which will prescribe minimum amount of wage that has to be given for each type of work. Now, to enforce this act, there is a administrative authority which will ensure that all the factories or whoever people for whom this act is applicable, whether they are properly following this Minimum Wages Act or not. Now, auditor can perform performance audit. Okay, government can appoint auditor to do performance audit of this enforcement mechanism. So, in this case, what points the auditor can verify? See, the auditors who undertake performance audit of program or unit must possess knowledge of the industries or labor contracts where these provisions are applicable. First of all, this auditor should have knowledge with respect to applicability of this act. Then, evaluate evidence available as to nature of returns prescribed and obtained for taking appropriate action. Okay, the auditor, he needs to gather all the evidence that is taken by this enforcement mechanism and how they have worked. Next, evaluate economy, efficiency, effectiveness in the welfare system to be audited. Okay, these three aspects you will verify in this enforcement mechanism. See, whenever performance audit is done, the verification of these three aspects is mandatory. Okay, next, study the shortcomings in the coordination between different agencies like labor department, EPF, ESI organization. If you see these organizations, EPF, ESI, these are also organizations related to employees. So whether there is proper coordination between all these three organizations, auditor needs to verify this aspect also. Next, the auditor shall have to point out lacuna. Lacuna means loopholes. Whether there are any loopholes in the system because of which the performance is being affected, right? You need to point out this. Next, study actual level of compensation required in each area, keeping in mind the local living conditions and where the minimum wages prescribed in the statute is demonstrably different from this level. Now, auditor should say, let's say for example, in a particular area, the minimum wage prescribed by the act is 500 rupees. Now, auditor should verify based on the local conditions whether that 500 rupees is sufficient for a person or for the family to get on to live in that area. So, auditor should analyze this also and prescribe to the authority for changes. Okay, even this aspect will be covered in case of a performance audit. Okay. Next, comprehensive audit. Now, as I have already told you, comprehensive audit is a combination of compliance audit, performance audit and financial audit. Now, what points you will verify in case of a comprehensive audit? Examples. comparison of overall capital cost of project with approved planned cost, and whether approved uh, whether the overall capital cost is exceeding the planned cost. You will see that. Next, how planned production or operational outputs have been achieved. Okay, have you achieved your target? Has planned rate of return is achieved, or the systems of project formulation and execution are sound, or cost control measures are adequate, or purchase policies adequate, research and development programs are proper, and is enterprise is having adequate system of repairs and maintenance, procedures are effective and economical, is there any proof or insufficient project planning. Okay, these are some of the areas that you will verify with respect to comprehensive audit. Next, propriety audit. Propriety audit I have already explained you. What is it? You will verify for ownership aspect in the government expenditure, whether the person or the officer is utilizing the money of the government in the same way with same responsibility as if he exercises for his own money. That is known as the propriety aspect. Now, for this propriety aspect, there are certain principles that needs to be verified. What are they? First of all, the expenditure is prima facie not more than the occasion demands. Okay, the expenditure that the government spends should not be more than the occasion demands. Let's say for a particular program, it requires 100 crores. Okay, generally it requires 100 crores. Now, the occasion demands only 100 crores. You should not inflate the expenditure. Okay, next, the second rule, that the authority exercises its powers of sanctioning expenditure to pass an order which will not directly or indirectly accrue to its own advantage. Okay, the authority who is passing the order should not pass the order in such a way that the benefit of the scheme will accrue to him itself. Okay, the benefit should be for entire general public. Okay, next, that funds are not utilized for benefit of particular person. Okay, the funds should be utilized for benefit of entire public. Next, that apart from agreed remuneration or reward, no other avenue is kept open to indirectly benefit the management personnel, employees or others. That means there should not be any loopholes for bribery. Okay, the government officers, they should get only the actual salary. Apart from that, there should not be any ways through which they can earn amount, they can earn bribe. Okay, so the auditor has to verify these four principles with respect to propriety audit. Now, if you see in Companies Act also, there is this propriety element. If you see section number 143 subsection 1, wherein auditor needs to report only if he finds negative points with respect to these 6 areas. Okay, if auditor finds that there is no negative points with respect to these 6 areas, auditor need not report. Okay, what are those 6 areas? First one, whether loans and advances that are made by the company have been properly secured or not. They should not be prejudicial to the interest of the entity. Next, whether transactions of the company which are represented by mere book entries are not prejudicial to the entity. Mere book entries means, let's say, company has to receive 1 crore rupees from Mr. A and the company has to give 1 crore rupees to Mr. B. Now, what the company has done is, company has asked Mr. A to give that 1 crore rupees to Mr. B and it has adjusted the entry in its books of accounts. Now, these type of transactions which are represented by mere book entries should not be prejudicial. Okay, prejudicial means should not cause loss to the entity. Hope that is clear. Next, see, all these are areas of propriety. Next, where company not being an investment company or a banking company, whether so much of assets of the company as consists of shares, debentures and other security have been sold at price less than at which they were purchased by the company. Okay, now company has purchased shares or debentures of some other company at 100 crore rupees. Now these shares should not be sold at a price less than 100 crore rupees. Okay, if at all the company has sold any of its investments or securities at a price less than the cost of acquisition, auditor needs to report it under section 143 subsection 1. Okay, next, whether loans and advances made by the company are shown as deposits, whether personal expenses charged to revenue account, and where it is stated in the books of accounts or documents that any shares have been allotted for cash, whether that cash has been actually received. Okay, if cash has not actually been received, whether the position has been properly accounted in the books of accounts. Okay, now propriety audit problems. Now if you see, this element of propriety is a moral term. Okay, moral term means, now this morality changes from society to society. Okay, a particular activity which is moral in one society might not be moral in some other societies. Okay, so this propriety is also a moral term. For some people, they might feel that propriety is there in this activity, and some other people might feel that propriety is not there in the same activity. So this is also a subjective decision, right, wherein some people might feel it is okay and some people will feel it is not okay. For example, for a program, the officer has spent 1 crore rupees. Now whether this 1 crore rupees is the proper amount or the officer has spent more than the required amount, making this decision is subjective. Okay, one person might feel that 1 crore rupees is completely okay for this program, considering the effect that this program is having, and other person might feel that 1 crore rupees is more than the required. Okay, you can do this program in just 50 lakhs, right? So this measuring the propriety element is a subjective decision, and with respect to these subjective activities, you cannot establish rules and regulations, right, based on the circumstances and based on the professional judgment of the auditor. He needs to conduct the audit, right? So this is one of the problem to establish rules with respect to propriety audit. It is a subjective term and it is also moral term. Okay, and this morals will change from time to time, right, as the time progresses. If you see, the activities which are considered as moral some 100 years back might not be moral now, and activities which are considered immoral some 100 years back will be moral now. Like some 100 years back, women going out for work is immoral, it is not accepted in the society, but the same activity is now moral, right? So this propriety term is also like that only. Okay, you have to constantly check whether it is moral or immoral in the society. Based on that, you need to develop the rules. Okay, since this propriety involves morality, it becomes difficult to develop rules in this propriety area. But however, C&AG, it has developed certain norms of propriety for conducting this propriety audit. And contents of, so these are the 5 types of audits, 5 types of PSU audits. Finally, the final concept, contents of audit report of C&AG. Now C&AG, it will submit the audit report to Parliament, right? And I have already told you, the people in the Parliament, they will not be having much time to go through each and every report that is prepared by C&AG. There will be thousands of government departments. For each government department, C&AG will conduct audit and audit report will be given. Now this, if you combine all those audit reports, it will become lot of documentation. So all the documentation can't be read in the parliament. So what they will do is, from all these reports, they will gather important points, significant points, and they will prepare summary report of all those reports. And this summary report will be presented in the parliament. So what will be the contents of this summary audit report? Let's see. Firstly, there will be introduction containing general review of working results of government departments. Okay, in the introduction, you will give during this year how government departments have worked, what is the performance of government departments. You will give a bird's eye view of the working of government department. Okay, that is the first section of audit report, which is introduction containing general review of working results of government departments. Next, results of comprehensive appraisal of selected undertakings conducted by audit board. Now audit board, it will select certain undertaking and it will conduct comprehensive appraisal of certain undertakings. Okay, comprehensive appraisals will not be conducted for all the organizations, only for certain selected organizations. So results of those comprehensive appraisal will be given in the audit report. Next, it will also give significant results of audit undertakings not taken up for comprehensive appraisal. Okay, the particular organization has not been taken up for comprehensive appraisal, but there are certain significant points in the audit of that undertaking that has been conducted. So even those significant results will also be included in the summary audit report, even if it has not been taken up for comprehensive appraisal. Next, resume of company auditors report submitted by them under the directions issued by C&AG. Now it will summarize the points given in all the audit reports and it will prepare a resume of company auditors reports. Okay, so these are the contents of audit report of C&AG. By this we have completed revision of audit of PSU. Before winding up, a small announcement: we have launched Lecturepedia app. In this Lecturepedia app, you can solve MCQs of all the subjects of CA Final, CA Inter and CA Foundation, and along with that you can also purchase classes of various faculties on Lecturepedia. You can download Lecturepedia app from Play Store. We'll meet in the next revision class. Until then, take care. Bye bye. See you. In the today's class, we'll be revising Audit of NBFC. We'll be revising this chapter from Audit Concise book. Okay. And before revising the chapter, a small information: we have recently launched Lecturepedia app. On this Lecturepedia app, you can solve MCQs of all the subjects of CA Final, Inter and Foundation, and apart from this you can also purchase classes of various topmost faculties, and you can download this Lecturepedia app from Play Store. Okay, now without any waste of time, let us quickly start with the revision. Now NBFC. Now first of all, what is meant by a NBFC? Definition of NBFC. Now NBFC is a financial institution, but it is not a banking company. Okay, NBFC is a financial institution but not a bank. However, NBFC is a company. Okay, so it is a financial institution, not a bank, and it is a company, and its primary business will be accepting deposits and lending money. These are the characteristics of NBFC. Apart from these, those types of companies which have been specifically notified by central government as NBFC will also be treated as NBFC. Hope that is clear. So this is the definition of NBFC. Now, in order to call a particular company as a NBFC, there is principal business criteria. Okay, this principal business criteria has to be satisfied in order to call a particular company as a NBFC. What is this principal business criteria? There are two conditions. First condition, 50%, okay, more than 50% of its total assets should constitute financial assets. Now what is meant by financial assets? Financial assets examples: debtors or loans given. Okay, these are financial assets from which that the amount is realizable to you will be known as financial assets. So of the total assets, more than 50% must constitute financial assets. That is the first condition. Second condition, now of the total income, more than 50% income should come from these financial assets in the form of interest, dividends, etc. Okay, so if these two are the principal business criteria of NBFC. Now if you satisfy this principal business criteria, you need to obtain a certificate of registration from RBI as per section number 45 IA. Now without obtaining certificate of registration, you cannot start the business of NBFC, and you should also have minimum net own fund of 2 crore rupees. Only if you have minimum net own fund of 2 crore rupees, and if you satisfy this principal business criteria, then RBI will issue the certificate of registration to you. Hope that is clear. Now this minimum net own fund of 2 crore has been increased to 10 crore rupees for certain categories of NBFC. What are those categories of NBFC in respect of which the net own fund requirement has been increased to 10 crore rupees? Basically a glide path has been given. As per that glide path, NBFC which is ICC, that means investment credit company, for those NBFCs currently the net own fund requirement is 2 crore rupees. It has to be increased to 5 crore rupees by 31st March 2025 and 10 crore rupees by 31st March 2027. A timeline has been given. Okay, through that timeline you have to increase the net own fund requirement from 2 crore existing to 10 crore. And in case of NBFC which is microfinance institute, presently the net own fund is 5 crore and 2 crore rupees for northeastern states. It has to be increased to 7 crore by 2025 and 5 crore in case of northeastern region, and by 2027 it has to be increased to 10 crore. Now what are those northeastern states? Arunachal Pradesh, Assam, Manipur, Meghalaya, Mizoram, Nagaland, Tripura, Sikkim. These are the 9 northeastern states. Okay, NE region means northeastern states. And for NBFC factors, currently the net own fund requirement is 5 crore rupees. It has to be increased to 7 crore rupees by 2025 and 10 crore rupees by 2027. Okay, this is the glide path that has been given, wherein through this glide path you have to increase the net own fund requirement of these specified NBFCs to 10 crore rupees by 2027. And net own fund requirement of certain NBFCs like NBFC IFC, that means infrastructure finance company, and infrastructure debt finance NBFC, and non-operating financial company. For these 3 types of NBFCs, the net own fund requirement is 300 crore rupees. Hope that is clear. And you have to apply to RBI once you satisfy these conditions for getting certificate of registration, and you cannot start your business of NBFC without getting certificate of registration. Hope that is clear. Next, now certain companies have been specifically excluded from getting registration from RBI. Why? Because those companies are already under the control of certain authority. There is a separate act and separate authority for controlling those companies. Okay, even though those companies are satisfying the definition of NBFC, they are not required to get a certificate of registration from RBI, because there are separate authorities for controlling those those companies. What are those exempted category of companies which need not get a certificate of registration from RBI even though they are satisfying these requirements of NBFC? Firstly, housing finance institution. For controlling this housing finance institution, there is National Housing Bank, so they need not get certificate of registration from RBI. In the same way, merchant banking companies are controlled by SEBI, so they need not get certificate of registration from RBI. In the same way, stock exchanges, companies engaged in business of stock broking. Okay, stock broking companies like Zerodha, Grow, okay, all these, they are regulated by SEBI, so they need not get certificate of registration from RBI even though they are satisfying the requirements of NBFC definition. Next, venture capital funds, Nidhi companies. See, these Nidhi companies are governed by Ministry of Corporate Affairs. If you see in Companies Act, there is separate chapter for these Nidhi companies, right? Next, insurance companies. For regulating insurance companies, there is Insurance Development Regulatory Authority, IRDA. So that particular authority will control the insurance companies. So for them, the certificate of registration from RBI is not required. Next, chit fund companies. For chit fund companies, there is a separate act, Chit Fund Act. In the same way, microfinance companies, securitization and reconstruction companies, mutual benefit companies, mortgage guarantee companies, and core investment companies with asset size of less than 100 crore and those with asset size of 100 crore and above but not accepting public deposits. First of all, what is a core investment company? There is a definition for a core investment company. This core investment company, its major business will be to acquire shares and securities. Now, in order to call a particular company as a core investment company, it has to satisfy 4 conditions. What are they? Now, of the total assets, it should hold 90% of its total assets in the form of investment in equity shares and other securities in its group companies. Okay, this is the first condition. Whatever the shares they might be, okay, equity shares or preference shares or even in the debentures or any other form of securities, but of the total assets, 90% of its assets should represent investment in these category of securities. Next condition, of these 90% investment, not less than 60% must be in the form of investment in equity shares. See, equity shares in group companies and units of infrastructure investment trust as a sponsor constitute not less than 60% of its net assets as mentioned in one above. That means of the total 90% investments that we have discussed, 60% should be in the form of equity share investment in group company or infrastructure investment trust. Okay, investment in the units of infrastructure investment trust. This is the second condition that it has to satisfy. Next, the third condition is it should not trade in its investments. Okay, it should not frequently trade in its investment. It has to invest for the purpose of holding them for long term purposes, and it does not carry any other financial activity apart from investment in shares and securities. Okay, if all these conditions are satisfied, then you will call that particular NBFC as core investment company. Now, this core investment company whose net worth is less than 100 crore rupees, they will not be regulated by RBI, so they need not get certificate of registration from RBI. If their asset size is more than 100 crore and they are not having access to any public funds, then also they are not required to get certificate of registration from RBI. If their asset size is more than 100 crores and they are having access to public funds, that means they are accepting deposits from the public. In such a situation, they have to get certificate of registration from RBI. Hope this is clear. And finally, alternate investment fund companies. All these companies, they need not obtain certificate of registration from RBI. Next, bank versus NBFC. Now, if you see, both bank and NBFC, their business will be similar. Bank will also accept a deposit and will give loans. NBFC will also accept deposits and will give loans. But what is the difference between a bank and NBFC? First of all, banks, they can accept saving deposits. That means demand deposits banks can accept, but NBFCs, they cannot accept demand deposits. They can only accept term deposits. That is the first difference. Next difference, banks are part of payment and settlement system, but NBFCs are not part of payment and settlement system. What is payment and settlement system? That means for bank, you can issue check, but NBFC will not be having a check. Next, bank will be having a ATM card wherein you can withdraw money, but NBFC is not having ATM card. Bank will be part of UPI network, but NBFC is not part of UPI network. Okay, so that is another difference between bank and NBFC. Next difference, the minimum lending to priority sector is not applicable to NBFC. What is this lending to priority sector? In our India, the priority sector is agriculture, let's say. Now, there is a requirement on banks that of the total loans that they give, certain portion of loan should constitute agriculture loans, like 5% or 10% of total loans that have been given by the company should be agriculture loans. Okay, that is known as lending to minimum exposure to priority sector lending. But such priority sector lending, minimum priority sector lending is not applicable to NBFCs. Hope that is clear. Next, the deposit insurance facility is not applicable for deposits with NBFC. What is this deposit insurance facility? We have discussed about this in banking, Audit of Banks chapter. There is Deposit Insurance and Credit Guarantee Corporation, DICGC. Now, what this DICGC will do is, it will insure all the deposits up to 5 lakh rupees that have been made with a banking company. So, in future, if bank becomes bankrupt and if it is not able to give or repay the deposits to the deposit holders, then DICGC will give the amount to the deposit holders because DICGC has insured those deposits. Such facility of insurance by DICGC is not available for NBFCs, okay, for the deposits made with NBFC. These are the differences between bank and NBFC. Hope this is clear. Next, coming to type of NBFC. Now, if you see, the classification of NBFCs has been done in 3 ways. Firstly, based on acceptance of deposits, you can classify the NBFC into NBFCs that are accepting deposits, NBFCs that are not accepting deposits, and NBFCs that are not accepting deposits but they are systematically important. Systematically important means those NBFCs whose net worth is more than 100 crore will be known as systematically important. So the first category is NBFC-D, NBFC-ND and NBFC-NDSI. Okay, NBFC-NDSI means not accepting deposits but they are systematically important. Okay, this is the first type of categorization of NBFC. Next categorization is based on the business activity that the NBFC will conduct. You can categorize NBFC into investment credit company. Okay, these types of NBFC, they will invest in various assets and they will also give loans to the public. That is investment credit company. Next, infrastructure finance company, which will give loans for purpose of infrastructure. Next, systematically important core investment company. We have already discussed this. Next, infrastructure debt fund NBFC. That means it will give debt fund to infrastructure projects. Next, non-banking financial company, microfinance institution. That means it will give loans of small ticket size. Next, NBFC factors, which will purchase the financial assets of various companies. That is factoring business. Next, NBFC non-operative financial holding company, which will invest in the group companies. Okay, these are the categorization of NBFC based on the business activity that it will do. Next, third type of classification is classification as per scale based regulation. Now, what is this scale based regulation? This is quite important. Okay, this scale based regulation is quite important. What RBI has done is, in order to regulate NBFCs, it has categorized NBFC into 4 layers. One is base layer, middle layer, upper layer and top layer. Now, what are these layers? For the NBFCs that are in base layer, the regulation by RBI will be less. Okay, the regulation, the rules that RBI will keep on these base layer NBFCs will be less. That means RBI will not regulate these NBFCs much. But NBFCs which are in middle layer, the regulation by RBI will be somewhat high. Next, NBFCs that are in upper layer, even more regulation by RBI. And top layer, the regulation, the RBI will completely regulate these NBFCs which are in top layer. Okay, so for the purpose of regulating the NBFCs, it has categorized NBFCs into 4 layers. First layer is base layer. Which types of NBFC will be categorized into this base layer? First one, those NBFCs which are not accepting deposits and whose net worth is below 1000 crores. Those NBFCs will always be in base layer. Next, NBFCs which are into the business of peer-to-peer lending, that is P2P lending. There are various platforms wherein peer-to-peer lending is offered. That means if you are having money, you can register into that app and you can find the people who are in requirement of money and you can lend your money to those people and they will repay to you that money along with interest. So that is known as a peer-to-peer lending. There are various platforms for this. So those NBFCs that are into peer-to-peer lending will be always categorized into base layer. Next, NBFCs that are account aggregator, they will also be into base layer. Account aggregator means, let's say you wanted to check your entire net worth. So let's say you are having 5 bank accounts. Now, instead of going to each bank account and checking your bank balance, you can link all those bank accounts to this account aggregator. And you can also link all your demat accounts to this account aggregator. So you can link all your financial assets and you can track your entire net worth in single app. those types of NBFCs which are providing these services are known as account aggregators. They will also be classified into NBFC base layer. Next, NBFC non-operative financial holding company, they will be holding shares and securities of group companies. They will be known as non-operative financial holding company. They are also categorized into base layer. Next, NBFCs which are not availing public funds and not having any customer interface. Okay, those NBFCs which are not accepting any deposits, that means non-deposit accepting, and they are also not having any interface with the customer or the public. Okay, they are not interacting with the customers or public. They are also categorized into base layer. Next, middle layer. In the middle layer, all the deposit taking NBFCs will be categorized into middle layer. Okay, if you are accepting deposits, then you will be categorized into middle layer. Next, non-deposit taking NBFCs whose asset size is more than 1000 crores, then they will be categorized into middle layer. If your asset size is less than 1000 crore, then base layer. More than 1000 crore, middle layer. Next, NBFCs which are standalone primary dealers. Standalone primary dealers means they will be dealing in purchasing and selling of government securities and government bonds. They will be known as SPDs. They will be categorized into middle layer, and they will be always in the middle layer only. Next, infrastructure debt fund NBFCs which will be giving loans for the purpose of infrastructure, they will also be always categorized in middle layer only. Next, core investment company, we have already discussed. They will be changing from middle layer to upper layer. Okay, sometimes they will be in middle layer, sometimes they will be in upper layer based on certain conditions. We will see. Okay, if the conditions of upper layer are met, then these core investment company will shift to upper layer. If they are not met, it will shift to middle layer. Next, housing finance company which will give loans for the purpose of construction of house, they will also be either in middle layer or upper layer. Next, infrastructure finance companies, they will also be either in middle layer or upper layer. Next, upper layer. Now, which companies, which NBFCs will be categorized into upper layer? See, upper layer shall comprise of those NBFCs which are specifically identified by Reserve Bank as warranting enhanced regulatory requirement based on set of parameters and scoring. Okay, if Reserve Bank feels that any of the NBFC requires more regulation, then Reserve Bank will itself shift the NBFC from base or middle layer to upper layer. Okay, hope that is clear. In upper layer, those NBFCs which are specifically identified by RBI as having more risk will be categorized into upper layer. And top layer, in most of the cases it will remain empty only. But however, this layer can get populated if Reserve Bank is of the opinion that there is a substantial increase in potential systematic risk. Okay, systematic risk means the risk that you cannot diversify is known as systematic risk. So if the NBFC feels that there is a significant increase in the systematic risk of any particular NBFC, okay, if RBI feels so, then it will categorize or it will shift that particular NBFC into top layer. If any NBFC has come into top layer, then it will be highly regulated by RBI. Okay, so this is the categorization of NBFC, and here is a particular point. These NBFCs, okay, NBFC P2P, account aggregator, non-financial holding company, NBFC without public and customer interface will always remain in base layer only. Okay, these NBFCs, they will be always in base layer only. Okay, the RBI, it cannot shift them from base layer to upper layer. Next, NBFC deposit taking CIC, IFC, HFC will be included in middle layer or upper layer and not in the base layer. Okay, these NBFCs, they will be in middle layer or upper layer but not in the base layer, as they may be, as the case may be. Next, SPD, that means standalone primary dealer, and IDF NBFC will always remain in middle layer. This point we have already discussed. Next, remaining NBFCs, that is investment credit company, microfinance institution, NBFC factor, mortgage guarantee company, could lie in any of the layers of the regulatory structure depending on the parameters and scale based framework. Okay, these remaining NBFCs apart from 1 and 2, they can be shifted from one layer to another layer by RBI based on the risk level. Next, government owned NBFCs shall be placed in base layer or middle layer. Okay, if any NBFC is owned by government, then that NBFC will lie either in base layer or in middle layer. Okay, they cannot be placed in upper layer. Hope that is clear. Next, coming to prudential norms. Now, there are three prudential norms. First one is with respect to capital requirement, next one is income recognition, and third one is provisioning requirements. Now, capital requirements means how much capital NBFC should have. Okay, how much tier 1 capital, how much tier 2 capital, how to calculate tier 1 capital, how to calculate tier 2 capital. All these we will be discussing in capital requirements. Next, income recognition on NPS. Okay, basically you should not recognize income on NPS until and unless it is actually realized. That is income recognition norm. Next, provisioning requirements. Okay, with respect to NPS, how you should provide provisions. Basically, there will be classification into standard, substandard, doubtful, loss assets, and there will be certain provision, percentage of provision for each of this category. That we will be discussing in provisioning requirements. Okay. Now, let us start these prudential norms. Firstly, with capital requirements. Now, there are two types of capitals. One is tier 1 capital and another one is tier 2 capital. Now, all the NBFCs, they should maintain not less than 15% of risk-weighted assets as on balance sheet date as a tier 1 and tier 2 capital. Okay, tier 1 and tier 2 capital both taken together should not be less than 15% of risk weighted assets. Now, what are these risk weighted assets? What RBI has done is, for each asset it has given a particular risk weight. You have to multiply with that risk weight and you have to calculate the entire risk weighted assets. Now, after you have calculated the total risk weighted assets, on this risk weighted assets, minimum 15% should be tier 1 and tier 2 capital. Here you can see, for cash the risk is 0. That means the amount of cash that will be included into risk weighted assets is 0. Next, for bonds of public sector banks, risk weighted asset is 20%. That means if the company, the NBFC is having investment in bonds of 100 crore rupees, then for calculating risk weighted assets, only 20 crore will be included. Next, for fixed deposits, 100%. Next, 100%, 50%. Like this, for each asset a specific risk weight has been given. If you see, for consumer credit exposure, it is 125%. Okay, if the exposure to consumer credit is let's say 100 crore, then 125 crore will be included for calculation of risk weighted assets. Okay, like this I have given the entire list. Okay, so this way you have to first of all calculate risk weighted assets, total risk weighted assets. Let's say total risk weighted assets of NBFC is 1000 crore. Now, on this 1000 crore, 15%, minimum 15% should be tier 1 and tier 2 capital taken together. Hope that is clear. Next, tier 1 capital alone should be minimum 10% of risk weighted assets. Okay, tier 1 capital alone should not be less than 10% of risk weighted assets. However, this is not applicable for NBFC mutual NBFC microfinance institute and NBFC primarily engaged in lending against gold jewelry. Now, for NBFCs that are primarily engaged in lending against gold jewelry, they have to maintain minimum 12% of tier 1 capital alone. See, this 10%, 12% is tier 1 capital alone. This 15% is tier 1 and tier 2 taken together. Hope that is clear. Now, what is meant by NBFC? That is primarily engaged in giving loans against gold jewelry. If of the total loans, at least 50%, that means more than 50% loans should be in the form of loans against gold jewelry, then you can consider such NBFC as NBFC primarily engaged in lending against gold jewelry. Okay, so such a type of NBFC has to maintain minimum tier 1 capital as 12%. Now, okay, you have you know how much percentage of tier 1 and tier 2 capital has to be maintained. Now how to calculate the tier 1 capital? You are telling that 12% of risk weighted asset should be tier 1 capital and 15% of risk weighted asset should be tier 1 and tier 2 capital taken together. First of all, what is this tier 1 capital and what is this tier 2 capital? Let us see that. If you see, I have explained this in the amendment lecture. Basically, this portion is there, calculation of tier 1 capital and tier 2 capital. It is newly introduced in our ICAI study material. Let me just take you to that PDF. Yeah, here in the amendment class I have explained it with an example. Let us use the same example because it is a revision class. Again, why to waste the time by writing the example again? So if you see tier 1 capital, I'll go a little bit slow here because this is the amendment. See, now what will be included in the tier 1 capital? Tier 1 capital for NBFCs except NBFC base layer is sum of following. What is it? Firstly, owned fund as reduced by investment in shares of other NBFC. Okay, you have to first of all take the owned fund of the NBFC. From this owned fund, you have to reduce investment in shares of other NBFC. If you see the example, let's say owned fund of the NBFC is 200 crore. Now, from this 200 crore, let's say investment in shares of other NBFC is 5 crore rupees. Okay. So, what I have done from 200 crore, okay, for calculating tier 1 capital, from 200 crore, I have first of all reduced 5 crore. After that, second point, you should reduce investment in other shares, in shares of other NBFCs, and you should also reduce the following. Okay, if you observe here, they are using the term and. You should also reduce investment in shares, debentures, bonds, outstanding loans, advances including hire purchase and lease finance made to and deposits with subsidiaries and companies in same group exceeding in aggregate. That means all these from here to here, all this total is there, na? Just a second, not here. Here to here, all these in aggregate exceeding 10% of the owned fund. That means first of all you have to calculate total of all these. Now total of all this is, see, investment in shares, debentures, advances, outstanding loans, all these is, let's say, 30 crore rupees. Now this 30 crore rupees exceeding 10% of own funds has to be reduced. That means for this purpose you have to first of all calculate 10% of own funds. 10% of own funds means, see, our net own fund is 200 crore. So by applying 10% on net own fund, you will get 20 crore, right? So the investment in shares, debentures, advances, outstanding loan exceeding 10% of net own funds. That means 30 crore minus 20 crore, which is 10 crore. So you should reduce 10 crore from this owned fund. So I have reduced 10 crore from the owned fund. So 200 crore minus 5% minus 10 crore, you will get 185 crores. This is not the tier 1 capital. This is just first part of tier 1 capital. Now for this 185 crore, you should also add perpetual debt instruments. Okay, this is first part of tier 1 capital. For this 185 crore, you should add, what you have to add? B point you have to add. What B says? Perpetual debt instruments. Perpetual debt instruments means, let's say for example, debentures, they are irredeemable. You will not redeem the debentures. They are irredeemable debentures. Then they will become perpetual debt instruments. Now these perpetual debt instruments issued by non-deposit taking NBFC in each year, to the extent it does not exceed 15% of aggregate tier 1 capital of such company as on 31st March of previous accounting year. See, now Let's say you are calculating this tier 1 capital for the financial year 23-24. Now for this financial year 23-24, first of all you have to take what was the tier 1 capital for financial year 22-23, previous financial year. Now for previous financial year, okay, tier 1 capital for financial year 22-23, that is previous financial year, is 200 crore. Now 15% of 200 crore, 15% of 200 crore is 30 crore. Now let's say the perpetual debt instruments that are issued during the current year, you have to take only the perpetual debt instruments that are issued during the current year, not during the previous year or during any of the previous years. Okay, for the calculation of tier 1 capital, you have to take only perpetual debt instruments that are issued in the current year for which you are calculating for which you are calculating tier 1 capital. Let's say perpetual debt instruments issued in the current year is 100 crore. Now what point B says? Perpetual debt instruments issued by NBFC in each year, to the extent it does not exceed 15% of aggregate tier 1 capital of such company of the previous year. That means 15% should not be exceeded by this perpetual debt instrument. If you see 15% of 200 crore is 30 crore and perpetual debt instrument that you have issued is 100 crore. So maximum amount of perpetual debt instrument that you can add for this tier 1 capital is 30 crore only, because the perpetual debt instrument that you add to tier 1 capital should not exceed 15% of tier 1 capital of previous year. So 15% of tier 1 capital of previous year is 30 crore, and in the current year we have issued perpetual debt instruments of 100 crore. So maximum amount of perpetual debt instrument that we can add to the tier 1 capital is only 30 crore. Hope that is clear. Let's say for example we have issued only 20 crore of perpetual debt instruments in the current year. In that case you can add this entire 20 crore to tier 1 capital, because this 20 crore is less than the 30 crore. Okay, if the perpetual debt instrument is exceeding the 30 crore, then you can add only 30 crore, up to 30 crore in the tier 1 capital. Now what about the remaining 70 crores? See, of the entire 100 crore of perpetual debt instruments, 30 crores, okay, 30 crore you are including in tier 1 capital. What about remaining 70 crore? This remaining 70 crore will be included in tier 2 capital. Hope that is clear. So this is how you will calculate tier 1 capital. So for this 185 crore, I will also add 30 crore and 215 crore. This is the tier 1 capital. So this tier 1 capital is there, na? This tier 1 capital should be 10% of risk weighted assets. Okay. Now I hope you understood the requirement. Now moving to calculation of tier 2 capital. Hope you understood this. Now for all NBFCs, these two should be added for calculating tier 1 capital. But for NBFCs which are in base layer, you should not consider point B. Okay, only point A constitutes tier 1 capital. Hope you understood. See, for NBFCs which are in base layer are not eligible to include perpetual debt instruments in tier 1 capital. Okay, next, tier 2 capital. How to calculate tier 2 capital? What will be included in tier 2 capital of all NBFCs except NBFCs that are in base layer? First of all, you will include preference shares other than those which are compulsorily convertible. Next, you will also include revaluation reserve at a discounted rate of 55%. Let's say in your books of accounts you are having 100 crore as revaluation reserve. That means 55% of 100 crore will be 55 crore. So you will include 55 crores in tier 2 capital of this revaluation reserve. Next, general provisions and loss reserves that you have made, to the extent these are not attributable to actual diminution in value of identifiable potential loss on any specific asset and are available to meet unexpected losses, they will also be included in tier 2 capital, okay, provided they are available to meet the losses. Okay, next, hybrid debt capital instruments, subordinated debt. Subordinated debt means this debt will be having certain lesser rights. Okay, let's say generally for debentures you have issued, the normal debentures, the rate of interest that you offered was 15%, but for subordinated debt you will offer lesser interest rate and their rights will also be less. And for subordinated debt, these subordinated debt holders will be repaid only after normal debenture holders have been repaid. So the rights of subordinated debt holders will be less when compared to the normal debt holders. Okay, so even this subordinated debt should also be included into tier 2 capital. And finally, perpetual debt instruments. In the tier 1 capital, we have not included the portion that is exceeding 15% of perpetual debt instruments. So that portion which has not been included in the tier 1 capital will be included in the tier 2 capital. Hope that is clear. And for calculating tier 2 capital of base layers, this will not be considered. This portion will not be considered. Hope that is clear. If you can find here, NBFC base layer are not eligible to include perpetual debt instruments in tier 2 capital. Okay, see the difference between tier 1 and tier 2 capital of all NBFCs and tier 1 and tier 2 capital of NBFCs which are in base layer is that NBFCs that are in base layer, for calculation of their tier 1 capital, perpetual debt instrument should not be included. In the same way, for calculation of their tier 2 capital, perpetual debt instrument should not be included. Hope that is clear. And the risk weighted asset, I have already discussed this with you. Next, income recognition. Now in this income recognition, the first point that you need to remember is, if an asset has become NPA, you should not recognize interest on that NPA until and unless it has actually been received. Next, if let's say you have recognized interest on a particular loan, at the time of recognition it was not NPA, but that interest which you have recognized is not yet received to you. Okay, if a loan is not a NPA, in such a situation, even though you have not received the interest, you can recognize it. So as per that, you have recognized interest. After recognizing interest, loan has become NPA. Now after loan has become NPA, you have not yet received this interest which you have recognized already. Now in this situation, since the loan has become NPA, you have to reverse this income. Okay, this is the second rule. Okay, these are the two rules in case of income recognition. Next, going to asset classification. Okay, you will classify the loans into 4 categories. Why you are classifying the loans into 4 categories? For the purpose of providing provision, you are classifying them into 4 categories. What are the 4 categories? First one is standard asset. Okay, all the loans in which there is no default, they will be categorized into standard asset. Next, substandard asset. What are the substandard asset? If any asset is classified as NPA for the period not exceeding 18 months, then they will be categorized as substandard asset. Okay, if any asset is classified as NPA for a period up to 18 months, then that will be classified as substandard asset. Okay. However, for NBFCs which are in middle layer, this period of 18 months will be reduced to 12 months only. Hope that is clear. Next, an asset where terms of the agreement regarding interest or principal have been renegotiated. Okay, see, with respect to a particular loan, it is not an NPA. Okay, a loan is not NPA, but there has been a renegotiation in the terms, a reschedulement of terms has been made, like reduction in rate of interest or increase in tenure. Now these types of loans, even though they are not NPAs, since there has been a reschedulement or reconstruction of the loans, they will be classified into this substandard asset till a period of 1 year from the date of such reconstruction, to check whether after the reconstruction the loan repayment is being done properly or not. Okay, even though that is not a NPA, it will be classified into substandard asset for a period of up to 1 year from the date of reconstruction. Okay, hope that is clear. Next, doubtful asset. If a particular NPA or if a particular asset remains in the state of substandard asset for a period exceeding 18 months, then it will be classified as doubtful asset. And obviously for NBFCs which are in middle layer, this 18 months period will be reduced to 12 months only. Hope that is clear. Next, loss asset. Loss asset means those assets which have been specifically identified as loss asset either by the bank or the auditors or the RBI during the inspection or investigation. Okay, those are known as loss assets. Next, non-performing asset. What is meant by a non-performing asset? An asset in respect of which interest has remained overdue for a period more than 180 days, or a term loan in respect of which the EMI has not been paid for a period of more than 180 days. Next, a demand loan or a call loan where it has remained overdue for a period of more than 180 days. If you see, for all these, the period of overdue is more than 180 days. Next, a bill which remains overdue for more than 180 days, and interest in respect of a debt or income or receivables under head other current assets for a period more than 180 days, and the lease rental and hire purchase installment is overdue for a period more than 180 days. Okay, so all these overdue for a period more than 180 days, then it will be treated as NPA. Next, another point, let's say for example Mr. A is having a term loan with a bank and he is also having a cash credit. So he is having two loans. Now term loan has become NPA, but cash credit is not NPA. Now in this situation, since a term loan has become NPA and it belongs to Mr. A, and Mr. A is also having another loan cash credit with the same bank, you should also treat cash credit as NPA. So NPA calculation is borrower wise but not loan wise. Hope that is clear. Next, now this period of 180 days is there na for calculating NPA. This will be gradually reduced to 90 days over a period of time. Okay, a specific glide path has been given. If you see, by 31st March 2024 it has to be reduced to 150 days, 120 days by 2025, and 2026 it should be reduced to 90 days. Hope that is clear. Next, provisioning requirements. If the loan is classified as loss asset, you should provide 100% as provision. If the loan is a doubtful asset and there is no security for that loan, then also you should provide 100% provision. If at all there is a security for the loan and the loan is in doubtful asset and it is in doubtful asset for a period of up to 1 year, then 20% provision. If it is in doubtful for a period 1 year to 3 years, then 30% provision. If it is in doubtful for a period more than 3 years, then 50% provision. Hope that is clear. Next, if a loan asset is in substandard state, then 10% will be the provision. Next, if it is in standard asset state, then 0.25% will be the provision. Hope that is clear. And if standard asset provisioning not applicable to NBFC which are upper layer, NBFC shall make provision for standard asset at 0.40% of outstanding amount which shall not be recovered. Okay. Okay, for NBFCs which are in base layer and the standard assets, see, for NBFCs which are in base layer, for those NBFCs it has to maintain 0.25% of standard asset as provision, and for all other NBFCs they have to maintain 0.4%. okay, 0.4% as provision for the assets which are in standard asset state. Okay, next, audit procedures that the auditor has to follow in an audit of NBFC. See, first of all, whatever the type of audit it is, first of all the auditor has to understand the business of the entity, right? So for this purpose he has to go through MOA and AOA, that is ascertaining business of the company. Next, he should evaluate the internal controls that have been implemented within the organization, both financial controls as well as other internal controls that are necessary for the purpose of auditor. Okay, he has to evaluate internal control. Next, since this is audit of NBFC, auditor has to specifically verify whether registration of RBI has been obtained or not. Certificate of registration from RBI has been obtained or not. You need to ask for that certificate of registration from the NBFC. And since this is a NBFC, auditor should also perform certain audit procedures with respect to prudential norms. Okay, whether the NBFC has complied with prudential norms related to income recognition, income from investments, asset classification, provision for bad and doubtful debts, capital adequacy norms, prohibition of granting loans against its own shares. All these are various prudential norms that the auditor needs to check the compliance with by the entity. Prohibition on loans and investment for failure to repay public deposits and norms for concentration of credit, etc. Okay, all these are various prudential norms. If you see in our syllabus, we have just discussed three types of prudential norms, right? Income recognition, asset classification, provisioning. But RBI has issued various prudential norms to the NBFCs. The compliance with all of them has to be checked by the auditor. Next, the auditor has to see whether board has framed a policy for granting demand and call loans and whether that policy is being actually implemented or not. Next, auditor should also check whether the classification of advances or assets into standard, substandard, loss and doubtful has been done properly or not. Next, auditor should ensure that unrealized income from NPAs should not be recognized in the books of accounts. This point we have already seen in the income recognition norms, right? Next, auditor should check that all NPAs of the previous year to verify whether during the current year any payment has been received from them. Okay, in the previous year that might be NPA, but if in the current year that borrower, if he repays, then it would not be treated as NPA, right? So whether any of the NPAs of previous year have turned to non-NPA in the current year, that has to be checked by the auditor. Next, classification of frauds by NBFC. See, all the frauds that will take place in the NBFC has been classified into certain categories so as to easily report them. Okay, for properly reporting them, frauds have been classified into these 7 categories. You can remember the mnemonic M Fun Sia. Now, M stands for misappropriation and criminal breach of trust. F stands for fraudulent encashment through forged instruments. U stands for unauthorized credit facilities extended for reward of illegal gratification. Okay, by taking some bribe, you are granting loans to the people who are not eligible to take the loans. Okay, next, N stands for negligence and cash shortages. C stands for cheating and forgery. I stands for irregularities in foreign exchange transactions. That means you have entered into foreign exchange transaction without complying the relevant requirements of FEMA. And finally, any other type of fraud not coming under the specific heads above. You will classify the frauds into these 7 categories. Now, these are there now, 4th one and 6th one, that is negligence and cash shortages and irregularities in foreign exchange transactions. These both has to be reported as fraud only if intention to cheat or defraud is identified or proved. Okay, only if intention to cheat or defraud is proved, only then these 2 will be reported as fraud. Otherwise, they will not be reported as fraud. However, for this first point, negligence and cash shortage, even though the intention to cheat or defraud is not proved, it will be reported as fraud if cash shortage is more than 10,000. Okay, general rule is you have to report this as fraud only if intention to defraud or cheat is proved. However, if cash shortage is more than 10,000, then you have to report it as a fraud even though the intention is not proved. Next, another exception, if cash shortage is more than 5,000 and it has not been reported to RBI, but it has been identified by management, auditor or inspecting officer while their investigation. In such a situation, it has to be reported as fraud. Hope that is clear. Next, RBI has given certain directions. You can classify RBI directions into first one, prudential norms. The prudential norm direction that the RBI has given, we have already discussed. Next, RBI has given directions with respect to deposits. These directions should be followed by NBFCs. Okay, these deposit acceptance directions are given by RBI to NBFCs. Next, RBI has also given certain directions to auditors of NBFCs. See, on audit report directions, these deposit directions are for NBFCs, this audit report directions are for auditors of NBFCs, and these directions are classified into those directions that are applicable for auditor of all the NBFCs. Next, those directions that are applicable for auditors of NBFCs that are accepting deposits, and those directions that are applicable for auditors of NBFCs which are not accepting deposits, and directions with respect to exception reporting. What are these directions? We would let us see. First of all, we'll start with deposit directions. Okay, NBFC acceptance of public deposit Reserve Bank direction 2016. Now, as per these directions, RBI has given certain directions to NBFC. Now, auditor has to check whether the NBFC has followed with these directions or not. Now, what has to be checked by the auditor? First of all, auditor has to see whether NBFC has been properly classified as per the requirement of various regulation. Okay, we are having classification regulation with respect to this base layer, middle layer, upper layer, top layer, whether the classification has been done properly or not. Next, with respect to acceptance of deposit, classification of NBFC accepting deposits, NBFC not accepting deposit, and we are also having NBFC microfinance institute. So whether this classification of NBFC has been done properly or not, that has to be checked by the auditor. Next, the quantum of public deposits that the NBFC can accept will depend on the credit rating that has been given to the NBFC. Let's say the credit rating of the NBFC is AAA. Then for AAA credit rating, you can accept 500 crore deposit. If credit rating is AA, you can accept 1,000 crores. Like this, based on the credit rating, the ceiling limit of the deposits that you can accept will be decided. So auditor has to check whether the deposits that you have accepted are as per that credit rating that is allocated to you or not. So for this, first of all, you need to obtain copy of credit rating. Who will give this credit rating? There will be credit rating agencies who will give this credit rating. So auditor should first of all obtain copy of this credit rating. Next, in the event of upgrading and downgrading of credit rating, NBFC will have to increase or reduce its public deposits in accordance with the revised credit rating. Okay, if let's say the current credit rating is AAA, so it can accept 5,500 crores. Now, if the credit rating has been decreased to B, then for B credit rating, let's say you can accept only 250 crore. So according to that, you need to decrease your public deposits. So whether that decrease and increase has been properly done as per the credit rating or not, auditor needs to check. Next, in the event of downgrading of credit rating below minimum specified investment grade, NBFC being a investment and credit company or factor shall regularize excess deposits. Now, for an NBFC to accept deposits, there will be minimum credit rating. That means if you wanted to accept the deposits, your credit rating must be minimum this much. Okay, minimum B plus should be your credit rating to accept deposits. If your credit rating falls below B plus, then you have to regularize the deposits that you have accepted till now. Now, what is meant by regularization of deposits? Regularization means, first of all, you should not accept any fresh deposits, and the existing deposits, they will run till maturity, and you have to report about the situation of deposits to RBI within 15 working days. This is regularization of deposits if your credit rating falls below minimum specified credit rating. Hope that is clear. Next, Just a second. Let me check whether I have started recording or not. Yeah, it is recording. Next, you need to test check the interest calculations in respect of public deposits, whether interest calculation has been done properly or not. Next, you should also check that NBFC should not accept or should not review the deposit, should not renew the deposits without consent from the deposit holder. Okay, only if the deposit holder gives written consent for renewal of deposit, you have to renew it. Okay, next, verify the deposit register that the NBFC maintains. Next, you should also check the specified returns that the NBFC files with RBI, whether these returns are filed in a timely manner or not. And in case NBFC not accepting or not holding any public deposits, check whether board resolution has been passed. This point we will also be discussing with respect to the directions given to the auditors of NBFCs that are not accepting deposits. Basically, if NBFC, the board of directors has to pass a resolution stating that NBFC should not accept the deposits in case the NBFC is not accepting or holding any public deposits. There should be a proper board resolution backed by this decision. Okay. And finally, in case of group holding investment company, check whether NBFC has passed board resolution to the effect that the company will invest only in the group companies. Okay, these are the points that the auditor needs to check with respect to whether NBFC has complied with the deposit acceptance directions. Okay, next, coming to the NBFC's RBI's directions to the auditors of NBFCs. Now, as per this, generally auditor of a normal company, he will give audit report as per section number 143(1), right? Those points he will include as per section 143. That is normal audit report as per Companies Act requirement. Now, auditor of NBFC, he will give audit report as per that section 143 of Companies Act. Apart from that, he should also prepare a separate audit report to the board of directors. Now, in that separate audit report, these points has to be reported. Hope that is clear. So that means auditor of NBFC will give two audit reports. One is normal audit report as per Companies Act, and another one is a special audit report by checking whether all these requirements are complied or not. Hope you are clear. Now, first, so in this special audit report, what points needs to be reported? Now, in case of all the NBFCs, the auditor has to verify whether NBFC has obtained certificate of registration from RBI or not. If it has obtained, whether it is entitled to continue to hold such a certificate of registration or not, and whether NBFC is meeting the required net own fund requirements. These 3 points need to be reported by the auditor for all the NBFCs, whether it is a deposit accepting NBFC or it is a non-deposit accepting NBFC. Hope that is clear. Next, in case of NBFCs that are accepting deposits, auditor needs to report on following points. The first point is whether the deposits that the NBFC is accepting is within the limits permissible as per NBFC acceptance of public deposit directions. We have seen in NBFC acceptance of public deposit direction, the amount of deposits that you can accept will depend based on the credit rating that has been given. So, whether the amount of deposits that you have accepted is within the limit of that credit rating or not, you need to check this. Next, whether public deposits held by the company is in excess of permissible limit or properly regularized. Okay, if at all it is in excess of permissible limit, whether they have been properly regularized. Regularizing means giving back those deposits is known as regularizing. Next, you should also check whether NBFC is accepting any deposits without having minimum specified credit rating. Okay, in order to accept deposit, you need to have minimum credit rating. Without having that minimum credit rating, whether you are accepting any deposits, you need to check that. And in case of NBFC companies referred to in clause 3 above, whether credit rating for each of fixed deposit scheme that has been assigned by one of the credit rating agency. Okay, for each deposit scheme that the NBFC frames, a separate credit rating has to be obtained, and whether aggregate amount of deposits outstanding at any point during the year has exceeded the limit specified by such credit rating agency. Okay, here also you need to check whether the amount of deposit that you have accepted is exceeding the limit prescribed by credit rating agency. Next, whether capital adequacy ratio as determined in the return that you submit to the RBI is properly calculated or not, that you need to check. Next, whether NBFC has violated any restrictions on acceptance of public deposit direction. Okay, whether you have complied with these directions or not, whether company has defaulted in paying to its depositors. Now, if you have accepted public deposit, there will be a tenure for the deposit, let's say 3 years. Now, after 3 years, you have to repay the deposit amount along with the interest. Whether NBFC has defaulted in paying the deposits, you need to verify that. Next, you need to verify whether the company has complied with prudential norms. We have discussed various prudential norms, whether all of them have been complied by you or not. Next, whether company has complied with liquid asset requirements as prescribed by bank in excess of powers under section 45 IB. With respect to this, you will be filing certain returns in terms of NBS 3. You need to verify whether those returns have been filed properly or not. Next, whether the company has furnished RBI within stipulated period return on deposits in DNBS 1. Okay, in DNBS 1, you will furnish return on deposits to RBI. In that return, the details with respect to the deposits that you have accepted will be there. Whether that return has been furnished in within specified time or not, auditor needs to check. Again, there will be quarterly return on prudential norms, whether you have complied with prudential norms or not. That will be in, okay, that has to be furnished on a quarterly basis. Whether it has been furnished on a quarterly basis or not, you need to check. Next, if NBFC has opened any new branches or if it has closed any existing branches, that has to be intimated to RBI through a separate return, whether that has been properly intimated or not. All these points auditor needs to report in his audit report to board of directors. Okay, this is a special audit report that the auditor of NBFC gives. Okay, auditor shall also make separate report to board of directors of the company. So first of all, we have seen the points that needs to be reported in case of all NBFCs. Next, in case of NBFCs that are accepting deposits. Now we will see points that needs to be reported in audit report of NBFCs that are not accepting deposits. Let us see whether board has first of all passed a resolution that this NBFC will not accept deposits. You need to report that, and even after passing resolution also, whether you have accepted any deposits, that also you need to report. Next, whether prudential norms have been complied or not, that also you need to report. See, for NBFCs which are not accepting deposits, the above these points will not be applicable. Okay, these points need to be reported only for NBFCs which are accepting deposits. For NBFCs that are not accepting deposits, you need to report only on these points. Okay, fourth point, whether capital adequacy ratio are disclosed in return submitted in NBS 7 has been properly arrived at or not, and whether company has furnished RBI annual statement on capital funds in NBS 7. You need to check whether these calculations have been done properly or not. Next, if NBFC is a microfinance institution, whether it has been properly classified as microfinance institution or not, you need to report on this point also. Okay, these are the directions given for the auditor of NBFCs. Next, auditor should also give exception report. Now this exception report has to be given to RBI. Okay, this exception report will not be given to board of directors. This exception report will be given to RBI. Now, what will the auditor report in this exception report? He will report if at all there is any non-compliance with chapter 3B of RBI Act, or if at all there is any non-compliance with NBFC acceptance of public deposit directions. We have discussed just now the NBFC acceptance of public deposit directions. If any of the NBFC doesn't comply with those directions, the auditor will include that point in exception report and he will report it to RBI. Next, if any NBFC doesn't comply with master direction Reserve Bank of India, NBFC scale based regulation direction, then also you will report that in this exception report. To whom you will give this exception report? To RBI. Hope that is clear. Next, applicability of Indian accounting standards on NBFC. See, for NBFCs also, Ind AS is applicable for certain NBFCs. From 1st April 2018, for all those NBFCs whose net worth is 500 crore or more, for them Ind AS is applicable. And from 1st April 2019, for all NBFCs whose net worth is 250 crore or more but less than 500 crore, for them Ind AS is applicable. For remaining all other NBFCs, accounting standards is applicable. Next, following is the format of financial statements. Basically, the format of financial statements for NBFC is prescribed in the Schedule 3 of the Companies Act only. Basically, if you see in the Schedule 3, Division 2 speaks about normal companies financial statements. Division 3 speaks about financial statements for NBFC. Okay. So this is the format. You can just go through this format once. Now, what is the difference between Division 2, that is Ind AS financial statements for other than NBFCs? Division 2 of Schedule 3 gives the format of financial statements for companies other than NBFCs, that too Ind AS format. And Division 3 speaks about Ind AS format of financial statements for NBFC. So what is the difference between Division 2 and Division 3? What are the major differences? We will see it here. Now, if you see NBFCs, they can present in the order of liquidity. Okay, in the balance sheet, they can present their assets and liabilities in the order of liquidity. That means they can present cash first, then bank, next investments, like this. In the order of liquidity, they can present their assets, but either assets or liabilities. But such feasibility is not there for normal companies. This is not allowed as per Division 2. Next, NBFC is required to separately disclose by way of note any item of other income or other expenditure. See, if at all in the profit and loss statement, what we will do, if that is a small amount, we will put it in other expenditure or other income. Now, as per Division 3, if that amount is exceeding 1% of total revenue, then you cannot include it in the other expenditure or other income. You have to separately present it. Okay, this is the requirement for NBFCs. Whereas for normal companies, if that amount is exceeding 1% of total revenue or 10 lakh, whichever is higher, then you need to separately disclose that item. Okay, this is the difference. Next, NBFCs has to report separately the amount that they have to receive from LLPs in which the director of NBFC is a partner. Okay, they have to separately report the receivables from these NBFCs. Next, NBFCs are also required to disclose items comprising of revenue from operations and other comprehensive income on the face of statement of their profit and loss account. Next, separate disclosure of trade receivables which have significant increase in credit risk and credit impair. Okay, if at all with respect to any trade receivable, the credit risk has increased, then you need to separately disclose them, because the NBFC's business itself is to grant loans. So for any of the loans, if the credit risk has highly increased, you need to separately disclose it. However, such requirement is not there for normal companies. Next, the conditions or restrictions for distribution attached to statutory reserves. Now, if the NBFC is having any statutory reserves, and for distributing those statutory reserve, if any conditions are there, then those conditions have to be separately disclosed in the notes as stipulated by relevant statute. Okay, these are the differences between Division 3 and Division 2. Hope that is clear. By this, we have completed the revision of Audit of NBFC. I will be winding up this class as of now. We will meet in the next revision class. Until then, take care. Bye bye. See you. In the today's class, we will be revising Audit of Banks. Now, if you see, the weightage of this chapter is around 4 marks, you can say. Okay, 3 to 4 marks. Along with NBFC and this chapter, you will get around 6 to 7 marks like that you will get. Okay, now The length of this chapter is a little bit huge, you can say, but it is quite easily understandable. Now, let us start the revision of audit of banks. Now, first of all, the banks, they are having certain special characteristics, right? Because of these special characteristics of banks, in the audit of bank, there need to be special audit considerations that needs to be taken into account. Now, what are these special characteristics of banks? First of all, nature of risk associated with the banks, because banks deal with cash, obviously the risk will be high. Next, scale of operations. If you see, each bank will be having a number of branches, thousands of branches it will be having, so the scale of operation at which the banks operate will be very huge. And extensive IT dependence, obviously in case of a banking company, you cannot visualize today's this present era's banks without information technology. And statutory and legal requirements, there are various laws and regulations that are applicable on the banks. We will be seeing in the next concept what are the laws that are applicable for the bank. And continuing development of new products and services. Each and every month there will be new products coming in the bank. Okay, there will be credit cards, there will be ATM, there will be agricultural loans, there will be educational loans, there will be FDs of different interest rates. Like this, the different types of products will be launched by the bank each and every month. So all these characteristics makes the auditor to have certain special audit considerations in case of a bank. Now, as I have already told you, there are various laws and regulations that are applicable to the bank, like Banking Regulation Act, RBI Act, Companies Act, RRB Act. RRB means Regional Rural Bank. Information Technology Act, PMLA, Prevention of Money Laundering Act, SARFAESI, that is Securitization and Asset Reconstruction Act. Next, Payments and Settlement System Act, Cooperative Society Act, SEBI regulations. Okay, in case the bank is a listed entity, then SEBI LODR regulations are also applicable to the bank. So these are just some examples. Still, there are various laws that are applicable on the banks. Next, financial statements. Just like for preparation of financial statements of a company, Schedule 3 of a Companies Act is having a format. Even here for financial statements of bank, Schedule 3 of Banking Regulation Act has given a format. Form A consists of balance sheet format. Form B consists of profit and loss statement format. So you have to prepare these financial statements of bank as per this format only. And disclosure requirement under Section 133 of the Companies Act. Section 133 deals with accounting standards and Indian accounting standards. So the banks then need to comply with Indian accounting standards or accounting standards as per their applicability requirement. Okay, they should comply with Ind AS. Next, appointment of auditor. How the appointment of auditor will be done in case of a bank? If the bank is a nationalized bank, board of directors will make the appointment. If in case of other banks, AGM, the members will make the appointment. However, in both the cases, RBI approval is mandatory. And in case of SBI, there was a different procedure earlier. But since SBI is also a nationalized bank, you please strike off this and include SBI also in the nationalized bank itself, RRB in other banks. Okay, you please strike this off. Hope that is clear. Next, stages of bank audit. If you see, there are 5 stages in the bank audit. Before planning, there is a initial consideration stage. So in initial considerations, what will you consider? Acceptance of audit, whether to accept the audit or not. Declaration of indebtedness. If you are having any loan with that bank, if you are having loan with that bank, you should not conduct the audit of that bank. Next, internal assignments, whether you have taken up any internal assignments. Terms of engagement, communication with the previous auditor, planning, engagement team. So all these will come under initial consideration. After that, you will understand the bank and its IT environment. Just like as per SA 315, you will identify and assess risk of material misstatement through understanding the entity and its environment, right? So here you are understanding. In next stage, you will assess the risk. You will also understand internal controls, accounting process that the bank is following, and risk management process. All this you will understand, and based on that understanding, you will assess the risk, identifying and assessing risk of material misstatement, risk of fraud, including money laundering. See, in case of banks, the fraud of money laundering, the risk of money laundering is very high. Money laundering means converting black money into white money. Banks play a crucial role in this process. So you should assess the risk of fraud with respect to money laundering. Next, assess a specific risk associated with outsourcing activities. Banks will outsource various activities, right? Here SA 402 will be applicable. Next, execution stage. Based on the risk engagement team discussion, you will discuss with the engagement team response to assess risk. How you will respond to assess risk? By designing respective audit procedures, right? Determine audit materiality, consider going concern of the bank. And finally, based on your execution, you will find out certain points. Those you will report. In reporting stage, you will give audit report, you will give LFIR. Okay, in case of bank, apart from audit report, there is also other audit report known as a long form audit report or LFIR. That also you need to give. And also, if at all any other certification is required that is specific to the bank branch, then report on any other matters. Okay, these are the 5 stages of bank audit. Next, internal controls in certain selected areas. Now, in case of bank, internal controls are very much necessary. We will see some of the internal controls in certain areas. First of all, we will see general internal controls that has to be there. See, general internal control. Shift staff positions without prior notice. Okay, you have to shift the position of the staff without giving prior intimation to them. Okay, you should not allow the same person to be in the position of cashier. You should not allow the same person to be manager of the same branch for a long time. Okay, you need to shift their positions. Next, maker checker concept should be there. Next, prove arithmetical accuracy of books of accounts every day, right? Every day bank staff should leave the bank only after tallying their books of accounts. All bank forms in possession of one officer. Mail should be opened only by the responsible officer only. Okay, you should open only your mail. Only the authorized person has to open the mail. Next, clear differentiation of financial powers should be there. Okay, who can grant loan up to certain value, and if that value exceeds, whose permission is required, and who can make entries in the books of accounts. So all those financial powers should be clearly differentiated. Next, periodic surprise inspection of head office and branch offices should be conducted. Okay, these are certain general internal controls that has to be implemented in case of a bank. Now, with respect to cash, what are the internal controls that has to be there? First of all, cash should be in the joint custody of 2 officers. Okay, you should not give the responsibility of cash only for one officer. Okay, if you have seen the movie, the recent movie that has come with respect of Dulquer Salman, Lucky Bhaskar. If you see in that Lucky Bhaskar movie, the cash, it is held with the responsibility of 2 officers, right? Next, daily test check and occasionally fully count the cash by some other higher officer other than the cashier. Okay, the cashier, he will daily test check the cash, and other officer will also test check the cash. But occasionally the higher officer like manager or senior cashier, he needs to detailedly check the cash, he needs to tally the cash. Next, no access to cashier to customer account and the day book. Okay, cashier should not be given access to the customer account and the day book, because there is a possibility that he might take away the cash and pass the fake entries to adjust that in the customer's account. Make payment only after authorization and entry in the customer account. Okay, if at all any customer comes from for withdrawal, you have to make entry in the customer account only after you have to make payment to that particular customer only after entry is made in the customer account. Next, compare receipt payment totals with cash column of the day book. High volume cash transactions to be verified by higher officer or manager. Okay, there will be certain limit of volume of cash that will be specific to each bank. If any transaction is exceeding that particular value, then that cash transaction has to be specifically verified by the manager or some higher officer. Next, remit excess cash to currency chest according to the bank's retention limit. See, each branch, based on its advance size, there will be a retention limit for the cash. That means, let's say for example, a branch can have only 15 lakhs cash with it. Now, at the end of the day, if the cash balance with it is exceeding 15 lakhs, that excess cash balance, it has to be sent to the currency chest. Okay. Next, check truncation system. What is this check truncation system? Check truncation means you will tear off the check once it is cleared. That is known as a check truncation system. Now, certain internal controls with respect to this check clearing. Call or email the customer if check received for 5 lakh and above. Auditor shall test check. Now, if any check is received for clearing and the value of the check is more than 5 lakh, once the bank officials, they have to call the customer and ask the customer, a check has been issued by you for more than 5 lakh. We have received the check for clearance. Whether this check has actually been issued by you, like this you need to test check with the customer. This is one of the internal control. Next, check whether signature of drawer of the check is being verified by the bank staff. Okay, on the check there will be signature, and bank will be having a specimen signature of the customers. So in the system they will be having the specimen signature. Okay, in the CBS core bank system they will be having that. So before clearing the check, they have to check whether the signatures are matching or not, and in case of unpaid checks, they have to be given back to the customer. Okay, next, bills for collection. Now, in case the bank has received any bills from the customer for the purpose of collection, then the internal controls that has to be there are all relevant documents to be received and entered in the register. Okay, whatever the documents that you have received with respect to bills collection, all those documents has to be entered into the register, and credit the customer account only if the bill have been collected. Okay, you need to credit the customer's account only if this bill has been collected by the bank. Okay, the amount that is mentioned in the bill has been collected from the respective person, only then you will credit the customer account. Next, ensure that there is no dual entry for bills sent from one branch to other branch. See, sometimes what happen is branch of Hyderabad might send the bill for collection to branch of Mumbai, because the respective person who will give the amount is present in Mumbai. Now, in this situation, what will happen is the entry for bills for collection is made in the Hyderabad branch and also in the Mumbai branch. Now, at the time of consolidation, while preparing the financial statements, you should ensure that only one entry with respect to this bill is shown in the financial statements. Okay, remaining entry should be cancelled off in the amalgamated balance sheet. Okay, next, bills purchased. Now, in case bank has purchased the bill, then officer has to verify that title documents are assigned to the bank. Okay, if you have purchased the bill, ownership of the bill has to be transferred to you. Next, sufficient margin or discount should be kept. Okay, if the bill amount is 1 lakh rupees, you should not purchase it for 1 lakh rupees. You should keep a margin of 5% or 10%. Like for 90,000, you should purchase it, or for 95,000, you should purchase it. That remaining 5,000 or 10,000 is your profit. Next, if bank fails to collect on due date, take steps to recover from the drawer. Report irregular outstanding accounts to the head office. For bills outstanding at close of the year, properly apportion the discount between 2 years. Okay, let's say on 29th March you have purchased the bill, and this bill is due to be collected in April or May. Now, in this situation, the commission amount that you earn on this bill has to be apportioned between 2 years, right? Till March it will be one financial year, after March it will be another financial year. So that apportionment of commission has been made properly or not, that internal control should also be there. Next, loans and advances. Internal controls with respect to loans and advances. See, whenever you are granting any loan to the borrower, you have to properly check credit worthiness of the borrower, and also you would have observed while taking the loan there will be this much bunch of documents that you have to sign. So the internal control is execute all necessary documents, and you should also maintain sufficient margin with respect to the security. Let's say you are giving you will not give the loan without any security. Let's say you have accepted a land for the security, and the market value or the value of that land is some 10 lakh rupees. Now, in this situation, for this land, you should not give entire 10 lakh loan. Okay, you will only give some 70% or 80%, like 7 lakh or 8 lakh as loan. The remaining is the margin for you. If who knows, suddenly in future, if the value of that land decreases, then the borrower, he will not repay the amount, right? So sufficient margin has to be kept. Next, securities in joint custody of 2 officers. Just like the cash is kept in the joint custody of 2 officers, even the securities has to be kept in the joint custody of 2 officers. Register securities in bank's name. Okay, and all accounts to be within drawing power and sanction limit. Temporary limit of 20% can be granted for maximum 90 days. Okay, all the accounts, they should be within drawing power and sanctioned limit. Sanctioned limit means the actual limit that has been sanctioned. It can be, let's say for example, 10 lakh. Now 10 lakh sanctioned means you cannot withdraw entire 10 lakh. You can withdraw only up to your drawing power. Now drawing power will be calculated every month or once in every 3 months based on the practice of the bank. This, for calculating drawing power, generally it will be calculated based on book dates, based on stock available with the customer. Now for calculating that, the customer will have to give on a monthly basis or on a quarterly basis a stock statement. Based on that stock statement, you will calculate the drawing power. Let's say the stocks available with the customer, or let's say 10 lakh worth of stock is available. Now of these 10 lakh worth of stock, you will reduce creditors. Let's say creditors are 2 lakhs, you will reduce 2 lakhs, 8 lakhs. Now of these 8 lakhs, you will take up margin of 25%. If you take margin of 25% from 8 lakh, roughly it will be around 6 lakhs, right? So 6 lakhs your drawing power. Even though sanction limit is 10 lakh, your drawing power is only 6 lakh, because it will be calculated based on the stock that is available with you. So however, a temporary drawing power of 20% excess can be given for a temporary period of maximum 90 days. Okay, you have arrived at drawing power of 6 lakhs. On these 6 lakhs, some additional 20% extra drawing power can be given for a maximum up to 90 days. Okay, hope that is clear. Next, irregular accounts to be brought to the notice of head office and review operation in each advance account at least once in a year. Okay, once in every year you have to review whether the loan is being repaid properly or not, and what transactions are being occurred in this loan account. Okay, next, coming to credit card operations. So what are certain internal controls that has to be there with respect to credit card operations? So first of all, while granting any credit card to the customer, you have to effectively screen his application. Okay, effective application screening with good credit assessment. Next, control over storage and issue of the credit cards. Next, merchant confirms unutilized limit of card before accepting. Now merchant at his point of sale, while accepting the swipe of the credit card and deducting the amount, a confirmation request will be sent to the bank to check whether this customer is having that respective credit limit or not, right? That has to be confirmed by the merchant for each and every transaction. That is also one of the internal control. Next, prompt reporting by merchant of all settlements accepted through cards. Okay, of whatever the amounts that the merchant has accepted through card, that has to be promptly reported to the respective bank. However, all this, it will be handled by payment gateways nowadays. Okay, they will take care of all these controls. Next, reimburse to merchants only after verification of merchant card acceptance. Okay, you will reimburse the amount to the merchant only after verifying whether merchant has actually accepted the card or not. Next, immediately charge to the customer. After you reimburse to the merchant, you will charge the same amount to the customer, because you have to collect from the customer the same amount at the end of the month, right? Next, send regular statements to the customer. Credit card statement has to be sent to the customer on a regular basis so as to collect the amount from the customer. Next, review accounts periodically to revise the limits. You have to review the account of the customer periodically and revise his limits. Monitor and follow up customer payments. Okay, you need to monitor and follow up whether customer is regularly paying the credit card bill or not. Okay, next, CRR SLR. CRR means cash reserve ratio. As of now, the CRR is 4.5%. SLR means statutory liquidity ratio. As of now, the SLR is 18%. Now CRR means the bank has to maintain this much amount of cash or deposit with the bank. With the bank means RBI. So of the total advances that of the total deposits, demand and time liabilities, we call it as, okay, DTL. Of the total demand and time liabilities, it is having 4.5% has to be maintained as CRR in the form of cash with itself and cash deposited with RBI. Next, of this demand and time liabilities, 18% has to be kept as liquid assets in the form of cash, gold, and some government bonds or deposit with RBI. Hope that is clear. and this SLR will be verified by the auditor at 12 odd dates of physical year not being Friday. Okay, the auditor, he will select 12 odd dates, okay, one day in each month not being a Friday, and he will verify whether SLR requirement of 18% has been maintained or not. Now, for maintaining this SLR and CRR, demand and time liabilities has to be calculated, right? These demand and time liabilities will be calculated on last Friday of preceding fortnight. On last Friday of preceding fortnight, how much demand and time liability is there? On that demand and time liability, this CRR and SLR will be maintained. Now, for calculating this demand and time liability, there is a certain procedure. Okay, you need to include certain items, you need to exclude certain items. Let us see. Audit approach regarding CRR and SLR. Understand RBI circulars regarding demand and time liability. Examine demand and time liability position based on consolidation of branch trial balances. Exclusion in DTL. Now, while calculating DTL, you need to exclude following. What are they? Paid up share capital, reserves, loan from RBI, loan from Exim Bank, loan from National Housing Board, loan from SIBI, loan from NABARD. Okay, if you have taken any loans from these people, you need to exclude it from calculation of demand and time liabilities. They need not be considered as demand and time liabilities. Next, amount of recovery is from doubt and bad debts. Amount of part recoveries, you can say. Okay, once you have considered any debt as doubtful debt, and if you have recovered any amount from that bad and doubtful debts, you should not consider it in calculation of demand and time liabilities. Next, amount received in INR against import bills held in sundry deposits pending receipt of final rates. Now, let's say for example, an importer has imported some goods into India. Now he needs to make the payment to the exporter in foreign currency, but he is not having foreign currency. What he will do? He will deposit Indian currency with the Indian bank, and Indian bank will convert it into foreign currency and it will pay to the exporter. Now the customer, Indian customer, importer has deposited the amount with the Indian bank, but Indian bank is still waiting for converting that Indian currency to foreign currency, because still the rate of exchange is not received. So in that time duration, that amount will be lied with the bank itself, and that is a liability for the bank. Even though it is a liability for the bank, it should not include it in the demand and time liability calculation. Next, unadjusted balances in link branches for payment made by such bank. That means for payment of dividends, for payment of consideration with respect to buyback of shares, what the companies will do is they will deposit the amount with the particular bank, and they will ask the bank to make the payment to the shareholders. Now the bank, what it will do is it will make the payment through its branches. Now if at all the amount is still lying with the bank and not yet paid to the shareholders, that will be liability to the bank, and such amount should not be included in the demand and time liabilities, even though it is a liability. Okay, next, margins held and kept in sundry deposits for funded facilities. Funded facilities means, the example of funded facility, you have given a guarantee. Now you will not give guarantee just like that. You will ask for a deposit, and based on the deposit you will give guarantee. Okay, if the customer gives a deposit of 1 lakh rupees, now you will give a guarantee of 1 lakh rupees. Okay, so this is a funded facility wherein you are providing a guarantee based on the fund that has been given. Now this fund that is available with you, it is a liability to you. Even though it is a liability, you should not include it in demand and time liabilities. Okay, next, inclusions in demand and time liabilities. What points you need to include in demand and time liabilities? Net credit balance in branch adjustment account. See, generally branch adjustment accounts should be tallied at the end of the year. Okay, you should not keep any amount in the branch adjustment account. So to encourage the banks to adjust the entries between the branches as quickly as possible, what the RBI told is, if at all there is any credit balance in the branch adjustment account, that will be considered in demand and time liabilities. Now what will happen if you consider it in demand and time liabilities? If you consider it in demand and time liabilities, the value of demand and time liabilities will increase. If value of demand and time liability increases, the CRR ratio and SLR amount will increase, because you will apply 4.5%, 18% on DTL only. If DTL amount is huge, the amount of cash that should be kept with the bank will be huge. Now if more amount is blocked in the form of CRR and SLR, the amount that is available to the bank for giving loans will be less. If it gives less loans, then the profit it makes will be less. So that much impact it will have. So In order to encourage the banks to clear these branch adjustment accounts as early as possible, if at all, the RBI told that if at all there is any credit balance in the branch adjustment account, that will be included in calculation of DTL. Next, borrowings from banks abroad. Okay, if at all you have taken any borrowing from abroad bank, then that will be included in calculation of demand and time liability. Next, interest accrued but not accounted in books of accounts. Okay, if at all there is any interest that has been accrued but that is not yet due, even such type of interest will be included in demand and time liabilities. Okay, next, verification of certain assets, starting with a cash balance. How will you verify cash balance? Obviously you will physically verify the cash. So physical verification at ATM and physical verification of cash that is available with the bank, and physical cash to be agreed with the balance that is available in the cash register or CBS. CBS means core banking system. So the balance of cash that is being shown in the books of account should match with the actual cash balance that is available with the bank. Okay. Next, balance with RBI. Now the banks, they will also maintain certain balance with RBI. How to verify that balance? Verify balance confirmation certificate and reconciliation statements. Okay, you should ask for a balance confirmation certificate from RBI and review reconciliation statements with special attention towards the following: cash transactions remaining unresponded, revenue items requiring adjustments, other credit and debit entries remaining unresponded for more than 15 days. Next, bank balances, balance with other banks. Now banks, they will also maintain balances with other banks like SBI. It might have some balance with HDFC, various other banks. So that interbank transactions will happen because the customers of one bank will transfer the amount to other bank. There will be checks issued from one bank to other bank by the customer. So obviously the amount of one bank will lie with other bank in its normal course of business, right? So how to verify that? Same procedures as you have followed in the above for RBI balance. Apart from those procedures, you should also following these procedures. No debit for charges or credit for interest is outstanding. Okay, there should be no transactions outstanding simply. No check sent or received is in clearing is outstanding. Examine large transactions to ensure there is no window dressing. Window dressing means passing fake entries to hide the frauds. Check bills or checks outstanding as on date or credited subsequently. Okay. Next, money at call and short notice. Money at call and short notice means loan that has been given for a short period of time, very short period of time, like for 1 week, 5 days, 2 days, 1 day. Okay, such type of loans are known as money at call and short notice. Generally for these types of loans there will not be any security, and these types of loans will be given only for the people who are having a high credit worthiness and who are very much familiar to the bank, and mostly these loans will be given between the banks. Okay, from one bank to another bank. See, for these money at call and short notice, there should be proper authorization, compliance with instructions of head office and the controlling office, verify with certificate of borrower and call loans receipts held by the bank. Okay, you should, the auditor, he should ask for a certificate of confirmation from the person who has taken the money at short notice. Next, examine subsequent repayments received. Do not net off call loans given against call loans taken. This is important. Now SBI Bank, it has given a call loan to HDFC Bank. At the same time, SBI Bank has also taken a call loan from ICI Bank. Now this bank, it should present them separately. It should not net off call loans taken and call loans given. Okay. Next, verify accounting of the interest. Okay, the accounting for the interest has to be made accurately. You need to verify that. Next, audit procedures for investment. Now here investments, they will be of two types. Bank, it will invest its own money. It will also invest its clients' money. Okay, banks can provide portfolio management services because there will be various general public who don't understand stock markets, who don't understand where to keep their money. So those type of people will take the help of the bank, because bank will have certain expert people who will invest the money of the customers. So bank will provide portfolio management services. So here, with respect to audit procedure for investment, you need to first of all review investment policy for the bank. Each and every bank will be having its own investment policy. In the investment policy, the objective of its investment will be there, and where should what are the permitted investments for the bank, all this will be listed down in the investment policy. Next, separation of investment functions. Okay, all the investment function should not be handled only by one person. Okay, there should be separation for investment function. Next, physically verify investment scripts. Okay, you need to verify the physical documents of investments. If at all physically the documents, investment certificates, they are not there, you should ask for a statement from depository. Okay, if at all the investments are in demat form. Next, obtain confirmation from the depositors and custodians. Examine proper classification into HTM. HTM means held to maturity. Next, HFT means held for trade. AFS means available for sale. So bank has to classify its investment into these three categories, and based on the change of its decision, it will shift its investments from one category to another category. So auditor needs to verify this. Next, examine valuation accounting of income from investments and special purpose certificate related to investment. The auditor, he needs to give a special purpose certificate with respect to investment. In that, while giving that certificate, the auditor needs to examine the following. See, examine whether separate accounts are maintained for investment on their own, investment on PMS client's account, and other constituents. I have told you now, investments will be made on their own and also on behalf of clients as part of portfolio management services. So accounts for these two has to be maintained separately. Next, get investment under PMS separately audited by the external auditor. Okay. Next, advances. With respect to advances given, what are the audit procedures that you will perform? Correctness of master data. Master data means what will be included in the master data: name of the customer, address of the customer, contact details of the customer, rate of interest of the customer, what is the amount of loan given to the customer. Okay, all these will be there in the master data of the customer. Next, all accounts of the customer are tagged to single customer ID. See, a particular customer, he might be having savings account with the bank, loan account with the bank, FD account with the bank. Okay, like this, he will be having various accounts with the bank. Now, for each account, there will be a separate account number, but all these accounts should be tagged to the single customer ID. Okay, each customer will have only one ID. Whatever the accounts he opens, those accounts will be tagged to that single customer ID only. Okay. Next, examine problem accounts not yet slipped into NPA. Okay, problem accounts, they will be categorized into SMA 0, SMA 1 and SMA 2. Basically, those accounts that have turned into NPA and in the stage of NPA, sorry, not in the stage of NPA, before NPA, if the amount is overdue for 0 days to 30 days, you will classify it as SMA 0. For 31 days to 60 days, you will classify it as SMA 1. For 61 days to 90 days, you will classify it as SMA 2, and above 90 days, then it will slip to NPA. Okay, so before NPA itself, to properly monitor and recover the amount from the customer, these three categories have been kept. Okay, they will be known as serious mention accounts, SMA. Next, examine accounts adversely commented by the concurrent auditor, internal auditor, or RBI inspection team. Okay, the statutory auditor, he needs to go through the reports of concurrent auditor, report of internal auditor, report of RBI inspection team. Now, in their reports, if they have adversely commented on any accounts, the auditor, he needs to specifically verify those accounts. Okay, and you should examine restructured accounts. See, restructured accounts means if at all borrower has negotiated for increase in the tenure of the loan or certain reduction in the EMI, so these types of adjustments to the loans is known as restructuring of loans. If at all there is any restructured loans, you need to examine it very carefully. Next, examine quick or early mortality accounts. What is quick or early mortality accounts? Within 12 months of granting the loan, if that loan becomes NPA, such a loan is known as a quick or early mortality account. Next, completeness and accuracy of interest being charged. You should verify completeness and accuracy of the interest that is being charged on the advances. If at all there is a slight change in the rate of interest that is being given in the master data, that will affect a lot of interest amount lost to the bank, right? So you should verify completeness and accuracy of the interest that is being charged. Next, recoverability of advances. How should you review whether the amount can be recovered or not? Periodic statements submitted by the borrowers. We have to verify the periodic statements that the borrower submits in case of working capital loan. right? Next, latest financial statements of the borrower you need to see. Reports on security inspection you need to verify. Review audit reports of borrowers whose credit facilities are beyond cut-off limits set by the board of directors by the bank. Next, classification and provisioning. You need to properly classify your advances into standard, substandard, doubtful and loss, and based on that you should also provide respective provision, right? So whether classification through CBS without manual intervention, okay, whether the core banking system software is having the ability to automatically classify the account into standard, substandard, loss and doubtful without manual intervention, and whether classification is appropriate, okay, whether the CBS has done the classification appropriately, proper segregation into secured and unsecured, and the provisioning. Compare date of NPA mentioned in current year statement with previous year, reasons for change. Okay, if at all this account is NPA during previous year also, you compare the date of NPA that is mentioned in previous year and in the current year. Next, regularization near balance sheet date. Regularization means an account has turned NPA. When will it be out of the state of NPA? If the amount is repaid, okay, if the outstanding amount is repaid, then it will be out of the state of NPA. So that process of bringing an account out of NPA is known as regularization. Now, if such regularization is done near to the date of balance sheet date, auditor should be very careful with respect to these type of accounts. See, need not be treated as NPA. Once the regularization has been done, you need not treat it as NPA. But however, such repayment of funds to the account is there, that funds should have come from genuine sources. It should not happen that sometimes what will happen is, in order to reduce the provision, banks, they will grant a fresh loan to the borrower, and borrower with that fresh loan, he will repay the amount of loan that has been classified as NPA. This is wrong. Okay, if that is happened, you should not consider, you should consider this account as NPA even if the regularization has been made, because regularization has been done, has to be done from the genuine sources. See, whether repayment is out of genuine sources or not, account indicates inherent weakness, then you need to deem it as NPA even though the account has been regularized. If there is an inherent weakness in the account, inherent weakness in the account means the borrower has filed for insolvency. Okay, the account is not NPA, but he has filed for insolvency. In this situation, there is an inherent weakness in the account. Borrower will not repay the amount, right? Filing for insolvency itself means that the meaning is that he is not having amount to repay all his loans, right? So in this situation, if there is inherent weakness, you should deem that account as NPA. Next, specific care in determining date of NPA. Next, drawing power calculation. About this drawing power calculation, I have already told you, right? As per guidelines formulated by board of directors by the bank, you need to follow the guidelines of board of directors. What happened? Just a second. Yeah. Ensure that stock doesn't cover amount outstanding to creditors and stock under LC means letter of credit and guarantee. See, while calculating the stock, amount of creditors has to be reduced, and also stock that is under letter of credit or guarantee should also be reduced. This point I have already told you. Next, in case of construction business, mobilization advance has to be reduced and proper valuation of work in progress has to be done. Mobilization advance means while you start a project, if at all any person wanted to purchase the flats in your apartment, you will take certain token amount or advance, right? Before starting the project itself or during the construction phase, you will accept certain advance. Such advance is known as mobilization advance. Okay. Next, review stock audit reports. You need to review the stock audit reports that has been submitted. Note, these stock audit reports for calculation of drawing power should not be older than 3 months. That means for every 3 months, at least for every 3 months, the borrower has to submit the new stock statement, and based on that, the drawing power will be calculated. If stock statement is not given for every 3 months, you can consider that account as irregular. Okay. Next, limits not reviewed within 180 days from due date of ad hoc sanction, then consider the account as NPA. In case of ad hoc sanctions, if the limit is not reviewed within 180 days, okay, for a period of 180 days, you can consider that account as NPA. Next, classification to be borrower wise and not facility wise. See, if a particular borrower has taken two loans, one is long term loan, one is working capital loan. Now, working capital loan has turned into NPA, but long term loan is not NPA. Now, in this situation, even though the long term loan is not NPA, since the working capital loan has turned into NPA, you should also treat long term loan as NPA because this belongs to same borrower. Okay, so classification is borrower wise but not facility wise. Next, government guaranteed advances. Now, if for a particular advance government has given the guarantee, then with respect to such advance, the income, the interest income is there na, that has to be recognized only if it has actually been received. Okay, if the government guaranteed advance has become NPA, then with respect to NPA, interest income has to be recognized only if it has actually been received. Okay, even though the loan is not guaranteed by government, if it turns into NPA, with respect to NPA, income has to be recognized only if the amount is actually received. Okay, only if the interest amount is actually received. Next, classification of government guaranteed asset. If the loan is guaranteed by state government, then if that account turns into NPA, you can categorize it as NPA. Next, if the account is guaranteed by, loan is guaranteed by central government and that loan becomes NPA, in such a situation, you should not treat that loan as NPA until and unless the bank has invoked the guarantee and central government has repudiated such guarantee. Until and unless central government repudiates the guarantee, you should not treat the loans that have been guaranteed by central government as NPA. Okay. Next, coming to agricultural loans. Now, NPA norms in accordance with SLB committee in each state. Basically, in each and every state, there will be state level board committee. Okay. Now, there will be norms that will be prescribed by SLB. You should follow such norms. Now, as per generally in every state, the crops will be categorized into short duration crops, long duration crops. Short duration crops means they will be for less than or equal to 1 year. Okay, the cropping, okay, the yield, you will get the yield from the crop within less than 1 year. If the yield is got to you for more than 1 year, then such type of crops will be known as long duration crops. Now, NPA classification in case of agricultural loans is based on this short duration and long duration. In case of long duration crop, if the amount is overdue for more than one crop season, it will be treated as NPA. And in case of short duration crops, overdue for more than 2 crop seasons, it will be treated as NPA. And ensure these norms are made applicable to all agricultural loans that are listed in master circular. Now, RBI will issue a master circular. In such master circular, it will list down what will be treated as agricultural loans and what will be treated as non-agricultural loans. Only if that loan is falling under the list of agricultural loans as per that master circular, you need to apply this criteria. Okay. Next, restructured advance. Restructured advance, I have already told you what is meant by restructured advance. Now, with respect to restructuring, you need to ensure compliance with RBI circular. Standard, substandard, doubtful assets can be restructured. Okay, these 3 categories of loans can be restructured, and restructuring cannot be made with retrospective effect. Okay, you can make restructuring only from the prospective effect. Okay, let's say as part of restructuring, you are reducing the interest rate. Now, interest rate, it cannot be reduced from retrospective effect. It can be reduced only from prospective effect. So, whatever the restructuring that you do, it has to be done only from the prospective, not from the retrospective. Next, on restructuring, standard is downgraded to substandard. Okay, if a standard asset is restructured, then automatically that will get downgraded to substandard stage because it is restructured. However, if a NPA is restructured, it will remain in NPA stage only. Next, examine accounts upgraded during year, do not upgrade on part recoveries. Next, sale or purchase of NPS. With respect to sale or purchase of NPS, certain aspects has to be verified. First of all, examine policy laid by the board of directors. For sale and purchase of NPA, there will be a policy that will be laid by the board of directors. You need to verify that. Next, must have remained as the NPA for at least 2 years. See, you can sell only those NPAs which are in the state of NPA in your books of accounts for at least 2 years. Okay, next, without recourse basis, you have to sell. Without recourse basis means once you sell, that's it. If in case the purchaser of that NPA is not able to recover the amount from the borrower the bank, the seller should not have any further liability. Okay, selling without any further liability is known as selling without recourse basis. So whenever you sell NPS, it should be without recourse basis and only on cash basis. You should not sell NPS on credit basis, and do not purchase NPS which you have originally sold them earlier. Okay, you should not purchase a NPS which you have sold them earlier. The same NPS you should not purchase, and remove from the books of seller. Once you sell the NPS, you need to remove them from the books of accounts. Next, non-banking assets acquired in satisfaction of claims. That means bank has given a loan. For that loan, the borrower has kept land as security. Now borrower is not able to repay the loan amount. So what the bank will do? Bank will take over that land. Now this land is non-banking asset acquired in satisfaction of claims. Now with respect to this, ensure these are held with the intention of dispense of. Okay, bank should not held that with itself. It should dispose it of. Generally banks will conduct auctions. In those auctions these type of assets will be disposed of. Okay, verify documentary evidence, check ownership is vested with the bank, compliance with holding period of such assets. See, so those type of assets which you have acquired as part of satisfaction of claim, you can keep those assets with you for a period of up to 7 years, maximum 7 years. However, if you wanted to use that asset for your personal use, then you can keep it even for more than 7 years. Okay, if you are not intending to use it for the personal use of the bank, then it can be maximum kept with the bank for a period of 7 years, and you have to sell it off within that period. Next, lower of net book value or of advance or NRV of asset. Okay, at how much value you should recognize this asset? Lower of net book value of the loan amount or realizable value of the net realizable value of that asset. Okay, lesser of these two values you need to recognize the asset in your books of accounts. Next, capital risk adequacy ratio, you will call it as CRAR, CRAR. The minimum CRAR is 9%. How to calculate this CRAR? Eligible total capital funds divided by risk weighted assets and off balance sheet items multiplied by 100. Okay, basically if you see in case of NBFC, we have a list of risk weighted assets. Just like that, even for banks also there is a risk weighted asset that has been given, but that list is not there in the syllabus. Okay, but this process of calculation of CRAR we have seen even in case of NBFCs, right? Next, stress testing. What is this stress testing? In case of this stress testing, you will test whether bank will be able to withhold the economic shocks, unforeseen circumstances. Okay, whether bank is having that much amount of capital with which it can withhold the unforeseen circumstances in the economic situation. Okay, that will be tested in case of stress testing. Okay, test to understand whether bank has enough capital to survive adverse economic conditions. Next, current and savings account. Verify adherence to KYC norms. KYC means know your customer. Check interest calculation has been done properly or not. No transaction for 2 years, then that account will be treated as inoperative account. Okay, if at all there is any no transaction in the account for a period of 2 years, then such account should be treated as inoperative account. Significant reduction in balance of revived inoperative accounts, check authorization for withdrawal. Okay, now an account has become inoperative, and in case such account has been revived and there is a significant reduction in the balance of the account that has been revived, then you should ensure that there is a proper authorization for withdrawal of amount from such a revived inoperative account. Okay, next, Basel III framework. What is this Basel III framework? Basel III framework, it is related to the stress testing. Basically, it will help to increase the ability of the bank to withhold this type of adverse economic conditions. Basel III framework, it will be having various requirements that needs to be complied by the bank. See, like the minimum capital that the bank has to maintain, the SLR requirement, CRR requirement, various ratios, all this will be part of this Basel III framework. This Basel III framework is international framework. Okay, now this will aim at improving banking sector's ability to absorb shocks from financial and economic stress, improve risk management and governance practices, strengthen banks' transparency and disclosure standards. Next, bills payable by the bank. See, with respect to bills payable, following internal controls has to be checked. Standard formats for drafts, mails, transfers and traveler checks should be there. Okay, for DDs, for traveler checks, all these become bills payable, right? So there should be standard format for these documents, and unused forms should be under the custody of a responsible officer. Okay, all the forms which are unused, they should be kept with the custody of the proper officer. Reliable private codes known only to the responsible officer, and signatures on demand draft to be checked with specimen signature book. This point we have already seen. And once a telegraphic transfer or DD is issued, immediately give advice to the concerned bank that in your name a DD or telegraphic transfer has been issued. On payment, paying bank shall send advice to the originating bank. Okay. Next, contingent liabilities. What are the various contingent liabilities that the bank can have? See, you should be very careful with respect to these contingent liabilities, because most of the times they will be off balance sheet items. They will not be entered into the books of accounts. But in case of a banks, to maintain record of these contingent liabilities, an entry has to be passed in the books of accounts, but they will not be reflected in the balance sheet or profit and loss statement, but they will be shown as off balance sheet items. See, claims against bank not acknowledged as debt. Okay, bank has not acknowledged as debt, but other party is saying that bank has to pay. There is a dispute. Now this is a contingent liability. Next example, liability for partly paid investment. Bank has invested in shares of other company, and the price of each share is 10 rupees. Bank has paid 5 rupees. Still 5 rupees is yet to be called by that company. So that becomes contingent liability. Liability for outstanding foreign exchange and derivative contracts. This you'd have learned in your AFM, right? Till the time the derivative contract reaches its expiry date, you don't know how much will be received to you, or how much has to be paid by you. So that becomes a contingent liability. Next, guarantees given on behalf of constituents, acceptance, endorsement, and other obligations, other items for which bank is contingently liable. Now, management representation regarding contingent liability. The auditor should obtain a management representation with respect to contingent liability. Now, in this management representation, what should be there? All off balance sheet items are properly accounted in the books of accounts. Okay, management should give a written representation that auditor, we have accounted all the off balance sheet items in the books of accounts. All off balance sheet items are supported by proper documents. Properly disclosed all contingent liabilities. Disclosed contingent liabilities do not include crystallized liabilities. Crystallized liability means the contingent liability turning into liability is known as crystallization. Okay, so you should not include those liabilities that have crystallized into contingent liabilities. Estimations of a financial effect is based on AS 29. Include management's justification of not disclosing contingent liability whose possibility of outcome is remote. Next, audit procedures with respect to contingent liabilities. What audit procedure the auditor will follow? Ensure non-fund facilities given only to the regular constituents. Okay, non-fund facilities like guarantees has to be given only to the only to the regular customers, and only to those customers with whom bank is having long relationship. Okay, to the regular constituents. If not, inquire financial position of those customers. Adequate internal controls has to be there. Overseas supplier is paid based on shipping documents. Okay, you have to pay the overseas supplier on behalf of the importer only on the production of shipping documents by the overseas supplier. That means only after goods are sent, you need to make the payment. Ascertain adequacy of accounting system, test completeness of recorded obligation. Now, with respect to claims against bank not acknowledged as debt, this is one of the contingent liabilities. So, how you will verify this? Examine relevant evidence, review minutes of meeting, ascertain status of outstanding claims from management. Okay, you have to ask from the management the list of outstanding claims against the management with the management has not agreed or there is a dispute. Review subsequent events, provides evidence about valuation and completeness of those claims against the management. Next, guarantees given on behalf of constituents. This is also one of the contingent liability. Now, how you will verify? Adequate internal control over issuance of guarantees is there. Internal control over unused guarantee form should be there. Examine register to see whether expired guarantees are marked off. Generally, the guarantee will be given by the bank for certain period like 1 month, 2 months, or 3 months. So once that guarantee period expires, you should mark off that guarantee in your register. Next, ensure all guarantees are properly disclosed as off balance sheet items. Next, verify guarantees with letter of guarantee issued by bank and counter guarantee received from the customer. Verify securities held as margin if claim arose. Check whether provision as per AS 29 is required or not. Next, bills for collection. Ensure bills drawn on other branches of bank are not included. Verify outward bills with register maintained. Examine collection subsequent to balance sheet date. Examine procedure for crediting party. Examine controls exist to debit customers. No income to be accrued with respect to bills outstanding as on the balance sheet. Okay, this point we have already discussed earlier, right? But from the point of view of concurrent audit, this discussion is made. Next, audit report of bank shall contain whether balance sheet shows true and fair view. Now, the auditor, he will give audit report, right? So, in that audit report, what should be there? The format as prescribed under under auditing standards, SS 700, that will be there. But this point should be specifically there. Okay, whether balance sheet shows true and fair view, profit and loss shows true balance, whether information and explanation asked by auditor is given. If you see all these points, you will cover even in the regular audit report format as per SS 700. Whether transactions of bank are within powers of that bank, this is an extra point. Returns received from branches are adequate. This point you will cover. However, in regular audit format also, audit report format also, any other matter which auditor considers to be brought to the notice of central government. Next, long form audit report. Now, what should be the procedure with respect to this long form audit report? Generally, in case of banks, there will be statutory central auditor and there will be statutory branch auditors. Now, this LFAR, it should be given by statutory branch auditor to the statutory central auditor. Now, the statutory central auditor at the entire bank level, he will consolidate this LFAR and he will prepare one LFAR for the entire bank. See, to be given by SBA and SCA. SBA means statutory branch auditor, SCA means statutory central auditor. SBA gives LFR to SCA and he consolidates at bank level. SCA submits LFR to management. Okay, the statutory central auditor, once he consolidates the long form audit report, he will submit it to management. Now, place LFR before ACB, audit committee board, with action taken or proposed. This management, it will place the LFR between audit committee board. Now, submit LFR to RBI within 60 days of submission by the auditors. Okay, finally, this LFR should be submitted to RBI within 60 days from the date auditor submits it to the management. Next, reports and certificates. In case of bank audit, the auditor has to give various reports and certificates. Some of the examples include report on internal financial controls of financial reporting, LFR long form audit report, report on SLR requirements. Okay, with respect to statutory liquidity ratio, auditor has to give whether the bank has maintained this SLR requirement of 18% or not. This SLR and CRR, they will be changing quite frequently, like for every 3 months or for every 6 months, the RBI will change them. Now, report on treasury operations, certificate on reconciliation of securities, asset liability management, certificate on interest subsidies and subventions. See, interest subsidy means generally for agricultural loans or for some education loan, the government will allow certain interest subsidy, right? So, with respect to that, a certificate has to be given. Next, certificate on corporate governance for listed banks, authentication of CARO and other ratios reported in notes, report on Ghosh and Gilani committee. So, all these are some of the examples of certificates and reports that you will give. Still, there are various certificates that you will give to the bank based on the requirement of the bank. Next, scope of concurrent audit. What will be included in the scope of concurrent audit? See, the scope of concurrent audit is even wide when compared to statutory audit, because the statutory audit at most the statutory auditor will do audit for 3 days, but concurrent auditor, every day he will be in the bank itself. He will verify each and every transaction. So his scope includes cash, deposits, advances, investments, foreign exchange, housekeeping, other items. Okay. Now, foreign exchange. With respect to foreign exchange, what items you will verify? Check foreign bills negotiated under letter of credit. Check FCNR, foreign currency non-resident accounts, to see debits and credits are permissible under the rules. Basically, there will be FEMA rules, Foreign Exchange Management Act, that should be complied. Next, proper accounting of inward and outward remittances. Inward means foreign exchange receipt, outward means foreign exchange payment. Ensure balances in no-store accounts or within limits. No-store accounts means the account that Indian banks maintain with foreign banks in foreign currency. Ensure reconciliation of no-store and wo-store accounts transaction. Wo-store accounts means foreign banks maintaining their account with Indian bank in Indian currency. Ensure adherence to guidelines issued by RBI or head office. Next, appointment of concurrent auditors. Now, whether concurrent auditor should be the staff of the bank or an external auditor, the decision is left to the bank itself. See, decision of own staff or external auditor is left to the discretion of the individual bank. Tenure will be decided by audit committee board of the bank, generally not more than 5 years. Okay, the tenure of the concurrent auditor will be for a period of maximum of 5 years. Now, do not continue with same branch for more than 3 years. A person should not act as a concurrent auditor of same branch for more than 3 years, and for same bank 5 years. Terms of appointment and remuneration will be fixed by ACB, audit committee board. Now, there will be separate audit committee board for each bank. Okay, just like there is a audit committee for the companies, there will be audit committee board for the banks. Next, reporting. Report serious irregularities to controlling officer, head office. Okay, during the audit, if you find any serious irregularities, you have to immediately report it to head office or the controlling officer. Next, quarterly and annual zone-wise report of findings to ACB. Okay, the concurrent auditor, he will report quarterly and annual zone-wise report findings to audit committee board. Next, report fraudulent transaction immediately to inspection and audit department, chief vigilance officer and branch manager. Okay, if any frauds are identified, you need to immediately report them to inspection and audit department, chief vigilance officer, branch manager. Okay, this is reporting in case of a bank. So by this we have completed revision of audit of bank. Before winding up the class, we have recently launched Lecturepedia app. In this Lecturepedia app, you can practice MCQs and you can also purchase classes of various faculties. You can download Lecturepedia app from Play Store. Okay, so yes, by this I'll be winding up this class as of now. We'll meet in the next class. Until then, take care. Bye bye. See you. In the today's class, we'll be revising professional ethics. Now, if you see in your CA final syllabus, the weightage of this professional ethics is around 20 marks, both theory and MCQs taken together. So this chapter, it is very much important, right? Now, this professional ethics, it can be divided into 4 parts. The discussion that we will be making in this chapter can be divided into 4 parts. First one is overview of code of ethics. Now, in this overview of code of ethics, we will be just seeing some basic introduction. Actually, if you see this code of ethics, it is some 3 volumes book. We will not discuss entire those 3 volumes of books. We will just be going through the overview of code of ethics, just the professional ethics that the chartered accountant, the fundamental principles the chartered accountant should comply with, and threats to such fundamental principles we will be discussing. Just those 2 concepts we will be discussing from here, from overview of code of ethics. Next part is CA Act 1949. Now, if you see some of the sections of this CA Act, with respect to membership, with respect to certificate of practice, with respect to maintenance of branches, with respect to KYC, and we will also be seeing schedules to this CA Act. There will be schedule 1 and schedule 2. Each schedule will be having clauses. In total, there are 34 clauses. All those 34 clauses will be discussing. In fact, if you see from this professional ethics chapter, those schedules are most important. Okay, at least 15 marks you will get from those schedules. Okay, professional ethics is nothing but those schedules. Okay, 80% of the portion constitutes those schedules only, right? You will be already knowing this. Next, you will be having council guidelines and certain self regulatory measures, and these self regulatory measures are recommendatory in nature. They are not mandatory. These are the 4 parts that we are going to discuss in professional ethics. Hope that is clear. Now, going to overview of code of ethics. Now, in this overview of code of ethics, there are, as I have already told you, there are 3 parts, 3 volumes. Now, the first part, it deals with complying with code, fundamental principles and conceptual framework. That is dealt in the first part. But in our syllabus, we will be seeing only fundamental principles and threats to complying with those fundamental principles. Next, part 2 deals with professional accountants in service. Basically, the concepts that are discussed here, they will be covered in schedules. You need not worry. So this one we will be discussing in the form of schedules. Next, part 3 also same, professional accountants in practice. This one also we will be covering through schedules. Next, certain independence standards. In order to maintain independence, there has been certain standards given. So part 4a of these independence standards are applicable for audit and review engagements. Okay, independence that has to be maintained by the auditor in case of audit engagement and review engagements will be dealt in part 4a, and part 4b deals with independence requirements for other assurance engagements. Okay, other assurance engagements we have already covered. SAE series, standards on assurance engagements, right? Now, starting with the fundamental principles. These 5 fundamental principles you already know: integrity, objectivity, confidentiality, professional behavior, professional competence, and due care. Right? Now, for confidentiality, there is certain exception. That means you need not maintain confidentiality in the following situations. What are they? If law or regulation asks you to produce certain documents, and also if it is permitted by law and authorized by client. In these two situations, you need not follow confidentiality. You can disclose the information to that particular authority or to that particular person after obtaining permission from the client. Next, there is a professional duty or right to disclose. Professional duty means, let's say for example, peer review or quality review. Now, in case of peer review, for the peer reviewer to review your documents, you should give your documentation, right? So in such a situation, there is a professional duty on you to submit the information related to the client's audit, right? So that is also exceptional situation where you need not follow confidentiality. Okay. Next, threats to the compliance of these fundamental principles. Now, the chartered accountant, the auditor, he needs to comply with those 5 fundamental principles, but there might be certain threats that might be faced by him in complying with those 5 fundamental principles. What are those threats? First one is self-interest threat. If, let's say for example, you or any of your relative acquires interest in the entity, like acquiring the shares or giving loan to the entity, okay, some form of interest you have acquired, so that will create threat to compliance with fundamental principles. Next, self-review threat. If you are reviewing the work that you have conducted earlier, then it will create self-review threat. Next, advocacy threat. You have promoted the client to such a way that you cannot give any qualified opinion with respect to the client. That is advocacy threat. Next, familiarity threat. You have become very familiar with the client. And intimidation threat. Intimidation means client is dominating you, either in terms of experience or in any other way. Client is dominating you. So in all these situations, it will create threat on you from complying with the fundamental principles. Okay, you might not be able to act independently, you might not be able to act objectively because of these threats. Now, you have to evaluate these threats. After evaluation of these threats, if these threats are at acceptable level, then you need not do anything. If these threats are not at acceptable level, then you have to bring them to acceptable level. So how you can bring them to acceptable level? You can either eliminate the circumstances that are creating the threat, or you can implement safeguards. If elimination of circumstances is not possible or implementation of safeguards is not possible, then the only option available to you is decline or end the engagement. So this way you can address the threats. Next, responding to no clause. What is meant by no clause? No clause means non-compliance with laws and regulations. Now this no clause, it is applicable to auditors of listed entities. Now auditor, when he is conducting audit of any listed entity, if he identifies any non-compliance with law or regulation, he needs to report it to responsible authority, respective authority. Same even with the chartered accountant in service also. If the chartered accountant, see, member who are employees of listed entities, then they should, if they identify any non-compliances by the listed entity, then he should inform them to the respective authority. This is, however, applicable only to senior level employees. Okay, if you have been employed as senior level employee, then in case you identify any non-compliance in that listed entity, you need to report the same to the respective authority. Now, if you see, SA 250 also speaks about this only. Responsibilities of auditor with respect to laws and regulation. Now, what is the difference between SA 250 and NOCLAR? If you see SA 250, it is applicable only for the audits. That means only for chartered accountant who is in practice, it is applicable. Whereas NOCLAR is there na. NOCLAR, apart from audit, it will be applicable even for other assurance engagements. For members in service also it is applicable. Okay, the members who are in employment, for them also this reporting requirement under NOCLAR is applicable. Next, no stakeholders are defined in SA 250, but NOCLAR has defined stakeholders as investors, creditors, employees, and public. And SA 250 doesn't speak about concept of imminent breach. Imminent breach means breach has not yet occurred, but there is possibility of occurrence of breach. So in SA 250, you will not report the possibility of occurrence of breach in the future. Only if the breach of law has occurred, you will report. Whereas as per NOCLAR, even the imminent breach should also be reported. Okay, just a second. Now moving to membership of the institute. Now, in order to be member of the ICI, you have to be chartered accountant. You have to clear CA exams, and there are certain disqualifications. Even though you are a chartered accountant, if you possess these disqualifications, then you cannot be a member of the institute. What are those disqualifications? If your age is less than 21, or if you are of unsound mind. Next, you are a undischarged insolvent, or even though if you are a discharged insolvent, but you have not obtained certificate from the court stating that the insolvency that was caused to you was due to misfortune. Okay, if you are a discharged insolvent, you have to get a certificate from the court stating that the misfortune, that the insolvency that was caused to you was because of misfortune only. Okay, like this you should get a certificate, otherwise you will be disqualified to be a member of the institute. Next, you are convicted of an offense involving moral turpitude and punished with imprisonment or transposition. Transposition means sending from one country to another country for punishment. Okay, previously this was there. Next, proved to be guilty of misconduct on inquiry. Okay, if you possess these disqualifications, then you cannot become member of the institute. Next, types of memberships. There are two types of memberships. One is associate chartered accountant, ACA. Once you qualify as a member of the institute and your name is entered in the register, you can call yourself as ACA. Now, FCA. To call yourself as a FCA, you should be in continuous practice for a period of 5 years in India. Then you can call yourself as FCA. Next, if you are not in a practice, then can't you call yourself as FCA? The answer is a member who is ACA for continuous 5 years and he is not in a practice, but council feels that he possesses such a experience and knowledge as a person who is in practice for a continuous period of 5 years will possess. In such a situation, you can call yourself as FCA. Hope this is clear. Next, removal of name from the register. In the following situations, institute will remove your name from the register. What are they? If you are dead, okay, you are a chartered accountant and you are died, then your name will be removed from the institute's register. Next, you have requested yourself to remove your name, then also it will be removed. Next, you have not paid prescribed fees. See, annually you have to pay membership fees. If you don't pay this membership fees, your name will be removed. However, if you again pay the membership fees, it will be again restored. Okay, now here from which date it will be restored? Let's say for example on 1st April, okay, generally by 30 September. on 30 September 2025, your name has been removed from the register for non-payment of the annual fees. Now, if you pay the annual fees within 1 year from this date, then your name will be restored from this date only. If in case, if you pay annual fees after 1 year, in such a situation, your name will be restored from date of payment of annual fees. Hope that is clear. Next, penalty for falsely claiming to be a member. See, if you are not a member, you are not a chartered accountant, but you are representing yourself as a chartered accountant, or you are a member but you are not having COP, certificate of practice, but you are stating to the public that you are a member in practice. In these two situations, on first conviction, a penalty of up to 1,000 rupees will be imposed on you. On subsequent conviction, imprisonment up to 6 months and fine up to 5,000 or both will be imposed on you. Hope that is clear. Next, certificate of practice. Now, after becoming a member of an institute, if you wanted to do practice, then you have to obtain certificate of practice. Without certificate of practice, you can't do practice. Okay. And for this certificate of practice also, there is separate annual fee that you need to pay. Okay. Next, cancellation of COP. In which situations your COP will be cancelled? If your name is removed from the members register, in such a situation, your COP will be cancelled automatically. Next, it was found that COP was issued to you based on false information. In such a situation also, your COP will be cancelled. Next, member ceased to practice. You have stopped to do practice. If you have stopped to do practice, then what is the necessary of COP to you? It will be cancelled. Next, you have not paid annual fee for the COP by 30 September. In such a situation also, your COP will be cancelled. Again, on payment of the annual fee, your COP will be again renewed. Okay. Next, member deemed to be in practice. Now, what is this deemed practice? What will happen is, if a member obtains a certificate of practice from the institute, then he needs to comply with various rules and regulations that the institute will impose. He needs to comply with the schedules, the clauses, right? Why to take all this headache? What the member will do is, he will not take the certificate of practice, but he will keep the office. He will do all the services except those works that involve signing. So in this situation, to cover those types of members who are providing accounting services, okay, he is a chartered accountant and engaged in practice of accounting. Next, he is a chartered accountant involving in auditing, verification of financial statements, etc., and holds himself to public as an accountant, renders services or assistance on accounting procedures, recording, presentation, etc. Such other services prescribed by council. So in these situations, if you are providing these services and you have not obtained a certificate of practice, then you will be deemed to be in practice and you need to comply with all rules. Hope that is clear. Next, a CA who is salaried employee of a CA firm will be treated as chartered accountant in practice for limited purpose of providing articleship training. Okay. Next, obviously companies should not engage in practice. Okay, if a chartered accountant wants to do practice, then he has to do its practice either in sole proprietorship or partnership or LLP. Another point, a LLP in which a company is a partner should also not engage in practice. Hope that is clear. If at all you contravene this rule, the director, manager or secretary or other officer who is responsible for this contravention will be liable with a punishment of up to 1,000 rupees on first convention and on subsequent convention up to 5,000 rupees penalty. Hope that is clear. Next, maintenance of branches. See, a CA firm, it can have branches. Let's say it is having a head office and it wanted to establish another branch. Now, in this situation, if you wanted to establish a branch, that branch should be having a separate in charge who is a chartered accountant. Okay. So each branch should have separate in charge who should be a chartered accountant. and that in charge who is a chartered accountant should be associated with the firm as a partner or as a full-time employee. Hope that is clear. Now there is a exception from this requirement of separate in charge for the branch. Now let's say for example the branch is located in the same premises. Head office is located in the first floor of a building and branch is located in the second floor of same building. So in this situation it is exception. The branch need not have separate in charge. Okay, next, if branch is having in the same city where the head office is located, let's say in Hyderabad there is head office of CFM, in same Hyderabad there is a branch of this CFM. So in this situation also no separate in charge for that branch is required. Next, branch is located, let's say this is a head office and this head office is located in a particular city. Okay, these are the municipal limits of this city. Now if branch of this CFM is located within 50 kilometers from these municipal limits, okay, if branch is located within 50 kilometers from these municipal limits, then also for that particular branch no separate in charge of CA is required. Hope that is clear. So that is with respect to maintenance of branch offices. Another important point, now that CA in charge of the branch is there, he should be associated with such office and he should reside in such a place where the branch office is located for a period not less than 182 days and he should attend the branch office for a period not less than 182 days. Only then you can call that this CA is in charge of that particular branch. Okay, next, the exemption from second office, we have seen it. And member can place name board at his residence but not the firm name. Okay, at the residence of the member he can mention the name plate but he should not mention the firm name at his house. Okay, next, guidelines for practice in hilly areas. Now for chartered accountants who are having their office in hilly areas, they are permitted to open their branches in the normal plain areas for a period not more than 3 months for a year. Okay, during the winter season they can open the branch in the plain areas. Now when branch is opened in the plain area, you need not close the office in the hilly area, you can continue it. And the address of the branch, that is the temporary office, it should not be mentioned in the stationery. See, can open temporary office in a city in plains for a period not more than 3 months in a year. No need to close the regular office. Next, at temporary office, name boards has to be displayed only during the period of functioning. Okay, only when the branch is opened, only during that period you have to keep the name boards, and remaining periods when the branch is closed you should remove the name boards. Next, do not mention temporary office in letterheads, visiting cards and all other stationery. You should have the address of only head office, not the branch office. Next, inform of opening and closing to the institute. Okay, whenever you open the branch and whenever you close the branch, you should intimate it to the institute. Next, disciplinary proceeding. Now any person can lodge a complaint against a chartered accountant with Institute of Chartered Accountants of India. So to deal with these complaints, there is a disciplinary mechanism. First of all, complaint will be received by disciplinary directorate, and this disciplinary directorate, it will prima facie verify whether there is a guilty involved or not. If the disciplinary directorate feels that prima facie there is a guilty, then it will see under which schedule the guilty is falling. If it is first schedule, the case will be transferred to Board of Discipline. Now Board of Discipline will observe the case whether there is any guilty or not. If it feels that there is a guilty, it will accept. Okay, prima facie it will also check and it will accept if it feels that there is a guilty. If it feels that there is no guilty, it will reject the case and case will be closed. Now if it has accepted, then it will conduct inquiry, and in that inquiry, if guilty is found, yes, if guilty is found, then the board of discipline will reprimand the member. Reprimand means give a warning to the member. Next, remove the name of member for up to 3 months and can also impose penalty up to 1 lakh. If no guilty is found, obviously case will be closed. Okay, this is with respect to the offense or misconduct falling under first schedule. Next, if disciplinary directorate feels that this misconduct is falling under second schedule, then the case will be transferred to disciplinary committee. Same procedure here also. If it feels yes, there might be guilty, it will accept, otherwise it will reject and the matter will be closed. If it has accepted, it will conduct inquiry, and if it finds any guilty, yes, it has found guilty, then it will reprimand the member. Name can be removed for such a period as the disciplinary committee might think, and can impose penalty up to 5 lakh. If you see, for misconduct under second schedule, the punishment is high when compared to the first schedule, because the offenses or misconducts falling under second schedule are somewhat severe. Okay, we will be discussing all these misconducts. Next, if disciplinary directorate on receiving the complaint, it feels that prima facie there is no guilty, in such a situation, it will submit all the information to board of discipline, stating that board of discipline, we have not found any guilty in this case. Once you also cross verify, like this, it will give to board of discipline. Now, if board of discipline also feels that yes, there is no guilty, okay, accepted, then matter will be closed. If board of discipline rejected, that means it is board of discipline is saying that there is a guilty here, then it will advise director of discipline to further investigate. Or if the guilty is falling under first schedule, then board of discipline itself will carry the or will take over the case, because the guilty is under first schedule will be dealt by board of discipline only, right? Proceed if related to first schedule. If related to second schedule, it will transfer to disciplinary committee, right? Because disciplinary committee will deal with second schedule or both. Okay, hope this is clear. And if anyone is not satisfied with the order passed by board of discipline or disciplinary committee, they can file appeal to appellate authority within 90 days. Hope that is clear. Now, schedules. These schedules are very much important. Now, if you see, first schedule is having 4 parts, second schedule is having 3 parts. Now, in the first schedule, schedule 1, part 1 is having 12 clauses. This part 1 deals with professional misconduct of CA in practice. Next, schedule 1, part 2 is having 2 clauses. This part 2 deals with professional misconduct of CA in service. Next, schedule 2, part 3 is having 3 clauses. This part 3 deals with professional misconduct of member in general, okay, whether he is in practice or he is in service. Next, schedule 1, part 4 is having again 2 clauses. This deals with other misconduct, okay, of member in general. Hope that is clear. See, professional misconduct means those misconducts that are related to his profession, okay, his professional work. Other misconduct means misconducts other than related to professional work. Hope that is clear. Next, second schedule. This second schedule is having 3 parts. Part 1 is having 10 clauses. Part 1 deals with professional misconduct of member in practice. Part 2 is having 4 clauses which deals with professional misconduct of member in general. And part 3 is having 1 clause which deals with general or other misconduct of member in general. Okay, so in total you will be having 34 clauses. Okay, now we'll start the discussion of all these clauses. Schedule 1, part 1. Now, for all the clauses in schedule 1, part 1, you have to write this point commonly. A CA in practice is deemed to be guilty of professional misconduct if he, okay, this line is common for all the clauses. Okay, a CA in practice will be deemed to be guilty of professional misconduct as per clause 1 if he allows any person to practice in his name as a chartered accountant, unless such other person is also a chartered accountant in practice and is associated with him as a partner or employee. Okay, now a chartered accountant in practice should not allow other person to use your name for his practice unless such other person is also a CA in practice and he is in partnership with you or he is employed by you. Hope that is clear. So these are the exceptional situations in which you can allow other person to use your name for his practice. Okay, next clause 2. Now as per clause 2, what clause 2 says is you should not share your professional receipts with other persons. However, there are certain exceptional people with whom you can share your professional receipts. See, as per clause 2, you will be deemed to be guilty of professional misconduct if you pays or allows or agrees to pay or allow directly or indirectly any share, commission or brokerage in what? In the fees or profits of his professional business to any person. Okay, you should not share the profits of your professional business to any person other than. That means these are exceptions. With these people you can share. Who are they? A member of institute. Okay, you can share your professional profits with member of institute or your partner or retired partner. Okay, if your partner has retired, even with the retired partner you can share your professional fees, or legal representative of deceased partner. Deceased partner means partner who has died and his legal representatives. With his legal representatives you can share your fees, provided the sharing is permitted as per the partnership agreement. Okay, the partnership agreement should permit sharing of professional fees with the legal representatives of deceased partner. Okay, next you can also share your fees with member of any other professional body. What are these professional bodies? There is a list of some 5 professional bodies that are given, we will see. Or with such other person having such qualification as may be prescribed. Okay, if the person is having such qualification as may be prescribed, you can also share your fees with that person. We will see who are these. Okay, the professional bodies and the persons having such qualifications we will see, for the purpose of rendering such professional services from time to time in or outside India. Okay, so with these people you can share your professional fees. Apart from these people you cannot share your professional fees with anyone. Now what are those professional bodies that are allowed to share fees? See, if any person is member of these 5 professional bodies, they are ICSI, that means company secretaries, ICWAI, CMS, Bar Council advocates, Indian Institute of Architects, that is architects, Indian Institute of Architectures. So if any person is member of any of these 5 institutes, chartered accountant can share his professional fees with these people. Okay, next, persons who are having following qualifications: company secretary, cost and management accountant, actuary, bachelor in late means law, architect, technology, engineering. If you are having bachelor in any of these subjects with them, or MBA. Okay, so with these professionals or people who are having with these qualifications, with them chartered accountant in practice can share his professional fees. Okay, next, percentage of fee can be paid to government to meet administration expenditure. See, sometimes what happens is, mostly in case of state cooperative society audits, for the purpose of meeting administrative expenditure, government will ask the auditors to pay certain amount of their fees to the government. Okay, so such payment to the government is allowed. It should not be treated as sharing of the profit. Okay, next, check substance over the form. Now in sometimes or in some situations what will be happening is, a chartered accountant, he will share his professional fee with other person, but the name that he gives will be different. He will not use the name commission, brokerage, share of profit. Without using these names, by using some other names like rent. Okay, he will say that he has taken a property as rent from him, and for that property he is paying the rent. Actually rent for that property would be only 5,000, but he is paying 50,000. So you have to see substance over form. Okay, so remaining 45,000 is there na, that he is paying as a share of profit. So you should observe this, you should identify this, you have to give importance to substance over the form. Okay, next, profit sharing with legal heir of deceased partner or member. Now, in case of partnership firms, as I have already told you, if the partnership agreements allows, the partners can share their profits with legal representatives of deceased partner. This is with respect to partnership firms. Whereas in case of a proprietorship firm, you cannot share profit with legal heirs of the proprietor. See, there is a chartered accountant CA Raju. Now he is having a practice from last 25 years. He is doing the practice. Now suddenly he dies. Now legal representatives of CA Raju, they wanted to sell his practice to some other chartered accountant. Now in this situation, the legal representatives cannot ask that chartered accountant to give share in the profits that he will earn. Okay, instead the legal representatives have to sell entire proprietorship firm on an outright basis for goodwill. Okay, sharing of profit is not allowed in case of sole proprietorship firm. See, no sharing of fee or profits, however, can sell goodwill to other eligible members of ICAI. Now, if death of the proprietor has occurred on or after 30 August 1998, then name of that proprietorship firm will be kept in abeyance for a period up to 1 year from the date of death. That means within 1 year from the death of the member, the legal heirs of that member has to sell the sole proprietorship firm to other member, because that name will be kept in abeyance. That means will be kept open by the institute only for 1 year. After 1 year, the institute can allot that name to some other members. Okay, next, if death has occurred on or after 30 August 1998, but there is a dispute of legal heir. Okay, death has occurred after 30 August 1998 only, but there is a dispute regarding who is the actual legal heir. In such a situation, you have to intimate the institute that there is a dispute regarding the legal heir. Then institute will keep the name of the firm in abeyance for a period up to 1 year from the date of resolution of the dispute. Hope that is clear. Next, if the death has occurred before 29 August 1998, in such a situation, sale should be completed before 28 August. This is not 1998, 1999. Okay, death occurred before 20 August 1998, then sale should be completed by 28 August 1999, and name is still available with the institute. Okay, institute will give this name only if it is still available with the institute. Okay, if death is occurred before 1998, because basically this provision was a transitionary provision. Okay, previously there was a different provision in this place, and for transitioning from old provision to new provision, this point was kept. Okay, this is not relevant as of now, because 1998 has already completed, and the last date for completion of sale, that is 28 August 1999, also got completed. Okay, next, clause 3. See, as per clause 2, you should not share your profits with other people. As per clause 3, you should not accept profits of other people. Okay, vice versa. See, you will be deemed to be guilty of professional misconduct if you accept or agrees to accept any part of profits of professional work of person who is not a member of the institute. However, here also certain exceptions are available. See, provided that nothing herein contained shall be constituted as prohibiting a member from entering into profit sharing or other similar arrangements, including receiving any share, commission or brokerage in fee with member of such professional body or other person having such qualifications as referred to in item 2 of this part. Item 2 means in clause 2. In clause 2, we have discussed certain professionals, we have discussed certain members of professional bodies with whom the chartered accountant can share his fees, right? So with from the same people, chartered accountant can also accept a share of their profits, okay, from CS, from CMA, from architecture, from actuary, from MBA, okay, from people who are having a bachelor in late, from all these people, from advocate, chartered accountant can accept share of their profits, okay, as per clause 3. Next, clause 4. Now clause 4 deals with entering into partnership. As per clause 4, chartered accountant should not enter into partnership with any person, but however there are certain exempted categories. With those exempted category people, you can enter into partnership. Again, the same names will get repeated. See, a chartered accountant in practice will be deemed to be guilty of professional misconduct if he enters into partnership either in or outside India with any person other than CA in practice. That means from here it is exception. With a CA in practice, you can enter into partnership, or such other person who is member of any other professional body having such qualifications as may be prescribed. The list we have seen, the same list. Next, including a resident who but for his residence abroad would be entitled to be registered as member under clause 4. That means a chartered accountant has went abroad, okay, he has done CA in India and he has also done some course of abroad CA, and he is doing practice outside India. Now if CA who is doing practice in India wants to enter into a CA who is doing practice outside India, it is permitted, okay. With those people also you can enter into partnership agreement, okay, of subsection 1 of section 4, or whose qualifications are recognized by central government or council for the purpose of permitting such partnerships, okay. Except with these people, you cannot enter into partnership with any other person. So what are those professionals? Same: CS, CMA, advocate, engineer, architect, actuary, okay. Next, clause 5. Now this clause 5, clause 6, clause 7, these 3 clauses, they will deal with advertisement, okay. See, as per clause 5, a member in practice shall be deemed to be guilty of professional misconduct if he secures professional works. That means if he get any professional work from the services of a person who is not an employee of such a CA, or who is not his partner, or by means which are not open to chartered accountant or to achieve any professional business, okay. He should not get any professional business from services of a person who is not his employee or who is not his partner, provided that nothing herein contained shall be considered as prohibiting any agreement permitted in terms of clause 3, clause 2 and clause 4, okay. This will not prohibit chartered accountant from entering into any type of agreement that is permitted as per clause 2, 3 and 4, okay. Next, clause 6, this also deals with advertisement only. Now a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he solicits means again securing, okay, tries to securing any clients or professional work either directly or indirectly by circular, okay. Circular means like pamphlets, issuing pamphlets, or advertisement, or personal communication, or by interview, or by any other means, okay, provided that nothing herein contained shall be considered as preventing or prohibiting any CA from applying or requesting for an inviting or securing professional work from another CA in practice. See, you should not solicit work through circular, through advertisement, through personal communication, or through interview. However, you can ask another CA who is in practice to give some work, because you are asking another CA only, your peer only, that is allowed. Next, you can also respond to tenders. Sometimes what will happen is clients, the people who wanted the services of CA, they will issue tenders. Now the chartered accountant, he can participate in the tenders, provided the tenders are for the services that are not exclusively reserved for the chartered accountant, okay. Let's say for example, if the tender is for a service which is exclusively reserved for the chartered accountant, like audit. Now a tender is issued by an organization for audit. Now, chartered accountant, he should not participate in that tender because that tender is for a service which is reserved for chartered accountant. Only CA should provide audit, and for that audit service they are issuing tender, so you should not participate. Okay, but however, there is an exception for this rule. What is the exception? If in such a tender, the minimum fees that has to be quoted is prescribed, in such a situation, you can again participate in the tender. Let's say an organization issued a tender for audit service, and in that tender, it is mentioned that a minimum fee of 1 lakh rupees should be quoted. Now, in such a situation, chartered accountant, he can participate in the tender even though it is for a service that is exclusively reserved for the chartered accountant, because the minimum fee is prescribed there. Okay, so this is with respect to the tenders in the areas that are exclusively reserved for chartered accountant. Next, if tenders are for services that are not exclusively reserved for chartered accountants, okay, anyone can provide those services like filing income tax returns, preparing financial statements, or providing any consultancy services. For providing these services, you need not be a chartered accountant, anyone can provide. So in these types of services, in these types of tenders, chartered accountant can participate even though minimum fee is not fee to be quoted is not prescribed. Hope that is clear. So the same points I have explained here. Next, further prohibition. See, various types of advertisements that are prohibited. I have given the list. Advertisement and note in the press. You should not give advertisement or note in the newspaper, but there are certain exceptions. First one, requesting another chartered accountant to give work. For that, you can give advertisement. Next, if at all there is change in details of your firm, like change in phone number or change in address, so for advertising these changes, you can give advertisement in the newspaper. Next, if any of your article student has qualified CA, then congratulating that article student, you can give advertisement, but you should make sure that advertisement should be restricted to mere statement of such fact. Okay, if you wanted to communicate change of address, only change of address should be communicated. If you wanted to congratulate your article student, only the congratulations should be there. Apart from that, nothing should be there. Hope that is clear. Next, application for empanelment for allotment of audit and other professional work. See, you can make applications for getting your name listed in the empanelments, provided you are having knowledge that that organization is maintaining a empanelment. Generally, RBI will maintain empanelment, central government will maintain empanelment, some authorities of central government will maintain empanelment. So if you are having knowledge that they are having a empanelment of chartered accountant, you can make application asking them to list your name in the empanelment. But you should not make applications to random persons stating that if at all you are having a empanelment, include my name in the empanelment. That is wrong. Okay, that is known as roving applications asking to include your name in the empanelment. That is prohibited. Okay, next, publication of books, articles, or presentation. You can publish books, you can write articles, you can do presentations. However, in those books, in that books which you write, mentioning professional attainment is prohibited. Okay, in those presentations, books, and articles, you should not mention professional attainments like I have done this course, I have achieved this achievement, these types of I have received this award, these type of attainments you should not mention. However, you can mention your firm name. Okay, firm name is allowed. It is you have to remember this. Okay, in the books that you publish, in the articles that you write, you can mention the firm name. Okay, next, issue of greeting cards or invitation. Let's say, for example, a particular chartered accountant is getting married, and in that invitation card, he is mentioning his designation as CA. Now, if you mention your designation as CA, these invitation cards has to be issued only to the friends, relatives, and clients of the member concerned. Apart from these people, you should not issue that invitation card to anyone, because there you have mentioned your designation as chartered accountant. Okay, now here another important point to be remembered. They have used the term friends, clients, relatives of members concerned. That means, let's say A, B, C and Co is a CA firm in which Mr. A, Mr. B, Mr. C are partners. Now A is getting married. In this situation, the invitation card is there na, that has to be issued only to the friends, relatives, clients of Mr. A, but not to the friends, relatives, clients of B, not to the friends, relatives, clients of C. Hope that is clear. Because they used the term members concerned. Next. Advertisement for silver, gold and platinum or centenary celebrations. You can give advertisement for these celebrations. Next, sponsoring activities. See, a CA firm generally it cannot provide any sponsorship activity, but there are exceptions. If the program is being conducted by program organization unit of ICAI with prior approval of CPE directorate, in such a situation, CA firm can sponsor these programs, or in members CSR activities can use CA prefix. Now a member he has given certain donation or he has constructed certain hospital, some CSR activity member has done. So for those CSR activities he can mention his designation as CA, but he cannot use firm name and CA logo. You cannot use CA logo and firm name for CSR activities of member. CSR activities of member means donations that the member gives or charitable activities that the member does. Next, advertisement of teaching coaching activities by member. You should not advertise your teaching or coaching activities if you are in practice. If you are not in a practice, you can advertise. There is nothing wrong in that. Next, see, all these rules are only for members who are in practice. Okay, part 1 is completely for members who are in practice. Next, sharing firm profile with prospective client. See, the other person is not your client, but if you share your profile and if you tell to that person about yourself, he might become your client. He is known as prospective client. Now you should not share your firm profile with the prospective client on your own. However, if he himself asks you, you can share. Okay. Next, television or movie credits. Now if let's say for example, for a particular movie you have done an audit. Now in the credits, in the names, like in the beginning of the movie you will get names, right? The who is hero, who is director, who is producer, the names you will get. So in those names you can allow your firm name to be represented as auditors for that movie, but you should take care that your name will be represented just like any other names are represented. Okay, in the same format as any other names are represented. There should not be any special characteristics for your name. Next, acceptance of original professional work by a member emanating from client introduced to you. See, Mr. A is a chartered accountant, Mr. B is a chartered accountant. Now Mr. A, he deals only with income tax clients. Now one particular client wanted GST services, so Mr. A referred him to Mr. B who provides GST services. Now next time this client is there now, who Mr. A has referred to Mr. B, he wanted another service. Now for that another service he has directly approached Mr. B. Now in this situation, since this client was referred to Mr. B by Mr. A, Mr. B should ask the client to come through Mr. A. Hope that is clear. Next, council guidelines for advertisement. See, giving advertisement through write-ups is permitted. Write-up means by writing an article you can advertise about your firm, but for this also there are certain conditions. The font size should not exceed 14 and there should not be any exaggerated claims about your firm. Okay. Next, website. A chartered accountant firm, it can have a website. Whether any specific format is prescribed for the website? No, there is no specific format. There is no guidance with respect to colors. You can use whatever colors you wanted. And another important point is this website should operate on pull basis. It should not operate on push basis. What is this pull basis and push basis? Push basis means you are giving advertisements of your website on Google. That is known as push basis. You are pushing your website to the users. Okay, you should not do that. Instead, it should operate on pull basis. Website should just be there like that. When user specifically asks for your website, it should be popped up before the user. That is known as pull basis. Next, in the website, the passport size photos of members can be displayed. You cannot display full size photos of the members. Next, you should not disclose the name of your clients. However, if the law or regulation or any authority specifically requires to disclose name of the clients, then you can disclose. And website link can also be provided in the social media platforms. Okay. Next, online third party platforms. There will be various third party platforms wherein you can register yourself as a CA and you can provide services. Now, through these platforms, you have to provide only consultancy services, and on this website you should not provide your address. Okay, you cannot provide your contact address. Next, publication in telephone or other directories. You can include your name in the telephone directory, but only under the category chartered accountants, and it should be in alphabetical manner, and it should not be highlighted. It should be, your name should be represented just like other names are represented. Okay, and the telephone directory should be circulated in the local area. Okay, that is belong to the same town. Next, listing on application based service providers. What are these application service providers? Example, Urban Clap. Now on this Urban Clap, there will be various service providers. Okay, carpenters, barbers, okay, plumbers, various service providers will be there. So you should not list your name in such type of platforms. Okay, in such type of application based service provider aggregators. Next, exemption. You can advertise name and address of firm for recruiting staff for own office or client's behalf. Okay, you can also give an advertisement for hiring staff for your firm or for your client. Okay, that is clause number 6. But however, you should not use the term well-known firm. Next, clause 7. Now, if you see clause 7, it deals with advertisement as well as using the designation chartered accountant. Okay, so as per clause 7, you will be deemed to be guilty of professional misconduct if you advertise your professional attainments or services or uses any designation or expression other than chartered accountant on professional documents, visiting cards, letterheads, signboards, unless it be a, that means these are permitted, these are exemptions or exceptions, unless it be a degree of university established by law. Okay, if that designation is degree of a university established by law, then you can use it along with CA in India, or recognized by central government if the designation is recognized by central government, or title indicating membership of Institute of Chartered Accountants of India, the designation CA, you can use it, or of any other institution that has been recognized by central government or maybe recognized by the council. Okay, that these designations you can use, provided that member in practice may advertise through write-up. This point we have already discussed, setting out the services provided by him or his firm and particulars of his firm subject to such guidelines as may be issued by the council. Now, certain other designations. Generally, on professional documents, apart from chartered accountant, he cannot use any other designation, but there are exceptions. If the chartered accountant is also a insolvency professional, that is IP, then he can use this designation insolvency professional. Next, if chartered accountant is also a registered valuer, he can also use this designation registered valuer along with the profession CA. Next, if chartered accountant is a member of foreign institutes of accountancy like USTPA or England, Wales, so these designations of foreign accountancy bodies the chartered accountant can use. These are exceptions. Next, date of setting up of practice you should not mention in your stationery. Next, practice as advocate. See, the ICAI has allowed chartered accountant to do practice as advocate if you have cleared LLB, the bar council exam, but the other side, bar council has not allowed chartered accountants to do practice as advocate. Hope that is clear. Next, practice as company secretary or cost management accountant. See, if you are dual qualified or triple qualified, then you can do practice as CS or CMA, but not simultaneously. Okay, you can do either only one practice. Okay, you can practice as a CA, or you can practice as a CS, or you can practice as cost accountant, not simultaneously. Okay, any one. Hope that is clear. Next, writing articles or letters to press, this is allowed. You can use designation CA. Next, size of signboard. Signboard means in front of your office you will keep the name board of the office, right? So there is no specific size that has been prescribed. It is left to the choice of the members, but you should take care that it should look professionally. Okay, you should not use LED lights and all those things. Next, public announcement with the details of director. Now, a chartered accountant who is in practice can act as a director simpliciter of a company. Now, whenever that company is making any public announcement wherein the name of the director is mentioned, care has to be taken that the firm name of the director who is also a CA should not be mentioned in that public announcement. Okay. Next, clause number 8. See, as per clause 8, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he accepts a position as auditor that was previously held by another chartered accountant or a certified auditor who has been issued certificate under restricted certificate rules 1932 without first communicating with him in writing. Okay. Now, if you are getting appointed as auditor of a company and previously some other person has audited that company, before accepting the position of auditor, you should first of all communicate with the previous auditor. If you accept without communicating with the previous auditor, you will be deemed to be guilty of professional misconduct under clause 8. Now, there will be certain reasons. First of all, if there has been non-compliance with section number 139 and 140 of Companies Act, then the new auditor should not accept the appointment as auditor of the company. See, section 139 deals with appointment of auditor. For appointment of auditor, there is certain process that has to be followed. Section 140 deals with removal of the auditor. For removal also certain process has to be followed. So if 139 and 140 is not followed by the company, in such a situation, the new chartered accountant, the new auditor should not accept audit of that company. Next, if undisputed professional fee of previous auditor is not paid by the firm, is not paid by the company, in such a situation also the new chartered accountant should not accept audit of that client until and unless the undisputed fee is properly paid to the previous auditor. Hope that is clear. Next, if company has removed the previous auditor because of the fact that the previous auditor has given a qualified opinion or modified opinion, in such a situation, new auditor, he can accept the audit if he feels that unmodified opinion can be given in the situation. Okay, these are the scenarios, and this is applicable to all types of audits. Okay, for all types of audit engagements, before you are accepting the uh, audit engagement, you have to communicate with the previous auditor except for special audits. Okay. Next, not applicable for bookkeeping, certification and other cases where outgoing auditor is not a CA. Next, there should be proof of communication. See, you are saying that you have communicated with the previous auditor, but what is the proof? So if you are communicating through post has to be sent to registered post acknowledgement due, or if you are communicating through electronically, you can send mail, or if you are communicating physically, you are going to the previous auditor and giving the communication to the previous auditor, then you should take acknowledgement from that previous auditor. Okay, so there should be proof of communication available. Now you have sent a post of communication to the previous auditor and the post is returned to you stating that premises locked or no address is found. In these two situations, it will be deemed that you have communicated with the previous auditor. Hope that is clear. This point is a non-payment of undisputed fee. This is not applicable in case the company is a sick unit. Okay, sick unit means its net worth is negative and it is not making any profits for the past 5 years. Okay, that will be known as a sick unit. Next, tight time schedule. In some situations, what will happen is the time available for accepting the audit is very limited. You have to conduct the audit immediately, like in case of bank audits. Okay, once you receive the audit, within short span you have to visit the branch, and within 2 to 3 days you have to complete the audit. In such a situations, once you receive the audit, you will communicate to the previous auditor, and if you wait for approval from the previous auditor, the time available to conduct the audit will lapse. So you will accept the engagement subject to the communication receivable from the previous auditor. Okay, such conditional acceptance can be given by you. That is clause 8. Next, moving to clause number 9. This clause number 9 we have discussed in clause 8 only, section 139 and section 140. You will be deemed to be guilty of professional misconduct if you accept an audit without first ascertaining from the company whether it has complied with section number 139 and 140 of the Companies Act 2013. See, section number 139. For applying you as an auditor, certain procedure has to be followed. Okay, communication has to be made to the MCA, and certain forms has to be filed, and also approval of shareholders through general meeting has to be taken, right? So all these requirements are there, which are mentioned in section number 139. That requirement changes. If the company is a government company, it will be different. If it is a non-government company, it will be different. So all the provisions has to be complied while appointing you as an auditor. So if the company has appointed without complying those provisions, and you have accepted that audit, in such a situation you will be deemed to be guilty of professional misconduct. Hope that is clear. Next, clause number 10. As per clause number 10, you will be deemed to be guilty of professional misconduct if you charges or offers to charge, accept or offers to accept in respect of any professional employment fees which is based on a percentage of profit, or which are contingent upon future findings or results of such employment, except as permitted under any regulation made under this act. See, you are accepting an engagement, and the fee for such engagement is agreed as a percentage of profit. That means if the entity gets 100 crore profit, of that profit my fee will be 2%, 3%, 5%. Such a percentage of fee is completely prohibited. Okay, next, fee which is contingent upon future findings. You have appointed as an auditor, you have been appointed as auditor, and if you find 10 mistakes, fee will be this much. If you find 20 mistakes, fee will be this much. If you find 30 mistakes, fee will be this much. Okay, thus that type of fee is also prohibited. Hope that is clear. However, there are certain exceptions. So in these exceptional situations, fee can be based on percentage of profit. First one, liquidator or receiver. Okay, if you have been appointed as a liquidator of a company, in such a situation you can accept fee on percentage of assets realized. Next, you for the audit of cooperative societies, percentage of fee is allowed. Next, if you have been appointed as a valuer, percentage of fee is allowed. For fundraising services, debt recovery services, cost optimization services, and such other audits or services as decided by the council. All these services, I'll just explain this cost optimization service. Remaining all, I guess you know. Now, sometimes what will happen is, let's say a product is being sold at 10 rupees. Okay, and that product is being manufactured at 6 rupees, and company on selling that product, it is just making 4 rupees profit. Now here, company has appointed a chartered accountant to provide cost optimization service. That means chartered accountant is appointed to reduce this cost of 6 rupees. So he has suggested various methods and various procedures wherein the 6 rupees has reduced to 4 rupees. So there is a savings of 2 rupees in cost. Let's say annually company sells some 1 crore products. 1 crore into 2 crore rupees savings. So 2 crore rupees of cost has been optimized. Now percentage of cost optimized, let's say 10%. CA has told that I will charge 10% of cost optimized. Into 10%, it will be 20 lakh, right? So 20 lakh fee. So this type of percentage of fee is allowed in case of cost optimization services. Next, clause number 11. A chartered accountant in practice shall be deemed to be guilty of professional misconduct if he engages in any business or occupation other than profession of chartered accountant unless permitted by the council. See, if you are in CA in a practice, you should do only practice. Apart from practice, you should not do any other service, any other activity, any other profession. However, there are certain exceptions. What are they? Now, these exceptions are there, na? They are covered under two parts. First one, general resolution. What the institute has done is, for certain type of uh, activities or for certain type of duties, institute has given general resolution. That means a chartered accountant who is in practice, if he wanted to take up any of these activity or any of these work, he can do that without specifically asking permission from the institute. Next, if chartered accountant wants to do any of these activities, then he requires a specific resolution. That means special permission from the institute. Okay, now let us see. First of all, those designations or those works falling under general resolution. First one, employment under chartered accountant in practice or firms of such chartered accountant. Okay, if you wanted to act as employee of a CA firm, you can join as an employee without taking any specific permission from the institute, because institute has given general permission. Next, private tutorship. If you wanted to give any private tuitions, private tuition means some one or two people will privately come to you and will take tuitions from you. That is also completely allowed without any specific permission. Next, authorship of books and articles, holding life insurance agency. This is important. A chartered accountant in practice, he can hold a life insurance agency license, but that license should be held only for the limited purpose of getting renewal premiums. But he should not make any, or he should not issue any new LIC policies. That means before he has become CA or before he has entered into practice, he might be holding LIC license, and under that LIC license he might have issued certain policies. Now, for those policies which he has issued prior to becoming CA or prior to entering into practice, on them to receive renewal commissions, he can hold that license as it is. But after entering into practice, he should not issue any fresh policies. Hope that is clear. Next, attending classes and appearing for any examination, that is also generally permitted. Holding public elective offices such as MP, MLA, MLC, that is also allowed. Honorary office leadership of charitable education allowed. Acting as notary public justice of peace, specific special executive magistrate. Part-time tutorship under the coaching organization of the institute. Now, if you see in the branches of the institute, there will be coaching classes. So for those coaching classes, you can act as a mentor. That is completely allowed. Next, valuation of papers, acting as paper setter, head examiner or moderator for any examination. Editorship of professional journals, acting as a surveyor and a loss assessor under the Insurance Act. See, whenever any claim comes to the insurance company, for assessing the loss, how much loss has occurred, a surveyor or loss assessor will be sent. So a chartered accountant, he can act as a surveyor or loss assessor. Next, acting as recovery consultant in the bank. Next, owning agriculture land and carrying out agriculture activity. Okay, a chartered accountant who is in practice, he can own agricultural land and he can do agriculture. That is generally permitted. You need not take any special permission. Next, specific resolution. For these activities, you have to take special permission from the institute. Full-time or part-time employment in business concerns. Okay, being chartered accountant in practice, if you also wanted to engage in employment in any organization, then you have to take specific permission from the institute. However, institute will not permit. Okay, next, full-time or part-time employment in non-business concern, like some charitable trust or NGOs, you wanted to join as an employee being a chartered accountant in practice, then you have to take specific permission from the institute. Next, office of managing director or whole-time director of body corporate within the meaning of Companies Act. See, if you want to act as a normal director simpliciter, you can become a director without specific permission. But if you wanted to get appointed as managing director or whole-time director, see, this managing director or whole-time director or such a positions where you have to continuously associate with the company 24/7. You need to employ. If you remember the SPOM set a Companies Act Directors chapter, there I have told you managing director and whole-time director are in employment with the company. Okay, since you are entering into employment with the company, you have to take a specific permission from the institute. Next, if you have acquired any interest in the family business concerns, then also you should get permission. Next, interest in any educational institution, part-time or full-time lectureship for courses other than those relating to institute's examination conducted under the auspices of ICAI. Okay, if you wanted to provide coaching for any examinations other than ICAI examinations, then also you should get specific permission. Next, part-time or full-time tutorship under any educational institution, editorship of journal other than professional journal. See, if you wanted to act as editor of professional journal, then no permission is required, general permission is given. If you wanted to act as editor of other than professional journal like a movie journal, sports journal, in such a situation you have to take permission of ICAI. Next, any other business or occupation for which executive committee considers that permission is necessary. Hope that is clear. That is clause number 11. And some questions: whether CA in practice can be director of a company? The answer is yes, you can act as director simpliciter, but you cannot act as whole-time director or managing director. Next, whether CA in practice can be promoter or promoter director of company? Obviously you can be a promoter of a company. Okay, next, clause number 12. As per clause number 12, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he allows a person not being member of the institute or not being his partner to sign on his behalf of or on behalf of his firm any balance sheet, profit and loss account or report or financial statements. Okay, if you have conducted the audit, only you have to sign the financials or any report or any certificate. You should not allow any other person who is not member of an institute or who is not your partner to sign that certificate or financials. However, certain routine documents will be there, like in your office, if you have received the post, then acknowledgement that the post has been received, that has to be signed. So that signature can be signed by anyone on your behalf. Or you have issued audit queries to the client. Now in this audit queries list, you are not providing any opinion or you are not certifying, so that audit queries list can also be signed any of your article assistant or any of your employee on your behalf. Next, let's say for example, still some routine documents like watching. Now your audit assistant, he has conducted the watching. Now the fact that watching has been completed, it can be signed by your article assistant on your behalf, because there any opinion is not provided. Okay, so like this, these routine documents, signing of routine documents can be delegated to other people to sign on your behalf. But signing of certain documents like financial statements, balance sheet, audit report, certificates, okay, there some assurance is provided, some opinion is provided, so only you should sign them. Okay, that is clause 12. Complete part 1 schedule 1 is completed. Now moving to part 2 schedule 1, which deals with professional misconduct of a chartered accountant in service. Now part 1, as per part 1, see, for this part 2, the common line that you have to use is a chartered accountant in service shall be deemed to be guilty of professional misconduct if he pays or allows or agrees to pay directly or indirectly to any person any share in the emoluments of employment undertaken by him. Okay, now he is employee of a company, he will receive some salary. Out of this salary, he should not share any of his emoluments to any person. Hope that is clear. Next, clause 2. Clause 1 says your salary you should not share. As per clause 2, you should not accept share or profit of others. See, you will be deemed to be guilty of professional misconduct if you accept or agrees to accept any part of fee or profits or gains from following people, from whom? Lawyer, chartered accountant, or broker engaged by your company. Now the chartered accountant, he can be employed with the company, or he can be employed with a firm, or he can be employed with a person. Okay, these three can be employers of chartered accountant. Okay, chartered accountant can do employment with a company or a firm or a person. Now this company or a firm or a person might hire a lawyer for providing services to them. They might hire a chartered accountant for providing audit services to them. They can also hire a broker. So from this lawyers, chartered accountant, broker, the chartered accountant who is employee of these people should not take part of their profits. And also the chartered accountant who is employee of these people should not from the agent or customer of such company, firm, or person by way of commission or gratification. Okay, you should also not accept any commission or gratification from the agent or customer of this company, firm, or person with whom the chartered accountant is employed. Hope that is clear. That is part 2. Next, moving to part 3. Now this part 3 deals with professional misconduct of chartered accountant in general. Okay, that means both for CA in practice as well as CA in service. Now clause 1, you will be deemed to be guilty of professional misconduct if not being fellow of institute acts as fellow of institute. Okay, you are not a FCA, but you are telling that you are a FCA. Okay, you are a ACA, but you are telling you are a FCA. Then you will be deemed to be guilty of professional misconduct. Next, clause 2, does not supply the information called for or does not comply with the requirements asked for by the institute. Okay, institute, it might ask you some information from you. You should provide that information, otherwise you will be guilty of professional misconduct. Or council of the institute can ask you some information, or any of its committees might ask, or director discipline, board of discipline, disciplinary committee, quality review board, or appellate authority. Okay, if any of these people ask you any information or asks to do any particular activity, you have to comply with it, otherwise you will be deemed to be guilty of professional misconduct. Next, clause 3, while inviting professional work from another chartered accountant, or while responding to tenders or inquiries, or while advertising to write up, or anything as provided for in items 6 and 7 of part 1 of the schedule, gives information knowing it to be false. Okay, while taking or while asking any work from another chartered accountant, or while responding to the tenders, or while advertising through a write up, if you provide any false information, then also you will be deemed to be guilty of professional misconduct under clause 3. Next, part 4. Part 4 deals with other misconduct. These are not related to profession, and these are applicable for all the members, whether in practice or in service. Clause 1, you will be deemed to be guilty of professional misconduct. C, is held guilty by civil or criminal court for an offence which is punishable with imprisonment for a term not exceeding 6 months. Okay, if you have been convicted of an offence by civil or criminal court and imprisonment that has been given to you is not exceeding 6 months, that means imprisonment is 6 months or less, then you will be guilty under clause 1 part 4. Now a question might come to you, what if imprisonment is exceeding 6 months? If imprisonment is exceeding 6 months, you will be guilty of misconduct under schedule 2. Schedule 2 part 3 clause 1. Okay, next, clause 2, if in the opinion of the council, see, you will be deemed to be guilty of other misconduct if in the opinion of the council brings disrepute to the profession or the institute as a result of his action, whether or not related to his professional work. Okay, you have committed such an activity that will bring disrepute to the profession, that will bring disrepute to the institute, then you will be guilty of professional misconduct. Let's say, for example, you have committed a robbery. Now, robbery is nothing to do with your professional work, but this act of you committing robbery is bringing disrepute to the entire profession. So you will be guilty of other misconduct. Okay. So these are the 4 parts of first schedule. Now, moving to second schedule. As I have already told you, in this second schedule, there will be 3 parts. Of these 3 parts, the third part I have already discussed to you, right? If a chartered accountant is has been convicted of an offense, and either criminal court or civil court has given him an imprisonment of more than 6 months, then he will be deemed to be guilty of misconduct under clause 1 of part 3. So part 3 of second schedule, it is done. Now we'll start with part 1 of second schedule. This part 1 of second schedule is applicable to chartered accountant who is in practice, and this deals with professional misconduct. Now, what is the difference between first schedule and second schedule? See, the offenses under or the misconducts under first schedule are not much severe, whereas the offenses or the misconducts under second schedule are more severe when compared to the first schedule. Now, clause 1, part 1, schedule 2. A chartered accountant in practice shall be deemed to be guilty of professional misconduct if he discloses information acquired in the course of his professional engagement to any person. This is confidentiality requirement. We have discussed the fundamental principles, confidentiality. Even this clause also dealing with confidentiality only. However, there are exceptions. Other than that, means for these people he can disclose. Who are they? Other than his client, so engaging him without the consent of his client. That means by taking consent of his client, he can disclose the information of the client, or otherwise than as required by any law for the time being in force. Okay, if at all as per the requirement of any law or regulation, the auditor is required to disclose the information of the client, then also he can disclose. These are the 2 exceptions, you can say. And another important point that you need to remember is information of client is different from working papers. Working papers are the property of the auditor. Okay, whereas information of the client is not property of the auditor. Okay, working papers, the auditor, he can make them available to other parties based on his discretion. If he wants, he can. But the client's information has to be disclosed only after obtaining permission of the client. Okay, next, clause 2. A chartered accountant in practice shall be deemed to be guilty of professional misconduct if he certifies or submits in his name or in the name of his firm what? A report of an examination of financial statements. That means audit report. He will be deemed to be guilty of professional misconduct if he submits audit report, unless the examination of such statements and related records has been made by him. Okay, he can give audit report only if the respective financial statements have been examined by him or by his partner or an employee of his firm or by another chartered accountant in practice. Okay, without reviewing the financial statements, you cannot give audit report. Hope that is clear. Next, clause 3. Here also, chartered accountant in practice shall be deemed to be guilty of professional misconduct if he permits his name or the name of his firm to be used in connection with estimate of earnings contingent upon future transaction. That means projections. Now, on projections, you should not sign in a manner which may lead to the belief that he watches for the accuracy of the forecast. Okay, you cannot watch for the accuracy of the forecast because the numbers that might actually occur will be obviously different from the estimated numbers. That is the reason why you are calling them estimate. So the chartered accountant, he should not sign those projected financial statements in a manner which may give belief to the public that he has watched for their accuracy. Okay, so without watching for their accuracy, he can sign. That means in the note, he has to indicate clearly in his report the source of information, the basis of forecast, and also the major assumptions that have been made in arriving at these forecasts. Okay, by indicating these things in the report, he can sign the forecast. Okay, and if possible, he should also clearly mention that he is not watching for the accuracy of the forecast. Hope that is clear. Next, clause 4. A chartered accountant in practice shall be deemed to be guilty of professional misconduct if he expresses his opinion on the financial statements of any business or enterprise in which his firm or a partner in his firm has substantial interest. Okay, substantial interest means you have acquired a substantial portion of equity in the company, or you are doing certain business with that company. Okay, or your relatives have given loan to that company. As per Companies Act, there are limits, right? That will be known as substantial interest. Then if you or any of your firm or any of partner of your firm is having substantial interest in the client, then the financials of that client should not be audited by you. Hope that is clear. Now here the term financial statements cover both reports and certificates. Okay, next, member not to write books of accounts for audit clients. Yes, this point you already know. You have to do only audit. Books has to be prepared by management. Next, statutory auditor should not act as internal auditor simultaneously. Okay, if you are internal auditor of a company, you cannot be a statutory auditor. Next, internal auditor not to be tax auditor simultaneously, and internal auditor should also not be a GST auditor. But a statutory auditor can be income tax auditor, that is tax auditor, and GST auditor. Hope that is clear. Next, clause number 5. Now this clause number 5 and clause number 6, they will look similar, but there is a difference between these two clauses. Let us explain, or let us discuss these two clauses. A chartered accountant in practice will be deemed to be guilty of professional misconduct if he fails to disclose material fact that is known to him but which is not disclosed in the financial statements. If you see clause 5 stating that a material fact is known to the auditor and that fact is not disclosed in the financial statements, but disclosure of which is necessary in making such financial statements where he is concerned with that financial statements in a professional capacity. If you see, clause 5 is speaking about financial statements. If at all any material fact that is known to the auditor but not disclosed in the financial statements, but disclosure in the financial statements is very much necessary for making the financial statements not misleading, then he will be guilty of professional misconduct. Okay, this is with respect to financial statements. Clause 6 speaks about audit report. Okay, if auditor fails to report a material misstatement known to him to appear in financial statements with which he is concerned in a professional capacity. Okay, in the financial statements there is a material misstatement, but he fails to disclose that material misstatement in his audit report, then he will be deemed to be guilty of professional misconduct. Okay, sorry. Clause 5 speaks about misstatement, or clause 5 speaks about material fact known to the auditor, not disclosed in the financial statements, but disclosure in financial statements is necessary for making that financial statements not materially misstated. Okay, whereas clause 6 speaks about a material misstatement present in the financial statements but not reported by the auditor in his audit report. Okay, next, clause 7. Chartered accountant in practice will be deemed to be guilty of professional misconduct if he does not exercise due diligence, that means proper care, or he is grossly negligent in conduct of his professional duties. Next, clause 8. If he fails to obtain sufficient information which is necessary for the expression of opinion, or its exceptions are sufficiently material to negate the expression of opinion. See, whenever you are expressing any opinion, all the information that is necessary, all the evidences that are necessary for expressing such an opinion has to be obtained by you. Without obtaining evidences, if you express any opinion, you will be guilty of professional misconduct under clause 8. Okay, next, clause 9. Chartered accountant in practice shall be deemed to be guilty of professional misconduct if he fails to invite attention to any material departure from generally accepted procedure of audit applicable to the circumstances. Now, audit standards on audit. Now, the chartered accountant, let's say he has not complied with any of the standard, and if he fails to disclose the fact that he has not complied with this particular standard because of this reason. In such a situation, okay, if he fails to bring the attention of the users to the fact that he has departed from particular auditing standard or auditing practice, then he will be guilty of professional misconduct as per clause number 9. Okay, next, clause 10. Now, as part of his professional duty or as part of his professional work, the chartered accountant, he will receive money from his client. Now, that money which he receives from the client for purposes of paying on behalf of the client should not be used for personal purposes. Okay, let's say client has given you certain amount for making income tax payment. That amount should be used for income tax payment only. Let's say client has given you certain amount for making certain payment after 5 months. Okay, certain payment on behalf of client has to be paid to some statutory authority, but such payment falls due after 5 months. Now, this amount which the client has given you, which has to be paid after 5 months, should be kept by you in a separate bank account, and it should be used only for that purpose. You should not use it for your personal purposes. Okay, that is clause 10. See, if you fail to keep monies of his client other than fees or remuneration, or money meant to be expended in a separate banking account, or to use such monies for the purposes for which they are intended within a reasonable time, in such a situation you will be deemed to be guilty of professional misconduct. Okay, these are the 10 clauses under part 1 schedule 2. Next, moving to part 2 schedule 2. Now, this part 2 schedule 2 also deals with professional misconduct only, but members in general, that means for all the members. Clause 1 contravenes any of the provisions of this act, that means CA Act, or regulations made thereunder, or any guidelines issued by the council. Okay, if you contravene any of these regulations or any of this act, then you will be guilty of professional misconduct. Next, clause 2, being an employee of a company, firm, or a person. Okay, chartered accountant being employee of a particular company or of a particular partnership firm or of a particular person, discloses confidential information acquired in the course of his employment except as and when required by any law for the time being in force, or except as permitted by the employer. Now, this is confidentiality requirement. Now, confidentiality requirement for chartered accountant in practice we have seen in clause 1 of part 1 of schedule 2. Now, clause 2 of part 2 of schedule 2 is dealing with confidentiality requirement for chartered accountant in service. That is the difference. Okay, next, clause 3 includes in any information statement, written or form to be submitted to the institute, council, or any of its committees, director discipline, board of discipline, disciplinary committee, quality review board, or appellate authority, any particulars knowing them to be false. Now, if any of these authorities has asked you for certain information and you have submitted false information, then you will be deemed to be guilty of professional misconduct. Next, if you defalcate or embezzles money received in professional capacity. Okay, just like clause 10 of part 1 is for members in practice with respect to using the money of the client, clause 4 is for member in service. Okay, and part 3 clause 1 we have already discussed. Now, moving to the council guidelines with respect to maintenance of books of accounts. See, every chartered accountant firm, it needs to maintain certain minimum books of accounts which shall include cash book and ledger. Okay, these two must be there. Apart from this, if at all any other books are necessary, all that you have to mention, maintain. Okay, next, tax audit assignment. See, a chartered accountant in practice will be entitled only for 60 tax audit assignments on his behalf. That is for individual chartered accountant. Now, let's say there is a partnership firm. In this partnership firm, there are 3 partners. Now, on behalf of these 3 partners, this entire CA firm is eligible for 180 tax audits, 60 for each partner. Like this, 3 partners are there. 60 into 3, 180. So, this firm in which there are 3 partners, it can do 180 tax audit assignments. And these 180 tax audit assignments, they can be signed by any of the partner, irrespective of the limit. Okay, since they are partners only, any one of them can sign. There is no restriction. Hope that is clear. Now, another point. Let's say there are 3 partners in the firm A, B, C. For on behalf of A, 60 audits, on behalf of B, 60 audits, on behalf of C, 60 audits, like this, 180 audits for the firm. Now, A is there, na? A in his personal capacity, let's say he is also partner in another firm or he is also doing practice individually. So individually he has signed 20 tax audits. In such a situation, on behalf of Mr. A, only 40 tax audits will be applicable for firm, because 20 of his limit out of 60 he has already used. So only balance 40 will be available for the firm. So 40 plus 60 plus 60, 160 on behalf of 3 partners for this partnership firm. Hope this is clear. This is how you need to calculate. Next, statutory audit of companies. Now, statutory audits for each partner or for each person, 30 statutory audit assignments are eligible. Okay, including private companies, excluding one person company and dormant companies. Hope that is clear. And for firm, if let's say there are 3 partners in the firm, then for each partner 30, 30, 30, 30, 90. So for entire firm, 90 statutory audit assignments. Hope that is clear. Next, another important point. A chartered accountant who is in practice, he should not accept audit assignment of public sector undertaking or a government company or a listed company and other public companies whose turnover is 50 crores and he has provided some other consultancy service to these companies. Okay, to these companies, the chartered accountant has provided some consultancy service, and the fee that he has accepted for this consultancy service is more than the fee that he has accepting for the audit engagement of these companies. In such a situation, you should not accept audit of these companies. Hope that is clear. Always the fee that you accept for audit assignment in case of these companies should be more than the fee that you have charged for providing management consultancy services to these companies. Hope that is clear. So what are these companies? Public sector undertaking, government companies, listed company, other public company having turnover of 50 crore or more. Hope that is clear. Next, guidelines for corporate form of practice. See, you already know that the chartered accountant, he should not provide audit services or he should not practice in the form of a company. Okay, he should practice either as sole proprietor, partner or LLP, right? But however, for providing consultancy services, a chartered accountant can incorporate a company, and through that company he can only provide consultancy services. He cannot provide these audit services. Okay, and in that company where that company is providing consultancy services, he is allowed to act as managing director or whole-time director without taking permission of institute. Okay, generally in order to act as managing director or whole-time director of a company, you need to take permission of the institute. But if the company is engaged in providing these accounting services, management consultancy services, then you need not take specific permission from the institute for acting as managing director or whole-time director of this company. Hope that is clear. Next, recommended self-regulatory measures. These are recommended in nature. They are not mandatory. Branch audits. Now, let's say for example, there is a private company or any company for that matter is having certain branches. Now, the statutory auditor of the company should encourage or should give the audit of those branches of the company to the local auditors. Okay, let's say there is a company present in Hyderabad. Now this company is having branches, let's say in Mumbai, in Kurnool, okay, in various places it is having branches. Now instead of the statutory auditor only auditing the branches, he should give these branch audits to the local auditors of that particular places. Okay, this is self-regulatory measure which is recommended in nature. Okay, next, joint audit. Now whenever in case of large business companies, large corporates, joint audit is applied or joint audit is requested by the management. The auditors has to ensure that chance has to be given to those CA firms where the partners are less than 5 members. Okay, let's say for example there is a AB and Co which is having 10 partners. Now, Mega Limited is a company. Now, this company is very huge company, so joint audit is required. So, along with AB and Co, some other auditor, a joint auditor also requested by Mega Limited. In this situation, this AB company has to take care or has to encourage a CA firm which is having less than 5 members to act as joint auditor in this assignment. Okay, this is also recommended, not mandatory. Next, ratio between qualified and unqualified staff. See, for every 5 non-qualified members, there should be 1 qualified member. Okay, excluding those article assistants and all other staff who are not involved in audit services. Okay. Next, network form of practice, guidelines for network. So, in this networking, what will happen is 2 or more firms, they will come together and they will practice under one network. Examples, PwC, KPMG, mostly these big fours, they operate as network firms. Okay, so they will have a common brand name, and under this brand name, 2 or more CA firms will operate, will provide services. Okay, so characteristics of network would be common brand name, common quality control systems. Okay, as per SQC1, they will have common system of quality control, and sharing of professional resources. They will share the article assistants, they will share the offices, they will share various professional resources. Profit or cost sharing will be there, and common ownership and control, common business strategy. Their business strategy will be common. Next, forms of network. See, the network organization can be either a partnership firm, LLP, company, or mutual entity. Okay, under this network, there will be firms operating. Okay, so that a network entity can be either LLP, company, mutual entity, or partnership firm. Okay, and some important points. One firm should be part of only one network. You cannot join in more than one networks. Next, if the firms are having common partners, they should join in only single network. Okay, let's say ABC and Co, CDE and Co. In this, 2 firms, Mr. C is common. Now ABC and Co has joined PwC network. Now CDE and Co cannot join KPMG. It should also join same network. Okay. Next, network name should be distinguished from firm name and approved by institute. Use the words and affiliates. Okay, network name and firm name should not be same. Network name should end with and affiliates, just like firm name will end with and co and associates. Okay, like that the extension should be, the suffix should be and affiliates, and the name should be approved by the institute. Network name should be approved by the institute. You have to make application to the institute for approving the network name. Institute will approve the network name. After name is approved, see, after you make application, institute generally within 30 days will approve or reject the name. Once the name is approved, after name is approved, network shall register with institute by applying in form B within 3 months. Okay, within 3 months of receival of name, you have to apply for network with the institute. Okay, see, there are 2 applications. First, name approval. After getting name approval, you have to make application for registration of network. Okay, and if at all there is any change in the constitution, it has to be intimated to the institute in form C within 30 days from the change of that constitution. Okay, so mostly we have completed. Still there are certain 2 amendments that has been given with respect to CA guidelines, CA logo and decision of ethical standard board. So that we will see. Let me open the document. Yeah, these are the 2 amendments that has been given in the professional ethics. First one is with respect to CA logo. Basically, this is the new CA logo that has to be used. You should not change the background color, you should not change the color, you should not tilt it. Okay, you should not rotate it, you should not crop it, and you should not change the font. You have to use it exactly. And some color codes that has to be used. The color palette has been given. Okay, so only this color palette has to be used by you. This is with respect to new CA logo. Next, ethical standard board has given certain recent decisions. Let us see them. Firstly, it is not permissible for member in practice being statutory auditor to prepare BRSR. Now, if you see in last chapter SDG and ESG assurance, there we have concept of this business responsibility and sustainability reporting. Now, statutory auditor of a company should not prepare this BRSR, because the auditor, he will be providing assurance on the BRSR. So BRSR report has to be prepared by the management, and assurance on that BRSR report will be provided by the auditor. So he should not prepare, the statutory auditor should not prepare BRSR report. Next, in the same way, statutory auditor of entity is not permitted to engage in assignment of compilation of the entity's financial statements as per SF 4410. Okay. Next, it is permissible for members in practice to engage in services assessment performance audit of centers of skill development council of government of India. Okay, government of India is having certain skill development centers. So for this skill development centers, CA in practice can conduct performance audits. It is permissible. Next, it is also permissible for member in practice to accept assignment of mystery audit. Mystery audit means surprise audit. Next, it is permitted for member in practice to mention position as promoter director on the portal of company. However, member cannot mention his professional attainments. Okay, if he is a director simpliciter of any company and he is also a promoter, then on the portal he can mention himself as a promoter director, but however he should not mention his professional attainments on the portal of the company. This point we have already discussed, right? Next, it is permissible for member in practice to become professional director in board of management of cooperative bank. Okay, in the board of management of cooperative bank, the chartered accountant in practice can become professional director. That means he will give professional related suggestions. Next, it is permissible for member to set up practice in IFSC or GIFT City. Okay, International Financial Services Center. Just like says for manufacturing entities, for financial entities, IFSC. Okay. Next, it is permissible for member to render professional services to IFSC units from offices outside of the IFSC unit. Okay. A firm is not permitted to publish its vision and mission statement on its stationery. Okay, it should not publish mission and vision on its stationery. Next, it is not permissible for member or firm being the statutory auditor of a bank to accept assignment of ASM of the customer. Generally, what will happen is bank will conduct annual stock audit of the customers. So for that purpose, it will hire chartered accountants. Chartered accountants only will conduct annual stock audit of borrowers on behalf of bank. Now, if chartered accountant is doing or is accepting this ASM of any customer of the bank, then he cannot do statutory audit of that same bank. Okay. Next, a member in practice cannot be appointed as internal auditor and procurement officer simultaneously in an organization. Okay, you cannot be appointed both procurement officer and internal auditor together simultaneously in the organization. Next, it is permissible for members in practice to charge fee on percentage of utilization amount of educational institution for certifying amount spent by educational institution out of a grant. Okay, if let's say government has given a grant to the educational institution, whether that grant has been utilized for the specified purpose or not. Okay, certifying this, a chartered accountant certificate has to be produced by the educational institution. So in that for giving that certificate, the CA can charge fee based on percentage of utilization of money. Okay, these are some latest decisions issued by Ethical Standard Board. From this, by this we have completed revision of professional ethics. We'll meet in the next class with a new revision video. Until then, take care. Bye bye. See you. And another important thing, recently we have launched a Lecturepedia app. On this Lecturepedia app, we can practice MCQs of all the subjects of CA final, inter and foundation. Along with this, you can also purchase classes of various topmost faculties on Lecturepedia app. You can download this Lecturepedia app from Play Store. Okay, I'll be winding up this video as of now. Take care. Bye bye. See you. In the today's class, we'll be revising due diligence. This chapter, basically, it is a very small chapter. First of all, before entering into this chapter, let us understand what is meant by due diligence. Let me give you an example for this. Most of you people, you might be knowing Shark Tank India. Basically, in Shark Tank India, entrepreneurs, they will come to the show for raising some money for their businesses. Now, the sharks, if they like the idea of the business, they will invest money into the business of the startup founder. Now, before investing amount into the business, sharks, they will conduct due diligence of the business of the, that particular startup. Now, on the Shark Tank show, the founders of the startup, they will be presenting various facts related to their business to the founders. Based on those facts, founders will agree to invest certain amount, okay, will agree to give certain amount. But before actually giving that amount, sharks, they will conduct a due diligence process of the business of the startup. Now, in this due diligence, it will be checked whatever the information that has been presented by the founder is correct or not, okay, the facts related to the business that has been presented, whether they are correct or not. And it will also be checked whether it is viable to invest into this business, and whether there are any hidden aspects, we will be calling them as deal killer defects, okay, whether there are any such points, all of them, they will be identified in due diligence process, okay. And this due diligence process on behalf of sharks, that is on behalf of investors, it will be conducted by a professional. Mostly chartered accountants will conduct due diligence, okay. However, apart from chartered accountants, if any other professional, if he is having ability to conduct the due diligence, if he is having knowledge to conduct the due diligence, he can conduct it, okay. So due diligence is examination of potential investment, okay. Potential means the investment that you are going to make. Examination of potential investment to confirm all material facts of prospective business opportunity. And this due diligence can be conducted in the following situations. First of all, corporate restructuring. Now, in case of corporate restructuring, mostly creditors will forego some of their amount that is receivable from the company. Now, during this restructuring process, creditors, they can ask for a due diligence of the company to be conducted on behalf of creditors. In the same way, venture capital financing, whenever venture capital funds, they invest any amount into the business, they also conduct due diligence. Lending, before giving any amount to the business, you will conduct due diligence. Leveraged buyouts, basically leveraged buyouts. Under this leveraged buyouts, a company will buy another company, but the funds that this company will use for buying another company will be mostly borrowed funds, okay. If by utilizing borrowed funds a company purchases another company, then such type of purchase is known as leveraged buyout. Next, public offerings. Whenever you are going for a public issue, then also due diligence might be conducted against the business of the company. And disinvestments. So in these situations, the process of due diligence can be conducted against the business, okay. Next, importance of due diligence. Basically, the major reason for conducting due diligence is to identify, to confirm business is what it appears to be, okay. What is actually shown to the investors, what the founder has actually communicated to the investors, whether that is true or not, okay. What it appears from outside of the business, whether it is true or not, this will be identified in case of a due diligence. And also whether there are any potential deal killer defects, okay, whether there are any issues in the company or business that will cause the investors, that will change the investors decision of not investing into the company, whether there are any such potential deal killer defects, even they will be identified. And gaining information for valuing and negotiating, for purpose of valuing the company, for purpose of deciding the consideration that has to be paid for investing into the company, what is the valuation of the company. In order to know this, you need to know the value of the assets and the worth of the business. All this, it will be identified in case of due diligence process. And verify that transaction complies with investment criteria. Investment criteria means investors, they might be having certain investment criteria, like the investment criteria of some of the investors might be they wanted to invest only in profit making companies, and they wanted to invest in only those companies where there are at least three co-founders. Like this, there might be certain investment criteria, whether the potential investment is fitting into the investment criteria or not, it will be verified, Okay, and you need to remember that due diligence is not audit. Due diligence is completely different from audit. Hope that is clear. Next, classification of due diligence. There are various types of due diligence. Firstly, we will be having commercial or operational due diligence. Under this commercial due diligence, the basic thing that will be checked is whether investing in particular company is viable or not, whether investing in particular company will create any operational synergies or not. This will be the main agenda of this commercial or operational due diligence. Once commercial or operational due diligence is conducted, next you will be conducting financial due diligence. In this financial due diligence, you will be going through all the financial aspects of the company. Next, you will conduct tax due diligence. Because of this investment, what will be the tax implications, and whether there are any tax dues, okay, pending tax litigations against the company. All these aspects with respect to tax will be taken care in case of tax due diligence. And information system due diligence, which will be related to technology that the company is using. And legal due diligence and environmental due diligence. These are various types of due diligence. Next, general points that will be verified in case of a due diligence. You can just change it as general points to be verified in due diligence. Okay, in case of a due diligence, what will be the general aspects that you will look into? First of all, you will see the history of business of the company. Next, you will check the background verification of the promoters of the company. Next, what are the accounting policies that the company is following, and from where management is getting their information for taking day-to-day business decisions. That is, what are the management information systems, and what are the results of operations of the business. That is, trading results of the business will also be verified in case of a due diligence. And what is the management structure, how management structure is there in the company, this will be verified. And current status of various litigations with respect to tax matters, even this will be verified. And cash flow patterns, what are the cash flow patterns from where the entity is generating cash, even this will be verified in case of a due diligence. And finally, what is the future profitability of the entity, okay, whether the entity will be able to generate profits in the future, that is, projection of future profitability. These aspects will be verified in case of any type of, okay, in a general due diligence, these points you will verify. And coming to specifically financial due diligence, what will you verify? Now, in case of financial due diligence, you'll first of all go through into the history of the business and the background of the promoters, and you'll also review the financial statements of the company. And you'll also go through the accounting policies that the company is following, and you'll also look into taxation matters. Okay, even though for taxation there is a separate due diligence, tax due diligence, since this taxation matter is also one of the part of financial aspects of the company, financial due diligence will also cover taxation aspect. And next, cash flows, from where the company is generating cash flows, and financial projection, management and employee related aspects, and finally statutory compliances. These aspects you will verify in case of a financial due diligence. Okay, next, another important aspect that you will search or that you will try to find out in case of a due diligence assignment is whether there are any hidden liabilities in the organization. Hidden liabilities means those liabilities which the founders have not communicated to the investors. Whether there are any such hidden liabilities in the organization, you'll try to find out them. And whether there are any overvalued assets in the organization. Okay, these two aspects also you will try to find out in case of a due diligence process. Now, what is meant by hidden liabilities? What are some of the examples of hidden liabilities? First of all, show cause notice that has matured into demand. Let's say, for example, income tax department, they have issued a show cause notice asking why we should not impose a penalty of 1 crore rupees on you. Okay, like this, a show cause notice has been issued. See, show cause notice, it is not a demand, it is just information that is sent to the company asking why income tax department should not impose this penalty. Okay, now for this notice the company needs to give response why the income tax department should not impose this penalty. For this, a response has to be given. So this is show cause notice. If income tax department is not satisfied with the response that is given by the company, then income tax department will issue a demand notice. Once the demand notice issued, then that becomes a liability on part of company. So whether there are any such show cause notices that have matured into demand notices and which are not communicated by the founders or which are not shown in the financial statements, you will try to find out whether there are any of these aspects. Next, LOC not disclosed in financial statements. LOC means letter of credit. Basically these letter of credits, they are off balance sheet items, they will not be disclosed in the financial statements, they will not be accounted for in the financial statements, but you need to disclose that there is a this contingent liability of a letter of credit worth this much of value. Okay, letter of credit, it is a contingent liability. We have discussed this letter of credit concept in bank audit. Okay, next, product and other liability claims, like whether there are any warranty claims that are not disclosed in the financial statements. If yes, then that becomes a hidden liability. Next, tax liabilities under direct tax and indirect taxes, environmental and third party claims. Okay, whether there are any third party claims against the company and the company has not acknowledged them as due, in that case that becomes a contingent liability. And if this contingent liability has turned into liability, whether it has been properly accounted in the books of accounts or not, if not, that becomes a hidden liability. Next, agreement to buy back shares at a stated price. Now let's say company, it has raised some 1 crore rupees by issuing shares, but at the time of issuing the shares, one of the terms and conditions of this issue is that company has promised those shareholders to again repurchase those shares after 10 years at a price of, let's say, some 120 rupees. Now each share has been issued at 100 rupees, but after 10 years the same share, it will be bought back by the company at 120 rupees. Now this becomes a hidden liability if it is not properly disclosed in the financial statements. Okay, next, unresolved labor litigations and future lease liabilities. Basically the future lease liabilities, you will not disclose them in the you will not account for them in the financial statements. You need to show it as a disclosure. If the disclosure has not been made properly, then that might become a hidden liability. Next, examples of overvalued assets. What could be examples of overvalued assets? Uncollectible receivables, that means bad debts or doubtful debts. If at all there are such doubtful debts or bad debts, you need to provide a proper provision. If the provision has not been provided and you are showing those uncollectible receivables at the same value, then that might become a overvalued asset. In the same way, obsolete inventory, that is being valued at net realizable value. Okay, obsolete inventory means it has become waste, the inventory has become waste, it is non-moving inventory, it is being it is left with the company for a long period of time, then that becomes a obsolete inventory. These obsolete inventory needs to be generally written off, but instead of writing off, or it needs to be shown at a net realizable value. Instead of showing it as a net realizable value, you are showing it still at the cost basis only, then that becomes a overvalued asset. Next, litigated assets. If at all there is any litigation against the asset, then the value of that asset generally it will reduce. Let's say there is a land. Okay, against that land there is a litigation, you have purchased that land at 2 crore rupees. Since there is litigation with respect to that land, no other buyer will be willing to purchase that land, so automatically the value of that land reduces because of litigation. So you need to reduce the valuation of land in the books of accounts also, but without reducing it, you are still carrying it at the market value or the cost that you have incurred for purchasing it, which becomes a overvalued asset. Next, investment carried at cost through realizable value is much lower. Okay, investments, you need to measure them at cost or realizable value, whichever is lower. Instead of even though the realizable value is much lower, you are still carrying the investment at cost only. That becomes again a overvalued asset. Next, investment carrying lower rate of return. If the rate of return that you are generating on investment has reduced, then proportionately you should reduce the valuation of that investment also. Okay, basically this will happen in case of debt securities. Next, intangible assets of no value. If there is no value for the intangible asset, why you are recognizing them in the books of accounts? You should not recognize them in the books of accounts, since there is no value for them. Group company balances under reconciliation. These are some of the examples of overvalued assets. Next, matters to be checked regarding cash flows. With respect to cash flows, you need to check whether the company is able to honor its commitments, whether the company is able to repay its liabilities or not. Next, how well company is able to turn its receivables and inventories. Okay, how well the company is able to turn receivables and inventories into cash, and how well it deploys its funds. Are there any ideal funds that are available with the entity, and what is the investment pattern of the company, and are they easily realizable? Okay, the investments that the company has made, whether they are easily realizable or not. Next, work approach to due diligence. Generally, in case of due diligence, you will first of all review the financials that are submitted by the target company. After reviewing the financials, you will also perform a on-site visit. Okay, first you will assess the business first hand by a site visit. Then during that site visit, you will conduct the due diligence process and prepare offer based on completion of the due diligence. Next, how to conduct due diligence. Here you please strike off this chart and note down this chart. How to conduct due diligence. First of all, you need to start with a open mind. You should not start the due diligence with a mindset that there will be some mistakes, there will be some frauds, we need to find out those frauds. No, you need to start with a open mind and identify trouble spots and ask ask the explanations for those trouble spots, and get the best team of people for conducting due diligence. And wherever possible, you take help of other people for various areas, because in due diligence you need to conduct due diligence in almost 360 degrees of the company. So you might not be having knowledge about all the aspects of the company. So wherever you are not having knowledge, you can take help of other experts and talk to customers of the company, suppliers of the company, employees of the company, and business partners of the company. You will get some information in this, and take a risk management approach. Wherever the risk is high, you focus more in that area and prepare a comprehensive report based on your due diligence. So this is how you will be conducting a due diligence, and once the due diligence has been conducted, you will be issuing a report, right? However, there is no a particular format for this due diligence report, but a illustrative points that needs to be present in a due diligence report are: firstly, there will be a executive summary, that is summary of entire report, then introduction, background of the company, what is objective of this due diligence, and terms and scope of this due diligence, and what is the shareholding pattern of the company under due diligence, and you will give assessment of various financial liabilities of the company, valuation of assets, trading results, that is operating results, and statutory liabilities and net worth of the company. You'll also comment on future projection, future profitability, what will be the cash flows in future. So you'll comment on the future projections. SWOT analysis you'll perform, that is strength, weakness, opportunity, and threat analysis. And finally, suggestions on steps care to be taken before and after the merger. Okay, here you need to strike off on suggestions on care to be taken before and after the merger. Okay, if at all the transaction is merger transaction, if you are conducting due diligence for a merger transaction, then what care need to be taken before merger and after merger, even that aspect you will discuss in your report. Okay, so this is complete revision of due diligence chapter, and you can download this chart from the link that I will be providing you in the description. And if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. And in place of this chart, you please note down this chart. Okay, you can just take a screenshot and you can note it down. I'll be winding up this video as of now. Take care. Bye bye. See you. In the today's class, we'll be revising forensic accounting. This chapter we'll revising it from my audit concise book. Will not be using handwritten charts for this chapter because those handwritten charts for this chapter I haven't updated them yet. So I will also suggest you to please go through this chapter through the concise book. Don't use handwritten charts for this chapter. Okay. So forensic accounting. First of all, what is meant by forensic? Forensic means something that is suitable to be used in court of law. Generally, whenever any fraud takes place, in order to prove that fraud, you need to submit some evidences to the court. Court will punish only based on the evidences, and the evidences should be suitable for use in court of law in order to prove the fraud. So the forensics department will help to collect those evidences that are useful in the court of law. Now, with respect to financial frauds, to gather evidences against the fraud, forensic accounting will help. Whenever any fraud takes place, in order to identify who has committed the fraud and how he has committed the fraud, in order to prove this fraud in court of law, judge will ask you some evidences. So all these evidences will be gathered with the help of forensic accounting. That means forensic accounting will be conducted only after fraud has taken place? No. Forensic accounting can also be conducted before fraud takes place. If management feels that there is something wrong in the financial statements, there might be some fraud in the entity, then in order to identify whether any fraud has taken place or not, management can take help of this forensic accounting. Hope that is clear. So forensic accounting involves combination of three skills. It is a combination of accounting, auditing, and investigative skills to gather evidences against the fraud. Okay, so that is forensic accounting. Now, example of forensics, basically you will be seeing in various movies. Once any murder or any bank robbery takes place, the forensics department, they will arrive and they will search the area for clues. So that is forensic with respect to normal criminal activities. Whereas with respect to financial frauds, how forensic accounting will work, let's say for example, the example that has been given here, accountant of a pharmaceutical company, he regularly reconciles the balance of inventory as per books of accounts and the physical inventory. Now one particular day he found that the amount of inventory in books of accounts is not matching with the physical inventory counting. Now here he has used his accounting skill to find out that there is a variance between these books of accounts and physical inventory. Now next he will use his auditing skill, that is he will physically verify the inventory to see which inventories are missing, and he finds out that certain expensive raw material has been missed from the physical inventory. Now he will use his investigative skills to find out how this pilferage has happened. He has checked CCTV cameras, and in those CCTV camera footage, it was found that while the stock has been received into the godown, the team which is unloading the stock has unloaded only some amount of stock. So the pilferage has occurred at the time of unloading the stock into godown. So in this way, this fraud has been found out by using accounting, auditing, and investigative skills, which will be known as forensic accounting. Hope that is clear. Next, what is the difference between forensic accounting and audit? Basically, the objective of audit is to express an opinion on whether financial statements are showing true and fair view or not. Whereas the objective of forensic accounting will be to find out whether fraud has taken place or not. If fraud has taken place, how the fraud has taken place. This will be the objective of forensic accounting, and the techniques that you will use in case of auditing will be substantive procedures you will perform, risk assessment procedures you will perform, test of controls you will perform. Whereas coming to forensic accounting, you will perform in-depth analysis, you will perform investigative. Okay, the procedures that you will perform in case of forensic accounting will be in the nature of investigative nature, and the period that will be covered by audit will be generally a one financial year. But in case of forensic accounting, there will be no such specific limitation of period, it can cover how much of period it wanted. Next, verification of assets and liabilities. In case of audit, you will physically verify the assets, but mostly you will rely on the representations that are being made by the management. But in case of investigation, you cannot rely on the representations of the management. You must independently verify the assets and other areas where you feel that the fraud has taken place. Next, off balance sheet items. In case of auditing, you will just watch the authenticity and arithmetic accuracy of balance sheet items. Let's say, for example, rental agreement. Rental agreement is a off balance sheet item. With the help of this rental agreement, you will verify whether the amount of rent that has been charged to the profit and loss statement is as per the rent amount that is shown in rental agreement or not. Let's say in rental agreement it is saying that 5,000 rupees per month, then 5,000 multiplied by 12, 60,000 should be charged to profit and loss statement. Just this arithmetical accuracy, for verifying this accuracy, you will use the off balance sheet item in case of auditing. Whereas in case of forensic accounting, off balance sheet items you will use to verify the propriety aspect also. See, the propriety and regulatory aspect also. That means in that particular area where the company has taken the property on rent, the general market rate is 10,000 rupees, but the agreement shows that the amount of rent that has to be paid to landlord is some 25,000 per month. Now, why that much huge amount is being paid by the company as per rental agreement when the general rent is 10,000 in the market? This propriety aspect you will verify in case of forensic accounting, whether the management is committing fraud, okay, by paying huge amount of rent to the landlord, whether management is receiving back the amount from the landlord in the form of cash, whether this is happening, whether this type of fraud is happening. This propriety aspect you will check in the off balance sheet items in case of forensic accounting. And adverse findings, if you find any adverse findings in case of audit, it will have an impact on your opinion. Here, legal determination of fraud, impact and identification of perpetrators depending on the scope. Okay, depending on the scope of the forensic accounting assignment, you will decide what impact these adverse finding will have on the assignment. Next, forensic accountant professional. Basically, forensic accountant professional, he will involve in fraud detection. Okay, whether any fraud has taken place in the organization, to detect this, forensic accountant will help. And also for computer forensics, generally for the purpose of analyzing evidences, some computer technology is required. In order to develop that computer technology which will be used in forensic accounting, the forensic accountant will help, okay, to develop this computer forensics. Next, for fraud prevention, forensic accountant will also help in fraud prevention and providing expert testimony. Now, in the court of law, someone has to provide a witness. Since forensic accountant has analyzed all the evidences, forensic accountant can also provide this expert testimony before judge in the court of law. So these services the forensic accountant can provide. And who will hire the forensic accountants? Lawyers, police officers, insurance companies, government regulators, bank, courts, business community, all these people, they will hire forensic accountants. And certain general services that will be provided by the forensic accountant. Next, process of forensic accounting. There will be 6 stages that will be involved in forensic accounting. First of all, initialization stage. In initialization stage, you will meet with the management and you will understand the scope of assignment and the objectives and goal. All this you will fix in case of in the initialization step. The next step will be planning. In this planning step, you will plan how to perform this forensic accounting based on the information that you have gathered in the initialization stage, that is developing a plan. Next, based on plan, you will obtain the relevant evidences. Okay, in order to obtain relevant evidences, you need to refer various documents, various records, various minutes of a board meeting, various accounting documents. All this you will refer in order to gather evidences. Once you have gathered these evidences, you will perform analysis on these evidences. Based on the analysis, you will find out some findings. These findings have to be reported to the client in the form of a report. You will give your findings to the client. And finally, there will be court proceedings. In this forensic accounting, you would have obtained evidences, right? So based on these evidences, you will submit to the court for helping in court proceedings, okay, to prove the fraud against the person who has committed that fraud. Next, forensic accounting and investigation report, FAIR. Shortly we will be calling it as FAIR, forensic accounting and investigation report. Just like for auditing we are having standards on auditing, for forensic accounting also the Institute of Chartered Accountants of India has come up with forensic accounting and investigation standards, FAIS. Now as per FAIS 510, it is a responsibility of the forensic accountant professional to issue a written report to the stakeholders after the forensic accounting assignment has been completed. Now, another question that arises is basically audit has to be, the statutory audit, it has to be conducted by a chartered accountant only. Whether forensic accounting should also be conducted by only a chartered accountant? No. Forensic accountant can be conducted by any professional who is having the skill to conduct this forensic accountant. You need not be a chartered accountant to conduct forensic accounting. Hope that is clear. Now, for this forensic accounting and investigation report, there is no specific format that has been prescribed, okay, but this report, it has to be in a written form, and the report has to be addressed to the client, that is who has appointed you, to that person it has to be addressed. And the format and the content of the report is not mandated. There is no fixed format and content of the report, but there is just a suggestive, indicative list of contents that must be present in the report has been given. What are those key elements that must be present? Let's see. There should be title, obviously, and addressee. Scope and objective of assignment. At the initialization stage, you would have fixed the scope and objectives that you need to mention in the report. And approach and broad work procedure undertaken. Okay, how you have conducted the forensic accounting, that you need to explain. Executive summary of the results that you have found out, and reference to use of an expert. If in case you have used the work of any expert, you need to refer to the work that has been conducted by such expert. And the fact that assignment has been conducted in accordance with FIRS, forensic accounting investigation standards, have been complied while conducting this forensic accounting. This point you need to mention. Basically, there is a list of forensic accounting standards. If you see here, I have given FIRS 100 series, 200 series, 300 series, 400 series, 500, 600 series. So these are list of forensic accounting and investigation standards that are present, as per which you need to conduct the forensic accounting. And list of findings that you have found during your forensic accounting, you need to mention. If at all you have taken any assumptions during the forensic accounting process, you need to mention those assumptions that you have taken in the report. And if you have faced any limitations while conducting this forensic accounting, those limitations also you need to mention in the report. And finally, conclusions drawn from the assessment undertaken. These are the brief points, elements that must be present in a forensic accounting report, but these are not the complete list of elements. This is just a indicative list, okay. Along with this, you can also include other elements if you wanted, but these must be present mandatorily. Next, if the scope of engagement asks the forensic accountant to discuss findings with the client before issuing the final report, you have to discuss the findings of forensic accounting with the client, and the responses that the client has given should also be included in the forensic accounting report. Yeah, that is a brief idea with respect to FAIR. Next, overview of forensic accounting and investigation standard. As I have already told you, ICAI has come up with forensic accounting and investigative standards. The purpose of this forensic accounting and investigation standards is to provide the professionals a minimum guidance regarding how the forensic accounting has to be conducted. Okay, these standards, they will provide some guidance to the professionals. In the same way, they will set a benchmark to the users of the forensic accounting and investigation services. Okay, if there is a benchmark, the forensic accounting, the users of forensic accounting and investigation services, they will be able to measure how our forensic accountant professional has provided the service, whether he has if he has provided the service as per the standards, then users can believe that yes, the objective is met. Okay, the minimum level of standard has been met. So to provide such a benchmark level of comparison to the users, these forensic accounting and investigation standards have been used. In the same way, the regulators and government agencies, with an appreciation of what can be expected from the forensic accounting and investigation services. Okay, to provide a brief idea to the government and to the regulators of how this forensic accounting and investigation services will provide value addition. Okay, what value addition these services they will provide, to give this an idea of this to government and to regulators, this forensic accounting and investigation standards have been developed. Okay, and four key, basically the forensic accounting and investigation standards, it has been issued in the form of a framework, and this framework, it consists of four pillars. Of those four pillars, one of the pillar is this standards. Apart from these standards, there are three other pillars. What are they? Basic principles with respect to forensic accounting, key concepts with respect to forensic accounting, the actual standards, the list of standards that have been issued, and the guidance to the forensic accountants. These four are present in the forensic accounting framework that has been issued by the Institute of Chartered Accountants of India. And this is a list of forensic accounting and investigation standards. By this, the revision of forensic accounting gets completed. And if you want to purchase the classes, you can visit our website lecturepedia.in and you can place your order. I'll be winding up this video as of now. We'll be meeting in the next video with a new revision class. Take care. Bye bye. See you. In the today's class, we'll be revising digital audit and assurance. If you see, the weightage of this chapter is around 4 to 5 marks, right? Let us quickly revise this chapter. Now, first of all, digital audit. If you see, there are two terms. One is digital audit and another one is auditing digitally. What is the difference between these two terms? Let us first of all understand. Firstly, digital audit. See, digital audit means you are auditing the technology that the company is using. Okay, the company in its business, it will be using various technology, various softwares, various tools. Auditing those technologies, auditing those softwares is known as digital audit. Okay, see, digital audit is placing assurance on effectiveness of IT systems implemented in an organization. Okay, why you are auditing those softwares and information technology that the organization is using? Because you wanted to place assurance on those information technology or software. So in order to place your assurance, you are checking whether they are working effectively or not. That is known as digital audit. Next comes auditing digitally. Now, what is meant by auditing digitally? Auditor, for the purpose of auditing, he is using technology. Okay, in the digital audit, not earlier, in the concept of digital audit, auditor has audited technology used by the entity. Here in auditing digitally, auditor uses technology to audit financial statements of the entity. Okay, see, auditing digitally. Auditing digitally is using advancements in technology for conducting effective and efficient audit. Hope you understood the difference between these two terms, digital audit and auditing digitally. Now, features of digital audit. What are the features of digital audit? You can call it either features of digital audit or advantages of digital audit. Now, this digital audit, in this digital audit, what will happen? Auditor will audit the technology of the organization. Since auditor is auditing the technology of organization, if there is any updates to the technology that has to be made, or if the entity is using any old technology, since auditor audits them, entity will be encouraged to use more of such technology and to upgrade their technology. So encourages the auditee, here auditee means entity, to update with the latest technology, right? Next, it leads to more reliable audit report. Obviously, if auditor audits the technology, audits the software that the auditor that the entity is using, auditor will get a confidence that the software is working properly. If the software itself is working properly, it will properly process the transactions, so there will not be any mistakes in the transactions. So this will lead to a reliable audit report, right? The quality of audit report will increase because of this digital audit. Next, solving in time, cost and not solving, saving in time, cost and human efforts. See, if auditor audits the technology, there is a lot of saving in time. Why? Because let's say for example the accounting software the entity is using, or let's say for example point of sale software which will record all the sales transaction. Okay, now if point of sales transaction, if POS software is not audited by the auditor, then he needs to verify each and every sale transaction to check whether it is recorded properly or not, right? So lot of time and lot of cost is involved. If auditor simply audits the POS software, if auditor simply checks whether POS software is working properly or not, then he need not audit the entire sales transaction, right? Here time is saved, human effort is saved and cost is saved, right? Next, allows to standardize processes and allow controls to be implemented. See, if technology is used, you can standardize various processes, because humans will do a particular activity differently, right? Each person will do the same activity in a different manner, but if you implement technology, it will do the work in the same manner, in a similar fashion. So you are standardizing by using technology and help auditee to make informed decisions. Okay, if the softwares and the technology that the auditee is using are working properly, it will help the auditee to make informed decisions, right? So these are the features or advantages of digital audit. Next, considerations of digital audit. Now, while doing the digital audit, what considerations the auditor has to take into account? See, know what benefits organization want to achieve through automation. See, you are auditing the technology used by the organization, and this technology or this software is actually implemented by the organization. So auditor should understand why the organization implemented this technology, what advantage or what problem the organization wanted to solve by implementing this technology. Okay, that should be considered by the auditor before auditing the technology or software. Next, think people first and do not underestimate change is difficult. See, before that technology is implemented, that particular activity might be done by the people manually. Now you have to ensure that you train those people first to use the technology. Okay, if you implement the technology without training the people, they can't use that technology, right? So the organization's approach should be people's first approach, whether the organization has followed that people's first approach or not. You need to see that. Next, target right process. The key is for successful automation. See, the auditor should also consider whether organization has targeted right process for the automation or not. If you see, all the processes cannot be automated, only some processes can be automated. Okay, so in order to achieve success in automation, the right process has to be targeted, whether entity has targeted that right process for automation or not. Next, automation is not a standalone solution and should be part of broader digitalization strategy, right? It is not that you automate just one particular activity or you implement software or technology with respect to one particular process. No, that implementation of software or implementation of automation should be part of broader digitization strategy. Okay, that should be in sync with the digitization initiatives of the organization. Okay, automating a particular activity is not a isolated activity. Okay, that should be in sync with all other digitization activities that are going in the organization. Okay, auditor has to consider this, whether the digitization strategy is in sync with the broader digital whether the automation of particular activity is in sync with broader digitization strategy of the organization. Next, ensure the process works and is in standardized before automating. See, now if you are automating a particular activity or if you are implementing technology for a particular activity, that activity would have been done manually, right? Before implementation of technology, that activity would have been done manually. Now while implementing the technology in that activity, you have to check whether that process is working properly in the when it is done manually. Okay, if it is not working properly when it is done manually also, you need to first of all fix the process. After that you have to implement the technology. Okay, next, don't forget about governance and data security in risk framework. Okay, auditor should also consider whether the entity or the management has considered data privacy or data security in implementing this technology or implementing the software. Okay, these are the considerations that the auditor should take into account during digital audit. And what are the focus areas of the auditor in these digital audit? See, whenever auditor is auditing the technology that the organization is using, you have to check whether new activities or changes to existing processes have occurred due to the technology. Auditor has to check this. Okay, this should be the prime focus of the auditor during a digital audit. Okay, new activities or changes to existing process due to technology. Why auditor should focus this? Because if the any change has occurred to the existing process because of implementation of technology, auditor should be more careful in that area to check whether that new process or the change to the process is working properly or not. Next, changes in which entity systems are developed and maintained, new risks due to these changes. Okay, because of these changes, any new risks has occurred because of implementation of technology, any new risks has occurred. This should also be the focus area. Okay, first focus area is what are the new activities or changes to the existing activities because of technology. Next focus area is what are the have any risks occurred because of this new change, and impact of new technology on how organization generates and uses information. Okay, how the organization's use of information and generation of information is impacted because of this new technology. Okay, even that has to be the focus area of the auditor during digital audit. These are the three focus areas. That means auditor should focus more on these three areas during digital audit. See, in order to understand all this, you should first of all be clear with what is digital audit. Okay, if you understand what is digital audit, all these points you can easily understand. And you should also know the difference between auditing digitally and digital audit. Okay, next comes auditing digitally. Okay, advantages of auditing digitally. Auditing digitally means auditor, he is using technology for the purpose of conducting audit. So if auditor uses technology for conducting the audit, what advantages auditor will get? First of all, the quality of the audit will increase because he can do the work in less time, so he can concentrate more on high risk areas. So the quality of audit will increase. Next, earlier, before using technology, that work, that audit is being done by various staff, human. So because of technology, human dependency will also reduce, right? And there will be increasing transparency. Transparency means you cannot hide. Okay, it is open, you will be able to track who has performed the work, what changes have been made, what are the conclusions. All this can be kept transparent because of technology. And if you use technology, you can automate various tasks, right? So automation and ease is also one of the benefit, and improves efficiency. I have already explained you what is the meaning of the term efficiency while discussing SA 500 audit evidence. I have explained efficiency. Efficiency means achieving the target with as much as lesser resources as possible, right? We will also discuss this concept of efficiency in PSU audit. Next, considerations in auditing digitally. Okay, what considerations auditor has to take into account when he audits digitally? That means he is using technology for the audit. Now, before, his staff was not having knowledge with respect to this technology. Now you are using technology for the audit, so you should consider upgrading the skill of your staff with respect to this technology. You have to provide training to the staff. Okay, how you will upskill your people, and which technology can help you. Okay, for the purpose of auditing, what technology can help you, that also you should consider. And what problems you are trying to solve. Just like while you are conducting digital audit, you have considered what problems the entity is trying to solve by implementing the technology. In the same way, you have implemented technology for conducting the audit. So what problems you are trying to solve by implementing the technology for the audit? Hope that is clear. So hope you understood the difference between these two concepts, auditing digitally and digital audit. Now if you see, there are various automated solutions that are available. Just a second. Now the first automated solution is macros and scripts. What is this macros and scripts? Basically, macros or scripts, you can find them in Excel. It is a small piece of code that will automate a particular activity. Let's say, for example, you wanted to send, you are having a list of email IDs, 1000 email IDs in Excel. Now you wanted to send single mail to all these email IDs at a single time, bulk mail you wanted to send. Now for this purpose, you can write a piece of code, you can write a macro. Okay, in our regular class, I have explained you how you can write a macro. Okay, the same example I have taken the list of mails and I have created a macro, and if you just click on that macro, the mails will be sent automatically, right? This this type of macro we have created in our regular class, if you remember. Next, business process automation. What is meant by business process automation? If you see, in the business there will be various processes. Now if you are trying to re-engineer or automate any particular process of a business, that will be known as business process automation. Why? Because you are automating a particular business process. Next, robotic process automation. Now this robotic process automation is also similar to that of business process automation, but here in robotic process automation you are automating those tasks which are human intensive. Okay, the tasks which are human intensive, that you are automating with the help of robots. Let's take for example, in a particular factory, you wanted to lift the material from one area to another area. This is a human intensive task. Now in this area you are implementing robots. Okay, you are implementing certain missions. Now these missions are pre-designed to lift the items and place them in particular desired location. So this is known as robotic process automation, where you are automating a human intensive task. Next, intelligent process automation. Now, intelligent process automation is combining robotic process automation with artificial intelligence. That means the robot, it can take its own decisions. Okay, you have implemented robotic process automation in a particular area. Now, you are also combining that. You are also giving AI, artificial intelligence capabilities to that robot. Now this robot, it can analyze the data, it can think, and it can react. Okay, so that is known as intelligent process automation. What is this artificial intelligence? We will be discussing, okay, in the coming slides. Next, understanding IT environment. Now the auditor, obviously before he audits the organization, just like in SA 315 we have seen that uh, if before auditing the financial statements, auditor has to first of all identify and assess risk of material misstatement. How? By understanding the entity and its environment. Here also auditor should understand the technological environment in which the organization is present. So how the auditor will understand? He will first of all understand applications that are used by the company. Okay, what applications you are using for accounting, which software, for recording sales, which software, for payroll management, which software, for maintaining employees attendance, which software. So what are all the softwares that the organization is using? Next, you will understand details of IT infrastructure. This is software and this is hardware. Okay, what infrastructure you are using, okay, how you are storing the data, whether you are having own servers or you have outsourced the storing of data, like for AWS, that is Amazon Web Services, or Google Cloud GCP. So what is the IT infrastructure of the organization? That is hardware. Next, organization structure and governance. Okay, who is owner of this entire activity, who takes the responsibility, what is the governance structure, and policies, procedures and processes followed. Okay, what policies and procedures the organization is following with respect to this information technology, you should understand this. Okay, there will be a uh, document which will contain all the policies and procedures. Okay, who are having which type of rights, who has given authorization to which type of data. Okay, all these policies and procedures will be there, that also you need to understand. Next, extent of IT integration. Okay, integration means integration between one software and another software. Let's say for example, there is payroll software. Now in payroll you will maintain details with respect to employees, the salaries, PF, ESI, TDS, professional tax, all these aspects will be there in payroll software. Now the entries, monthly entries with respect to payroll activities has to be passed in the books of accounts. Now for this purpose, the accounting software should be integrated with payroll software, right? So that the accounting software can automatically take the information from payroll software and pass the entries. So how much integration is there between different softwares? Auditor should understand this extent of IT integration and IT risks and controls. Because of use of this information technology, what risks the organization is facing, and in order to overcome those risks, what controls the organization have implemented. Okay, so auditor, in order to understand information technology environment, auditor should understand all these aspects. Okay, next, examples of how automated environment can be documented. Okay, here I have given an example, like let's say the application SAP. Now for SAP, how you will document the you will audit the software. So when you have audited, how will you document the details of that particular software? First of all, used for, okay, for which purpose it is used? It is a integrated application software which you can use for maintaining accounts, for managing data with respect to manufacturing activity and payroll activity. For all other various activities you can use SAP. Okay, basically in SAP there will be modules, there will be various modules. Okay, each module will be used for different purpose. So it is a integrated application software. Next, database. You are maintaining database in Oracle 19c. Just a second. So we are discussing how you will document the audit of automated environment that you have conducted, right? So application wise, you will write for which purpose this is being used, and in which database the data is being stored, and what is the operating system, network in which it is implemented, and servers and storage. So like this, for each software you will document the characteristics of those software, right? So this way you will document the IT environment that you have audited. Now since you use information technology in your business, there are some risks that are associated with information technology. Let us see the risks that are associated with information technology. See, unauthorized access to data. See, if you are using information technology and if you don't implement proper authorization controls, that is username, password, right, then there is a possibility that unauthorized third parties might get access to the data of the organization. Next, possibility of IT personnel gaining access privileges beyond those necessary to perform their assigned duties. Now employees of the organization should be given access to the information technology only to the extent that is required for performing their works, right? Let's say an example. Now for example, in case of a bank, cashier should be given access only to the cash account and the respective customer account for passing entries, right? He should not be given access to, you know, expenditure accounts or loan accounts, right? So if you the risk of using information technology is that employees might gain access that is necessary beyond that is required for the purpose of their work. This is also one of the IT risk. Next, unauthorized changes to IT environment. This is also another risk. Failure to make necessary update to IT applications. Okay, whenever any update is required for an application, you have to update it, otherwise various losses will occur, like someone might attack, someone might hack the system if there are no proper updates, no proper security updates made to the system. So failure to make required updates is also one of the IT risk. Next, data loss or corruption. Risk of system downtime. See, system downtime means unavailability of the system. If huge traffic has you know sent requests to the system, then the system might not be able to service the request of all those people, then the system downtime will occur, right? The system will not be available. This will occur in case of DOS attack, DOS attack, denial of service attack. Next, system integration and compatibility issues. Okay, uh, because of use of information technology, compatibility issues also will occur. Like for example, some applications or some softwares will work only on certain standard of operating system. Okay, some applications will work only on Windows 10 or above operating systems. Like this, there will be certain compatibility issues because of use of information technology, right? These are the risks of using information technology. Next, IT dependency. What is meant by IT dependency? The organization depends on information technology for various activities. Now, this is known as IT dependency of the organization. If suddenly that information technology is not present, or that software fails, then that causes a risk to the organization, right? So IT dependency is also one of the risk. So in what ways an organization can depend on IT? Types of IT dependencies. First of all, automated controls. For implementation of controls, the organization might depend on information technology. Like one of, let's say, when the user gives his mobile number, it should be 10 characteristics. Mobile number will not be 11 characteristics. So you will allow the user to enter only 10 characteristics. This is a control, right, which is automated control. The system itself, the control is inbuilt into the system itself, right? So if such a control doesn't work, if the failure of the system occurs, then that control will not work, and the user, he will give 11 numbers or 12 numbers or as mobile number, right? So one of the way in which organization depends on information technology is for implementing automated controls. Next, reports. Now if you see the system, it will automatically generate various types of reports, right? Sales report, the cash book, the bank reconciliation, the customer report. So various reports the system will automatically generate, which will be used by the organization in its day-to-day business. So if suddenly the system fails to generate the report, then it is a risk to the organization, because it has become dependent on system generated reports, which is IT dependency. Next, calculations. Okay, for performing various automated calculations also, the entity can depend on information technology. Next, security, right? For implementing security for the assets also, the organization can depend on information technology. Security means, like for example, in order to enter into server room, you will have access card. Okay, only if you swipe the access card, you can enter into the server room. So this is a technology. You have dependent on information technology for implementing the security, right? This is one type of IT dependency. Next, interface. Interface means programming language that transfer data from one IT system to another. That is the example I have told you, transfer of data from payroll software to accounting software. So this transfer of data is possible because of information technology. So you have become dependent on information technology for interfaces, right? Now, how to overcome this IT dependency, how to overcome the risk that is arising due to IT dependency? You have to implement proper general IT controls. Okay, general IT controls have to be implemented in order to overcome the risks from these IT dependencies. So what are these general IT controls? For example, access controls. Okay, access security objective. Some general IT controls with respect to access security. First of all, access of terminated user is removed on a timely basis. That means if the employee has been uh, resigned, or employee has been removed from the organization, then access that he is having to the organization's systems should be removed. Okay, this is one type of control that you will implement. You can call this as access control. Next, access rights to application are periodically monitored for appropriateness. You have to periodically monitor which person is having access to which software. And the transactions of administrators and sensitive general IDs are monitored. You need to regularly monitor the transactions of sensitive user IDs. and security policies or procedures are maintained. Access to operating system and database is restricted. Okay, you should not give access to database to each and everyone. Only restricted people should be given access to database. So these are access controls. Okay, access controls will restrict the access of unauthorized people to the system. And in the same way, with respect to data center, you can implement controls like policies and procedures for data backup and recovery is maintained. Okay, whenever you loses the data, there should be proper backup so that your business will not get disturbed. Data is appropriately backed up and recovered. Restoration testing is performed. Restoration testing means whenever data is hacked, you should be able to restore the data from the backup. Okay, you have backed up the data, but you are not able to restore, then what is the use of backing up the data? So on a periodic basis, you should also perform restoration testing, that is whether you are able to restore the data from the backup. And batch job scheduled or monitored for failure and access is restricted. Okay, these are some of the general IT controls that you can implement in order to overcome the risks because of IT dependencies. Okay, next, cyber attack. What is cyber attack? Cyber attack is basically an attempt to gain unauthorized access to the systems, to the organization system, so as to damage, steal, expose, alter or disable or destroy the data of the organization. Okay, the cyber attackers will gain unauthorized access to the data of the organization with an intention to steal the data or alter the data or destroy the data. Okay, this is cyber attack, where there are various types of cyber attacks. Let us see those types of cyber attacks. Types of cyber attacks. Yeah, firstly, malware. Under malware, we are having ransomware, fireless malware, Trojan, and mobile malware. We will discuss all of these one by one. First of all, I am just giving a overview of all the types of cyber attacks. Next, denial of service, DOS attack. Next, phishing. Under phishing attack, we are having spear phishing, whaling, smishing, and wishing. Next, we have identity based attack. Next, spoofing, domain spoofing, email spoofing, and other types of attack, internal insider threat, DNS tunneling, and IoT based attacks. These are the complete list of cyber attacks. Now we'll discuss one by one, starting with malware. Basically, malware is opposite of software. Basically, software will help the users to do particular task, right? Whereas malware will attack the systems. Okay, malware is opposite of software. Okay, malware will harm your system, harm your information technology, right? There are various types of malwares. Basically, malware is also a type of coding, a type of code that will create harm to the user's system. So first type of malware is ransomware. Now under this ransomware, what will happen is, once you click on the link and the malware gets installed onto your system, the entire system gets locked. Okay, the system will be under the control of the attacker and you will not be able to access the system. Okay, now in order to again gain access to the system, the attacker will ask for ransom. Ransom means will ask for certain amount. If you pay that amount, he will release the access of the system again to you. So this type of attack is known as ransomware. Next, fireless malware. Now fileless malware is also a type of malware which will attack your system, but you will not know that your system is attacked. Okay, there will not be any instances of malware file that will be that will be visible to you in your system, but it has already installed into your system and it will directly attack your OS. So, okay, since it is invisible to you, it is known as a fileless malware. The purpose of this fileless malware is also to gather the data of the user, right, to hack the credentials of the user. That is fileless malware. Next, Trojan. Now, Trojan is something like it will look like a genuine application, right? Let's say you have downloaded a hacked version of paid software. Okay, it will look like the normal software. Okay, it will perform whatever the works that software has to do, but unknowingly it will be transferring your data to the attacker. Okay, that is known as Trojan, wherein by looking at it, it will look like just normal good file. Okay, normal file on your system, but in the back end it will be performing its malicious activities. That is known as Trojan. Okay, next, mobile malware. Malware that is intended to attack mobile phones is known as mobile malware. Next, denial of service attack. What is this denial of service attack or DOS attack? Let me quickly explain this with an example. Let's say Flipkart's application. Now, each and every app, it will be having a capacity of users. Okay, it can handle certain capacity of users based on the server size it is having. Now, let's say Flipkart's application, it can handle 1 lakh users simultaneously. Now, attackers, they wanted to shut down the Flipkart's application for certain period of time, whatever the reason might be. So what they will do is they will send fake requests. Okay, they will bombard the Flipkart's application with fake requests. Some millions of requests they will send to the Flipkart's application. Now, the Flipkart's application, it will not be in a position to handle these many requests at the same time because it has crossed its capability. So for certain period of time, the Flipkart's application will not be available. It will shut down, right? That is known as denial of service. Okay, because of the fake requests that are sent by the attackers, the Flipkart's application will not be able to provide service to the genuine users also. Okay, for genuine users also, the application will deny the service. Okay, this is known as DOS attack or denial of service attack. Hope you understood this. Next, phishing attack. Now, in this phishing attack, the purpose will be to entice the user to share his personal data with you. Okay, you wanted some information from the user, either his login credentials or some other data you wanted. So you are enticing the user to gather that information from that user or the victim. Okay, now in this phishing attack, you will be mainly using either SMS or emails or over call. You will do these phishing attacks. There are 4 types of phishing attacks. Let us see them. First one is spear phishing. Okay, spear phishing means you will send email to a particular user. Okay, and in that email you will give a link. Okay, and if the user clicks on that link, next, phishing attack. What is this phishing attack? Basically, in this phishing attack, the attackers will try to entice the user by saying that you have won a lottery, or you have won a car in a lucky dip. Like this, by giving some excited offers, the attacker will try to gather the information, the personal information of the user, right? So the attacker will try to entice the victim and gather his data from the user, right? This is known as a phishing attack. Now phishing, for conducting this phishing attack, the attackers, they will use emails, they will, you know, call the victims, or they will message the victims stating that you won a lottery, or you won a trip to so and so country. So in order to win, in order to utilize this trip, you have to share these details with us, right? So like this, they will gather the personal information of the users. There are various types of phishing attacks. First one is spear phishing. Now in case of spear phishing, what the attackers they will do is, they will send emails, bulk emails, to large number of persons, to some lakhs of persons. They will send bulk emails randomly. Okay, now in that email, they will design the email in such a way that the user, he will get attracted to the mail. Like, you won a lottery, okay, you won 1 crore rupees. In order to claim this amount, you have to share your bank details, you have to share your OTPs. So in this manner, the attackers will try to collect the information from the user. Now, why we are calling it as spear phishing? Spear means, the javelin throw, right? You will just throw it like this. Just like you are throwing a javelin like this, the attackers, they are also sending bulk emails to random persons, and if any user gets attracted to that mail, he will become victim, right? So it is known as spear phishing. Without any knowledge, attackers are simply putting the mails. Okay, next, whaling. Whaling is also a type of phishing, but here in whaling, the attackers know the identity of the person whom they are going to attack. Okay, in whaling, what the attackers they will do is, they will attack high net worth people, like CEOs of company or directors of company, in order to gather the personal information, or in order to gather the business information related to the companies. Okay, this is known as whaling. The difference between whaling and spear phishing is that in whaling, the attackers know whom they are attacking. Okay, they know their target. Hope that is clear. That is known as whaling. Next, smishing. If you are doing this phishing attack with the help of SMS, it is known as smishing. With the help of emails, spear phishing. And wishing, if you are doing this phishing attack with the help of voice call, you call it as wishing. Okay, the modus operandi is same, but the way in which you perform it is different. Okay, next, spoofing. Basically, there are two types of spoofing. In this spoofing, what will happen is, the attacker will act as if he is a genuine source, as if he is a legal source. Okay, there are two types of spoofings. See, a technique through which cyber criminal disguises themselves as a known or trusted or genuine source. Okay, the first type of spoofing is domain spoofing. Now, in this domain spoofing, what will happen is the general example that I tell you. If you, most of the users, in order to log in to their net banking, let's take for example SBI Bank, they will type SBI net banking, and the, let's say the domain of SBI net banking is SBI net banking. Okay, www.sbinetbanking.com. Now the attacker, he will create a web page that looks similar to that of SBI net banking. Okay, but in the domain name he will slightly alter the domain name. Here the original domain is SBI net banking, right? So what the attacker will do is he will add one more I here. It becomes SBII net banking, but user will not observe that domain. Okay, a I is introduced over there. The web page, it looks similar to that of the normal web page of the normal net banking login of the SBI. So the user, he will give his user ID and password in that sbiinetbanking.com, and once he inputs the data will be taken over by the attacker. So this is known as domain spoofing. Here the attacker has disguised himself, okay, as if he is a trusted source. Next type of spoofing is email spoofing. Now in this email spoofing, what will happen is you will get a mail from a particular domain or from a particular email address, and that email address will look as if it is a genuine source. Like for example, let us take the SBI only. Okay, contact@sbi.com. This is the actual mail ID of SBI. Now the attacker, he will send a mail from contact at the rate, okay, contact@sbi.com. Now the user might not observe the two I's that are present over there. Okay, it looks similar to that of SBI mail ID, right? So since the user has received some mail from SBI asking for some information, the user will respond with that information to that particular mail ID. But this mail ID belongs to attacker, which looks similar to that of a genuine mail ID. So this is known as email spoofing. Okay, here the attacker is gaining the trust by resembling that he is the trusted source. Okay, that is email spoofing. Next, identity based attacks. Now in this identity based attacks, what will happen is the attacker, he will take the identity of some other genuine person, like let's say for example an employee in the organization. Now this employee, he will give or he will respond to the information that is asked by his manager, right? Now in order to gather the information from this employee, the attacker takes identity of the manager, the user ID and password of the manager, and he requests for the information from the manager's account to the employee. Now employee, he doesn't know to whom he is responding, since he has he got information request from the manager's account. He thinks that he is responding to manager only and he will give response, but the identity of manager has been stolen by someone. If you see, in the digital era, your identity is nothing but your user ID and your password. Okay, your user ID and your password represents your identity in the online, right? So that is identity based attacks. Next, insider threat. Okay, threat from people within the organization is known as insider threat. Okay, your organization employs itself selling the data of the company. Okay, next, DNS tunneling. Now DNS tunneling is basically a separate type of attack which will take around 1 hour for me to explain, but I'll just explain you quickly. Now websites will be there, right? Let's say for example, website of our Lecturepedia, www.lecturepedia.in. Whenever you type in your search bar lecturepedia.in, the system cannot understand English, so it will convert this lecturepedia.in to IP address. Okay, each domain name will be having a IP address, right? Each domain name will be matched to a IP address. Now, which domain name is having which IP address? This data will be maintained in DNS servers. Okay, DNS means domain name servers or domain name system servers, DNS servers. Now, in this servers, the list of websites and IP address allotted to that website will be there. Now, whenever you type in your search bar for Lecturepedia, that request will be first sent to DNS servers, and in the DNS servers the IP address will be taken, and from there the request will be sent to respective IP address. Okay, this is how the internet will work. Okay, this is how the data will be gathered and it will be shown to you. Now here in DNS tunneling, what will happen is the attacker will attack the line where the communication is happening between user's system and DNS servers. Okay, in this route he will attack and he will enter the system. Okay, this is known as DNS tunneling. This is one way of cyber attack. Next, IoT based attacks, which is Internet of Things based attacks. Okay, you are attacking the device that is connected to the internet. This you will understand while we are discussing IoT technology. Okay, these are the types of attacks. Next, moving to stages of cyber risk. Now, if you see, there are 3 stages of cyber risk. First of all, you will assess what is the cyber risk that the organization is facing. Okay, which type of attacks can occur on the organization. Okay, you will consider at least risk of ransomware, risk of email phishing, and risk of insider threats. Okay, so you will assess which type of cyber attack can take place on the organization. Next, impact of cyber risk. If such cyber risk actually happens, what impact will be there on the organization, right? See, the organization might have to pay certain regulatory costs or fines and penalties. See, if you don't maintain your systems properly, and if your systems are attacked and the data of public is taken over by the attackers, the government will impose penalty on you for not properly maintaining the systems or for not properly securing your softwares or systems. So because of cyber attack, you might have to pay regulatory costs, you might have to pay fines and penalties. Next, business interruptions. Just like in DOS attack we have discussed, if Flipkart's application doesn't work for 1 hour, the business interruption will occur to Flipkart, right? Next, data loss. Obviously, the organization will suffer data loss because of this cyber attack. Ransomware attack. Okay, it might have to pay certain ransomware if ransomware attack takes place. IP theft, that means intellectual property theft. Privacy breach of privacy also occurs because of cyber attacks. So this will be impact of cyber risk. Now, manage cyber risk. How you have to manage cyber risk? You will manage the cyber risk by implementing controls, right? Strategic risk management can help the organization to gain holistic understanding of cyber risk, assess existing IT and cyber security risk, align cyber security and IT information initiatives with strategic objectives. Okay, these are the 3 stages of cyber risk. What are they? First of all, you will assess the cyber risk. Then what will be the impact of that cyber risk? Then you will manage the cyber risk, right? Next, cyber security framework. What is this cyber security framework? See, just like for preparation of financial statements, we are having a financial reporting framework. For implementation of cyber security, there are cyber security framework. Okay, so in this cyber security framework, there are 5 steps. What are they? See, this cyber security framework includes how management is identifying the risk, protecting and safeguarding its assets from the risk. Okay, how the management is identifying the risk, how the management is protecting from the risk, and how the management is safeguarding its assets from cyber risk. There are 5 steps in this cyber security framework. First one is you need to identify the risk. Okay, determine whether entity's risk assessment process considers cyber security risk. I have already told you while discussing SA 315 in components of internal control system, we have discussed this point. Management will conduct entities risk assessment, right? In while conducting or during the entities risk assessment process, it should also consider the risk of this cyber security. Okay, next, entity should conduct periodic risk assessment, determine overall responsibility for cyber security, and establish roles and responsibilities over cyber security. Okay, you should assign the responsibility of cyber security to a particular officer. You can call him as either CISO or Chief Information Officer or Chief Information Security Officer. So in the first step, you are identifying the risk. The first stage of a cyber security framework is to identify the risk. Once you have identified the risk, you have to protect from the risk. So how will you protect from the risk? You will develop and implement appropriate safeguards. Safeguards are nothing but controls. See, this is a preventive measure. Okay, protecting the organization is a preventive measure. Okay, next, formal training to teams about cyber security risk. You should provide training to your employees about how cyber attack can take place on the organization. Okay, so that employees will be careful if they receive any email phishing attacks, or if they receive any ransomware attacks, they will not click on the unknown links if you provide proper training to the employees. So this is a preventive measure. Okay, before the risk has occurred, you are taking measures so that you will prevent from the risk occurring. Okay, next, implement effective controls for data security. Now you have implemented controls for preventing the risk. Even after implementing the controls, there is no 100% guarantee that cyber attack will not occur. It might occur. So when cyber attack actually occurs, your organization's systems should be having capability to detect that attack. Okay, you should at least know that attack has taken place, so that in future you will take appropriate measures to effectively battle that particular attack, right? So the third stage is detect the risk. See, entity should have controls and procedures to identify cyber security risks. Basically, the firewall of the organization will keep complete log of attacks that has taken place. If you see, even in your laptop also, the antivirus that you have installed will keep log of attacks that has taken place and how your antivirus has protected you from that attack, right? That log will be maintained. So such type of log should also be maintained. Review entities process to detect security breaches, whether management has implemented antivirus. So this is the third stage, which is detect the risk. Now after detecting the risk, you have to respond to the risk, right? Capture details of nature of incident and how incident or data breach was identified. Communicate the same with those who are ultimately responsible for this framework and with those charged with governance. After you communicate that this type of risk has this type of attack has taken place, the respective authority, he will take appropriate measures to recover from the risk. Okay, you cannot stay in the risk as it is, or you cannot stay in the attack as it is. If you don't take further steps to recover from the attack, the hackers will gain even more access to your systems, and your business will get disturbed or interrupted. So in order to avoid the disruption, you need to respond as early as possible. So by responding, you will recover from the risk. See, entity should take appropriate action to recover from the attack. Necessary improvements like patch upgrades means the updates to the applications, just like you receive updates to your applications. For the softwares also, patch upgrades, security upgrades will be made. Better controls, improved technology in terms of firewall, antivirus tools, etc. needs to be implemented to safeguard the entity. Okay, this is cyber security framework, 5 steps of cyber security framework. Okay, still we have some more concepts. We'll discuss the remaining concepts from the book. I'll open the book, just a second. I'll close the PPT and open the book. Next, remote audit. Now, what is meant by remote audit? See, in case of remote audit, the auditor, he doesn't visit the client's place. Instead, he will conduct the audit remotely, like work from home. Okay, see, he will use various online tools and he will do the remote audit. So, what are the considerations that has to be taken into account during the remote audit? Feasibility and planning. Planning should involve audit timelines, meeting platform. Okay, since you are doing remote audit, you cannot you will not visit the physical client place, but in order to interact with the client, what platforms, what meeting platforms you will choose, and audit timelines within which you need to complete the audit, all these it should be planned. And confidentiality and security of the data. Now, whatever the data that is being shared between auditor and the client, it should be encrypted. And for sharing the data between client and the auditor, let's say the the client, he is giving the access to the data by placing it in Google Drive folder, and the auditor is accessing from the Drive folder. Once auditor has taken the data that is kept in the Drive folder, Google Drive folder, it should be removed. Okay, and you should also consider legislation and regulations, and auditor should access the network of the client through VPN, virtual private network. Okay, with the help of VPN, you can securely access the network of the organization. And what are the advantages and disadvantages of remote audit? Firstly, cost and time will be saved because you need not travel to the client's place. However, if at all there are any network issues, you cannot properly conduct the audit. Okay, the continuous huge huge bandwidth of a network should be present for conducting the remote audit. If there are network issues, then that becomes a disadvantage. Next, comfort and flexibility to the audit teams, as they would be working from home environment, but at the same time, since they cannot visualize the physical facility of the client, they will not, the auditor will not understand culture of the organization. That is one of the disadvantage. And auditor can get first hand evidence directly from the IT system, as direct access to the IT system of the organization will be given to the auditor. But however, the disadvantage is remote access to sensitive IT informations might not be given to the auditor. And another advantage is the client, he can select the auditor from wide range. Okay, from global network of experts, the client can select the auditor. But however, if you select the auditor from another country, that auditor will not be having knowledge with respect to local laws and regulations. The cultural challenges for the auditor can occur. Okay, these are advantages and disadvantages of remote audit. Next, automated tools in audit. Basically, if you prepare meaningful information from raw data, it is known as data analysis or data analytics, right? Preparation of meaningful information from raw data is known as data analytics. Now, auditor, for the purpose of data analysis, he uses various tools. These tools are known as CATs, computer assisted audit techniques. Now, there are various data analysis tools that are available in the market. These are just some examples. See, these are some softwares for data analysis. Okay, almost all the softwares, they will be having same types of features, uh, but with slight modifications. Okay, so some of the examples are given. First one is ACL, audit command language, which is a data analytic software for the auditor. Next, Altrix is also one of the data analysis software. Next, Power BI from Microsoft is also one of the data analysis software. And Caseware, Caseware is also another data analysis software. Basically, by using these softwares, auditor, he can analyze the data and gather meaningful information from that raw data. Okay, next, emerging technologies in audit. Basically, there are certain booming technologies like IoT, artificial intelligence, blockchain, NFT. Okay, these technologies, will just go through them. First of all, IoT. What is meant by IoT? IoT is nothing but connecting various devices to internet is known as IoT. In our regular class, we will be discussing around 1 hour with respect to this IoT technologies. Just like you connect your mobile devices or your laptops to the internet, you can also connect all the electronic devices like air conditioner, like your microwave oven to the internet. So what is the use of connecting these devices to the internet? You can track those devices, you can gather data from those devices, you can operate those devices from anywhere, and still there are a lot of use cases of these IoT technology. Now, what are the audit implications because of this IoT? A shift to connected devices and systems may result in auditors not being able to rely only on manual controls. Auditor should also scope in new controls into his audit, which are automated controls, technology based controls. Next, audit firms may need to train and upskill the auditors. See, till now the auditors, they are conducting audit manually or by using some other technologies. But because of these emerging technologies, auditors, they have to upskill themselves with new technologies. This is also one of the implication on audit because of these technologies. Next, consider payment processing tools. This is one of the example that allow users to pay via credit card at a retail location through a mobile device. This could create new path for incoming payments that may rely in part on a new service provider supplying and routing information correctly. See, basically, if you are an online platform, you will use a payment gateway provider for collecting the payments. So, because of these new technologies, what's happening is there are new sources of payments that are coming to the organization. So, auditor, he has to scope in all these areas, right? Next, common risk of IoT. The common risks because of using this information technology is device hijacking. Attackers might hijack the device, or data siphoning, denial of service attacks. DOS attack can happen if you use IoT technology, and data breaches and device theft. These are some of the common risk of IoT technology. Next, artificial intelligence. This, what is this artificial intelligence? Now, the intelligence that human beings are having is known as natural intelligence. Now, we are trying to give the human type of intelligence to systems, so it is called artificial intelligence, which is not natural one. Now, we are training the systems in such a way that they can behave just like they can think, they can analyze, and they can involve in decision making just like human beings. This is known as artificial intelligence. The best example of artificial intelligence is chat gpt, wherein that is a type of model which has been trained by giving it the data that is available over the internet. And it the chat gpt, it can also learn from that data. It can learn from the interactions that it is having with the people, and it can analyze and it can give responses, right? So just like chat gpt, there are various use cases of this artificial intelligence. With respect to this artificial intelligence also, we have discussed various examples and various use cases in our regular class, right? We have discussed around half an hour to 1 hour with respect to artificial intelligence. What are the use cases of ai? Siri to help find your airpods, quick commands to open phone camera, ai to predict when to book the lowest price for the flights. And auditor implication: given the invincible nature of algorithms, auditors must focus on logical flow of process. A review of ai should ascertain whether unintended bias has been added to the algorithms. See, basically how the ai works is, it will work based on the algorithm, how the algorithm has been coded. Okay, the auditor, he has to verify whether any whether algorithm is showing any biasedness. Okay, if you see, during the us elections, there it was said that twitter twitter's algorithm was showing biasness towards one of the party. Okay, it was popping up more tweets that are against a particular party, right? So the auditor, he has to verify whether the algorithms are showing any biasness. Since the algorithms are invincible to the auditor, okay, the coding is invisible, you don't know how the algorithm works, right? So this is one of the audit implication. Next, auditor should assess the effectiveness of algorithms and whether their output is appropriately reviewed and approved. Auditors must also consider cyber security and search for possible bugs and vulnerabilities. Understand of how the use of AI affects the entity's flow of transaction. Okay, how the use of artificial intelligence will affect the transactions in the organization. The auditor needs to understand this. And common risks of AI: security is one of the key risk. Obviously, if you are using information technology, data security is the most common risk. And inappropriate configuration: okay, you need to configure these systems and algorithms properly. If you inappropriately configure them, they don't work properly, right? And data privacy. Next, coming to blockchain. So this blockchain technology, you can use this blockchain for storing the data. And blockchain offers you security, blockchain offers you transparency, and the blockchain also offers you irreversibility. Okay, and blockchain is also a decentralized, and it is also a distributed ledger. See, I cannot explain the complete knowledge of a blockchain now in the revision class, because it will take around 30 minutes for explaining this blockchain technology. What I will do is, I will make a separate video on this blockchain technology, and I'll also make a separate video on artificial intelligence. Okay, if you want to clearly understand them, you can watch those videos. But since this is a revision class, I will be quickly explaining you these concepts. So blockchain is based on decentralized and distributed ledger. Each transaction is validated by the blockchain participants. All blocks are sequenced so that any modification or deletion of a block disqualifies the information. Okay, so if you see the structure of the blockchain, it will be like this, and each block will be linked to the next block, and in this block you can store data, whatever the information you want you can store, and the data in this block will be encrypted. Okay, with hashing technology you will encrypt this data in the block, and each block will be linked to the next block. If at all any alteration is made to the data in the block, the link between the first block and the next block will get disturbed, so that you will identify that the data has been altered. Okay, and what are the auditors implication? Auditors should consider appropriate governance and security around the transaction. Basically, if you see, as of now there is no law or regulation with respect to the blockchain. No one is governing blockchain. So auditors should consider the appropriate governance and security around this blockchain, as blockchain interacts with legacy systems and business partners. Concerns related to insecure application programming interfaces, data confidentiality and privacy cannot be ignored. See, blockchain, it doesn't work individually. Okay, it works along with the existing systems. Okay, you will integrate blockchain technology with existing solution. Okay, so since blockchain is integrated with existing systems, you have to ensure that there is no tampering that has been done with respect to this technology. Next, data privacy laws and regulations may be area of concern as data are communicated across geographic boundaries. Okay, data privacy laws and regulations should also be considered, and regulatory landscape is still evolving for blockchain, right? There are no proper laws and regulations to govern these blockchain technology. Common risk: inability to reverse the transaction. I have already told you, you cannot reverse the transaction that has been entered in the blockchain until and unless all the participants of the blockchain approve the reversal. And operating through network nodes, I have told you blockchain is a decentralized network. It will operate through nodes. Okay, each participant of the blockchain will be having copy of that blockchain, right? And auditors should also ensure that organization has the necessary data management process and complies with regulations. Next, NFTs, which is non-fungible tokens. This non-fungible token, it also works on blockchain technology. Basically, if you see physically, let's take an example, Mona Lisa painting, right? The Mona Lisa painting, it has huge value. Okay, its value is crores of rupees. Now tell me, if you have Mona Lisa painting with you, will you get any benefit out of it? No, you will just hang it over the wall. Okay, you are not deriving any benefit from it, but its value, its worth is crores. Just like that, in the same way, the Kohinoor diamond, even the value of Kohinoor diamond is worth crores of rupees. But let's say you have Kohinoor diamond, will you get any benefit out of it? No, it will just stay in the locker, right? But its value is huge. Why? Because people are thinking that its value is huge, so its value has become huge. Okay, we have, it's a perceived value, you can say. Since all the people around you are thinking that it's valuable, it has gained value, right? So that's how valuable items will work physically. Now the same concept has been replicated online. Now let's say, for example, Virat Kohli. Now Virat Kohli, he has given an autograph and he has created NFT for his autograph. Now since Virat Kohli is popular, the NFT that has been created by him will also have huge value, right? So his fans, he will purchase the NFT that has been created by Virat Kohli. Now if you think physically, why the value of Mona Lisa painting is that high? Because there is only one such painting. Why the value of Kohinoor diamond is such high? Because there is only one such diamond. So even though everyone around us thinks that its value is high, if fake copies of it are created, its value might diminish or people might lose confidence over it. So in order to maintain its value, it should be unique. Okay, there should not be any replicas of it, there should not be any duplicates of it, right? So to ensure uniqueness of NFTs, blockchain has come into existence. Sorry, blockchain has been used. Okay, blockchain technology has been used to ensure uniqueness of NFTs. I have told you that in the blockchain you can store the data, right? So blockchain is being used to store ownership data of this NFT. Okay, let's say today I am the owner of this NFT, and after some days I sell this NFT to some other person. So the data with respect to the next owner will be stored in the blockchain. And blockchain, since it is very secured, and since it is it operates on a decentralized system and no one can hack this blockchain, the replicas of the NFTs can't be created. Okay, so NFT means something unique and cannot be replaced. NFTs contain digital signature which make them unique. NFTs are digital assets, example photos, videos, artwork, sport collectibles, etc. Okay, you can create NFT of anything you wanted. And there are also marketplaces where NFTs are being sold. Just like stock exchanges, there are NFT exchanges. Now, NFTs are tokens used to represent ownership of unique items. NFTs allow their creators to tokenize their artwork. Next, robotic process automation. We have already discussed the robotic process automation. A case study with respect to this RPA is being given here. You can just go through that. That case study, it is related to a chatbot of railway booking system. Okay, how the ticket booking of railway has been automated with the help of chatbot, that is being discussed over there. You can just go through it. Next, risks due to technology. Okay, because of use of technology, what type of risks can occur? Firstly, inaccurate processing of data or processing inaccurate data. Okay, there is a possibility that the software might process the data inaccurately. Okay, if it is wrongly coded, or software might process inaccurate data itself. Okay, that is one of the risk. Next, unauthorized access to data. This we already knew. Gaining access privileges beyond those necessary. This also we discussed. Unauthorized or erroneous changes to data, unauthorized changes to system, failure to make necessary changes, inappropriate manual intervention, potential loss of data, third party service provider, and cyber security risk. So these are some of the risks because of use of technology. Next generation audit. Now, some of the tools that the auditor can use with respect to auditor. Firstly, drone technology. Now, drones are such a tools which can carry payloads of huge weight. Auditor, he can use these drones to conduct stock audit, right? See, using drone technology in the remote locations for stock counts. Drones have great payload capacity for carrying sensors and cameras. Thus, they can photograph and physically examine the count of large quantities of physical assets. Next, augmented reality. Augmented reality means you are making some additions to the existing reality. That is known as augmented reality. Example, if you take Lenskart app. Now on Lenskart app, you can try the specs on your face. Okay, there is a feature wherein you can just keep your mobile phone like this, and you can your face will be replicated in the app, and you can try various specs on your face. Now your face is reality. To your face you are adding something which is virtual. So this is known as augmented reality. Augmentation means making addition. Okay, making addition to existing reality is known as augmented reality. The technology allows user to view real world environment with augmented elements. Next, virtual reality. Virtual reality is complete virtual. Okay, you are not taking any real world, you are creating completely a new world. Okay, completely new, you are not adding something to the existing reality. Okay, completely you are creating a new world, so it is known as virtual reality. One of the example for virtual reality is metaverse. Okay, now VR goes a step forward and replaces real world entirely with simulated environment, right? So one of that example is metaverse. The metaverse is a emerging 3D digital space. Now, metaverse, as you already know, which is a project that has been taken up by Mark Zuckerberg. What they are trying to do is they are trying to create a complete virtual world with the help of all the technologies that we have discussed till now. Okay, in this metaverse, they are using blockchain technology, they are using artificial intelligence, they are using NFTs. Okay, they are using virtual reality. So by using all these technologies, they are trying to create a digital space. Okay, let's say for example, in this metaverse, the possibilities are they can create a bank. Okay, now physically we are having a bank wherein we can store our money. Just like that, in the metaverse also you can store your money in the bank. For that, in the metaverse there will be cryptocurrency, obviously the blockchain technology. With the help of blockchain technology, cryptocurrency, and you can store the money in the blockchain itself. Okay, and NFTs, you can purchase and sell NFTs in the metaverse, and for purchasing those NFTs you can use cryptocurrency, right? So like this, by integrating all the technologies, they are creating a metaverse. So the same you can find here, virtual banking and transaction. Okay, in future, once the metaverse has been completely developed, who might know, all the banks that are present as of now physically, they might open up their branch in the metaverse. Okay, wherein people can open accounts in the metaverse branch and they can transact online. Next, digital asset management. Just like we are having stock exchanges, we are having mutual funds in a physical world, there the same can be replicated in metaverse as well. Next, virtual financial education and training. Just like we are having schools and colleges here in physical world, the same can be replicated even in metaverse also. You can attend the schools just from sitting at your home. This is a possibility of metaverse. Virtual meetings and conferences, digital visualization and analytics. Common risk associated. What are the common risks? The same types of risks: public safety, cyber security, data privacy, data protection, lack of standard, and technical challenges. Since they often track movements and data, massive amount of data are generated about the whereabouts of users. Okay, to enable all this to happen, they have to collect the data of the users. So this is one of the risk of losing the privacy of the users, right? So this is a complete revision with respect to digital audit and assurance. We'll meet in the next class with another revision video. And before that, a small announcement: we have launched Lecturepedia app. On this app, you can practice MCQs of all the subjects, not just audit. You can practice MCQs of all the subjects of CA final, CA inter, and CA foundation. And you can also purchase classes of various faculties on Lecturepedia app. You can get this app from Play Store. Okay, we'll meet in the next class. Until then, take care. Bye bye. See you. In the today's class, we will be revising sustainable development goals and ESG related assurance. Basically, this chapter, it is newly introduced in the new syllabus. It was not there in the old syllabus. So it is a completely new chapter. So first of all, before going into the chapter, we need to understand what is meant by sustainable development. Once we understand sustainable development, then we will come to know why sustainable development goals have been issued. See, sustainable development is a concept wherein goods and services will be produced to satisfy the needs of the present generation without compromising the ability of the future generations to satisfy their own needs. That means, with the available natural resources, with the available man-made resources, we are satisfying our own generations needs. But we should not consume all the resources, and we should not develop in such a way that it will restrict, or it will constrain the ability of the future generations to develop. See, let's say petroleum. If we consume all the petroleum that is available without sustainably utilizing it, then entire petroleum reserves, they will get completed, and the future generations, they will not have any resources left. So instead of that, if we consume the resource, the natural resource, that is petroleum, in a sustainable way, that means not consuming entire resource, but partly utilizing that petroleum resource, and partly shifting towards some solar energy or some other renewable energy resource. If we do that, then new petroleum reserves, okay, we will be giving time for the environment to generate new petroleum reserves, right? So that even the future generations, they will be having this petroleum. So this is the concept of sustainable development. Whatever the activity that you do, you have to do it in a sustainable manner. Okay, sustainable means which will last for a long duration of time. It will not get completed within a short duration of time. So your development should be sustainable. It should not the development should not come at the cost of destruction of the environment, at the cost of destruction of the ability of the future generations to develop. You have to develop in a sustainable manner. The development should run for a longer generations. So that is the concept of sustainable development. Now, in any country, the development happens through companies, right? Through businesses. The more the more GDP you generate, the more developed economy you are. So in order to develop sustainably, you need to focus on your companies, okay, on the businesses in your country. So the United Nations, first of all the countries, they wanted to develop sustainably. In order to develop sustainably, if you tell all the companies in your country to develop sustainably, whether they will follow? No. Instead of that, if you give them certain goals, okay, if you give the companies in your country, if you give the businesses, whoever doing the businesses, if you give certain goals to those people and tell them to achieve those goals, once they achieve those goals, the sustainable development will take place automatically. So in order to achieve sustainable development, certain sustainable development goals have been given. Okay, first of all, we need to sustainably develop. So in order to develop sustainably, you need to achieve certain sustainable development goals. There are 17 sustainable development goals that have been issued. Now you told the companies to achieve sustainable development goals, and you have not yet put you have not put any reporting responsibility on the companies. Okay, companies are not accountable. In that case, tell me whether they will follow or they will thrive for achieving these goals. No, they will not put any efforts for achieving these sustainable development goals. Instead, if you tell the companies, once a year completes, you prepare a report how you have developed sustainably. Okay, what steps you have taken, what processes you have implemented to achieve these goals. If you ask them to give sustainability reporting, then they will uh, you know they will become conscious, because at the end of the year they need to give reporting. This sustainability reporting, it will be seen by all the stakeholders. If the company, it has not it has not taken any steps for achieving these sustainable development goals, then stakeholders, they will question why the company is not taking any steps. So in order to bring some sense of seriousness, sustainability reporting has to be done by the company. However, the sustainability reporting, it is not applicable for all the companies. Only for top 1000 listed entities, sustainable reporting is mandatory. Sustainability reporting. So in India, the sustainability, the name that has been given for this sustainability report is BRSR, that is business responsibility and sustainability reporting. Now in this BRSR, there are 9 principles on which the company has to report how it has performed with respect to these 9 principles. Okay, what are those 9 principles? We will be discussing. So companies, they will prepare this BRSR report. Once they prepare this BRSR report, there is a chance that they can include whatever they wanted. Okay, even though they have not achieved that performance, they might include it in the BRSR. So in order to avoid that, because this BRSR report, it will be used by the stakeholders. So in order to give assurance to the stakeholders that whatever presented in BRSR report is correct, audit will be done. We will be calling it as ESG assurance. Okay, ESG assurance. So this is the brief idea of this chapter. We will be seeing what is sustainable development. I have explained you. Next, we'll now, in order to achieve sustainable development, there are 3 main pillars, that are environment, social, and governance. You need to focus on these 3 pillars. What are these 3 pillars? We'll discuss. And there are 17 sustainable development goals that have been given, and there is also sustainability reporting in the form of BRSR report. There are 9 principles. In these 9 principles, you will be reporting on essential indicators as well as the leadership indicators. We'll discuss that. And finally, ESG assurance, and there is also concept of integrated reporting. So this is the brief overview of this chapter. Okay, now, so sustainable development, as I have already told you, sustainable development is development of goods and services to meet our present needs without compromising the ability of future generations to fulfill their own needs. Now, in order to achieve these sustainable development, you need to focus on 3 main pillars. What are the 3 main pillars of sustainable development? First of all, environment. Your activities should not cause any harm to the environment. You need to develop climate related policies. Okay, policies and procedures that will impact the climate. You need to develop them, and you need to focus on natural resource conservation, and you need to reduce pollution and waste. And That is the first pillar, which is environment. Second pillar, coming to social. In the social, it will be focused on the relationships that you develop with the people. There will be employees in your organization. Okay, you need to maintain proper relationships with the employees, and there will be various vendors. Okay, external stakeholders will be there. The company, it has to maintain proper relationship, sustainable relationship. Okay, the relationship, it should last for a long. Okay, it should not complete with just one transaction that takes place. It should be sustainable relationship. So the companies, they should also focus on social aspect. And finally, governance. Just a second. Finally, governance. Governance refers to how the company manages its own operations. The company has to perform its activities in the best interest of the stakeholders. Okay, so see, in order to control the activities of the company, certain policies and procedures will be there in the company. These policies and procedures, they should be in the best interest of the stakeholders. The company should be governed in the best interest of the stakeholders. So corporate governance and corporate behavior, these are the three pillars that has to be focused in order to achieve sustainable development. What are the three pillars? You need to focus on environment, social, that is relationships and network, and finally governance aspect. You need to govern your company in the best interest of the stakeholders. Okay, with respect to governance, that is corporate governance, you will be having various provisions in the SEBI LODR regulations. If you are a listed company, then SEBI LODR regulations will be applicable to you. If you comply with those LODR regulations, you will be complying with the corporate governance requirements. Okay, next. Now, there are 17 sustainable development goals that have been recommended by United Nations members. They have agreed to achieve these goals in their countries. Okay, with the help of the companies that are there in their country, each member of United Nations has agreed to achieve these goals. What are those goals? There are 17 sustainable development goals. See, first of all, why these goals have been given? Without a goal, if you work towards any aspect without a goal, then there is a high chance that you won't uh, be successful in achieving that. So here your objective is to develop sustainably. Now, in order to develop sustainably, if you give certain goals to the company and you tell to the companies that if you achieve these goals, it means that you are putting steps towards sustainable development, towards achieving sustainable development, then companies, they will try to achieve these goals. Okay, that is the reason for giving these sustainable development goals. Now, there are 17 sustainable development goals. We will remember these 17 sustainable development goals in the form of a story. Okay, first of all, the first sustainable development is no poverty. There should not be any poverty in the country. Now, if there is no poverty in the country, then everyone will be having money, right? So if everyone will be having money, they will be able to eat properly. So there will not be any hunger, that is zero hunger. First of all, no poverty. If there is no poverty, there will be zero hunger. If there is zero hunger, all the people, they will be fit, right? There will not be any diseases. So good health and well-being will be there to the people if there is zero hunger. First of all, there is no poverty. If there is no poverty, there will be money, so they will be able to buy the things and they will be eat, so there will be zero hunger. If there is zero hunger, people will be well-being and good health. Once well-being and good health is there, you can concentrate on your studies, right? So there will be quality education. Once there is a quality education, then there will not be any gender inequalities, because all the people they will be educated and they will not show any gender inequality, so there will be gender equality. Hope that is clear. So these five, they are like disease, okay? Having poverty in the country, having hunger in the country, people are not educated, all these are like a disease in the country. So these five problems are there in a particular city, let's assume, okay? These five problems, that is poverty, hunger, lack of education, and gender inequality, and not having proper health, these five problems are there in a particular city, okay? Now in order to save this city from these five problems, a hero has come. Now hero means he will be having certain powers, right? Now our hero, he is having two powers, one for each hand. So for the left hand, the power is that water will be generated, okay? From the left hand, clean and clean water and sanitization, that is water will be generated. This is the first power that the hero is having, which is a sixth sustainable development goal, clean water and sanitization. And the second power is electricity, okay? The affordable and clean energy will be generated from the right hand. So these are the two powers that this hero is having, one is water, one is energy. So with these two powers, our hero, he has eliminated the five problems that are there in this particular city. Hope that is clear. Once we will revise these seven sustainable development goals. First of all, there will be no poverty. If there is no poverty, there will be zero hunger. If there is zero hunger, you will be well-being and good health. If you are having good health, then there will be quality education. If there is quality education, then there will not be any gender inequalities. These five problems are there in a particular city. In order to eliminate those five problems, a hero has come. He is having two powers. One power is clean water and sanitization, and another power is affordable and clean energy. Hope that is clear. Now with the help of these two powers, our hero, he has eliminated these five problems. Once these five problems are eliminated, the people in that city, they will be getting decent work, and there will be economic growth, right? If the people, they are not having any problems, means what they will do, they will concentrate on the work, okay? And they will strive for the economic development. So that is decent work and economic growth will happen in that particular city, right? Decent work and economic growth. Once economic grows, there will be lot of infrastructure that will be built, right? There will be roads, there will be dams, and there will be bridges that will be constructed in the city if there is a economic development. So industry, innovation, and infrastructure, and there will be reduced inequalities, okay? There will not be any inequalities in that particular city. If the city has developed, all the people are having money, all the people are educated, then why will there be any type of inequalities? First of all, we have eliminated gender inequality. Later on, after achieving even more growth, we are able to eliminate all other inequalities. Hope that is clear. And all other inequalities are eliminated in that particular city. So now this city, it has become a role model, because there is no hunger in the city, there is no poverty in the city, all the people are educated, it is well developed, there is infrastructure in the city. So all the aspects that has to be present in a particular city are present here. So this city, it has become a role model. Now it will spread its good culture or its development to the neighboring cities as well. So sustainable cities and communities will be developed. Once this particular city has developed, the neighboring cities will also take inspiration from this, and they will also develop sustainably, and they will also uh, improve communities. So sustainable cities and communities will be developed in the neighboring areas also. So by this, the story gets completed, okay? The 11 sustainable development goals we remembered in the form of a story, and remaining points you need to remember individually. 12th sustainable development goal is responsible consumption and production. The people in the country, in this city, all the people, they are having money and they are having education, all that they are having. So now they should not waste the resources, right? They should consume responsibly. And the companies in this city, they should also produce responsibly. They should not waste the resources, they should not cause harm to the environment. So they should there should be responsible consumption and production. Okay, you can also include this 12th point also into the story. So the first 12 sustainable development goals we will remember in the form of that story. Remaining, individually you need to remember remaining 5 sustainable development goals, that is climate action. Okay, you need to take steps in order to prevent the adverse effect of your activities on the climate. Okay, whatever the activities that the company is taking up, they should not cause any harm to the climate or to the environment. That is climate action. And you should focus on life below water. Life below water means in ocean there will be various lives that will be living. So you should not cause disturbance to their living. So you should focus on life below water also, and you should also focus on life on land. Apart from human beings, there will be various other animals that will be living on land. So you should not cause any disturbance to those other creatures also with your activities. And peace, justice and strong institutions should be developed. And in order to achieve all these goals, if you have to partner with any other countries, then partnership for goals has to be done. Okay, these are the 17 sustainable development goals. Hope that is clear. Now, as I have already told you, if you just give sustainable development goals to the companies and tell them to achieve these goals, you don't know whether they will achieve those goals or not, whether they are taking any steps for achieving those goals or not. So in order to measure their performance, you are asking them to give sustainability reporting. Okay, so sustainability reporting involves communication of companies ESG performance. ESG performance means how it is contributing to the environment, social, governance, what steps it is taking in order to develop sustainably in these 3 areas. So that performance it has to give in the form of a report. Now, for preparing this report, there are various frameworks that are available. Just like for preparing balance sheet, profit and loss statement, that is the financial statements, there will be frameworks that will be available, right? AS, Indian accounting standards, like this, the frameworks are there. In the same way, for sustainability reporting also certain frameworks are there. Based on that frameworks, you can give your sustainability reporting. Now, there are various frameworks. The most commonly followed frameworks are Global Reporting Initiative. This Global Reporting Initiative is basically a non-government organization which will develop standards for sustainability reporting. These standards, they will mainly focus on economy, environment and social impact. The standards that are issued by Global Reporting Initiative are mostly followed in many countries for this sustainability reporting. And also there is a Carbon Disclosure Project. Even this Carbon Disclosure Project is a non-government organization which focuses on capturing data related to CHG emission, that is greenhouse gas emissions. How much greenhouse gases emissions that the companies are doing. Okay, this uh, this data from the companies will be collected by this carbon disclosure project, and they will prepare reports, and these reports which are prepared by carbon disclosure project will be used by various stakeholders, various investors community for taking investment related decisions. Okay, this carbon disclosure project, it will also focus on water conservation, forest related management and supply chain activities. And finally, international integrated reporting framework. It will establish principles to generate integrated reports. Basically, integrated report is a report wherein you will integrate both financial as well as non-financial aspects of the company. Okay, in the financial statements you will give financial related disclosures, right? In the sustainability reporting you will give non-financial related disclosures, but in the integrated reporting you will include both financial as well as non-financial aspects. Okay, that is the concept of integrated reporting. There will be 6 C's on which you will be reporting. Okay, we'll discuss that integrated reporting. So these are the main frameworks that you can use for preparing these sustainability reporting. Now, in our India, Institute of Chartered Accountants of India, it has taken various initiatives towards this sustainability reporting. First of all, it has constituted a separate board by name Sustainability Reporting Standards Board. The purpose of this Sustainability Reporting Standards Board is to issue standards for sustainability reporting and give various material and develop various books with respect to sustainability reporting. This is the main purpose of this board. It will carry various activities related to sustainability development. And our institute has also started certificate courses on sustainable development goals, business responsibility report, and integrated reporting. On these aspects, institute has started certificate course. Basically these certificate courses you can do after completing your chartered accountancy. Okay, post qualification courses you will be calling them. And institute has also developed following publications: SAE 3410, which is Standard on Assurance Engagement 3410, which deals with greenhouse gas statements, and background material on BRSR. BRSR is a sustainability reporting that you will do in India. And SDG, accountants creating sustainable world. Okay, basically there will be 3 parts in this book. It is basically a background material that has been issued. And FAQs on sustainability reporting maturity model. This sustainability reporting maturity model you will use for ranking the companies. That is based on sustainability report that the companies has given. In the sustainability report they will present how they have performed during the year. Based on that performance you will give ranking to the companies. Okay, for giving that ranking you will allot certain points to the company. If the company gets more points it will be having the more rank. So for the purpose of giving ranking to the companies you will be using this sustainability reporting maturity model. ESG reporting in India. So SEBI has introduced business responsibility and sustainability report. We will be calling it as BRSR. Okay, in India the sustainability report, the name of a sustainability report that the companies issue is business responsibility and sustainability report, BRSR. Okay, this is the name of the sustainability report that the companies in India issue. However, this is not applicable to all the companies. Only top 1000 listed entities from financial year 22-23 has to mandatorily issue these BRSR report. And this reporting is in line with ESG parameters. And BRSR discloses performance of entity on 9 principles. I have told you now, in this BRSR reporting there will be 9 principles. In each of these principles you will be giving essential indicators as well as leadership indicators. Basically these 9 principles they are given by national guidelines on responsible business conduct, NGRBC. Okay, NGRBC has issued these 9 principles. On these 9 principles, how you have performed on these 9 principles, you will give your performance in the BRSR report. Your performance with respect to these 9 principles which are issued by NGRBC will be given in BRSR. Hope that is clear. Next, 3 sections of BRSR reporting. Basically, this business responsibility and sustainability reporting, it will be given in 3 sections. There will be 3 sections in this report. First section, that is section A, it will deal with general information related to company, like name of the company, SIN number of the company, and in which products and services the company deals with, what are the operations of the company, and what are various CSR activities that the company is taking up, and what are the information related to employees of the company, and whether the company is having any subsidiaries and associates. All this information with respect to company, it will be presented, it will be disclosed in section A of this report. Next, section B, which will contain policies and procedures that have been framed by the company for the purpose of achieving the 9 principles, okay, for purpose of achieving the performance in the 9 principles of BRSR reporting. So what are the policies and procedures that the company has framed? They will be disclosed in section B. And section C, it will contain actual performance of the company with respect to those 9 principles. So these the performance in these 9 principles, it will be measured through key performance indicators. These key performance indicators, they will be of 2 types. One is essential indicators, one is leadership indicators. First of all, what is this key performance indicators? Let us understand this with the help of an example. Let's say you wanted to measure performance of a particular student. Let's say that student, he is going to a school and you wanted to measure his performance. So you will measure it with the help of key performance indicators. What can be the key performance indicators? First of all, you will see his attendance. Okay, how many days he is attending the school. Based on his attendance percentage, you will measure his performance. Okay, whether he is regularly coming to the school or not. If he is coming regularly, then he would have been properly listening to the classes, so he is studying properly. This is one of the essential key performance indicators. Okay, why it is essential? Because this you will check for all the students. Okay, all the students, they must attend to the school regularly. So attendance is one of the essential key performance indicators. Next, you will also check how many marks, what is the percentage that he is securing in the examinations. Even this is also you will check for all the students, right? So this is also one of the essential key performance indicators. Coming to leadership indicators, these leadership indicators, they are not mandatory. Okay, let's say for example, a particular student, the key performance indicators with respect to leadership, uh, this leadership indicator is like, you will check whether the student is participating in extracurricular activities. See, in not all the students will participate in the extracurricular activities. So this is a leadership indicator. If a particular student is participating in extracurricular activity, then it is an indication that he is somewhat extraordinary student when compared to all other student. So this leadership indicator, it will not be checked for all the students. Only for certain students this leadership indicator will be there, like participation in extracurricular activities. So essential indicator, it is mandatory for all the for all the students, you will check. For leadership indicator, it will not be there for all the students. Only for certain students you will measure this. In the same way, here also, in case of this BRSR reporting, essential indicators, they are mandatory in nature. Okay, and leadership indicator, they are not mandatory, they are optional in nature. See, principle wise performance disclosure. So here also you will be using key performance indicator to measure the performance of the company in these 9 principles. So these key performance indicators, they will be essential and leadership. If any company is performing extraordinarily, okay, if it is doing beyond what is required, then that is a leadership indicator, and this leadership indicator, it is optional to be disclosed. So coming to the 9 principles, these 9 principles, the performance in these 9 principles, it will be given in the section C. First of all, we'll see what are these 9 principles they are related to. First principle is related to ethics, and second principle is related to creation of safe and sustainable goods and services. Companies, they will produce goods and they will provide services. Those goods and services, they should be safe. Okay, firstly they have to follow ethics transparency and accountability. Next, safe goods and services has to be produced. Next, they have to concentrate on their employees and also on their stakeholders. Okay, related to employees, principle number 3; related to stakeholders, principle number 4. And human rights, they should not cause any harm to the human rights of the people with whom they are dealing. So the fifth principle is related to human rights and protection and restoration of environment. With respect to environment, sixth principle. Seventh principle, influencing public and regulatory policy. Okay, the companies, they will be asked for their opinion whenever government is framing a new policy, that is known as policy advocacy. So with respect to that policy advocacy, principle 7. Principle 8, inclusive growth and equitable development. The company, it should not focus only on its own growth and its own development. It should take all others along with its growth. Okay, it should strive for the development of all other people with whom it is dealing. There should be inclusive growth and equitable development. And finally, value to the consumers has to be provided in a responsible manner. So these are the 9 principles. First principle deals with ethics. Second principle, safe goods and services. Third principle deals with employees. Fourth principle deals with stakeholders. Fifth principle deals with human rights. Sixth principle deals with environment. Seventh principle deals with policy advocacy. Eighth principle deals with inclusive growth and equitable development. Ninth principle deals with consumers. Okay, now in each of these principles, what are the core elements that we'll see? First of all, ethics, transparency, and uh, accountability. Whatever the policies and procedures that the company develops, whatever the policies they follow, they have to be developed in such a way that ethics are not compromised. Okay, do not compromise on ethics. And all the information related to its policies and procedures, they have to be disclosed transparently to the stakeholders. Okay, the information related to their business must be transparently disclosed to the stakeholders, and take more care for transparent disclosures. And not only you should also encourage other participants in the value chain to follow these 9 principles. And if you find that any other participant is not following, is violating the any of the 9 principles, you have to take appropriate action. Okay, you have to respond proactively. You need to take accountability. So this is the first principle, ethics, transparency, and accountability. Next, principle number 2, providing safe and sustainable goods and services. See, while designing products, production methods, and techniques, you have to take care that the resource utilization will be very minimal. Okay, the product has to be designed in such a way that for developing that product, the resources that you use will be very minimal. Okay, as much minimal as possible. And educate consumers and clients about their rights. Okay, you need to educate consumers about the rights and take measures to reduce over exploitation of natural resources. Okay, while producing these goods and services, while conducting the business of the company, while providing services, you should take care that the exploitation of natural resources should be reduced. So this is the second principle, providing safe and sustainable goods and services to the customers. Principle number 3, with respect to well-being of the employees. Okay, you should take care of your employees. Comply with all regulatory requirements related to employees. Okay, there will be various regulatory requirements like PF, ESI, and there will be laws with respect to child labor. Okay, all those law and regulation with respect to employees has to be complied by the organization. And do not restrict freedom of forming unions. Okay, employees, they can form unions and associations to voice about their rights. So you should not restrict employees from joining those unions. You should not restrict employees from forming such a type of unions. You should encourage them to develop their own unions. Hope that is clear. Next, prevent child labor and bonded labor. You should not allow child labor in your factories and in your premises. Do not compromise on employees' work-life balance and timely payment to the workers. And such payment should be in line with the minimum wage that has to be paid in order to help that particular employee to meet his basic needs. Okay, you have to take care that the amount of wage, the minimum wage that you are giving, is sufficient for that employee to meet at least his basic needs. And you should make the payment of wages on timely basis, and create safe and hygienic workplace. Okay, the workplace, it should be safe and hygienic, and skill development training you need to provide to the employees, and creation of harassment free workspace. These are the core elements with respect to third principle of well-being of the employees. Next, stakeholders. Fourth principle, you should also take into account the interest of the stakeholders. First of all, you need to identify who are the parties that are interested in the business of the company, and be transparent and communicate impact of operations and decisions on people and nature. Okay, you should communicate with the stakeholders what will be the impact of business activities of the organization on the nature and people and on the stakeholders, because this will help the stakeholders for making proper decisions, and fairly share benefits with the stakeholders. You should not take the benefits that you generate by doing the business only yourself. You should fairly share these benefits to the stakeholders. Okay, for the shareholders in the form of profits you will share, for employees in the form of proper wages and salaries you will share the benefit, and for public, for the general public, you will share the benefit in the form of CSR activity. Okay, so you need to fairly share benefits with all the stakeholders. That is fourth principle, which deals with stakeholders. Fifth principle deals with human rights. First of all, the organization, it should get an idea of what are the human rights and how these human rights will be violated, so that the company will take care that the human rights will not be violated by the company. Clearly understand human rights and ways by which the human rights will be violated. You need to have an understanding of this, and integrate human rights into policies and procedures while developing management systems. Okay, management, while developing the systems and procedures in the organization, you should integrate human rights into these policies and procedures. Recognize and represent human rights of all the stakeholders. Okay, you should respect the human rights of all your stakeholders. Next, principle 6, with respect to protection and restoration of environment. First of all, the policies and procedures to assess and rectify impact on the environment. You should have policies and procedures to measure and to reduce the impact that the company's business activities is creating on the environment. If at all any harm is being caused to the environment, you need to reduce that impact of your activities on the environment. Use natural and man-made resources optimally to ensure sustainability. Measure performance related to prevention of pollution, forest destruction, waste generation, etc. Contribute towards climate change resilience, and look out for avenues to improve performance towards various environment responsibilities. Okay, how you can discharge your environment responsibilities, various alternatives through which you can discharge your responsibilities towards environment. You should look out for those alternatives. Next, principle number 7, when engaged in influencing public and regulatory policy, do so in a manner that is responsible and transparent. Generally what happens is, some large companies, they will be approached by government and various authorities whenever they are developing any law which influences that company, so that this company or this management, they will give inputs for developing that particular policy or that particular law by the government. So that is known as policy advocacy. Okay, so when the company is involved in the policy advocacy, it should take care that whatever the policy it suggests, it will not cause harm to the small players in the industry. Okay, there should be fair and fair competition that should be present in the industry. So core element of BRSR will be met when organization makes a contribution to policy formation, and the contribution to this policy formation, it should be made through the help of associations. See, use collective associations for policy advocacy and formulations. Basically, uh, all the businesses which are dealing with a particular activity, they will form a association. Let's say, for example, all the people who are dealing with iron and steel, they will form a association. Okay, and the government, it will approach this association if while developing any law or regulation which impacts this particular business. So this association, it can give its suggestions to the authorities or the government for policy making. And role in policy advocacy should encourage fair competition and prevent human right abuse. Okay, if you are a huge company and if you suggest any policy, any inputs for policy making, you should take care that inputs will not benefit only to you. Okay, that inputs should be benefit, should give benefit to all other small players in the industry. Okay, there should be fair competition. Okay, the policy should not be in such a way that it eliminates the competition in the industry. Hope that is clear. Next, principle 8, inclusive growth and equitable development. It is not that only the company develops. Along with the company, it should take all other stakeholders. Okay, it should strive for development of all other stakeholders. Systems to identify and address impact of activities on social, culture and economic aspects of the people. Okay, there should be systems that has to be developed to assess what impact the activities of the company is creating on the economy, what impact the activities of the company is creating on the social culture. Measure and track impact of their activities on society and environment, make plans to mitigate them. Okay, if their activities is causing any negative impact on the society, take action to mitigate that negative impact. Make efforts to bring creative products, technologies to help marginalized communities. Okay, you should strive to develop the products and services which will help the backward communities, the marginalized communities. Let's say, for example, you are in the financial related sector, then you should develop such a products or services which will help the poor people. Okay, you should develop such loans with a less rate of interest for helping the poor people. So based on the industry in which you are doing the business, you should develop products and services which will help the marginalized communities. Only by this you can achieve this equitable growth and development, inclusive growth and equitable development. And review local and regional development priorities in CSR activities. Basically, the companies, they needs to spend certain 2% of their profits on the CSR development, right? So while incurring this CSR expenditure, we have to focus on the local area. Okay, the area in which the company is having its office. Okay, the area in which the company is doing its business. Okay, for those people, it needs to focus while spending this CSR expenditure. And ensure that business induced replacement of communities do not happen. Let's say company, it wanted to set up a factory. For setting up the factory, it needs a land. Okay, so it requires land in a particular area. That land belongs to various small people. Okay, various residents. So for taking over that land for setting up the factory, you should not cause relocation of those existing people. Okay, you select such a area which is not occupied by any other people. So business induced replacement of communities does not happen. If at all it is very much necessary to set up the factory in that area, then you properly relocate those people to some other area. Okay, and all forms of intellectual property should be you know respected by the organization. You should not fraudulently utilize the intellectual property of any other organization. Ninth principle, dealing with providing value to the consumers in a responsible manner. What are the core elements that you need to consider for providing value to the consumers in a responsible manner? Firstly, you need to put your efforts to reduce any negative impact that the product or service will be having either on the environment or on the consumer. If your product or service is having any impact to the consumer, okay, let's say certain products they will not be suitable for certain consumers, they might be getting some skin issues or some allergies if they use a particular product. So if at all your product is not suitable for any type of consumer, you need to clearly mention this fact on the product itself. See, transparently disclose all adverse impacts to user, planet, society on or biodiversity from their products. If your product is having any adverse impact either on the user or on the biodiversity or on the environment or on the climate, you need to disclose this fact on the product itself. And do not prevent freedom of choice and fair competition in conceptualizing, designing and marketing the products. Okay, while designing the advertisement, while designing the marketing strategy of your product, you should not do it in such a way that consumers they will not go for any other product. You should encourage fair competition. Okay, you should not communicate that you should not use other products, there are some disadvantages in the other products, so consumer you should not use that, you should use only our product. These type of communication you should not make. Okay, and maintain right to privacy of the consumer data. If you are having access to any of the consumer data, you should maintain confidentiality, privacy of the consumer data, and inform customers about responsible ways of usage, recycling and reusage and disposal of the product. Okay, how your product can be used by the consumer, how it can be recycled, how it can be disposed, it needs to be properly communicated to the consumer. And while advertising, do not expose misleading or confused information about the product. Okay, you properly present the correct information with respect to the product in the advertisement, you don't give any misleading information. And transparent and accessible grievance redressal. If the consumer is facing or having any complaints about your product, there should be a transparent grievance redressal system. These are the 9 principles that needs to be reported in BRSR. So the company they will prepare this BRSR report and it will be given to the users. Now users they needs to get assurance that whatever the company has presented in this BRSR report is accurate only. So for the purpose of giving such assurance, auditor will be appointed for auditing the BRSR report. Okay, so BRSR is a main document to stakeholders for sustainability related information. Hence, assurance in this reporting is more critical, since the only document that is available to the users with respect to sustainability reporting is BRSR report. Providing assurance on this report is very much important. And ICAI, it has issued standard on sustainability assurance engagement SSAE 3000. It is applicable on a voluntary basis from 31st March 2023. Okay, for the period ending 31st March 2023 it is not mandatory, but for period ending 31st March 2024 this standard is mandatory. Okay, mandatorily the auditor needs to comply with this while reporting while providing assurance on BRSR report. And methodology to provide the assurance on BRSR report. First of all, you will review the BRSR report that is submitted by the company, and you will also perform on-site assessment. Based on this, you will prepare a preliminary report. Okay, issue assessment report based on this preliminary review of the report and the on-site assessment. Once you have issued this assessment report, the company it will give its response. So review responses of the company and clarifications that the company has given on the findings of the auditor. Finally, based on these clarifications and responses, you will prepare a final assessment report including final results. And social audit standards. Basically, the Institute of Chartered Accountants of India, they have established sustainability reporting standards board. As I have discussed with you, they have established SRSB. Now this SRSB, it has come up with certain 16 social audit standards. What are these social audit standards? Basically, there will be certain organizations which are non-profit organization, they will take up a particular aspect and they will work towards that particular aspect. Let's say, for example, education. A particular organization, it will take up education as its primary area, and it will work in education sector, okay, on a non-profit basis. Some organization, they can take up like environment activity, and they work on this environment activity. These are social organizations, they are working for a particular cause. So when assessing whether they have achieved their cause or not, these social audit standards will help. So social audit standards 100 to social audit standard 1600, 16 social audit standards are issued. Each social audit standard deals with a different type of entity, and it provides guidance to social auditor relating to impact assessment of social enterprises. Okay. And finally, coming to the integrated reporting. As I have already told you what is integrated reporting. In integrated reporting, there will be reporting with respect to both financial as well as non-financial aspect. Basically, here there will be 6 C's, 6 capitals. Okay, the reporting will be done in these 6 areas. How the organization has utilized each of these 6 capitals to provide value. Okay, how it has added, how it has made value addition by using each of these 6 capitals. Okay, this will be reported in integrated reporting. First capital is financial capital. Financial capital is the financial resources with the help of available money, how the organization has strived for value addition, that is financial capital. Next, manufactured capital, with the help of tangible assets that are available with the organization, that is land, plant and machinery, buildings. Okay, with all these manufactured capital, how it has added value, how it has made value addition. Next, natural capital. Okay, with the help of natural resources, how it has utilized natural resources for making value addition. And human capital, how it has utilized human intelligence, how it has utilized its employees for value addition. Social capital, how it has utilized its network. Okay, how it has utilized its relationship with other stakeholders for making value addition, that will be reported in social capital. And intellectual capital, how it has utilized its intangible assets. It might be having various copyrights, it might be having various patents. Okay, how it has utilized this intellectual property for making value addition. Okay, you can remember this 6 C's with the help of a mnemonic. Finance Minister, FM, H, Nirmala Sita Raman. Okay, F for financial capital, M for manufactured capital, H for human capital, N for natural capital, S for social capital, I for intellectual capital. Finance Minister H, Nirmala Sita Raman. Hope that is clear. Okay, so by this revision with respect to this chapter gets completed. We will be meeting in the next class with a new chapter, and if you want to purchase the classes, you can visit our website lecturepedia.in and you can place your order. I'll be winding up this video as of now. Take care, bye bye, see you.